Good day friends, some quick points before we begin this video. This video is a fast track video for quick revision. Video timestamp is given in the description box. This is a single video of around 11.5 hours covering the entire syllabus. However, chapter wise videos are also available if you want to use them, and the playlist link is given in the description box. So let's begin. We will first look at certain basic concepts. The Income Tax Act extends to the whole of India. India not only includes the territory of India but also its territorial waters and its airspace. The charging section is section 4. And how is income tax charged? By virtue of section 4, the charge is of income tax, and it is charged when? In the assessment year. How? As per the provisions of the Act. On what? On the total income. Of which period? Of the previous year. Of whom? Total income of whom? Of a person. And at what rates? As prescribed by the Finance Act. So income tax is charged when? It is charged in the assessment year. Right? What is the meaning of assessment year? The assessment year is a period of 12 months commencing on 1st of April every year. And what is the meaning of previous year? It is the financial year immediately preceding the assessment year. But the concept of previous year gets modified slightly when income is not earned for the whole of the previous year, and there are two situations where business or profession is newly set up. In that case, previous year, instead of beginning with the 1st April of the financial year, it begins with the date of setting up of the business or profession. And where a source of income newly comes into existence, then the previous year begins with the date on which the source newly comes into existence. In both the cases, the previous year ends normally with the 31st March of the financial year. In certain cases, income of a previous year is assessed in that previous year itself, without waiting for the assessment year. And this is called accelerated assessment. Two sections are important from an exam point of view. Section 174 covers a situation where an individual may leave India during the current assessment year or shortly after its expiry, and he has no present intention of returning to India. In such case, income from 1st April of that year up to the probable date of his departure is chargeable to tax in that assessment year. Section 176 covers a situation where any business or profession is discontinued in an assessment year. In such case, income from 1st April of that year up to the date of discontinuance may be charged. So it is in the discretion of the AO, may be charged to tax in that assessment year. On top of this, the regular assessment in that assessment year, of course, happens for the previous year which precedes such year. Now, there are a few sections which govern undisclosed sources of income, but section 69B is important to us, and this covers a case where assessee had made investments or is found to be the owner of what? Of bullion, jewelry, or other valuable article, and the AO finds that the amount spent thereon is greater than the amount which is recorded in the books, and the assessee offers no or unsatisfactory explanation. In such case, the excess amount may be deemed as the income of the assessee. Now, income tax is charged on the total income of a person, and person includes an individual. A sole proprietorship is treated as an individual. An HUF, a company, a firm. Firm includes an LLP, an association of persons or body of individual, local authority, and an artificial juridical person, or AJP. AJP is the residual category of persons. We will now look at the steps for computation of total income. So first we determine the incomes that will enter the computation. So we determine the relevant previous year, and then we determine the residential status for that previous year. Then we determine all items which will be considered as incomes for that previous year in accordance with the scope or the definition of income which is there in section 224. And then we move to section 5 and determine, basis the scope of total income, as to what are the incomes out of these incomes, what are the incomes that will be included within the scope of total income for the relevant previous year. So we include those incomes and we exclude the incomes which are outside the scope. Now, once we have determined the incomes that will enter the computation, we then move to compute the total income. So first we classify and compute the income under the following 5 heads of income: salaries, income from house property, profits and gains of business or profession, capital gains, and income from other sources. This is computed under the various heads after giving effect to the exemptions. So the incomes which are exempt, they are not included while computing the total income. They don't enter the computation. Further, we allow the deductions as available under the provisions of the Act. We club the income with the income of the person as per the provisions of the Act, and we make adjustments on account of set off and carry forward of losses. Thus, we arrive at the amount of gross total income, from which we allow deduction from the gross total income under chapter VIA. This gives us the amount of total income which is defined under section 245. Now this is supposed to be rounded off. So total income is rounded off to the nearest multiple of 10. And for this we ignore any paise. And then if the last figure is 5 or more, we increase it to the next higher multiple of 10. But if the last figure is less than 5, then we reduce it to the next lower multiple of 10. Now, should the income be computed on due basis or receipt basis? So it depends on the head of income. As far as salary, income from house property, and capital gain is concerned, the method of accounting which is followed by the SSE is not relevant, and income under these heads is computed on the basis of specific provisions of the Act as relevant for these heads of income. But as far as income under the head PGBP and IFOS is concerned, income is computed in accordance with either the cash or the mercantile system of accounting which is regularly employed by the SSE. We will now look at the rates of tax. Income tax is charged at the rates prescribed by the Finance Act. And what are the steps? First, we compute the tax on the total income as per rates which are prescribed by the relevant Finance Act. Then we allow the rebate under section 87A if it is available, or add surcharge if it is applicable, adjusted for marginal relief if available. Rebate and surcharge cannot be applied at the same time, because rebate is not available where total income is more than rupees 5 lakh, while surcharge becomes applicable where total income is more than rupees 50 lakh. To the balance, we add HEC or health and education cess at the rate of 4%. Tax payable is rounded off to the nearest multiple of rupees 10, and the steps are the same as that we have noted for the total income. What are the rates of tax for individual, HUF, AOP, BOI, or AJP, artificial juridical person? It depends on the level of total income. In a normal case, for an individual HUF, AOP, BOI, or AJP, the tax rate is nil if the total income is up to 2,50,000. Where total income is more than 2,50,000 and up to 5 lakh, the slab rate is 5%, and tax is equal to 5% of the amount by which total income exceeds 2,50,000. Where total income is more than 5 lakh and up to 10 lakh, then the slab rate increases to 20%, and tax is equal to 12,500 plus 20% of the amount by which total income exceeds 5 lakh. Where total income is more than 10 lakh, the slab rate is the highest rate of 30%, and the tax is equal to 1,12,500 plus 30% of amount by which total income exceeds 10 lakh. In the case of a senior citizen, and who is a senior citizen? Senior citizen is a resident individual, not a non-resident, and therefore HUF, AOP, BOI, or AJP cannot be categorized as a senior citizen. So a resident individual who is 60 years or more but less than 80 years of age at any time during the previous year, the slab rate is nil for total income up to rupees 3 lakh. For total income which is more than rupees 3 lakh and up to rupees 5 lakh, the slab rate is 5%, and tax is equal to 5% of amount by which total income exceeds 3 lakh. Where total income is more than 5 lakh and up to 10 lakh, the slab rate becomes 20%, and tax is equal to 10,000 plus 20% of amount by which total income exceeds 5 lakh. Where total income is more than 10 lakh, the slab rate is the highest rate of 30% and tax is equal to 1,10,000 plus 30% of amount by which total income exceeds 10 lakh. Super senior citizen is a resident individual who is 80 years or more at any time during the previous year. In such case, the slab rate is nil for total income up to 5 lakh. Where total income is more than 5 lakh and up to 10 lakh, straight away we move to the slab rate of 20% and tax is equal to 20% of amount by which total income exceeds 5 lakh. Where total income is more than 10 lakh, then the slab rate is the highest rate of 30% and the tax is equal to 1 lakh plus 30% of amount by which total income exceeds 10 lakh. Now what if the date of birth of a person is 1st of April? So if a person was born on 1st of April, when would he complete a particular age? On 1st of April or on 31st of March? So he completes a particular age as on 31st of March, that is the day preceding his birthday. For reference, you may note the cutoff date of 1st April 1963 for a person to become a senior citizen and 1st April 1943 for a person to become a super senior citizen for previous year 22-23. The basic exemption limit therefore is 2.5 lakh for a normal case, 3 lakh for a resident senior citizen and 5 lakh for a resident super senior citizen. We now look at the rates of surcharge, marginal relief and HCC in the case of an individual HUF, AOP, BOI or AJP. We need to note that the rate of surcharge cannot exceed 15% in the case of 1. Dividend, or 2. Capital gains which are taxable at special rate. That means under section 111A, 112 or 112A. This is the table which we can use to determine the rate of surcharge. We need to bifurcate the total income into 1. The amount of dividend 111A, 112 and 112A income, and 2. Quantum of other income. Where the total income is up to rupees 50 lakh, surcharge is not applicable. Where the total income is more than 50 lakh and up to rupees 1 crore, then the rate of surcharge is 10%. Where the total income is more than 1 crore and up to 2 crore, the rate of surcharge is increased to 15%. Where the total income exceeds rupees 2 crore, but the other income is up to 2 crore, then the rate of surcharge remains at 15%. But in such case, where the other income is greater than 2 crore and up to 5 crore, then the rate of surcharge on tax on the other income increases to 25%, but it remains 15% in the case of tax on dividend 111A, 112 and 112A income. Where the total income exceeds rupees 5 crore and the other income is greater than 5 crore, the rate of surcharge on tax on the other income is the maximum at 37%, but it remains limited to 15% for tax on dividend 111A, 112 and 112A income. Now marginal relief is supposed to be checked, and if marginal relief is available, then the amount of surcharge needs to be restricted. To compute marginal relief, we need to compare A and B. So A is what? First we need to compute the tax and surcharge on the total income without marginal relief. That means as per the normal method, right? We figure out the tax and basis this table, we figure out the rate of the surcharge, we compute surcharge and we determine the amount of tax plus surcharge. B, we compute the amount as per the formula given in the table above. So this is the formula. So we compute this particular amount. So where the surcharge becomes applicable at the rate of 10%, we compute tax on 50 lakh plus within brackets total income minus 50 lakh. Where surcharge gets increased to 15%, we compute tax plus surcharge on 1 crore plus within bracket total income minus 1 crore. Where the surcharge increases from 15% to 25%, we compute the amount which is tax plus surcharge on 2 crore plus within brackets total income minus 2 crore. And where the rate of surcharge increases to 37%, we compute the amount which is tax plus surcharge on 5 crore plus within brackets total income minus 5 crore. So this is B. And now we ensure that A does not exceed B. In other words, we take the lower of A or B. If A exceeds B, that becomes the amount of marginal relief which we provide, and therefore the lower of A or B becomes the final amount of surcharge which we need to apply. In this table, for your reference, these are the approximate range of total income to check for marginal relief. So where the total income exceeds 50 lakh or 1 crore or 2 crore or 5 crore, then you need to check if marginal relief is available for a total income ranging up to 52 lakh. That means from 50 lakh to 52 lakh, up to 1 crore 3 lakh, 2 crore 10 lakh, and 5 crore 31 lakh. These are the approximate ranges, but these are given for your use. These will help you because for reference purpose, you can use these to check for marginal relief. That means if total income is beyond this range, then you need not spend your time checking whether marginal relief will be available in that particular case in the question. HEC is levied at 4% of tax and surcharge in all cases irrespective of the total income. So we compute tax, we compute surcharge on tax, then we aggregate tax and surcharge, and then we apply HEC to that amount. Rebate of tax in the case of certain individuals is provided under section 87A. It is allowed to a resident individual whose total income doesn't exceed rupees 5 lakh. So this is the threshold of total income. Rebate is allowed before adding HEC. So first we compute tax on total income, then we allow rebate, and to the balance we add HEC at the rate of 4%. Rebate is equal to lower of tax on total income or 12,500. So 12,500 is the maximum amount of rebate. Rebate under section 87A is not available from tax on LTCG under section 112A. Now we look at the rates of tax for other persons. That means other than individual, HUF, AOP, BOI or AJP. Cooperative society. Total income up to 10,000, rate of tax is 10%. Total income more than 10,000 and up to 20,000, 20%. Total income more than 20,000, 30%. Rate of surcharge, nil for total income up to 1 crore. 7% for total income more than 1 crore and up to 10 crore. And 12% for total income more than 10 crore. In this case, we need to ensure that the tax plus surcharge does not exceed tax on 1 crore plus within bracket total income minus 1 crore. And therefore, we allow for marginal relief to restrict the tax plus surcharge to this level. In this case, we need to ensure that tax plus surcharge doesn't exceed tax on 10 crore plus within bracket total income minus 10 crore. HEC is then added at the rate of 4%. For a firm, 30% flat rate of tax is applicable. No surcharge up to total income of 1 crore and 12% for total income beyond 1 crore, in which we need to check that tax plus surcharge doesn't exceed tax on 1 crore plus within bracket total income minus 1 crore. HEC at the rate of 4% is applicable. Similar is the position in the case of local authority. So rate of tax and surcharge and the formula for marginal relief is the same for local authority and a firm. As far as company is concerned, if the company is a domestic company, then where the total turnover or gross receipts in the previous year 2021, here we are looking at the rate applicable for previous year 22-23. But what we need to check is total turnover or gross receipts in previous year 2021. If that is not greater than 400 crore, then the rate of tax is 25%, else it is 30%. No surcharge for total income up to 1 crore, 7% for greater than 1 crore and up to 10 crore, and 12% for greater than 10 crore. And these are the respective formulas for checking for marginal relief. And HEC is at the rate of 4%. If the company is other than a domestic company, then 50% rate applies in the case of royalty or FTS in certain cases, and on the balance of total income, 40% rate applies. Surcharge is nil for total income up to 1 crore, 2% for greater than 1 crore and up to 10 crore, and 5% for greater than 10 crore. And these are the respective formulas for marginal relief, and HEC is at the rate of 4%. There are certain special rates of tax applicable as far as capital gains is concerned. These are taxable at special rates under these three provisions. Under section 111A, short-term capital gain on transfer of equity share in a company or unit of equity-oriented fund, a concessional rate of 15% applies. Concessional rate of 15% applies. But where it is a case of long-term capital gain, then the LTCG in excess of rupees 1 lakh, is taxable at a further concessional rate of 10%. In the case of other long-term capital gain, that means which is other than 112A, section 112 applies and the rate of tax becomes 20%. In each of these cases, the surcharge rate is as we discussed above. The surcharge rate cannot exceed 15% as we noted above in the case of individual HUF, AOP, BOI or AJP. And HEC in all these cases is at the rate of 4%. Section 115BB covers winnings from lotteries, races, games, etc. It is taxable at a flat rate of 30% and surcharge rate is as we discussed above. HEC is at the rate of 4%. The unexplained money, investment, expenditure, etc. under section 68, 69, 69A, 69B, 69C, 69D is taxable under section 115BBE and it is taxable without any deduction of any expenditure or allowance or set off of any loss. So gross amount is taxable at a flat rate of 60%, to which we apply the rate of surcharge at 25% and 4% HEC on tax plus surcharge. As far as buyback of shares by a domestic company is concerned, the domestic company is supposed to pay tax on distributed income under section 115 QA, which is called buyback tax. Shareholder is not taxable and the buyback tax is at the rate of 20% of distributed income, to which surcharge at the rate of 12% is applicable and HEC at the rate of 4% of tax and surcharge. Now, the benefit of unexhausted basic exemption limit is applicable while computing tax on capital gain, which is taxable at special rate. That means under section 111A, 112A and 112. We will talk about this in detail in the capital gains. Deduction from gross total income under chapter VIA is not available in any of these cases because these incomes are taxable at special rate. Rebate under section 87A is not available in the case of long-term capital gain under section 112A, but it is available in other cases. It is not relevant in the case of buyback tax. We will now look at residential status and scope of total income. First, we will look at residential status. An individual or HUF can either become a resident or a non-resident. If resident, he can further become a resident and ordinarily resident ROR or resident but not ordinarily resident RNOR. However, in the case of a firm, AOP, BOI, company or any other person, the person can either be a resident or a non-resident. The concept of ROR and RNOR doesn't apply to such person which is not an individual or HUF. We will first look at the residential status of an individual. There are three kinds of rules which apply: special rules, general rule and stateless rule. There are four kinds of special rules: ship crew rule, employment rule, visit rule and visit and income rule. There is a criteria that needs to be satisfied for a person to fall within a special rule. Then there are basic stay conditions which need to be checked in order to figure out whether the person will become a resident under that rule. If a resident, then secondary stay conditions need to be checked to figure out the categorization of a person as either a RNOR or ROR. As far as ship crew rule, employment rule and visit rule is concerned, the basic and secondary stay conditions are the same, so the criteria is the same. So ship crew rule applies to a person who is a citizen of India, who leaves India in the previous year as a member, not as a passenger, as a member of the crew of an Indian ship, not a foreign ship. Employment rule applies also to a citizen of India who leaves India in the previous year for the purposes of employment outside India. And thirdly, visit rule not only applies to a citizen of India, but also where the person is a person of Indian origin or a PIO. But as against ship crew rule or employment rule, which apply when the person is leaving India, visit rule applies to a person who comes on a visit to India in the previous year. The further condition for visit rule is that such person should be having total income, but other than income from foreign sources up to rupees 15 lakh in the previous year. Now for ship crew rule, employment rule and visit rule, all these three rules, the basic stay condition is the same. The person in such cases becomes a resident when he is in India for 182 days or more in the previous year. Once a resident, then we come and check secondary stay conditions. And there are two secondary stay conditions. One, whether the person is a non-resident in 9 out of 10 preceding previous years. Second, whether the person is in India for 729 days or less in the preceding 7 previous years. If any of these conditions is satisfied, then the person becomes a RNOR. But if none of the conditions is satisfied, then the person becomes a ROR. Fourth, we have the visit and income rule. Like visit rule, this also applies to a citizen of India or person of Indian origin who comes on a visit to India in the previous year. But the difference between this rule and visit rule is that the threshold for total income other than income from foreign sources is up to 15 lakh for visit rule, but where such total income other than income from foreign sources is more than 15 lakh in the previous year, instead of visit rule, what applies is the visit and income rule. Now in this case, the basic condition of 182 days is not applicable. Rather, a lower threshold of 120 days applies. So the condition that needs to be checked is whether the person is in India for 120 days or more in the previous year, and there is a second condition as well. Whether the person is in India for 365 days or more in the preceding 4 previous years. So both these conditions need to be satisfied. In that case, the person becomes a resident under the visit and income rule. But for this rule, secondary stay conditions are not applicable. Like that for the other 3 rules. In the visit and income rule, once a person becomes a resident, then we need to straight away check whether the person is in India for less than 182 days in the previous year. If so, then the person straight away becomes a RNOR. So the person cannot become a ROR under the visit and income rule. In the case of visit and income rule, when the person is, however, for 182 days or more in the previous year, instead of visit and income rule, 182-day rule starts becoming applicable, and then as per that rule, he becomes a resident and further a ROR or RNOR as the case may be. Who is a PIO? PIO is an individual if he or any of his parents or grandparents was born in undivided India, that is, before partition. The general rule is that the dates of arrival in India and date of departure from India are included in the period of stay in India, but there is an exception. There is a benefit which is provided by Rule 126 in the case of a citizen of India who is a member of the crew of a foreign bound ship which is leaving India, in which case the period beginning with the joining date and ending on the signing of date entered in the continuous discharge certificate or CDC is not included in the period of stay in India. So joining date and signing of date are not included in the period of stay in India. Now we saw above that income from foreign sources is relevant because for visit rule and visit and income rule, we need to figure out the total income other than income from foreign sources. Now what is income from foreign sources? Income from foreign sources is income which accrues or arises outside India. Now we will see in some time that even where income accrues or arises outside India, it can be deemed to accrue or arise in India in certain cases, right? So the condition for an income to become income from foreign sources is that income which accrues or arises outside India is included, but it should not be deemed to accrue or arise in India. In that case, it will be called income from foreign sources. Now, even where income accrues or arises outside India, it is still not treated as income from foreign sources in one case, where it is derived from a business, where income is derived from a business controlled in or from a profession which is set up in India. In that case, it is treated as income from Indian sources. It is still not treated as income from foreign sources, even if it accrues or arises outside India. Now we look at the general rules, and there are 2 general rules, 182-day rule and the 60-day rule. And again, there are basic stay condition and there are secondary stay conditions. Under 182-day rule, a person becomes a resident in India if he is in India for 182 days or more in the previous year. Secondary stay conditions are basically exactly the same as that we saw above in the case of special rules. There are 2 secondary stay conditions, same as for special rules, and if any of them are satisfied, then the person is RNOR. else the person becomes a ROR. So this is the 182-day rule. As far as 60-day rule is concerned, the basic stay condition is different. In that case, two conditions need to be satisfied. The person should be in India for 60 days or more in the previous year, and the person should be in India for 365 days or more in the preceding four previous years. If these two conditions are satisfied, then the person becomes a resident. And then the secondary stay conditions need to be checked to categorize a person either as RNOR or ROR. Now, general rules are applicable to all individuals, whether a citizen of India, whether a person of Indian origin, Indian national, foreign national, or any other individual, it doesn't matter. So it applies to everyone. Finally, we take a look at the stateless rule. Now, where a person becomes a resident under any of the special rule or the general rule, stateless rule is not relevant. But where a person doesn't become a resident under either the special rule or the general rule, then we need to check the stateless rule and figure out whether the person would become a resident under this rule. What is the stateless rule? The stateless rule applies to an individual who is a citizen of India. So it doesn't apply to a foreign citizen. Having total income other than income from foreign sources, which is greater than 15 lakh in the previous year. And the further condition is that he is not liable to tax in any other country or territory by reason of his domicile, residence, or any other criteria of similar nature. If these conditions are satisfied, then the person, even if not actually a resident in any other rule, he is deemed to be a resident and he is categorized as RNOR. He cannot become a ROR. Now, person liable to tax includes a person who has been subsequently exempted from tax liability under the law of that country. Right? So even if the person is liable to tax but he is exempted from tax liability, he is still covered within the meaning of the term person liable to tax. Now, certain points which are common to all the rules which we have discussed above. As we noted above, the dates of arrival in and departure from India are included in the period of stay in India. However, Rule 126 is the exception, as we noted some time back. An individual who is in India for 182 days or more during the previous year is always a resident for that previous year. An individual who is in India for less than 60 days during the previous year will always be a non-resident for that previous year. If, however, the person is covered by the stateless rule, the person will be deemed resident and thus RNOR. Otherwise, the person will always be a non-resident if the person is for less than 60 days. If the individual is falling within the visit and income rule, that means if he is in India for less than 182 days in the previous year, then the person will always be a RNOR. Similar will be the case where the person is falling under the stateless rule. So in both these cases, the person will always become a RNOR, cannot become a ROR. But individual falling under the other rules can either be ROR or RNOR depending on satisfaction of the secondary stay conditions. What are the steps to follow to determine the residential status? So we have seen the special rules, the general rule, and the stateless rule. And these are the steps to be followed to finally determine the residential status of a person. First, we see whether a special rule applies to a person, whether the person falls within the purview of a special rule. If yes, then we need to check the stay conditions. If those are met, then the person becomes a resident. And further, a ROR or RNOR. However, in the case of visit and income rule, the person can only be an RNOR, not a ROR. If the person is falling within the special rule, but the stay conditions are not met, that means the person is not becoming a resident under a special rule, then in that case, we need to check the stateless rule. If that becomes applicable, the person is deemed resident and consequently a RNOR. Else, the person can be said to be a non-resident. Now, if the special rule doesn't apply in the first place because the person doesn't fall within the purview of a special rule, then we fall back on the general rule and check whether the stay conditions of the general rule, 182-day or 60-day rules are met. If yes, then the person would become a resident and further a ROR or RNOR. If the stay conditions are not met, then we need to check the stateless rule and accordingly determine whether the person will be a deemed resident, which is RNOR, or if not, if stateless rule also doesn't apply, then the person will be categorized as a non-resident. Residential status of HUF. Now it depends on where is the control and management of its affairs situated. If it is wholly outside India, then the HUF is non-resident. If it is wholly in India or partly in India, then the HUF is a resident. Further, the HUF can become ROR or RNOR, and it depends on the Karta, where and the two conditions need to be checked. And these are similar to the secondary stay conditions that we checked in the case of individual. So for Karta, we need to check, is the Karta non-resident in 9 out of 10 preceding previous years? Is the Karta is in India for 729 days or less in the preceding 7 previous years? If either of these conditions is satisfied, then the HUF is RNOR, otherwise the HUF is ROR. Residential status of a firm, AOP, BOI, local authority and artificial juridical person, where the control and management of its affairs is situated wholly outside India, the person is non-resident, otherwise the person is a resident. What about residential status of a company? An Indian company is always a resident. A foreign company is generally a non-resident. But where the company is a foreign company and its POEM, place of effective management, is in that year in India, and it has turnover or gross receipts greater than 50 crore in the previous year, in that case, it is treated as a resident. Else, foreign company is a non-resident. We will now look at the scope of total income, and this is provided under section 5. Total income is classifiable either as Indian income or foreign income. An income is categorized as Indian income based on either receipt basis or accrual basis. Income which is received in India or which is deemed to be received in India is Indian income on the basis of receipt. Income which accrues or arises in India or which is deemed to accrue or arise in India is Indian income on the basis of accrual. Income which is not Indian income is foreign income. Indian income is included in the hands of all persons irrespective of their residential status, ROR, RNOR or non-resident. Foreign income is generally included only in the hands of ROR, not in the hands of RNOR or non-resident. But foreign income is included in the total income of a RNOR in a case where it accrues or arises outside India and is derived from a business controlled in or a profession set up in India. In such case, even though the income is foreign income, it is still included in the hands of a RNOR. So basically, if we look at ROR, Indian income as well as foreign income is taxable. So therefore, global income is taxable for a ROR. For a non-resident, only Indian income is taxable, foreign income is not taxable. In the case of RNOR, Indian income is taxable, foreign income is not taxable, but only in one case, and that is where the income is derived from a business controlled in or a profession set up in India. Section 9 lists down certain cases where income is deemed to accrue or arise in India and therefore it is taxable in the hands of all persons irrespective of their residential status. 1. Business connection. Income from any business connection in India is deemed to accrue or arise in India and therefore taxable in India. And this concept of business connection includes business activity carried out through an agent who fulfills any of the criteria of either conclusion of contracts or maintenance of stock of goods or merchandise or securing orders. However, independent agent is not included. So income which arises on account of a business connection in India becomes taxable in India. There is an exclusion. Income is not deemed to accrue or arise in India in the case of a non-resident where the operations of such non-resident are confined or limited to purchase of goods in India for the purpose of export. Number 2, in the case of property, etc., income from any property, asset or source of income in India is deemed to accrue or arise in India and is therefore taxable in India. Third, capital asset. Income from transfer of a capital asset which is situated in India is deemed to accrue or arise in India and is therefore taxable in India. 4. Income from salaries. Income under the head salaries which is payable for service rendered in India is deemed to accrue or arise in India and is therefore taxable in India. Also, such income which is for rest period or leave period following after or before services rendered in India and which is forming part of employment contract is also deemed to accrue or arise in India. Where service is rendered outside India, generally it is not deemed to accrue or arise in India except in one case, where it is payable by a government to a citizen of India. But even in such case, the allowances or perquisites which are paid or allowed outside India are exempt by virtue of section 10(7). Fifth, dividend. Dividend which is paid by an Indian company outside India is deemed to accrue or arise in India. Sixth, interest. It depends on who is the payer. It depends on who is the payer. Where interest is payable by the government, then it is deemed to accrue or arise in India in the hands of the payee in all the cases, and there is no exception. Where interest is payable by a resident, then it is deemed to accrue or arise in India for the payee in all the cases except where it is payable in respect of any debt incurred or money borrowed and used in two cases. One, for the purposes of a business or profession carried on by the payer outside India, or two, for the purposes of making or earning any income from any source outside India. In these two cases, income is not deemed to accrue or arise in India, otherwise it is deemed to accrue or arise in India. Where the interest is payable by a non-resident, it is deemed to accrue or arise in India in the hands of the payee only in one case, where it is payable in respect of any debt incurred or monies borrowed and used for the purpose of a business or profession, for the purpose of a business or profession which is carried on by the payer in India. 7. Royalty or FTS. Just like interest, this also depends on who is the payer. Where royalty or FTS is payable by the government, then it is deemed to accrue or arise in India in the hands of the payee in all cases, and there is no exception. Where royalty or FTS is payable by a resident, then it is deemed to accrue or arise in India except where it is payable in respect of any right or property or information or services used in two cases. 1. In or for the purposes of a business or profession carried on by the payer outside India, or 2. For the purposes of making or earning any income which is from any source outside India. In these two cases, income is not deemed to accrue or arise in India, else it is deemed to accrue or arise in India. Where royalty or FTS is payable by a non-resident, then it is deemed to accrue or arise in India only where it is payable in respect of any right, property, information, services used in either of these two cases. 1. Used in or for the purpose of a business or profession carried on by the payer in India, or 2. For the purposes of making or earning any income from any source in India. Only in these two cases it is deemed to accrue or arise in India, otherwise it is not. And lastly, gift to a non-resident, and we will cover this in the topic on income from other sources. We will now look at incomes not forming part of total income. That means incomes exempt from tax. First, we will look at agricultural income. What is agricultural income? Following incomes, which you can see in this table, from land situated in India and used for agricultural purposes is agricultural income, and it is exempt. Number 1, rent or revenue from such land. We need to note, however, that income from transfer of an urban agricultural land, that means which is not in a rural area, is not agricultural income, and therefore it is not exempt. It is taxable as capital gain. Second, income from such land by agriculture, it is exempt. What we need to note is income from saplings or seedlings grown in a nursery is also deemed to be agricultural income and is therefore exempt. Third, income from such land by performance of compulsory process, or 4, by sale of produce on which only compulsory process has been performed. So if only the compulsory process has been performed, income is agricultural income exempt from tax. But if there is any further processing, then that results in a composite income, that is partly agricultural income and partly business income, and the composite income needs to be split. Fifth, income from a building which is required as a dwelling house or a storehouse or other outbuilding, which is either assessed to land revenue in India or subject to a local rate, or it is not situated in an urban area. In these 5 cases, the income from land situated in India and used for agricultural purposes is exempt. Now we noted above that if any extra process beyond compulsory process has been performed, then composite income arises, and then it needs to be split. There is a general rule and there are special rules. First, we will look at the special rules, and there are 3 special rules. Rule 7A applies to income from manufacture of rubber, in which case 35% is taxable as business income and the balance 65% is exempt as agricultural income. Then we have Rule 7B, which covers income from manufacture of coffee. In this case, where it is a case of sale of coffee which is grown and cured by the seller in India, then 25% is business income and 75% is exempt as agricultural income. But where it is a case of sale of coffee which is not only grown and cured, but grown, cured, roasted and grounded by the seller in India, then a higher percentage of 40% is business income and the balance 60% is exempt agricultural income. Then we have Rule 8, which covers income from manufacture of tea grown and manufactured by the seller in India, in which case 40% is business income and the balance 60% is agricultural income. Where a special rule doesn't apply, we apply the general rule, in which case where there is a sale of agricultural produce, where no processing has been performed or only compulsory processing has been performed, we have noted above some time back that this is pure agricultural income exempt from tax. However, where there is an extra processing which has been done, it results in a composite income and then it needs to be split between the business income and agricultural income. How do we determine the amount of agricultural income? First, we figure out the market value of sales proceeds, from which we deduct the amount of cultivation expenses, which gives us the amount of agricultural income. How do we determine business income? We determine the sales proceeds of the produce in the market. From that, we reduce the market value of sales receipts of agricultural produce which has been utilized as raw material. So basically, this market value of sales proceeds which we had considered while determining agricultural income is what we reduce, and we further reduce manufacturing expenses, and this gives us the amount of taxable business income. The agricultural income is partially integrated with the non-agricultural income for the purpose of levy of tax, and this method applies only in the case of an individual, HUF, AOP, BOI or artificial juridical person. And 2 conditions need to be satisfied for partial integration. Number 1, the net agricultural income should be greater than 5,000, and 2, the total income, which is the non-agricultural income or the taxable income, the total income should be greater than the basic exemption limit, which will either be 2.5 lakh or 3 lakh or 5 lakh as the case may be. And then the tax liability is computed as you can see on your screen. So first we compute A. A is what? Tax on net agricultural income plus the total income. Then we compute B, which is what? Tax on net agricultural income plus the basic exemption limit. Then tax on the total income is A minus B. It is equal to A minus B, from which we reduce the amount of rebate under section 87A if it is applicable, or add surcharge and then add HEC at the rate of 4%, and which gives us the amount of tax liability. This is about agricultural income. Section 10AA makes special provisions in respect of newly established units in special economic zones, and this provision applies to an SSE to a person who begins to manufacture or produce articles or things or provide services in any SEZ during the period 1st April 2005 to 31st March 2020. But this cutoff of 31st March 2020 is extended to 31st March 2021, provided the letter of approval under the SEZ Act is issued on or before 31st March 2020. If this condition is satisfied, then the quantum of the deduction under section 10AA is in the first 5 years, beginning from the year in which the unit begins to manufacture, produce or provide services. It is 100% of the profits derived from export. For the next 5 years, 100% is reduced to 50%. And in the subsequent 5 years, the deduction is equal to lower of 50% of profits derived from export, or the amount which is credited to SEZ, RRA or the Special Economic Zone Reinvestment Reserve Account. So deduction is available for a total period of 15 years. So deduction is based on profits derived from export. This means profits of the business of SEZ unit multiplied by a ratio. What is the ratio? Export turnover of SEZ unit divided by total turnover of the business carried on by SEZ unit. So this is the ratio, export turnover of SEZ unit divided by total turnover of SEZ unit, and this ratio is multiplied to profits of business of SEZ unit. This gives us the amount of profits derived from export. Now export turnover doesn't include two items. One, it doesn't include freight or telecommunication charges or insurance attributable to the delivery of the articles or things outside India. Second, it doesn't include expenses incurred in foreign exchange and rendering of services outside India, including computer software. So if these amounts are included, we exclude. Now, if we exclude these from export turnover, logically, if we also then exclude them from the total turnover. How is deduction under section 10AA allowed? It is allowed from the total income computed under the Act before giving effect to this deduction. But please note that deduction under section 10AA cannot exceed such total income. So total income cannot become negative on account of this deduction. We will now look at certain other exemptions provided by section 10. Under section 10(2), a member of HUF is provided exemption on account of any sum paid out of income of the HUF. Section 10(2)(a), exemption is allowed to a partner of a firm on what? On the share in the total income of the firm. However, please note that interest, salary, bonus, commission, remuneration received from the firm is taxable in the hands of the partner under the head PGBP. And this is something that we will talk about in the topic on PGBP. 10(4)(2)(i). In the case of an individual, interest on non-resident external account in any bank in India is exempt. 10(10)(b)(c). In the case of an individual or his legal hire, compensation which is received on account of any disaster from the central government or state government or a local authority is exempt. 10(10)(d) is life insurance, which we will see in some time. 10(11)(a). For in the case of any person, any payment from Sukanya Samriddhi account is exempt. 10(16) is scholarship which is granted to meet the cost of education is exempt. 10(17) in the case of a member of parliament or member of legislative assembly, daily allowance and constituency allowance is exempt. Section 10(17)(a). In the case of any person, what is exempt is any award or reward instituted or approved in the public interest by the central or state government. And 10(43) in the case of an individual, any amount which is received as a loan, whether in lump sum or in installment, is exempt if it is received in a reverse mortgage scheme. Now we noted above that any sum received under a life insurance policy is exempt. So we need to keep in mind that there can be three situations. If it is a situation of a key man insurance policy, the proceeds are taxable whether received on the death of a person or otherwise. If it is a case of an excess premium policy, then it is taxable, but it is exempt if received on the death of a person. In the case of any other policy, the proceeds are exempt, whether received on the death or otherwise. Now, as we noted, in respect of an excess premium policy, if the proceeds are received otherwise than on death, then the proceeds are not exempt, they are taxable. So the question is, what is an excess premium policy? And it depends on the date of issue of the policy. Where the policy is issued from 1/4/2003 to 31st March 2012, then the policy is an excess premium policy if the premium payable for any of the policy year is greater than 20% of sum assured. 20%. If the date of issue of policy falls during the financial year 2012-13, then the policy is an excess premium policy where premium payable for any of the policy year is greater than 10%. So 20% is reduced to 10% of the minimum sum assured. And on or after 1st April 2013, this is the position, and there are two categories. In the case of an insured with disability, which is referred under section 80U, or who suffers from a disease specified under 80DB, the threshold is 15% instead of 10%. That means premium payable for any of the policy year is greater than 15% of minimum sum assured, then the policy is an excess premium policy. In all other cases, the threshold of 15% is reduced to 10%. We also need to keep in mind the provisions of section 14A, as per which no deduction is allowed of what? Of an expenditure incurred by the assessee in relation to exempt income. So expenditure related to taxable income is allowed as deduction, but expenditure which is incurred relating to exempt income is disallowed. It is not allowed as a deduction. We will now look at income taxable under the head salaries. First, few basic concepts. Employer-employee relationship is necessary for income to be charged to tax under the head salaries. As far as a partner in the firm is concerned, salary, bonus, commission or remuneration from the firm is not taxable under the head salaries but under PGBP. As far as a MP, MLA, MLC is concerned, remuneration received by such person is taxable under the head IFOS and not under the head salaries. However, daily allowance and constituency allowance are exempt under section 1017, which we have noted in the topic on exempt incomes. What is the basis of charge of income under the head salaries? Salary is chargeable either on due basis or as advance or as arrears. Due basis. Salary which is due in the previous year, whether it is paid or not in that previous year, is taxable in that previous year. Then advance. Salary which is paid or allowed in the previous year, though it is not due in that previous year or before it became due, is taxable in the previous year in which it is paid or allowed. This refers to salary in advance. Lastly, arrears. The arrears of salary which is paid or allowed in the previous year is taxable under the head salaries in that previous year if not charged to tax for any earlier previous year. If it was already charged on due basis, then it will not be charged again on its receipt. Now let's look at the master chart for computing income under this head. First, we aggregate taxable salary payments, taxable allowances and taxable perquisites, which gives us the amount of gross salary income. From this, we allow deductions on account of section 16. First is the standard deduction, second entertainment allowance, and third professional tax. And finally, we arrive at the income taxable under the head salaries. As far as taxable perquisites are concerned, what we need to note that perquisites are taxable not only when provided to the employee, but certain perquisites are taxable even when provided to any member of the household of the employee. And member of the household includes what? It includes spouse of the employee, the children and their spouses, parents, servants and dependents. We will now look at certain general payments. Certain general payments are fully taxable. Basic salary or wages, commission, whether it is based on turnover or otherwise, fees, then overtime salary, salary in lieu of notice period, bonus, all these are fully taxable. Commission which is based on a fixed percentage of turnover is considered as part of salary for computing retirement benefits. And we will look at this when we will refer to the retirement benefits. And this is denoted as C within brackets TO in this document. As far as DNS and compensatory payments are concerned, certain allowances are fully taxable. These are DNS allowance, city compensatory allowance, project overtime, interim allowance. All of these are fully taxable. If the terms of employment provide that DNS allowance or DA is to be considered as part of salary for computing retirement benefits, then we need to make calculations accordingly. And this is something that we will look at while referring to the retirement benefits, and this is denoted by DA within bracket T in this document. Certain special allowances which are in the nature of DNS and compensatory. 1. So underground allowance, employee covered, an employee working in uncongenial, unnatural climate and underground mines, place at which allowance is exempt, the whole of India, and exemption is 800 per month while the balance is taxable. Second, special compensatory allowance like tribal area allowance, scheduled area or agency area allowance. All employees are covered and the place at which allowance is exempt, there is a list of specified states. In such case, exemption is 200 per month and the balance is taxable. We now look at the taxability in respect of retirement benefits. As far as annuity is concerned, it is fully taxable. Gratuity. Gratuity which is received while in service is fully taxable. But gratuity which is received on death, retirement, etc., it is exempt. If it is received by an employee of central government, state government or local authority, it is fully exempt. If it is received by any other employee, then the exemption, the quantum of exemption depends on whether the employee is covered under Payment of Gratuity Act or not covered under Payment of Gratuity Act. Where the employee is covered under POGA or Payment of Gratuity Act, exemption is equal to lower of ABC. A, amount actually received as gratuity. B, rupees 20 lakh, which then becomes the maximum amount of exemption possible. And C is 15 days salary for each year of service. What is 15 days salary for each year of service? It is 15 days salary multiplied by the years of service. What is 15 days salary? 15 days salary is equal to salary multiplied by 15 divided by 26. What is salary? Salary means basic salary plus DNS allowance which is last drawn. As far as years of service is concerned, what is this? It is retirement date minus joining date. And we need to note that period which is more than 6 months is rounded off as 1 year. And accordingly, we then compute exemption which is lower of A, B or C. For employee which is not covered under POGA, exemption is the lower of A, amount actually received as gratuity, B, rupees 20 lakh. This AB is the same as that for covered under POGA, but C is different. C is half month salary for each year of service. Half month salary for each year of service is what? It is half month salary multiplied by years of service. So what is half month salary? For computing half month salary, we determine it as equal to average salary for 10 months preceding the month of event. We find out the average salary for 10 months preceding the month of event and then we divide it by 2. That gives us half month salary. What is salary for this purpose? It is basic salary plus DNS allowance, but only when it forms part of salary for computing retirement benefits, DAT, and commission only when it is based on fixed percentage of turnover, CTO. As far as years of service is concerned, we figure out retirement date minus joining date, but only completed years are taken into account. So this is how we compute the exemption on account of gratuity. Where the gratuity is received from multiple employees in the same previous year, we need to ensure that the total exemption should not exceed the maximum exemption limit of 20 lakh. Similarly, where gratuity has been received in an earlier previous years and therefore exemption was claimed, then we need to ensure that this limit of 20 lakh is the cap. This is the maximum exemption possible for an employee. So therefore, the limit of 20 lakh is reduced by the exemption claimed earlier. Pension. So uncommuted pension, that is periodical pension, is fully taxable. But commuted pension, that is lump sum pension, is exempt to the extent provided. In the case of employee of a central government, state government, local authority or statutory corporation, it is fully exempt. It is fully exempt. But for other employee, exemption depends on whether the employee receives any gratuity or doesn't receive any gratuity. Where the employee receives any gratuity, then the exemption is what? It is commuted value of 1/3 of pension which he is normally entitled to receive. In other words, this is the formula in simple terms. So we need to do 1/3 multiplied by commuted pension received. divided by commutation percentage into 100. Where the employee does not receive any gratuity, the formula remains similar, but 1/3 gets changed to half. So exemption is equal to commuted value of half of pension which he is normally entitled to receive, and in simple term this is the formula: half into commuted pension received divided by commutation percentage into 100. Leave salary or leave entitlement. The amount received during employment is fully taxable, but that which is received on retirement is exempt to the extent provided. In the case of employee of a central government or state government, it is fully exempt. But in the case of any other employee, exemption is lower of A, B, C or D. A is leave salary received, B is the maximum exemption, the cap of 3 lakh, C is 10 months into average salary, and D is leave credit in months into average salary. So the question is, what is the meaning of average salary? Average salary is equal to average salary of 10 months immediately preceding the date, not the month, preceding the date of retirement. So we pick up the duration of 10 months preceding the date of retirement and we figure out the average salary. Salary means what? Salary means basic plus DNS allowance if the terms of employment so provide. That means where it is considered part of salary for computing retirement benefits, and commission if it is based on fixed percentage of turnover. For D, what is also relevant is the leave credit, which we compute in months. Now leave credit is what? How do we compute this? We first determine the leave entitlement in number of days. For the period the employee had rendered the service, the entire leave entitlement. However, this cannot exceed, so there is a cap, it cannot exceed 30 days for each completed years of service. So from leave entitlement, we deduct certain leaves which have been availed or which have lapsed or which have been encashed while in service. So what is left? What is left is what can be encashed on retirement. So that is called leave credit. We divide it by 30 days. So this gives us leave credit in months. And accordingly, we determine the amounts in A, B, C or D, and exemption is lower of A, B, C or D. Where leave salary is received from multiple employers in the same previous year, then we need to ensure that the total exemption should not exceed the cap of 3 lakh. Similarly, where leave salary is received in earlier previous year and exemption was claimed in respect of that, then we need to ensure that the limit of 3 lakh is not breached. The exemption is limited to this cap. So therefore, what we do is limit of 3 lakh in the current previous year for exemption, computation is reduced by exemption which was claimed earlier. We will now look at the tax treatment of Provident Fund. Now the Provident Fund can be either statutory provident fund or SPF, recognized provident fund or RPF, unrecognized provident fund or UPF, or public provident fund or PPF. And the tax treatment, we will look at A, during employment, B, for lump sum payment of accumulated balance on retirement, resignation or termination. So as far as SPF is concerned, employer's contribution is exempt and interest credited on employer's contribution is also exempt. As far as employee's contribution is concerned, he can claim deduction under section 80C. As far as interest on employee's contribution is concerned, it is exempt. But in case of excess contribution, it is not exempt. We will look at this. What about lump sum payment of accumulated balance? It is exempt. What about RPF? Employee's contribution. It is exempt up to 12% of salary. Beyond this, it is taxable. It is exempt up to 12% of salary. And what is the meaning of salary? Salary is basic plus DNS allowance if it is part of salary for computing retirement benefits, and commission if it is based on fixed percentage of turnover. Further, if the employer makes a combined contribution to 3 funds, which is RPF, Approved Superannuation Fund ASF, or National Pension Scheme NPS, and that combined contribution is greater than 7.5 lakh, then that excess is also taxable. What about interest credited on employer's contribution? It is exempt up to 9.5%. Further, the interest which relates to this excess, of 7.5 lakh is also taxable. Now coming to employees contribution. Employees contribution, he can claim deduction under section 80C. What about interest on his contribution? It is exempt up to 9.5%. But in relation to the interest on the excess contribution. So the interest which is in relation to an excess contribution, which we will look in some time, that is not exempt, that is taxable. As far as lump sum payment of accumulated balance on retirement, resignation, termination is concerned, it is exempt, but only if certain conditions are satisfied. If those conditions are not satisfied, the amount is not exempt. And what are those conditions for exemption of accumulated balance of RPF? If the employee rendered continuous service with the employer for at least 5 years or more, then the accumulated balance is exempt. If this is not the case, then we need to check whether the service was terminated due to ill health or contraction or discontinuance of employee's business or other cause which is beyond the control of the employee. If that is the case, then the amount is exempt. If this is still not the case, then we need to see whether the employee has transferred the balance in the fund to the RPF account with his new employer. In that case, the amount is exempt. If even this is not the case, then we need to check whether the entire balance was transferred to the NPS account of the employee referred in section 80CCD. If yes, then it is exempt. If none of these conditions A, B, C and D are fulfilled, then the amount is taxable, and the amount is taxable as if the fund was an unrecognized provident fund from the beginning. Now in case C, where the employee transfers the balance to his RPF account with a new employer, later on when the accumulated balance is withdrawn and when we need to check for the condition of these 5 years continuous service for determining whether exemption is available or not, the service period under previous employer and the new employer will be aggregated to check the 5-year condition. So this was about RPF. Now we come to unrecognized provident fund or UPF. So employees contribution 80C deduction cannot be claimed, it is not available. As far as employers contribution is concerned, interest on employees contribution is concerned and interest on employees contribution is concerned, it is not taxable during the employment, it is exempt. But all this becomes taxable when the lump sum payment is received of accumulated balance. In such case, employees contribution is anyways exempt because it is employee's own contribution. So there is no benefit to the employee as such. So there is nothing which can be made taxable. But interest on employees contribution is taxable, but not under the head salaries, under the head IFOS. What about employer's contribution and interest thereon? The whole of it is taxable as salary. What about PPF or Public Provident Fund? So this has got nothing to do with the head salaries, but for a completeness point of view, we will discuss this here. Employer's contribution and interest on employer's contribution is not relevant because employer does not contribute to the PPF. Employee's contribution, he can claim deduction under section 80C and interest on his contribution is exempt. Further, lump sum payment of accumulated balance on PPF is also exempt. Now in this table, we noted that in the case of SPF or RPF, as far as interest credited on employees' contribution is concerned, the interest which is in relation to excess contribution in both SPF and RPF is not exempt, it is taxable. So we now look at this provision. Interest accrued during the previous year which relates to the excess employees contribution, we are not talking about employers contribution, to SPF and RPF is not exempt, it is taxable. So interest accrued during the previous year relating to employees contribution which exceeds the following limit is not exempt, right? And we need to bifurcate the employees contribution as contribution made till previous year 2021 and contribution made from the previous year 21-22. As far as contribution till previous year 2021 is concerned, there is no limit applicable. So therefore, irrespective of the amount of employees contribution, the interest on employees' contribution is not taxable, it remains exempt. But there is a limit which sets in as far as contribution from previous year 21-22 is concerned. And if it is a situation where both employee and employer are contributing to the fund, then the limit is 2.5 lakh per year. If only the employee is contributing, employer is not contributing, then the limit is double to 5 lakh per year. So where, for instance, both are contributing, and from previous year 21-22 and onwards, whatever is the amount which the employee contributes, which is in excess of 2.5 lakh per year, we determine the interest on that excess, and that amount of interest is not exempt, it is taxable. The other portion of the interest remains exempt. Approved superannuation fund. Tax treatment during employment. Employer's contribution, as we noted above, in the case of RPF, combined contribution of the employer to the three funds RPF, ASF and NPS, which is greater than 7.5 lakh in the year, that excess beyond 7.5 lakh is taxable, and the interest in relation to that excess is also taxable. Employee's contribution, he can claim deduction under section 80C, and interest on employee's contribution is exempt. What about payment from the fund? It is exempt if payment is made in certain cases like on death, etc. NPS. As far as NPS is concerned, employer's contribution and employee's contribution. What about employer's contribution? Both can contribute. Employer's contribution, it is first included under the head salaries. You need to first include it under the head salaries, and thereafter you need to provide deduction under section 80 CCD from the gross total income. Further, as we noted above, combined contribution of employer to the three funds which is greater than 7.5 lakh is taxable. Employee's contribution, he can claim the deduction under section 80 CCD from the gross total income. So as we have noted above, for both RPF and ASF and NPS, that there is a combined upper limit for employer's contribution of 7.5 lakh. So employer's contribution to these three funds, the combined contribution, which is in excess of rupees 7.5 lakh in a previous year, is taxable as perquisite. And accretion, which is relating to such excess, is also taxable as perquisite. Accretion, interest or dividend, etc. So both excess contribution and interest relating thereto is taxable. And there is a formula which has been prescribed for computation of taxable accretion. And there are three steps. In step 1 and 2, we need to determine certain amounts. In step 1, we need to determine the amounts for the period from the previous year 2021 to the previous year preceding the current previous year. If we are talking of previous year 22-23, then from previous year 2021 to 21-22 is the period under step 1. And in step 2, we need to compute certain amounts for the current previous year. In step 1, there are two amounts which we need to figure out. Number 1, we need to determine the taxable employer's contribution to the fund or the scheme. What is the taxable amount which is greater than 7.5 lakh, the combined contribution? This we determine for each previous year and then we aggregate. And this is what we call as PC1. Next, we figure out the accretion relating to that excess, which is taxable as we noted above for each previous year as computed under this particular method, and then we aggregate all of that, and that gives us what we call as TP1. So this is step 1. In step 2, we consider the current previous year. First, we figure out the taxable employer's contribution, which is the combined contribution greater than 7.5 lakh, which is taxable. This is what we call PC. Income accrued in the fund or the scheme in the current previous year is I. Average balance in the fund or the scheme, that is balance on 1st April plus balance on 31st March, that's opening plus closing divided by 2. This is what we call FAVG. And then accordingly we determine the rate of return in the current previous year, and which we call R. And R is what? I divided by FAVG. And then finally in step 3, we move to compute the amount of taxable accretion for the previous year. And this is a certain amount multiplied by the rate of return, which is R, which we computed above. And what is that amount? It is PC divided by 2. So PC divided by 2 plus PC1 plus TP1, PC1 plus TP1. So PC divided by 2, first part, PC1 plus TP1, second part. We add both these parts and then the amount we multiplied by R, and that is what gives us the amount of taxable accretion. And this is taxable in the current previous year. So both the excess, which is greater than 7.5 lakh, the employee's combined contribution to the three funds, and the taxable accretion, which is computed as per this formula, both become taxable in the current previous year. So this was about Provident Fund. VRS compensation. VRS compensation, voluntary retirement compensation received by an employee. It is exempt to the extent of lower of A, B, C, D. A is amount received, B is the upper cap of 5 lakh, C is 3 months salary multiplied by completed years of service, not part year. And D is salary at the time of retirement multiplied by months of service which is left. And what is salary for this purpose? It is basic plus DA if it forms part of salary for computing retirement benefits, and commission if it is based on fixed percentage of turnover. We need to note that this exemption of VRS compensation is available only one time during the life of an SSE. He cannot claim it more than once. So this was about retirement benefits. We now move to the theme of health and life. As far as fixed medical allowance is concerned, it is fully taxable. What about medical facility provided by the employer? It depends on whether it is provided in India, whether the medical treatment is in India or whether it is outside India. If the medical treatment is in India, then it is exempt. Then no taxable perquisite arises in the four situations. Number one, where the medical treatment is in the employer's own hospital. That means in any hospital maintained by the employer. Second, where the employer reimburses expenditure on medical treatment which has been done A, in a hospital maintained by the government or by the local authority, that means in a government hospital, or B, in any other hospital but which is approved by the government for medical treatment of its employees. 3, where there is reimbursement of expenditure by the employer which has been incurred on medical treatment of what? Of prescribed diseases in any hospital but which is approved by the tax authority. That is also exempt. And lastly, where the employee has reimbursed expenditure which has been incurred on medical treatment of what? In respect of any illness but which is relating to COVID-19. That is also not a taxable perquisite, but there is a condition that the employee should submit the prescribed documents to the employer. And these documents include medical documents for illness suffered within 6 months. So there is a time limit within 6 months from the date of being determined as COVID-19 positive. In case of medical treatment outside India, the expenditure incurred by the employer needs to be bifurcated into expenditure on medical treatment, 2 stay abroad, and 3 travel abroad. As far as medical treatment and stay abroad is concerned, the expenditure, there is a limit, there is a cap. So it is exempt only to the extent permitted by the RBI. Beyond this limit, it is taxable. As far as expenditure on travel abroad is concerned, it is exempt only if one condition is satisfied, otherwise it is not exempt. What is that condition? That the gross total income of the employee, not the total income, the gross total income should be up to rupees 2 lakh. Should be up to rupees 2 lakh, and this gross total income is computed how? It is computed before including such travel expenditure. What about health insurance premium paid by the employer for the employee? It is exempt. Now these benefits are not only covered for the employee but also for member of his family. And family means what? Spouse of the employee, children of the employee, whether they are dependent on the employee or not, it doesn't matter. It also includes parents, brothers and sisters, but only when they are wholly or mainly dependent on the employee. Hospital includes dispensary, clinic or a nursing home. What about the expenditure for the attendant which is accompanying the employee for treatment outside India. In such case, expenditure on stay and travel of only one attendant, not more than one. One attendance is also covered by the exemption. What about personal accident policy? When the employer takes the policy on the life of employees and pays premium, it is exempt. We need to note that the sum which is received for COVID-19 expenditure from the employer is exempt and is covered under the head salaries. But when it is received from a non-employer, it is not covered under the head salaries, rather it is covered under the head income from other sources, and its tax treatment is governed under section 56(2)(x), which we will look at in this topic. Life insurance. Life insurance premium paid by the employer is taxable. It is not exempt. Employer's contribution to group insurance scheme is not taxable. It is exempt. We will now look at housing. First, house rent allowance or HRA. Where HRA is granted to the SSE by the employer to meet expenditure on rent in respect of residential accommodation occupied by the SSE. So the HRA is granted by whom? By the employer. To whom? To the employee. For what? For meeting rental expenditure. In respect of what? The accommodation should be residential and it should be occupied by the SSE. In such case, exemption is allowed, which is lower of A, B or C. A is actual HRA received, B is rent paid minus 10% of salary, and C is 40% of salary. 40% is increased to 50% in the case of Mumbai, Kolkata, Delhi and Chennai. What is salary? Salary is basic salary plus DNS allowance if terms of employment so provide. That means where it is forming part of salary for computing retirement benefits, and commission if it is based on fixed percentage of turnover. Now there are certain negative conditions. That means exemption is not available where either of this is satisfied. Where the residential accommodation which is occupied by the SSE is actually owned by the SSE, then HRA exemption is not available. Or where the SSE has not actually incurred expenditure on payment of rent, then also HRA exemption is not available. Residential accommodation. What is the taxable value in respect of rent-free residential accommodation provided by the employer? There are three situations. First, where it is provided by the government employer, that means where the employer is the government, whether central or state. The value, the taxable value of the perquisite is the license fee. Where the residential accommodation is provided by any other employer, then it depends on whether the accommodation is owned by the employer or it is hired by the employer. Where the accommodation is owned by the employer, the value is a specified percentage of salary. What is the specified percentage? It depends on the population of the city. For population up to 10 lakh, it is 7.5% of salary. Population greater than 10 lakh and up to 25 lakh, 10% of salary. Greater than 25 lakh, 15% of salary. Where the accommodation is taken on lease or rent by the employer, then the value is what? It is lower of lease rental or 15% of salary. Okay. Now the accommodation may be furnished. If the accommodation is furnished, we further add the following amount. If the furniture is owned by the employer, the amount that we add is 10% per annum of the cost of furniture. If the furniture is hired by the employer, what we add? Higher charges. Third, this was second, now third. Where the residential accommodation is provided by the employer in a hotel, then the value is what? It is lower of actual charges paid by the employer to the hotel or 24% of salary. Now this was the value we compute for rent-free residential accommodation. What if the accommodation is provided at a concessional rate? In that case, to the value that we have computed as per the above chart, we provide the deduction of rent actually paid by the employee, and this gives us the amount of value of residential accommodation provided at concessional rate. Now in the formula, salary is an important parameter. So the question is, what is the meaning of salary for this purpose? So salary is computed for the period the accommodation is occupied by the employee. So any other period is not considered. And certain items are to be included in the salary and certain items are to be excluded from salary. What is included? basic salary, bonus, taxable allowances, commission, whether it is fixed commission or commission based on percentage of turnover, it doesn't matter. DA is included only when it forms part of salary for computing retirement benefits. And finally, any monetary payment not a perquisite. Why? Because perquisite is excluded from the meaning of salary. So perquisite is excluded, employee's contribution to provident fund is also excluded, and lump sum payments received on retirement like gratuity etc. are also excluded. So for inclusions in the salary, this is the mnemonic for learning which you can use if you want. BBACDM. BBACDM. And finally, exclusions P, P and R. So this is the mnemonic which you can use for your learning. Gas, electricity, water. Where the benefit is provided to the employee by way of supply of gas or electricity or water for his household consumption. Then if the supply is by an agency, the value is the amount paid by the employer to the agency. That's the taxable value of perquisite. If it is supplied by the employer from his own resources, that means by the employer himself, then the value is the manufacturing cost per unit. And if the amount has been paid by the employee, that is reduced, the balance is the taxable value. Domestic servants may be provided. Sweeper, gardener, watchman, personal attendant. Not only provided to the employee, but also to any member of his household. That is covered. And what is the taxable value? Salary, which is paid or payable by the employer for such services. And of course, we reduce any amount which is paid by the employee. If it is a case of servant allowance, it is fully taxable. We now look at travel and conveyance. First, we look at certain special allowances. Category A allowance and Category B allowance. Category A special allowances of 3 types, and all categories of employees are covered here. First is traveling allowance for tour or transfer, and the second is daily allowance for tour or transfer. So both A1 and A2 cover a case of tour or transfer. What is the expense for which allowance is granted? Cost of travel on tour or on transfer, and this includes expenses on transfer, packing, etc. Or ordinary daily charges which are incurred by the employee due to absence from his normal place of duty. Same, either on tour or for the period of journey in connection with transfer. And third is the conveyance allowance, and this covers expenditure on conveyance and the performance of official duties, for example between the office and the client location, so official duties. And what is the amount of exemption? To the extent expenses are actually incurred for purpose for which the allowance is granted, and the balance is taxable. Category B allowances, there are 2 special allowances. First is the disabled conveyance allowance, granted to a blind or deaf or dumb or orthopedically handicapped person for meeting expenditure on what? For commuting between residence and place of duty, but it should be in India, not outside India. And it is exempt 3,200 per month, and the excess is taxable. Second, transport system allowance. To an employee working in any transport system, but in India, not outside India. For what? For personal expenditure during duty of running such transport. But the condition is that the person should not be in receipt of daily allowance. In such case, the exemption is to the extent of 70% of allowance, but with a limit or a cap of maximum of 10,000 per month. Now what we need to note is, as far as expenditure for commuting between residence and place of work is concerned, the exemption is not available for everyone. It is only available in the case of B1, that is for a disabled person, but not for others. Conveyance allowance is exempt under A3 for all the employees, but it is not for commuting between residence and place of work. It is for conveyance of the performance of official duties alone. Leave travel concession or LTC. Exemption is available for LTC, which is received by an employee from whom? From the employer. For what? For proceeding to any place in India. So travel outside India is not covered. And this can be either on leave or even after retirement or termination of service. Now, who should travel? The travel should be for employee and his family. So the family alone without the employee, exemption is not available. Either it can be only employee or employee plus his family. What is the meaning of family? The spouse, Whether dependent or not on the employee is not relevant. As far as children are concerned, there is a limit. For children born after 1st October 1998, the exemption is limited to maximum of 2 children. And when we compute this number, if there is a case of twins which is born after the first child, the twins are considered as one child. So one child, which is the first child, plus 2 children which are twins, even though they are 3, but they are considered as 2, and therefore exemption is available. Parents, brothers and sisters are covered, but only when they are wholly or mainly dependent on the employee. Now there is this concept of block, as per which exemption is available only for up to 2 journeys in a block of 4 calendar years. Beyond 2 journeys, exemption is not available. And the block is for 4 years, and the current block is running from 2022 to 2025, and this is the calendar year. There is this benefit of carryover also, which is provided. If the leave travel concession is not availed by an employee during a particular block, then that can be carried forward to the next block. So that benefit can be claimed in the first year of the next block, but only for one journey, So this is the carryover benefit which is available. Now, what is the quantum of exemption for LTC? The quantum of exemption is the lower of A, the amount which is spent on travel, or B, the following amount. And what is that amount? That is the cap. If the journey is performed by air, then the limit is economy class fare of Air India for the shortest route. Okay. If the journey is performed by any other mode, say by rail or by bus, etc., then there are 2 situations. If the origin and destination are connected by rail, then the cap is AC first class rail fare for the shortest route. But if the origin and destination are not connected by rail, then it depends on whether a recognized public transport system exists or not. Where it exists, then the cap is first class or deluxe class fare on such transport by the shortest route. And where such recognized public transport system does not exist, then we need to consider the rail fare, and that is the AC first class rail fare for the distance of the journey by the shortest route, and we deem as if the journey had been performed by rail. The point we need to note is LTC exemption covers only the cost of travel. So other expenses like accommodation, food, etc. are not covered by this exemption. Now, what is the taxable value in respect of motor car provided to the employee? Now, there are certain situations. Situation A, where the use of motor car is by the employee wholly for official use, then the perquisite is exempt. But if the specified documentation conditions are fulfilled. And what are those conditions? There are 2 conditions. The employer has maintained details of official trips, and he gives a certificate to the employee to the effect that the expenditure was incurred wholly for official purpose. If this is satisfied, then the perquisite is exempt. Situation B, where the use of motor car is wholly for personal use, and it can be not only by the employee but also by any member of his household. So in effect, we take the expenditure incurred by the employer. So where the motor car is owned by the employer, we add 10% per annum of the actual cost of motor car. If the motor car is hired by the employer, we add the hire charges. If running and maintenance expenses are incurred by the employer, we add them. If chauffeur's remuneration is paid by the employer, we add that. And if any amount has been charged from the employee, we reduce that. And the balance is the taxable value of perquisite. Situation C, where the use is a mixed use. That is partly official and partly personal. And the use may not only be by the employee but also by any member of his household. Now in this case, it depends on who owns the motor car, employer or the employee, and who bears the running and maintenance expenses. Where the employer owns the motor car, and this also includes a case where the employer has taken the motor car on hire. So where the employer owns or has hired the motor car and the R&M expenses are borne by the employer, in that case, the taxable value is at the rate of 1,800 per month or 2,400 per month, depending on whether the cc of engine is up to 1.6 liter or more than 1.6 liters. If chauffeur is also provided to run the motor car, then a further 900 per month is added. But if the R&M expenses are borne by the employee, in that case, the value is a slightly reduced value. So this 1,800 becomes 600, 2,400 becomes 900. The rate for chauffeur remains the same at 900. In the second scenario, the motor car is owned by the employee. And then if the R&M expenses are borne by the employer, then how do we determine the taxable value? We first figure out the actual amount of expenditure incurred by the employer. Actual amount, and then we reduce a certain amount. What we reduce is actually the amount attributable to the official use. And what is that amount? At the rate of 1,800 per month or 2,400 per month, depending on the cc, whether it is up to 1.6 liters or more than 1.6 liters, and a further 900 per month if chauffeur is also provided to run the motor car. Now, if the employee claims that a higher amount of official expenses have been incurred than a higher amount, then this 1,800, 2,400 or 900 per month can be claimed as a deduction if documentation conditions that we saw some time back are fulfilled. What if the employee owns the motor car and also bears the expenses? In that case, there is actually no perquisite because there is no benefit which is arising to the employee. Next situation is for any other automotive conveyance, for example, a motorcycle, which is owned by the employee and where the expenses, R&M expenses, are borne by the employer. In that case, two situations can arise. Where the use is wholly official use, like motor car, the value is exempt if documentation conditions are fulfilled. Where there is a mixed use, then we first take the actual amount of expenditure by the employer and then we deduct 900 per month attributable towards official use. And this amount can be raised. So a higher amount can be claimed as a deduction if documentation conditions are fulfilled. The point that we need to note is that if there is a use of vehicle which has been provided to the employee by the employer, for what purpose? For journey between the residence and place of work. If there is use of vehicle, that benefit is provided by the employer to employee. For using it between residence and place of work, it is not taxable, it is exempt. Now we come to transport facility by a transporter. In certain cases, the employer himself may be engaged in the carriage of passengers or goods. That means the employer may be the transporter. And the benefit may be provided to the employee. In what sense? Personal or private journey can be provided by such transporter employer. Not only to the employee, but also any member of the household of the employee. Then, what is the valuation? Where the employer is an airline or the railways, the value is exempt, it is not taxable. But in the case of any other employer, for example, running buses, then what is the value? The value is the value at which this benefit or amenity is offered by the employer to the public, and we reduce any amount which is recovered from the employee and the balance becomes the taxable value. We now look at the area of education. First, certain special allowances. Research allowance is exempt to the extent expenses are actually incurred for purpose for which allowance is granted and the balance is taxable. Children education allowance, which is for children education in India, not outside India. What is the amount of exemption? At the rate of 100 per month per child, but up to a maximum of 2 children. Children hostel allowance. This is for what? Hostel expenditure on the child in India, not outside India. The exemption is what? 300 per month per child, up to a maximum of 2 children. What about educational facility provided to the employee? Now, where the educational facility is provided or training is provided to the employee, it is exempt. But where the educational facility is provided to any member of the household of the employee, it is taxable. And there are three situations. In situation A, the educational institution is employer's own educational institution. So educational institution is itself maintained and owned by the employer. In that case, what is the value? The value is the cost of education in a similar institution where in or near the locality. And there is a threshold exemption of 1000 per month. So the perquisite is exempt if the benefit per child is up to 1000 per month. Else it is taxable. In situation B, though the educational institution is not the employer's own, but the employer has a tie-up. And because of that reason, the educational facility is provided to the member of household. In that case also, the valuation is similar to that of A and the similar exemption threshold of 1000 per month is available. For any other case, the value is the expenditure incurred by the employer in this respect. In any case, for each of these A, B, C, we reduce the amount which is paid or recovered from the employee and the balance becomes the taxable value. Now, as far as the threshold of 1000 per month is concerned, there are two views. One is that if the value exceeds 1000 per month, then the entire value is taxable. View 2, if the value exceeds 1000 per month, only the excess over 1000 per month is taxable. Mostly view 1 is followed, but if you follow view 2, then it will be better if you give a note to clarify this in your answer. What about assets which are provided to the employee? And it can be either use of movable asset or transfer of movable asset. Use of movable asset. Where there is use by the employee of any movable asset, and not only the use by employee but also use by any member of household of the employee, then in case of laptops and computers, the value is exempt, it is not taxable. But in respect of all other assets, it depends on two situations. Where the movable asset belongs to the employer, then the taxable value is 10% per annum of the actual cost to the employer. Where the asset is hired by the employer, then the value is higher charges. In either case, we reduce the amount paid or recovered from the employee and the balance is the taxable value. Movable asset may be transferred by the employer to the employee, right? And the movable asset is belonging to the employer and it is transferred. And it not only covers the case of transfer to the employee, but also any member of the household of the employee. In that case, what is the taxable value? We pick up the actual cost to the employer, and we make deduction on account of depreciation and amount paid or recovered from the employee. That gives us the taxable value. As far as depreciation is concerned, for how many years do we provide depreciation? We provide depreciation for each completed year for which the asset was put to use by whom? By the employer. And what is the rate and the method of depreciation? It depends on what kind of asset is it. For computers and electronic items, the highest rate of 50% applies and the depreciation is provided on reducing balance method. For a motor car, there is a reduced rate of 20% on the same reducing balance method. But on any other asset, it is the lowest rate of 10%, but not on reducing balance, on straight line method. Now, as far as electronic items is concerned, what is the scope? It means it includes data storage and handling items like computer, digital diary and printer. So these are also considered as electronic items. But it does not include household appliances. For example, washing machine, microwave oven, mixer, hot plate oven, etc. So if there are household appliances, they are not electronic items, they are categorized under as any other asset. The next area is office support. There are certain special allowances. Helper allowances, which is granted to meet expenditure on helper, but only for official duties, not for personal duties. That is provided exemption. Secondly, uniform allowance for expenditure on purchase or maintenance of uniform, but only for official duties. The exemption is provided. And what is the extent? To the extent expenses are actually incurred for the purpose for which allowance is granted. This is the quantum of exemption. The balance is taxable. What about food and beverages? Food and beverages provided by the employer. And there are certain situations. As far as tea or snacks provided during working hours are concerned, taxable value doesn't arise, the perquisite is exempt. As far as free food and non-alcoholic beverages are concerned, three situations arise. One, where these are provided during working hours, where either at office or at the business premises, or in the second situation where they are provided by way of paid vouchers, which are non-transferable, which cannot be transferred to anyone else and which the employee can use at eating joints. In both these cases, the valuation is the same. And what is the value? Expenditure incurred by the employer minus rupees 50 per meal. And then we of course reduce the amount which is paid or recovered from the employee, and that gives the value. In the third situation of free food and non-alcoholic beverages, these are provided during working hours but in a remote area or an offshore installation. In such case, no taxable value arises and the perquisite is exempt from tax. In any other case, the value is the expenditure which is incurred by the employer, of course reduced by the amount paid or recovered from the employee. So what we need to note is alcoholic beverages is fully taxable, it is not exempt. Also, if the employee receives an allowance, say lunch allowance, dinner allowance or tiffin allowance, it is fully taxable, no exemption is provided. In case of the telephone expenses, they may be incurred by the employer on behalf of the employee. That is exempt, it is not taxable, and telephone includes mobile phone as well. But if the employee is in receipt of telephone allowance, it is fully taxable. It is fully taxable. We now move to financial incentives. Interest-free or concessional loan. So either the loan can be interest-free, that means 0% interest, or it can be at a concessional rate of interest. So either an interest-free or a concessional loan, and it can be for any purpose whatsoever. And it is made available to whom? To not only the employee but to any member of his household. And it is made available by the employer. It can also be made available or by any person on behalf of such employer. So all this benefit is taxable. And what is the valuation? For this, first we need to check the amount of loan. The amount of loan. And if there are multiple loans during the year, then we need to see the aggregate amount. So if the amount or the aggregate amount is not more than 20,000, that means it is 20,000 or less than 20,000, right? That means the loans are petty in nature. Then nothing is taxable, the perquisite is exempt. If that is not the case, then we need to check whether the loan has been made available for medical treatment, but not in respect of all the diseases, in respect of prescribed diseases. In such case also, the valuation is not taxable, it is exempt, right? If either this is not satisfied or this is not satisfied, then the perquisite becomes taxable, and then we need to make the valuation. But where the loan is for medical treatment of prescribed diseases, we need to make a note that in such case, the employee may receive a claim under a medical insurance scheme from the insurance company. In that case, to that extent, the perquisite is not exempt. To that extent, the loan is not exempt. What is the extent? To the extent to which the claim has been received by from the insurance company under a medical insurance scheme. The balance of the loan is exempt, but to this particular extent, the loan is not exempt. And anyways, if the loan is not covered either by this or by this, it is not exempt. So in this case, we proceed to value the taxable perquisite. And what is the value? It is the interest benefit multiplied by the maximum outstanding monthly balance. So first we need to figure out the value of interest benefit. So we need to compare the actual interest rate charged and we need to benchmark that against what? Against the SBI interest rate prevailing was on 1st April of the previous year for the loan for the same purpose, right? So the actual interest rate and the SBI interest rate we need to compare, and the difference is the interest benefit. Then we need to calculate the maximum outstanding monthly balance, and that is the aggregate outstanding balance for each loan as on the last day of each month. If it is a case of multiple loan, then we need to figure it out for each loan, and then we need to aggregate that. For a single loan, it becomes a single computation. So for each loan, what we need to do, we need to first figure out the outstanding balance of that loan for each month, but on the last day of the each month, and then we aggregate all that up, right? And then the value becomes interest benefit into the aggregate, right? But since it is the aggregate for all the months, we multiply it by 1 by 12, right? So that brings us to the amount of value of perquisite. As far as ESOP or employee stock option plan is concerned, the taxable value is the fair market value of a specified security or sweat equity shares. But FMV on what date? On the date on which the option is exercised by the SSE. Option is exercised, and we reduce the amount paid by or recovered from the SSE. There may be a gift or a voucher or a token which may be received by the employee. Not only the employee, but also by any member of the household of the employee. Maybe on ceremonial occasions or otherwise. From whom? From the employer. In that case, the benefit is taxable as perquisite. And what is the valuation? If this is received in cash, then no exemption is provided, it is fully taxable. But if it is in kind, then there is a threshold of 5,000, right? So in multiple cases, we aggregate the value for the previous year, and if that value is less than 5,000, that means the value is small and therefore it is exempt, it is not taxable. Otherwise, it is fully taxable. And there are two views in respect of the 5,000 threshold. As per view 1, the entire value is taxable if it is 5,000 or more. As per view 2, only the value in excess of 5,000 is taxable. Mostly view 1 is followed, but if you choose to follow view 2, it will be good if you give a note in your answer to this effect. In case of a gift check, you should remember that it is equivalent to a cash gift and therefore it is fully taxable and threshold of 5,000 doesn't apply. Credit card expenses. This is taxable, and what is the value? So expenses may be incurred by the employee and they may be charged to a credit card. Not only by the employee but also by any member of his household, right? And that is then paid or reimbursed by the employer. So that becomes the taxable value. We deduct the amount paid or recovered from the employee. Now expenses not only include the usual expenses but also the membership fees and the annual fees. And the credit card not only includes the primary credit card but also the add-on card. But if the expenses are claimed to have been wholly incurred for official purposes, then the perquisite is exempt, it is not taxable if the documentation conditions are fulfilled. And these are similar to what we saw in the case of motor car. Club expenses, it's also largely similar to credit card expenses valuation. So expenditure may be incurred in a club by the employee. Not only by the employee but also by any member of his household, and that is ultimately paid or reimbursed by the employer. That is the taxable value, and we reduce the amount paid or recovered from the employee. Now the expenditure also includes annual fees or periodical fees. In certain cases, the employer takes corporate membership of the club. In that case, while doing the valuation of the perquisite, we need to make sure that we do not include the initial fees which has been paid by the employer for acquiring the corporate membership. In certain cases, the employer may provide the facility of health clubs, sports, and similar facilities uniformly to all the employees. In such case, perquisite is not taxable, it is exempt. What if the employee claims that the expenses are wholly for official purposes? Then, just like for credit card expenses, perquisite is not taxable if documentation conditions are fulfilled. Now, there is this concept of obligation of employee being met by employer. If something is the obligation of employee but it is met by the employer, then it is actually a benefit provided by the employer to the employee, and therefore it is taxable as perquisite. Therefore, it is taxable as perquisite. For example, if the employer pays income tax of the employee on his behalf, which is actually the obligation of the employee, then that becomes a taxable perquisite. But there is a specific exemption provided under section 1010 CC in this respect, but not for the entire tax. What it says is that tax on the non-monetary perquisites paid by the employer on behalf of the employee is exempt. If it is any other case, then it is not exempt, it will be taxable. So all the other allowances and perquisites which we have not discussed so far are fully taxable. Whatever exemptions are available, we have discussed so far. So finally, we provide deductions under section 16 from the gross salary income. So we aggregate the salary payments, taxable perquisite, taxable allowances, and then we get gross salary income from which we allow deductions under section 16, and there are three of them. First is the standard deduction, section 16IA, which is lower of rupees 50,000 or the amount of salary. Second is deduction on account of entertainment allowance, section 16(2)I. So it is an allowance which is first included in salary, and thereafter from gross salary income a deduction is allowed. If it is a case of a government employee, then the deduction is allowed to the extent of lower of 20% of basic salary, only the basic salary, or the upper cap of 5,000, or the entertainment allowance which is received. For a non-government employee, no deduction is allowed. Lastly, deduction on account of professional tax under section 16(3)I. If it is paid by the employee himself, then from the gross salary income we allow deduction of such tax which is paid by the employee. But where the employer pays such tax on behalf of the employee, then first it becomes a perquisite. Then because the employer is paying on behalf of the employee, so it is first included in the salary as perquisite, and thereafter from gross salary income deduction is allowed of tax paid. So the deduction of professional tax is not on due basis, it is on payment basis. Finally, we summarize the connotation of salary or meaning of salary for different purposes. So the salary means only the basic salary, where we are talking about deduction for entertainment allowance. Salary means basic salary plus DNS allowance, when we are talking of gratuity exemption for a POGA employee. Salary means basic salary plus DNS allowance, but only when it is considered as part of salary for computing retirement benefits and commission based on fixed percentage of turnover. When we are talking about gratuity exemption for non-POGA employee, leave salary exemption, exemption for employees' contribution to RPF, VRS exemption or HRA exemption. And salary, when computing the value of residential accommodation, it includes BBACDM and excludes PPR. This is the mnemonic for the different inclusions and exclusions that we have discussed while discussing residential accommodation valuation. So this brings us to the end of income taxable under the head salaries. We will now cover income under the head income from house property. First, we look at the basis of charge and computation under this head. What is charged under the head income from house property? The annual value of property of which the SSE is the owner and which is not occupied him for business or profession carried on by him is chargeable to tax under the head income from house property. Property means buildings or lands appurtenant thereto. As far as income from vacant land is concerned, it is taxable under the head PGBP or IFOS, but not under the head IHP. Where the SSE is not the owner of the property, income is not covered under the head IHP but under PGBP or IFOS. Where the property is occupied for business or profession, PGBP comes into play and IHP is not relevant. However, where property is held as a stock in trade, then that is taxable under IHP. As far as farmhouse used for agriculture is concerned, income therefrom is exempt as agricultural income, which we have seen in the topic on exempt incomes. We now look at the types of properties. The property can either be LOP or SOP or UOP or DLOP. A property which is let out is treated as let out property or LOP. A property which is in the occupation of the owner for his own residence is called SOP or self-occupied property. If there is a property of which the SSE is the owner, but the SSE cannot actually occupy that property. Why? Because due to his employment, business or profession, which is carried on at some other place, the SSE cannot actually reside in that property and he has to reside at that other place in a building which does not belong to him. So that's why the property remains unoccupied. So that is called unoccupied property or UOP. Now both for SOP and UOP, where such property consists of up to two houses, the classification is that of a SOP or UOP. But where such property consists of more than 2 houses, then the SSE can specify up to 2 houses at his option as SOP or UOP. As SOP or UOP, and this option can be changed every year. For the other houses, that is, for the houses which are more than 2, for the other houses, the treatment is that of a DLOP, which is deemed to be let out property. So even though the property is not let out, it is deemed to be let out, and that's why it's called DLOP. As we noted above, property which is occupied by the owner for his own business or profession, it is not covered under IHP in the first place. Now, as far as SOP or UOP is concerned, self-occupied or unoccupied property, where the property or any part thereof is let during the previous year, or maybe any other benefit is derived from such property by the owner, then the classification is changed from SOP or UOP to that of a LOP, and the tax treatment applies as that which applies in the case of a LOP. We now look at the master chart for computation of income under the head IHP, and these are the steps to be followed. The computation is different for LOP, for SOP or UOP, and for a DLOP. So first we look at the computation for LOP. In step 1, we compute the expected rent. An expected rent is the higher of A or B, A fair rent or the municipal value. But this is restricted to standard rent, so this cannot exceed the amount of standard rent. In step 2, we compute the actual rent. This is what? This is the rent received or receivable during the year minus unrealized rent. Minus unrealized rent. In step 3, gross annual value is computed, GAV. It is the higher of expected rent or actual rent. But there may be a case where the property is let out and there is a vacancy, and if certain conditions in that case are satisfied, then vacancy allowance is available, as per which the gross annual value GAV is not the higher of expected rent or actual rent, but GAV is equal to actual rent. We will look at that. From the GAV, in step 4, we deduct municipal taxes actually paid during the previous year by the owner. That gives us the amount of NAV or the net annual value. From the NAV, we allow deductions provided under section 24. And there are 2 deductions. One is on account of standard deduction, which is at the rate of 30% of NAV, and interest on borrowed capital to the full extent. And that gives us the income under the head IHP, which can either be income or loss. For SOP or UOP, the NAV is taken as nil. So we straight away jump to step 5 and we take NAV as nil. Consequently, standard deduction becomes irrelevant. What is then allowed is only the interest on borrowed capital, and there is a limit of either 30,000 or 2 lakh. So that results in a loss under the head IHP. Now DLOP, as we have noted, though the property is not a let out property, but it is deemed to be let out property. So therefore the computation is same as that of LOP. The computation is same as that of LOP, but the only difference is while computing GAV. So GAV in the case of DLOP is not the higher of expected rent or actual rent, because there is no actual rent in the case of DLOP, and therefore by default the GAV becomes the expected rent. The other steps remain the same as that for LOP. Now sometimes the property will come into existence during the previous year. So that means the property will not be in existence for the whole of the previous year. In that case, we need to keep in mind that the annual value should be computed only for the proportionate period. That means for the period the property is in existence. The date property comes into existence till the 31st March of the previous year. That means expected rent and the actual rent, and consequently the GAV. But the other values, that is deduction on account of municipal taxes and interest on borrowed capital, standard deduction, will be allowed in full and not proportionate. Now we look at each of the items which we have discussed in the master chart. So first we compute GAV, and for GAV we need to find out the amount of expected rent and the actual rent. So what is the expected rent? As we noted above, it is higher of fair rent or municipal value, but it cannot exceed the amount of standard rent. What is fair rent? Fair rent is the rent from a similar property in the same or similar locality and in the question it may also be referred to as reasonable rent. What is the municipal value? It is the value determined by the municipal authority for levy of municipal taxes on the property. What is the standard rent? It is the rent which is fixed under the Rent Control Act of the relevant state. Then we determine actual rent, which is actual rent which is received or receivable by the owner during the previous year. And consequently, we compute GAV, which is what? Which is the higher of A, expected rent, or B, actual rent. Now, as we noted above, actual rent does not include the amount of unrealized rent. So while computing actual rent, GAV is higher of expected rent or actual rent, but actual rent excludes the amount of unrealized rent. What is unrealized rent? Rent which is payable, but it has not been paid by a tenant. And it is proved to be lost and irrecoverable where four conditions of Rule 4 are satisfied. Number 1, tenancy is a bona fide tenancy. Number 2, the defaulting tenant has vacated the property, or steps have been taken by the assessee to compel him to vacate the property. Number 3, the defaulting tenant is not in occupation of any other property of the assessee. And number 4, assessee has taken all reasonable steps to institute legal proceedings for recovery of rent. If that is not the case, then he has satisfied AO that legal proceedings would be useless or worthless. If these four conditions are satisfied of Rule 4, then unrealized rent is deducted from actual rent, otherwise it is not deducted from the actual rent. We have noted above in the master chart that vacancy allowance is also available in certain cases. Normally the GAV is higher of expected rent or actual rent, but where vacancy allowance is available, then GAV is equal to actual rent. This is applicable when the property is let and is vacant during the previous year. In that case, we need to follow two steps. Step 1, we compare the actual rent with the expected rent. And actual rent is what we determined after reducing unrealized rent, if any, if the conditions of Rule 4 have been fulfilled. Then, if the actual rent is less than the expected rent, but owing to vacancy, in that case vacancy allowance is available and GAV is equal to the actual rent. So vacancy allowance is provided where actual rent is less than expected rent only due to vacancy, not on account of any other reason. If vacancy allowance is not applicable because this condition is not satisfied, then GAV is computed normally, which is what? Which is higher of expected rent or actual rent. So once we have computed the amount of GAV, then we deduct municipal taxes which are actually paid during the previous year. By whom? By the owner. And these are deducted from the GAV to arrive at what? At the net annual value or NAV. And municipal taxes also include the service taxes which are levied by the local authority, like what? Like sewerage tax, water tax, etc. After we have computed NAV, we allow for deductions under section 24, and there are two deductions. The first is standard deduction under section 24A, and this is equal to 30% of NAV. This is equal to 30% of NAV, and this subsumes all the expenses. Therefore, no separate deduction is allowed for expenses like repair and maintenance, insurance premium, electricity, water, etc. Only standard deduction is allowed. The second deduction under section 24 is under section 24B on account of interest on borrowed capital. What is the quantum of interest? Interest payable on borrowed capital is allowed as a deduction where property is acquired, constructed, repaired, renewed, or reconstructed with borrowed capital. 5 cases. Where the property is treated as LOP or DLOP, the interest payable on borrowed capital is fully deductible, there is no limit. But where it is a case of SOP or UOP, up to 2 houses, then there is a limit. Why up to 2 houses? Because beyond 2 houses, the property will be treated as DLOP, for which there is no limit, interest is fully deductible. So for up to 2 SOPs or UOPs, there is a limit. And it depends on for what purpose is the amount borrowed. So where the property is repaired, renewed, or constructed, that means number 3, number 4 and number 5, then the deduction is allowed up to a maximum of 30,000. Okay. Beyond this, if interest is payable, it is not allowed as deduction. If the property is acquired, number 1, or constructed, number 2, with borrowed capital. So out of these 5, number 3, 4, 5 are covered here, deduction 30,000, and number 1 or 2, acquisition or construction, is covered here. In the case of acquisition or construction, it depends on when is the capital borrowed. If the capital was borrowed before 1st April 1999, then the deduction is limited to 30,000. But if the capital is borrowed on or after 1st April 1999, then an enhanced deduction limit of 2 lakh is available, but only if 2 conditions are satisfied. The first condition is that the acquisition or construction of the property should be completed, not started, completed within what? Within 5 years from not the date on which the capital was borrowed, but from the end of the financial year in which capital was borrowed. And the further condition that needs to be satisfied is that the SSE should furnish a certificate from whom? From the lender, specifying the amount of interest. If both these conditions are satisfied, then the interest is deductible up to the extent of 2 lakh. If both these conditions are not satisfied, then the limit remains at rupees 30,000. Now the aggregate deduction for SOP UOP cannot exceed 2 lakh. That means if there are 2 properties for which say for one deduction is allowed of say 30,000 and for another deduction is allowed of say 2 lakh. So 2 lakh 30,000 cannot be claimed as deduction because the overall limit cannot exceed 2 lakh. 2 lakh will be allowed as deduction for both these properties. Now there may be a case where the SSE takes a new loan to repay the original loan, and then the SSE would pay interest on that new loan. So that interest on that new loan will also be eligible for deduction as per the above said limits. Now interest which is deductible as per the chart above, which we just now saw, is not just the current year's interest, but also the prior period interest. Current year interest for the current previous year, prior period interest for the preceding previous years, which was not allowable as a deduction because the property was not in existence in that year, because construction was ongoing, for example, and therefore the property was not in existence, and therefore the income was not taxable under the head IHP, and consequently no deduction was allowed for that prior period. But now when the property gets acquired or when the construction gets completed, now prior period interest becomes deductible. So what are the steps? Step 1. First, we compute prior period interest. What is the amount of prior period interest? We compute interest for a particular period. For what period? For the period prior to the previous year in which property is acquired or constructed. So that is the prior period interest. That means we start the computation of interest from the date of borrowing, and we end on 31st March immediately preceding the date of completion of acquisition or construction, which is prior to the previous year of acquisition or construction. That is the prior period interest. And then we deduct this prior period interest in 5 equal annual installments. And the first year of deduction is the previous year in which property is acquired or constructed, and 4 subsequent years. So ultimately, we deduct not only the current year's interest but also the prior period interest. What you need to note is the prior period interest is deductible only when loan is taken for acquisition or construction, not for other purposes. And prior period interest is deductible whether the property is LOP, DLOP, SOP or UOP, it doesn't matter, but the loan should be taken for acquisition or construction. Now interest under section 24B is deductible not on payment basis but on due basis. Expenses like brokerage, commission, etc. for arrangement of loan are not deductible. Only interest on capital borrowed is deductible. What about repayment of principal? 80C deduction can be claimed in the terms of that provision. Certain interest may not be deductible under section 24B because there is a limit of 30,000 or 2 lakh. So entire interest may not be allowed as deduction. What about that? That unabsorbed interest, it can be claimed as deduction from the gross total income in terms of section 80EEA. We will now look at certain special situations. So as we noted some time back, where there are more than 2 self-occupied or unoccupied properties, only up to 2 properties can be specified by the SSE at his option as SOP UOP, and the others are treated as DLOP, and therefore the assessee will be required to make the selection. What are the steps for selection? In step 1, we compute income from each property assuming it is SOP or UOP. So for all the properties, we make the computation like this. In step 2, we make the computation for each property assuming it is DLOP. Then in step 3, we create combinations of properties where in each combination we take any two property as SOP or UOP and we take the others as DLOP. And then we compute income under the head IHP for each such combination. In step 4, we select the combination with the minimum income which is taxable under the head IHP, that is the most beneficial to the assessee, and accordingly we depending on the selected combination we earmark the two properties as SOP UOP and the other properties become DLOP. Now when we are making this computation for these combinations, so in respect of SOP UOP properties, when we are allowing the deduction in respect of interest, we should ensure that it should not exceed the limit of 30,000 or 2 lakh as the case may be. Now there can be a case where a self-occupied or unoccupied property is let out during the previous year, or say any other benefit is derived by the owner from such property. So as we have noted some time back, in such case the property ceases to be classified as SOP or UOP and it is treated as LOP. Consequently, the benefit of nil NAV is not available and computation of such property is made as if it is LOP. Therefore, all the values are taken for the whole year. For the whole year, because treatment is that of a LOP. But as far as actual rent is concerned, it is only taken for the let out period, because it can only be taken for the let out period. What happens where a portion is used as SOP or UOP and a portion is used as LOP? In that case, we treat the different portions differently. So SOP UOP portion is treated as SOP UOP, LOP portion is treated as LOP, and computation is made accordingly. So therefore, the values are apportioned. Municipal value, fair rent, standard rent, municipal taxes, interest are apportioned based on the usage of portions. But obviously actual rent should not be apportioned because it cannot be for SOP OP portion, it will only be for LOP portion. When we allow deduction of interest, it will be as per the limits. That means for LOP portion, there will be no limit of deduction, but for SOP UOP portion, the limit will be 30,000 or 2 lakh as the case may be. Sometimes the property may be owned by co-owners. It depends on whether the share of co-owners is definite and ascertainable. If that is not the case, that means their classification will be as an association of persons and income from house property will be taxable accordingly. But if their shares are definite and ascertainable, then income from house property will be taxable in the hands of co-owners. And it depends on the nature of the property. If the property is LOP, let out property, then first we compute income from the house property and then we apportion the income to the co-owners as per their respective shares. But if it is a case of SOP or UOP, then the income from house property is separately computed for each co-owner, and therefore each of the co-owner is entitled to the benefit of nil NAV. Also, each co-owner is entitled to deduction of interest up to the limit of 30,000 or 2 lakh as the case may be. So 30,000 2 lakh limit is not the combined limit for all the co-owners put together. What we need to note here is where say a co-owner is owning a SOP or UOP which is other than this SOP or UOP which is co-owned. That means there are more than one SOP UOPs in that case. In that case, as we noted above, the overall interest deduction limit cannot exceed the limit of 2 lakhs. This is what we need to keep in mind. The assessee may receive arrears of rent or may realize unrealized rent in a subsequent previous year. In that case, this is deemed to be income from house property and it is taxable. In which previous year? In the year in which rent is received or realized. What if the assessee is not the owner of the property in that year? It doesn't matter. It is taxable. While computing such income, standard deduction is allowed to the extent of 30%, and therefore any expenses like on litigation, recovery expenses, etc., are not deducted separately. All that is taken care of by the standard deduction of 30%. Sometimes the SSE may not just let out the building. This will be a case where, say, there is a letting of building with services or letting of building with other assets like plant, machinery, or furniture. In that case, a composite rent may be received. So where it is a case of letting of building with services, right? Then the rent needs to be split. Charges for services will be taxable under the head PGBP or IFOS as the case may be, whereas rent for building will be taxable under the head IHP. Where there is letting of building with other assets, plant, machinery, or furniture, then we need to see whether both the lettings are separable or inseparable. Both the lettings are inseparable where the letting of one is not acceptable without the other. For example, auditorium is not acceptable without the furniture or air conditioning equipment. So where both lettings are inseparable, then the entire rent is taxable as PGBP or IFOS as the case may be. It need not be split. But where both the lettings are separable, then we need to split the rent. Rent for the building will be taxable as IHP and rent for the other assets will be taxable as PGBP or IFOS. In the case of real estate developers, they may hold the property as their stock in trade. A benefit is provided whereby the annual value of property is taken to be nil. But two conditions should be satisfied. The property should be held as a stock in trade and it should not be let during the previous year. In that case, the annual value of the property is taken to be nil. But this benefit is not open-ended. There is a timeline. It is available only up to 2 years from the end of the financial year in which certificate of completion is obtained from the competent authority. In certain cases, the transferor of the house property is deemed owner and therefore taxable on account of income from that property, even if the transferor is no more the legal owner of that property. There are certain situations, but we will discuss only one situation relevant from an exam point of view. And that is where an individual has transferred the house property to either his or her spouse or the minor child without adequate consideration, that is as a gift or for inadequate consideration. In that case, such individual transferor is deemed to be the owner and therefore income from house property is taxable in his hands. But there are two exceptions. Number one, where the individual has transferred such property to the spouse in connection with the agreement to live apart, in that case, individual is not deemed owner. Second, where the transfer of property is to a minor child, being a married daughter, in that case also individual is not deemed owner. Now there may be a case where instead of transfer of house property, money is gifted to the spouse of minor child and out of that money gifted, they acquire the property. In that case, section 27 won't apply and individual will not be deemed owner. Rather, the income from house property will be taxable in the hands of the transferee, that is the spouse of the child, but then it will be clubbed back with the income of the transferor as per the provisions of clubbing. We will now look at how to compute income under the head PGBP. First, we look at the master chart for computation of income under the head PGBP. And we look at the adjustments to be made when in the question we are given the profit and loss account and certain other information is given. So we begin with the net profit as per P&L account and then we make adjustments to the incomes. What kind of adjustments? We add the income which is taxable but which has not been credited to P&L account. We reduce the income which is credited to P&L account but which is not taxable. Maybe because it is exempt, say under section 10, or maybe because it is though taxable, but it is taxable not under the head PGBP, but under other heads of income. We add deemed profits which are covered under section 41. Next, we make adjustments on account of expenses. So we add expenses which are debited to P&L account, but which are disallowed, say under sections 40, 40A, 43B. And we reduce expenses which are allowed as deduction but which have not been debited to P&L account. And the various allowances and deductions are covered under sections 30 to 37. and the result is the income taxable under the head PGBP. Section 28 lists down the incomes which are taxable under this head, and in this table we will look at certain key incomes. Profits and gains of any business or profession which is carried on by the SSE at any time during the previous year is basically taxable under the head PGBP section 28I. Section 28(2)I covers a case of compensation. Two types. One, compensation which has been received for either the termination or the modification of terms and conditions of what? Either of an agency or of a business contract or in relation to office of management of a company. That is taxable as BGBP. Second, there may be a statutory vesting of management of any property or business in the government, and the government will pay compensation. That compensation also is taxable under PGBP. Third, section 28IV, benefit or perquisite. Value of any benefit or perquisite, if it arises from the business or the exercise of a profession, is taxable under the head PGBP. Section 28VA, non-compete fees. What is this? Any sum which is received or receivable under an agreement for what? Either for not carrying out any activity in relation to any business or profession, or for not sharing any intellectual property. For example, know-how, patent, copyright, etc. That is called non-compete fees, taxable as PGBP. Then we have section 28VI, keyman insurance policy. So any sum which is received under a keyman insurance policy, if it is connected to the business, it is taxable under the head PGBP, including the amount of bonus. As far as deductions are concerned, it's useful to note down certain general principles. Business expenditure is allowed as a deduction. This is what all of us know. And these deductions are and allowances are provided under sections 30 to 37. So these are allowed as deductions unless disallowed. What about loss? Loss per se is not an expenditure, but it is also deductible if it is revenue in nature. That is, it is not capital in nature. It is incurred in carrying on business or profession, and it is incidental thereto. It is also deductible unless it is specifically disallowed. What about exempt incomes? We have already noted under the topic of exempt incomes that expenditure, if it has been incurred in relation to exempt income, it is not allowed as a deduction by virtue of section 14A. What about distinction between a capital expenditure and a revenue expenditure? So we need to note that capital expenditure is not allowed as a deduction under three provisions: section 30, 31 and 37(1). 37(1) is the general deduction provision and 30(31) is what we will now look at. Capital expenditure is not allowed as a deduction under these provisions. So we now move to the first theme, which is deductions in respect of assets. And we look at sections 30 and 31. And these allow for deduction in respect of the premises, section 30, or machinery, plant or furniture, section 31. And the deduction depends on whether the SSE is the owner or the tenant. 5 items are listed. Number 1, land revenue, local rates or municipal taxes are allowed as deduction in respect of the premises, whether the SSE is the owner or the tenant, and this is subject to compliance with section 43B. Second, insurance premium is allowed as deduction in all the cases. Rent is allowed as deduction to the tenant. Fourth, repairs which are revenue in nature, these are allowed as deduction in all the cases. Fifth, repairs which are capital in nature are not allowed as deduction. However, depreciation can be claimed in terms of section 32. We now look at the provisions regarding depreciation which are contained in section 32. First, we look at the conditions to claim depreciation. There are 3 conditions basically. The asset should be 1, a specified asset. What is a specified asset? If it is a tangible asset, the asset should be buildings or machinery or plant or furniture. If it is an intangible asset, then the asset should be know-how or patents or copyrights or trademarks or licenses or franchisees or any other business or commercial rights of similar nature. not being goodwill of a business or profession. So depreciation is not allowed on goodwill of a business or profession. The second condition is that the asset should be owned by the SSE either wholly or partly. And the third condition is that the asset should be used for the purposes of business or profession. We now pick up or take up certain points in respect of each of these conditions. Condition 1 is that the asset should be a specified asset. In respect of land, depreciation is not allowed. What is the scope of the term building? Building includes roads, bridges, culverts, wells, and tube wells. What about plant? Plant specifically includes certain things and specifically excludes certain things. Plant includes ships, vehicles, books, scientific apparatus, and surgical equipment used for the purposes of business or profession. But plant does not include tea bushes or livestock or buildings or furniture and fittings. Buildings or furniture and fittings are a separate category of specified asset for purpose of depreciation. Condition 2. The asset should be owned whether wholly or partly by the SSE. So this means that the co-owner can also claim depreciation and to the extent of his share. What about a case of lease? Depreciation is allowed to the lessor, not the lessee, to the lessor, whether the lease is an operating lease or financing lease. What about hire purchase? Hire purchase, in that transaction there are two components. One is the sale price. Sale price as on the date of agreement, that is called as the cash value. And the other is the hire charges which are supposed to be paid. Right? So deduction is allowed to whom? To the lessee. That means to the buyer, to the lessee on the cash value. Depreciation is allowed. What about hire charges? Hire charges are deductible over the term of the agreement. Now the condition is that the asset should be owned by the SSE. So what about a tenant? What about a person who is a lessee? So if the SSE does not own the building, we are talking about a building, the SSE does not own the building, but he incurs capital expenditure for the purpose of business or profession, right? And that may be in the form of construction of any structure or any work by way of renovation, extension or improvement to the building. Then such a structure or work, even though that is not owned actually by the SSE, it is deemed to be a building owned by the SSE. And consequently depreciation is allowable even if the SSE is not the owner of the building. Condition number 3 is that the asset should be used for the purposes of business or profession, right? And what is relevant is that the asset must be put to use for the purposes of business or profession at any time during the previous year, even if that be for a day. What is put to use? Put to use not only includes active use but also the passive use. Passive use means that the asset is ready for use though it is not actually used. So both active and passive use are considered as put to use and therefore depreciation is allowed. Now depreciation is not optional, it is mandatory. Whether or not the SSE claims depreciation is not relevant. There are two methods to compute depreciation, the SLM method and the WDV method. The straight line method or the SLM method is applicable to an undertaking engaged in generation and distribution of power. In that case, SLM method applies and depreciation is calculated as per the formula actual cost of asset multiplied by the percentage rate of depreciation. So depreciation is allowed year on year on SLM basis and the total depreciation cannot exceed the actual cost of the asset. The undertaking also has an option to opt for the WDV method instead of SLM method. But this option can be exercised in the first previous year, that is the previous year in which it begins to generate the power. And it can be exercised before the due date of filing return of income for that previous year. If this option is not exercised, then SLM method continues to apply. In all other cases, written down value method of depreciation applies. And depreciation is calculated as WDV of the block of assets multiplied by the percentage rate of depreciation. Now the question is, what is the meaning of block of assets? Block of assets means a group of assets falling within a class of assets in respect of which the same percentage of depreciation is prescribed. There are 4 classes of assets: buildings, furniture and fittings, plant and machinery and intangible assets. And The block means a group of assets which falls within a class in respect of which the same percentage of depreciation is prescribed. So as you can see, the following blocks arises which are relevant to us. Where the class is a building, then residential buildings are entitled to the lowest rate of 5%. This is except hotels and boarding houses. Non-residential buildings, a higher rate of 10%. Purely temporary erections such as wooden structures, the highest rate of 40%. Furniture and fittings, only one single rate of 10% applies. And furniture and fittings include electrical fittings as well. And electrical fittings in turn include what? They include electrical wirings, switches, sockets, and other fittings and fans, etc. What about plant and machinery? 4 blocks are relevant to us. The highest rate of 40% applies to aircraft, pollution control equipment, life-saving medical equipment, containers, energy-saving devices, then renewable energy devices. The important items are computers, including computer software, and books. These are also entitled to 40% rate. The next lower rate of 30% applies to bus, lorry or taxi which is used in the business of running on hire. So in the hiring business, or molds or semiconductors. The next lower rate of 20% applies to ships. And finally, the lowest rate of 15% applies to oil wells, motor car which is not used in the business of running on hire. That means general cases of motor cars. And this is also the general rate. It applies to any other plant and machinery. 15% is the general rate. Intangible assets, only one rate is prescribed, 25%. So this is the only block for this class. Now computers, as we saw, is entitled to 40% rate. What does computer include? Computer also includes the peripherals, like what? Like printer, scanner, anti-server, UPS, router, etc., which form an integral part of the computer. Now depreciation can be either normal depreciation or it can be additional depreciation, which we will look at in some time. How do we compute normal depreciation? These are the steps. Step 1. We determine the opening WDV of the block of assets, and mind you, normal depreciation is computed for each block of assets. So each block of assets is considered separately. So step 1 is opening WDV of the block as on 1st April of the previous year. To this we add the actual cost of assets acquired during the previous year. And we deduct monies payable for assets disposed of during the previous year. For example, sold or discarded or demolished or destroyed during the previous year. So monies payable is what? The price for which the asset is sold, or insurance, or salvage money, or compensation monies, or scrap values, if any. And then the result is what? The result is WDV of the block as on 31st March of the previous year for the purpose of computing depreciation. Then in step 5, we deduct the amount of depreciation. And how do we compute depreciation? It is WDV of the block as on 31st March of the previous year as per this step multiplied by the percentage rate of depreciation. This is what we deduct, and then we arrive at the closing WDV of the block for the relevant previous year. This in turn becomes the opening WDV of the block for the next or the subsequent previous year. Now WDV cannot become negative on account of deduction for monies payable. On account of this deduction, the WDV cannot become negative. At the most, WDV will become nil or zero, in which case depreciation won't be allowed. Now, what is the quantum of depreciation? The quantum of depreciation which we deduct as per step 5. What is the quantum? It depends on the period the asset is put to use during the previous year. So where the asset is acquired during the previous year, and there are 3 situations that are possible. The asset is acquired during the previous year and it is not put to use for business or profession in that previous year in which it is acquired. Then no depreciation is allowed. Right? If it is put to use for 180 days or more in that previous year, full depreciation is allowed at the full rate. However, if it is put to use for business or profession for less than 180 days in that previous year, then depreciation is restricted to 50%. Note that 50% restriction is applicable only in the year of acquisition of the asset and not to the subsequent years. For your reference, you can note down the date of 3rd October for a normal year and 4th October for a leap year, latest by which the asset should be put to use in order to meet the condition of 180 days or more. So if the asset, say for a normal year, is put to use after 3rd of October, then the put to use will be for less than 180 days. So 3rd October and 4th October is the date that you can remember for reference purpose. Now, as we noted above, the actual cost of assets acquired during the previous year is supposed to be added. Now, how do we compute actual cost? There are 3 basic steps: 1, 2, and 3. So in step 1, we determine the actual cost of the asset to the assessee, which will be either the purchase cost or the construction cost, etc. Then to this we add certain items if they are not forming part of actual cost. If they already form part of actual cost, no further adjustment is required. What are these items? First, on account of interest. Interest in connection with acquisition of the asset. And the interest we need to bifurcate. There is a cutoff. The cutoff is the date when the asset is first put to use. So interest till this date is supposed to be added to the actual cost. It forms part of the actual cost. Interest after this date doesn't form part of actual cost, but rather it is deductible as expenditure under section 36(1)(3)(I). Second, the expenses that the assessee incurs to acquire and bring the asset to the site. For example, freight, insurance, carriage, loading, unloading, etc. These are added. Expenses to install the asset. For example, installation charges, technician fees, etc. Fourth, expenses to facilitate its use, or if certain modification is necessary to make it fit to use, those expenses, they form part of actual cost. But these are expenses which are incurred before the asset is put to use. After the asset is put to use, they can be claimed as expenditure under section 37(1). In step 3, we reduce the following. That means they don't form part of actual cost. So if they are not forming part of actual cost in the first place, no further adjustment is required. The first item, GST on which ITC has been allowed, and this also includes excise, customs duty on which the tax credit has been allowed. Second, if the assessee has received any subsidy, grant or reimbursement from the government or any statutory authority or any other person, and this amount has been received for being used to meet the cost of the asset, it should not form part of the actual cost. Third, if there is a payment which is made to a person in a day for acquiring the asset, and the payment is made otherwise than by a specified mode, and the payment exceeds rupees 10,000, or if multiple payments are made to a person in a day, then the aggregate of the payments exceed rupees 10,000, then that payment or the aggregate of payment is not supposed to be included in the actual cost. What are the specified modes? Account pay, check or draft, bank ECS, credit or debit card, net banking, IMPS, UPI, RTGS, NEFT, Bheem, Aadhaar Pay. For example, payment made by cash or by bearer check or by uncrossed checks. So these are the examples, and then after steps 1, 2 and 3, we arrive at what is the actual cost for the asset. Now we come to the computation of additional depreciation, and the relevant section is section 32(1)(2)(IA). Additional depreciation is in addition to the normal depreciation, and it is computed at 20% of the actual cost of new plant and machinery. And there are 2 conditions to be satisfied. 1, the plant and machinery should be acquired and installed after 31st March 2005. Second, the assessee should be engaged in the business of A, either manufacture or production of any article or thing, or B, generation, transmission or distribution of power. There is a negative list. Additional depreciation is not allowed. On what? 5 items. Ships and aircraft, second-hand plant and machinery, plant and machinery installed in any office premises, for example, computer installed in office, or any residential accommodation, which includes a guest house. Fourth, office appliances or road transport vehicles, for example, motor cars. Fifth, Plant and machinery whose 100% actual cost is allowed as a deduction. For example, capital expenditure on scientific research, which is allowed 100% under section 35. What about the case where asset which is acquired is put to use for less than 180 days in the previous year of acquisition? Similar to normal depreciation, 50% restriction applies. So additional depreciation in the year of acquisition is 50%. That means to the extent of 10%. What about the balance? Balance 10% additional depreciation is allowed in the next year. Additional depreciation is not available to a power undertaking which follows SLM method. It is available though to a power undertaking which has opted for the WDV method. Now section 43A is a section which makes a special provision in respect of change in foreign exchange rate, foreign currency exchange rate. The situation covers 3 ingredients. 1. The SSE has acquired any asset in the previous year, but not from India, from a foreign country for business or profession. So the purchase is made abroad. Second, the asset is acquired through monies borrowed in foreign currency. So money has been borrowed in foreign currency and then the asset has been acquired, or through foreign suppliers' credit. So the money is to be paid at a later point of time. Third, there is a change in the rate of exchange during any previous year after acquisition of asset. And consequently, there is increase or reduction in liability at the time of making payment as compared to the liability at the time of acquisition of asset. So 2 points of time. One, at the time of acquisition of asset. At the time of acquisition of asset. And the second point, which is the later point, is the time of making the payment. And the rate of exchange in both the dates may not necessarily be the same. So there will be a variation. And therefore, there will be a consequent increase or reduction in the liability at the time of making payment. Such increase or decrease in liability is adjusted. That means it is added to or deducted from the actual cost of asset, and consequently depreciation is then provided on the revised actual cost to align it to this particular change in the foreign currency exchange rate. So this is the adjustment under section 43A. Now, actual cost is computed in a certain fashion in certain special cases, and we will look at 2 cases here. One, so there are several cases, we will just look at 2 cases which are important from an exam point of view. One is where the asset is acquired by the assessee by way of gift or inheritance. Gift or inheritance. In such case, what should be the actual cost to the assessee? We pick up the actual cost to the previous owner, and then we allow deduction of notional depreciation, which is what? Deduction which would have been allowable to the assessee as if the asset was the only asset in the relevant block of assets. That becomes the actual cost to the assessee. Second is a case of a private building. This particular case applies in the case of a building, which is the private building, not used for business or profession, but now it is brought into use for business or profession. So when it is so brought into use, its actual cost is what? It is actual cost of building minus notional depreciation. And what is that? Depreciation which would have been allowable had the building been used for business or profession since its acquisition. There is a special provision for computing WDV in case of composite agricultural income. So where there is a processing beyond compulsory processing, composite agricultural income arises, which is to be split into taxable business income component and exempt agricultural income component. And therefore depreciation will also be allowed proportionate to the taxable business income component. But how do we compute WDV of the assets? So for computing WDV of the assets acquired before the previous year, that means for computing the closing WDV of the asset for a particular year, which will then become the opening WDV of the asset for the subsequent previous year, the total amount of depreciation is to be computed as if the entire income was business income, and the total amount of depreciation is then deemed to be actually allowed, because we deduct the depreciation which is actually allowed from the closing WDV in order to arrive at the closing WDV of the relevant previous year. So in this particular case, even when the entire depreciation is not actually allowed, because only a part is taxable business income. But for computing written down value, the entire depreciation is supposed to be deducted by virtue of this particular provision, and then WDV is accordingly computed. The next deduction for assets is an investment linked tax incentive for specified businesses, and this is section 35AD. What is the extent of deduction? 100% of the expenditure is allowed as deduction under 35AD. If it is capital in nature and it is incurred for any specified business which is carried on by the SSE during the previous year. What about pre-commencement expenditure? That is also allowed. Expenditure incurred prior to the commencement of operations of specified business is also allowed as deduction. When is that allowed? In the previous year in which operations are commenced. But the condition is that the amount should be capitalized in the books of account when? On the date of commencement of operations. So pre-commencement expenditure is also allowed, while the current year expenditure is anyways allowed under 35AD if these conditions are satisfied. There is a list of specified businesses, but some of the select businesses are given here. Cold chain facility, warehousing facility for storage of either agricultural produce or sugar. If it is a case of hotel, it should be at least 2-star. If it is hospital, it should have at least 100 beds. Fertilizer production in India, beekeeping and production of honey and beeswax, and the business of new infrastructure facility. These are some of the specified businesses covered. 3 basic conditions need to be satisfied by the specified business for claim of deduction under 35AD. 1. The specified business should be carried on by the SSE during the previous year in which expenditure is incurred. 2. It should not be set up by splitting up or reconstruction of an already existing business. 3. It should not be formed by transfer of second-hand plant and machinery. Plant and machinery should be brand new. But there is an exception which is allowed up to the total value of second-hand plant and machinery up to 20%. So up to 20% of total value of plant and machinery which has been used can be second-hand. There is another exception in respect of second-hand imported plant and machinery. It is also not regarded as second-hand if certain conditions are fulfilled. There is a negative list, and therefore 35AD deduction is not allowed in respect of this expenditure. 1. Expenditure in respect of which a payment is made to a person in a day which is otherwise done by a specified mode and which exceeds rupees 10,000. If there are multiple payments, then we need to check the aggregate. So this is similar to the point that we saw while computing the actual cost of an asset. Second, expenditure on land 1, goodwill 2, financial instrument 3 is not allowed 35AD deduction. Implications of deduction in respect of specified business and in respect of expenditure. In respect of specified business, if deduction is allowed under 35AD for a specified business, deduction cannot be allowed under section 10AA or chapter VIAC. 10AA is the deduction on account of newly established units in special economic zone. Chapter VIAC, deduction on a by virtue of sections 80HS to 80 RRB. So either you can claim deduction under 35AD or under 10AA plus chapter VIAC. Deduction cannot be claimed for both 35AD and 10AA plus VIAC. In respect of expenditure, if deduction is allowed under 35AD for an expenditure, the deduction in respect of that expenditure is not allowable elsewhere. Therefore, depreciation is not allowed where 35AD is allowed, whether normal depreciation or additional depreciation. 35AD is optional, it is not compulsory. If the SSE opts for 35AD, then these implications arise. There is a lock-in period of 8 years which is prescribed, which means that the asset for which the deduction has been allowed under 35AD should be used only for a specified business. Right? It can be another specified business, but it should not be a non-specified business. And this Restriction runs for a period of 8 years. From when? From the previous year of acquisition or construction of the asset. What if there is a default? If there is a default, deemed business income, it arises in the previous year of default. That means in the year in which the use is for a non-specified business within the 8-year lock-in period. And in such case, the amount of deemed business income that is taxable is the total deduction under section 35AD which has been allowed for the asset. That means 35AD deduction which was allowed is now completely reversed. However, the depreciation under section 32 is allowed in place of 35AD. So depreciation which would have been allowable all throughout this particular period is now allowed. So while 35AD is completely reversed, depreciation throughout this period is now allowed as a deduction. So this is the provision for 35AD. Insurance premium which is paid for stocks or stores, it is not covered under 30 and 31, the sections that we discussed some time back, but it is covered under 36(1)(I), and this is also deductible. There are specific provisions made for amortization of certain category of expenses. Section 35D deals with preliminary expenses. Who is the eligible assessee? In the case of a company, it should be an Indian company. Where the assessee is not a company, the assessee should be a resident in India. What is the coverage of specified expenditure? A specified expenditure should be incurred either before the commencement of business. It can also be incurred after the commencement of business, but it should either be in connection with the extension of an undertaking or setting up of a new unit. The deduction is allowed of specified expenditure in 5 equal annual installments. That means 1/5 in each year. And it begins with the previous year in which either the business commences or extension is completed or new unit commences production or operation. So the question is, what is covered as a specified expenditure? So there are 7 items which are covered as a specified expenditure. While items 1, 2, 3 and 4 can be incurred by any eligible assessee, but 5, 6, 7 are applicable only to a company assessee. Who should carry out the work? In respect of all the items 1 to 7, the assessee himself can carry out the work, or the work can be outsourced also to a concern. But in respect of items 1, 2 and 3, the concern should be approved. If the concern is not approved, item 1, 2, 3 is not allowed as specified expenditure. Now we will look at these items quickly. 1, 2, 3, what are these? Expenditure in connection with what? Preparation of feasibility report, project report, market survey or other survey or engineering services. Number 4 is what? Legal charges for drafting agreements for the purpose relating to setting up of or conduct of business. 5, 6, 7 are what? This is applicable to a company. Legal charges for drafting memorandum or articles of association, fees for registering the company under Companies Act, and in connection with public issue of shares or debentures. There is a cap in terms of specified expenditure. It is not without a limit. There is a cap in respect of the total expenditure which can be categorized as specified expenditure. So total expenditure cannot exceed the following. Where the assessee is an Indian company, the limit is what? The limit is 5% of A or B, either cost of the project or capital employed in the business of the company, and both these terms have been specifically defined. If the assessee is not an Indian company, then what is relevant is only 5% of cost of project. Capital employed is not relevant to a non-company assessee. So a specified expenditure is eligible for amortization but subject to this limit. So the specified expenditure, the total amount cannot exceed this limit. VRS expenditure is allowed as deduction under section 35 DDA, and all the assessees are covered by this provision. It covers sums which are paid to an employee in connection with his voluntary retirement. And the amortization is 1/5 every year in 5 annual installments from the previous year in which such sum is paid. 36(1)(ix) provides for amortization of family planning expenditure, and this applies to a company only. What expenditure is covered? Which is incurred bona fide for promoting family planning but amongst its employees. If the expenditure is revenue in nature, 100% is allowed as deduction. If it is capital in nature, then it is amortized in 5 annual installments, 1/5. What about a non-company SSE? This special provision does not apply. If it is a capital expenditure, one can explore claim of depreciation as per that provision. If it is revenue, then one can explore the provisions of 37(1). We will now look at expenditure for special purposes, and we will take a look at section 35, which provides for deduction on account of expenditure on scientific research. And these are on 2 counts: payments to specified entities and expenditure on in-house research. First, we look at deduction on account of payment to specified entities. 100% deduction is allowed for sum paid to the following entities. First, if the sum is paid either to a research association or university or college or other institution, and these entities should be approved and notified. You can use the mnemonic RICU for the sake of better learning. In such case, 100% of deduction is allowed. And the condition is that the sum should be paid to be used for scientific research or statistical research or research in social science. Second, if the sum is paid to a company which is registered in India, not outside India, having its main object of what? Of scientific research and development, then 100% deduction is allowed if the sum is paid. The condition is that the company should be approved and the sum should be paid to be used for scientific research. In both these cases, there may be a situation where after the payment has been made of such sum, the approval which has been granted to the entity has been withdrawn. But in that case, the deduction is not affected. It is not denied merely on this ground. 100% deduction is also allowed in respect of sum paid to a university or national laboratory or IIT or an approved person. The mnemonic which you can use if you want is UNIA. The condition is that the sum should be paid with a specific direction that it shall be used for scientific research, but such research should be undertaken under an approved program. It may so be the case that after the payment has been made, the program is withdrawn or the approval granted to the entity is withdrawn. But in such case, the deduction is not denied merely on this ground. That means the deduction is not affected. Now we come to the second category, which is in-house expenditure. It should be on scientific research, but it should be related to the business of the SSE. This is the condition. It can be after commencement of business or before commencement of business. If such expenditure is after commencement of business, it can be either capital in nature or revenue in nature. If it is revenue in nature, 100% deduction is allowed. If it is capital in nature, then also 100% deduction is allowed. But deduction is not allowed in respect of acquisition of land. It is not allowed in respect of land. What about expenditure which is incurred before commencement of business? That is also allowable as deduction, but there is a time limit. The time limit is expenditure should have been incurred within 3 years immediately preceding the commencement of business. It doesn't refer to immediately preceding the previous year of commencement, but the date of commencement of business. So we pick up this period and we figure out the pre-commencement expenditure. In which year is this expenditure allowed? It is allowed in the previous year in which the business is commenced. And this also can be either of capital nature or revenue nature. If it is capital in nature, then 100% deduction is to be allowed, but not on acquisition of land. If it is revenue in nature, then deduction is allowed only on 2 counts. 1. Payment of any salary. Salary would have been paid to employees engaged in scientific research, or the materials would have been purchased for used in scientific research. Only these two categories of expenditure is allowed, provided the expenditure is certified by the prescribed authority. In such case, deduction is 100%. If the expenditure is not certified, or if it is the case of any other expenditure, no deduction is allowable. No deduction is supposed to be allowed. We need to note that salary, which is referred here, it does not include perquisites. Now, if an expenditure is allowed deduction under 35, depreciation is not allowed, whether normal depreciation or additional depreciation. So if 35 is claimed and allowed, depreciation cannot be allowed. Certain tax implications arise when the asset which is used for scientific research is sold. And there are two possible situations. In the first situation, the scientific research asset is sold without having been used for any other purpose. Scientific research asset is acquired, deduction under 35 is claimed, and it is straight away sold without being used for any other purpose in the business. In that case, deemed profits arise under section 41(3), which is lower of A or B. A is sale proceeds, or B, deduction made under section 35, which would have been to the extent of 100%. Are these deemed profits taxable even if the business is not in existence in the year of sale? Yes, it doesn't matter. The deemed profits are taxable in the year of sale even if the business is not in existence in that year. Further, capital gains also arise, which is computed in the manner in which capital gains are computed. Second situation is where the scientific research is acquired, a deduction is claimed under section 35, and it is then being used in the business, and after that it is sold, right? So it is used, it is brought into use in the other areas of business, and after that it is sold. So when the asset is used in the business, after it ceases to be used for scientific research, the assessee would like to claim depreciation. Depreciation would become admissible, and therefore the asset would be added to the relevant block of assets. But at which actual cost? What will be the actual cost at which the asset would be added? So actual cost will be nil or zero. Why? Actual cost of asset minus 100% deduction earlier allowed under section 35. So effectively, depreciation will not be allowed in effect on account of this asset, but it will be added to the relevant block of assets. Now, when this asset is sold, since it is a part of block of assets, capital gain will be computed under section 50, which we will talk about in the topic on capital gain, since the asset is part of block of assets. Coming now to the deduction on account of interest, and this is provided by section 36(1)(3)(i). What is covered is interest which is paid in respect of capital borrowed. If the capital is borrowed for personal purposes, deduction is not allowed. But where the capital is borrowed for the purposes of business or profession, deduction is allowed. It depends then on whether the loan or borrowing is from a bank, public financial institution, state financial corporation, state industrial investment corporation, or an NBFC, or whether the loan or borrowing is from any other person. If the loan or borrowing is from these specified entities, then deduction is allowed under this section, but it is subject to compliance of section 43B. But if the loan or borrowing is from any other person, the deduction is allowed under this provision, and section 43B compliance is not necessary. There is another angle to it, and this is what we have already discussed when seeing the computation of actual cost for the purposes of depreciation. So this covers a case where interest is paid in respect of capital borrowed for what? For acquisition of an asset. In that case, we need to bifurcate the interest before and after a particular date, and that date is the date on which the asset is first put to use. Till that date, whatever interest is computed, it is added to the actual cost, and then depreciation becomes allowable on that actual cost. After this date, whatever interest may be, it is not added to the actual cost, rather deduction is allowed under this provision 36(1)(3)(i) as per these provisions that we have discussed. What about interest which is payable but not on capital borrowed? For example, interest may be payable on delayed payment to vendor for purchase of goods. In such case also, deduction is allowed not under this provision but under the general deduction provision of 37(1). What about expenses to arrange the loan, brokerage commission, etc.? It is deductible not under this provision but under the general deduction provision of 37(1). What if TDS is required to be deducted as source on payment of interest? Then the provision of section 40AI and 40AIA become applicable, and disallowance can be made if these provisions are not complied with. We will look at these provisions in some time. Now we move to the deductions governing employee welfare. What are the deductions available in respect of contribution to employee welfare funds? It depends on the category of the fund and whether the sum which is paid by the assessee is the employer's contribution, that means own contribution, or whether it is sum which is received by the assessee from the employees as their contribution. That means employees' contribution which is received by the assessee to be deposited by the assessee on their behalf in the fund. Number 1, where the fund is a recognized provident fund or approved superannuation fund. Employer's contribution is deductible subject to compliance with 43B. In this case, what about employee's contribution which is received by the assessee? It is first included as income of the assessee, and thereafter deduction is allowed to the assessee provided the sum is credited to the employee's account in the fund on or before which date? Not the due date of furnishing return of income, but on or before the due date as per the rules of the fund. If this condition is not satisfied while it is included in the income of the assessee, no deduction is allowed. Second, approved gratuity fund. Employer's contribution is deductible subject to 43B compliance, but provision for gratuity is not deductible. Now there are certain provisions which apply in this respect, and on a consideration of all the provisions, the net effect is this: that deduction is allowed in respect of approved gratuity fund in respect of this particular area for either of the following: A, B, C or D. Deduction is allowed either for, when we talk about contribution to approved gratuity fund, it can be payment of contribution to approved gratuity fund or provision made for such payment, that is for contribution to approved gratuity fund. Both payment as well as provision for payment is allowable as deduction. When we talk about the payment of gratuity, it can be either provision which is made for payment of gratuity but only for gratuity that has become payable during the previous year, or it can be payment of gratuity during the previous year. In A, B or C or D, deduction is allowable, but deduction is allowable for either of the following. That means one of these. So for example, if a provision has been made for contribution to approved gratuity fund, the deduction is allowed, but then the deduction is not subsequently allowed once again when the payment of contribution is made to the approved gratuity fund, or out of that fund payment of gratuity is made to the employee. So deduction is allowed for either of A or B or C or D. Health insurance premium is allowable as deduction which is paid by the employer for his employees, but the condition is that payment should not be in cash. If it is in cash, no deduction is supposed to be allowed. Bonus and commission paid to an employee is also allowed as deduction, but there is a condition that it should not have been payable as profits or dividend if it had not been paid as bonus or commission. That means bonus or commission should not be paid in the guise of profits or dividend. This deduction is subject to compliance with section 43B. We now look at deductions provided on account of taxes. As far as securities transaction tax (STT) or commodities transaction tax (CTT) is concerned, which is paid by the SSE, the deduction in computing PGBP income is allowed only if the security or commodity is held as stock in trade. Because if it is held as capital asset, capital gain will arise and it will not be covered under the head PGBP. What about income tax? Section 48(2)(i) is the relevant section. Income tax is not allowed as deduction, it is disallowed. This not only includes income tax, but also surcharge, cess, interest, fine, penalty, fees under the Act. What about refund of income tax? Since income tax is disallowed, refund of income tax is not taxable. But as far as interest on delayed refund of income tax is concerned, it is taxable. Interest on refund is taxable but not under this head, under the head IFOS. What about other taxes? For example, indirect tax or municipal tax, professional tax, etc. These are allowed as deduction under section 37(1), but that is subject to compliance with 43B. What about a penalty which has been paid? Right? So penalty, say under these other taxes, can be of two categories. Penalty can either be for breach of law. In such case, it will be penal in nature. It will not be allowed. There can be another kind of penalty which is not penal in nature, but which is compensatory in nature, to compensate for the loss of revenue to the government. In such case, it is allowed as a deduction. Now, section 40AB deals with tax on non-monetary perquisites. While discussing the topic on salary, we noted that if the employer pays tax on behalf of the employee on non-monetary perquisite, although it is generally considered as perquisite because it is the obligation of employee which is met by the employer, but it is specifically exempt in the hands of the employee under section 1010cc. Consequently, such tax which is paid by the employer is disallowed in the hands of the employer under section 40AB. Now we look at certain special deductions. Bad debts are covered by section 36(1)(7), and the deduction is allowed in respect of any bad debt which is written off as irrecoverable in the books of accounts of the SSE for the previous year. If it is written off as irrecoverable in the books, then a deduction is allowed. If not, then deduction is not allowed. But if it is so, then a further condition needs to be satisfied. It needs to be checked whether such debt has been taken into account in computing the income of the SSE or not. If it was taken into account in computing the income of the SSE, for example, sales, well, sales occurred, the SSE would have taken into account the sales in computing his income. And then the amount became bad and it is written off as irrecoverable. In such case, the amount of such debt is allowed as a deduction. But where such debt has not been taken into account in computing the income, for example, in the case of loan, then it is not allowed as a deduction. Then it is not allowed as a deduction. But there is only one exception. That exception is the business of banking or money lending. In the case of banking or money lending, the loan which is given would not be taken into account in computing the income of the SSE, but it represents money lent in the ordinary course of the business of banking or money lending. In that case, there is an exception. In such case, the bad debt will be allowed as deduction under this provision. What about provision for bad and doubtful debts made in the accounts? It is not allowed as a deduction. Provision is not allowed as a deduction. Now, after the deduction has been allowed, there may be a subsequent recovery or ultimate recovery. And then tax implications arise. And there are two steps. In step 1, we calculate is what we call is the difference. Difference is what? Amount of debt minus the amount that was deducted under this provision. In step 2, there are two situations. Number 1, if the amount ultimately recovered is less than this difference, then there is a deficiency. That deficiency is deductible in the previous year in which the ultimate recovery is made. But if the amount subsequently recovered is more than the difference, then there is an excess, and that excess is taxable as deemed business income of the previous year in which it is recovered. What if the business or profession for which deduction was allowed earlier is not in existence in the year of recovery? Even then the excess is taxable. Even then the excess is taxable. We now look at deduction on account of remuneration and interest to partner of a firm or LLP, and the relevant section is section 40B. So a firm is allowed deduction on account of remuneration to working partner, not to a non-working partner, and is also allowed deduction of interest whether to working partner or non-working partner. And there is a limit up to which the deduction is allowed. So there is an upper cap. As far as the remuneration is concerned, the upper cap is determined based on the quantum of book profit. What is the formula? On the first 3 lakh of book profit, or in the case of loss, the deduction is allowed to the extent of higher of 1.5 lakh or 90% of book profit, and on the balance of book profit at the rate of 60% of that balance. So basis this formula, we compute the amount that becomes the upper limit for allowing deduction of remuneration to working partner in the hands of the firm. As far as deduction of interest goes, deduction is allowed only up to 12% simple interest per annum. Beyond 12%, interest is disallowed. When we talk about remuneration, it means salary, bonus, commission, or remuneration by whatever name called. Book profit is important. It's an important consideration. What does this mean? It means income under the head PGBP, not under any other head. Income under the head PGBP, but before deducting remuneration to partners, right? So if the remuneration has been deducted, we need to add it back. Remuneration to non-working partners is not allowed as deduction, but interest to working as well as non-working partner is allowed as deduction. What about taxation in the hands of the partner? So if the amount is allowed as a deduction in the hands of the firm, it is taxable in the hands of the partner. If the amount is not allowed in the hands of the firm, it is not taxable in the hands of the partner. So interest, salary, bonus, commission, or remuneration, if it is deductible in the hands of the firm, it is taxable in the hands of the partner, but not under the head salaries, under the head PGBP. What about share of the partner in the total income of the firm? It is not covered under section 40B. We have noted earlier in the topic on exempt income that it is exempt in the hands of the partner under section 10(2)(a). There may be a situation where the inventory is converted by the SSE into his capital asset. Relevant section is 28 VIA. When the inventory is converted into a capital asset, business income arises at the time of conversion, and the business income is equal to the fair market value on the date of conversion. Now, after the conversion, the capital asset may be used for business or profession. In such case, for the purpose of depreciation, we will need to figure out the actual cost. Actual cost will be the fair market value, which is taken here, right? Now, this inventory which is converted into the capital asset, if it is subsequently transferred, that means, for example, if it is sold, then capital gains arise. We will look at this when we discuss topic on capital gain. Now, so far we were looking at the various specific deductions under different provisions. Now, section 37(1) provides for a general deduction. That means whatever we have not covered in the provisions and whatever is not described in those provisions can fall under this provision. It can be claimed as a general deduction. Any expenditure is deductible under section 37(1) provided all the following 5 conditions are satisfied. Number 1, it is not of a nature described in sections 30 to 36. And if that be the case, then the provisions of those sections apply, and allowance or disallowance is made as per the provisions of those sections. Second, it is not capital expenditure. It should be revenue. Third, it is not a personal expense of the SSE. Fourth, it should be laid out or expended wholly and exclusively for the purposes of business or profession. And lastly, it should not be incurred for any purpose which is an offense or which is prohibited by law. And this includes A, B, and C. It includes expenditure which is an offense or prohibited by law, not only an Indian law but also a foreign law. Okay. It also includes expenditure to provide any benefit or perquisite to a person, right? So the SSE incurs expenditure to provide a benefit or perquisite to a person, but where the person is accepting such benefit or perquisite, that acceptance is in violation of any law, rule, regulation, or guideline. And thirdly, to compound an offense under any law, whether it be Indian law or foreign law, compounding fees. So A, B, C are also not allowed as a deduction. They are included in the condition 5. Certain instances of expenditure deductible under section 37(1), all the above conditions are fulfilled in these cases. Scheme and insurance premium, the litigation expenses to defend business, legal and compliance expenses like filing of returns, audit, etc. Penalty which is not penal in nature, which is compensatory in nature. Damages for failing to fulfill terms of a contract. Expenditure on raising loan or borrowing like brokerage, bank charges, drafting or loan agreement, etc. Salary to employees, professional tax. Interest, not being interest on capital borrowed because that is covered under section 36(1) 3I. So interest like what? Interest on delayed payment of purchase price, etc., which is not in respect of capital borrowed. Advertisement expenditure, customary expenses, say on Diwali, Muhurat, New Year. Training expenses to gain skills for use in business or profession. We now look at instances of expenditure which are not deductible under 37(1) because one or more of the above said 5 conditions are not satisfied. Reserve created against contingent liability because it is not an expenditure which is incurred. Protection money, extortion, hafta, bribes, all these are offences. Freebies, gifts, travel, cash, etc., which is provided to medical practitioners by the pharma industries. Why? Because acceptance of such benefit is in violation of the Medical Council of India guidelines. Penalty and damages paid for infringement of law. It is an offence. CSR expenditure under the Companies Act is specifically disallowed by virtue of explanation 2 of section 37(1). If there is expenditure on advertisement in a publication of a political party, it can be a souvenir or brochure or tract, pamphlet or the like, then that is specifically disallowed by section 37(2)(b). Appropriation of profits like dividend, transfer to reserve, etc. is not allowed because it is not an expenditure to earn income. Expenditure which is disallowed under any specific provision cannot be allowed under section 37(1). We will now see expenses which are not deductible in certain circumstances, and first we will take a look at section 40A(IA), which deals with payments on which tax is not deducted or paid, basically where TDS provisions are not complied with. There are 3 sections basically, 40AI, 40AI-A and 40A(3)(I), but 40AI-A is more relevant from an exam perspective, so we will only take a look at this provision. What is the payment that is covered by this provision, by this disallowance? It covers any sum which is payable to a resident during the previous year. When is the payment disallowed under 40A(IA)? The payment is disallowed in either of these 2 situations. Where tax has not been deducted in the previous year. So TDS was required to be deducted. Okay, so this provision doesn't apply where TDS is not required to be deducted in the first place. Where TDS is required to be deducted and where sum is payable to a resident, then this provision applies. In such case, situation 1, where tax has not been deducted in the previous year, disallowance is made. Or the second situation is that where though tax has been deducted in the previous year, but it has not been paid to the account of the government. And there is a timeline. By when should it be paid? Right? It should be paid on or before the due date to furnish return under section 139(1) of such previous year. So, if though the tax has been deducted in the previous year, but it has not been paid on or before such due date to furnish return of income for such previous year, then disallowance is made. In both these cases, what is the quantum of disallowance? 30% of such sum is disallowed. That means 70% is allowed as deduction, 30% is disallowed. What is the effect of this? No disallowance is made in the previous year in which expenditure is incurred, in either of cases 1 or 2. If tax has been deducted and paid in that previous year, so the full compliance is made, no issue. Or tax has been deducted in the previous year, but it is paid when? By the due date to furnish return of that previous year. In that case also there is sufficient compliance and no disallowance is made. Disallowance is not permanent. Disallowance can be rolled back. That means 30% of the sum which has been disallowed can be subsequently allowed as deduction where either of these 2 situations are fulfilled. 1. So we noted above in 1 that disallowance is made when tax has not been deducted in the previous year. Disallowance can be rolled back where tax has been deducted in any subsequent previous year. Right? So above we also noted that disallowance is made where though tax is deducted in the previous year, but it has not been paid even till the due date to furnish return of income of such previous year. That means disallowance can be rolled back where though tax had been deducted in the relevant previous year, but it is paid after the due date to furnish return of income for that previous year. Okay. In either of these cases, the deduction is allowed. That means disallowance is rolled back in the previous year in which such tax is paid. Now, as we noted above in 1, that disallowance is made where tax has not been deducted in the relevant previous year by the payer. Even in such case, deduction can still be claimed by the payer, provided the payee fulfills these three conditions. 1. The payee has furnished his return under section 139. The payee has taken into account such sum for computing income in such return. And 3. The payee has paid the tax due on the income declared by him in such return. Further, the payer furnishes a certificate to this effect from an accountant in the prescribed form. If these conditions are satisfied, then even if the payer has not deducted the tax, then the payer is deemed to have deducted and paid the tax on such sum when on the date of furnishing of return by the payee. And accordingly, the disallowance of 30% that was made earlier will now be rolled back even if the payer had not deducted tax at source. Thus, what is the effect? While the sum is disallowed in the year of incurring expenditure, because tax had not been deducted in the previous year, 30% was disallowed, but then it is now allowed in the year of furnishing of return by the payer if the above conditions are satisfied. We now move to the next disallowance in respect of related party transactions, section 40A2. What are the conditions for disallowance? 1. The assessee has incurred expenditure in respect of which payment is made to a related party, and the AO is of the opinion that such expenditure is excessive or unreasonable. Then so much of the expenditure as is considered to be excessive or unreasonable by the AO is disallowed. Now the question is, who is a related party? So related party is any relative of the assessee. Assessee relative is the relative party. This is the related party. Second, any person who carries on a business or profession. Say this is the person carrying on business or profession where the assessee has a substantial interest in the business or profession of that person. So assessee has substantial interest, or any relative of such assessee has a substantial interest, or any relative has a substantial interest. In that case also, this particular person who is carrying on a business or profession will be considered as a related party in the context of the assessee. So any payment made to related party will fall under section 40A2. Now who is a relative? Relative means spouse, brother, sister, or any lineal ascendant or descendant. You can use the acronym SBS LED for quick learning. And what is the meaning of substantial interest? For substantial interest, the person should be the beneficial owner of 20% or more equity shares if it is a case of a company, or should be beneficially entitled to 20% or more of business profits in the case of non-company. At what time? At any time during the previous year. Section 40A3 makes disallowance in respect of payment by non-specified mode greater than 10,000, and note that we have already made reference to it in the context of actual cost and section 35 AD. Under section 40A3, what is the disallowance? It's of any expenditure in respect of which a payment is made to a person in a day which is otherwise than by a specified mode exceeding rupees 10,000. In case of multiple payments, we need to consider the aggregate. In case of transporters, where say the payment is made for plying, hiring or leasing of goods carriages, this 10,000 limit is raised to rupees 35,000. The specified modes are the same as that we have discussed earlier in the context of actual cost. So since similar provision exists for actual cost and 35 AD, section 40A3 provisions does not apply in those cases. There may be a situation where the expenditure is allowed as a deduction in full in a previous year on due basis. Payment has not been made, but on due basis. Now payment is made in a subsequent previous year, but it is made in violation of section 40A3. It is made in a non-compliant manner. Okay, what will happen? Disallowance cannot be made because expenditure has already been allowed in full. So the other way around is that to make this payment taxable as deemed business income of such subsequent previous year. So the effect becomes the same. So while the expenditure was allowed in the earlier previous year, in the previous year in which non-compliant payment is made, deemed business income becomes taxable to the extent of that payment. There is a list in Rule 6DD which prescribes cases where disallowance is not applicable even if the payment is non-compliant. Two cases that we need to note from an exam point of view. Disallowance is not made where payment is made to Reserve Bank or any bank or LIC or to the government. Disallowance is not made where payment is made by way of a book adjustment. That means by way of adjustment against the amount of any liability incurred by the payee for any goods supplied or services rendered by the assessee to such payee. So if A is supposed to pay to B and B is then supposed to pay to A, so the accounts are settled or squared off by way of a book adjustments, then this squaring off is not covered by the disallowance provision. Section 43B covers a case where the deduction is supposed to be allowed in respect of certain sums only on actual payment. If 43B is not complied, disallowance is made and the payment is not allowed as a deduction. There are 7 sums which are covered by this provision. 1. Tax, duty, cess or fees by whatever name called under any law, for example GST. 2. Employer's contribution, not employee's contribution, employer's contribution to Provident Fund, Superannuation Fund, Gratuity Fund or any other employee welfare fund. 3. Bonus or commission to an employee, which we have discussed some time back under section 36(1)(2)(i). 4. Interest, we discussed this some time back under section 36(1)(3)(i). What is covered here? Interest on loan or borrowing from PFI or SFC or SIIC or deposit taking NBFC or systemically important non-deposit taking NBFC. 5th, interest on loan or advances from a scheduled bank or some other categories of banks. 6th, leave salary, that is sum payable to an employee by the employer in lieu of the leave standing to the credit of the employee. And lastly, payment made to the Indian Railways for use of railway assets. In respect of these sums, deduction is only allowed on actual payment, and there are 3 situations which are possible. Situation A, there is no issue that the sum is actually paid in the previous year in which liability is incurred. So the liability is incurred and the payment is made in the same previous year. There is no issue whatsoever. So deduction is allowed of such sum in the previous year in which liability is incurred. The problem arises in situation B, where the sum is not actually paid within the same previous year. But deduction is still allowed in the same previous year if the sum has been actually paid on or before the due date for furnishing return of income under section 139(1) in respect of such previous year. And the further condition is that the evidence of such payment should be furnished by the assessee along with the return of income. So long as though the sum is not actually paid in the year in which liability is incurred, but it is paid till the due date of furnishing ROI, even then the effect remains the same, that deduction is allowed in the relevant previous year in which the sum became due. But where the sum is not paid even till the due date of furnishing return of income, deduction is not allowed in the relevant previous year. So this will be a case where the sum is actually paid after the due date of furnishing return of income referred in situation B. In that case, when will the deduction be allowed? It will be allowed only in the previous year in which such sum is actually paid, not in the previous year in which the liability was incurred. In certain cases, interest may be converted into a loan. So interest is payable. As we saw, it is one of the sums which is covered by section 43B. Interest which is payable, instead of actual payment of interest, it may be converted into another loan or borrowing or debenture or any other instrument. So that conversion is not considered as constructive payment, and therefore deduction is not allowed. Deduction of such interest payable is allowed only once such interest is actually paid, not on such conversion. Now we look at certain special provisions. Section 41(1) covers a case of recovery against deduction already allowed. This is a case where there is a loss or expenditure or trading liability in a previous year and the assessee is allowed a deduction or allowance in respect of this in computing the income. But subsequently during a previous year, the assessee has obtained an amount in respect of, say, the loss or the expenditure which was earlier allowed as a deduction, or say the trading liability has been remitted or it has ceased and there is a benefit which has been obtained by the SSE in respect of the trading liability. In that case, since a deduction or allowance was already allowed earlier, then the amount which is obtained or the value of benefit which is obtained by the SSE is taxable as deemed profit in the year of recovery. Even if the business or profession is not in existence in that year, it does not matter, it is not relevant. It is taxable, deemed profits are taxable in the year of recovery. What if it is a case of amalgamation, demerger or succession of the business where the amount of benefit has not been obtained by the original SSE but maybe by the successor? In that case, the successor is taxable under section 41(1). Section 176. There is a business which was running and the business is discontinued, and there is a sum which is received after such discontinuance, and such sum had not been taxed while the business was running, and the sum has been received after discontinuance. In such case, the sum will be taxable as income of the recipient. When? In the year of receipt. Section 43 CA makes a special provision for determining full value of consideration for transfer of land or building. So it covers a case where there is transfer of what? Of land or building, which is not a capital asset. If it is a capital asset, capital gains will arise and the corresponding provision will be section 50C. This is PGBP, 43CA applies, and this will be a case where land or building is a stock in trade. That means this covers a case of a person engaged in real estate business. In that case, we need to figure out what is the actual consideration and what is the stamp duty value. We need to compare both. If SDV is more than 110% of the consideration, then full value of consideration for on such transfer is not taken to be the actual consideration but rather the SDV, and business income is computed accordingly. But if SDV is not greater than 110%, then actual consideration is accepted. Where the SSE claims that the SDV is even more than the FMV, and that is unjustified, and the SDV has not been disputed by him in any appeal or forum, authority or court, then the assessing officer or AO may refer the valuation of the property to the valuation officer. In that case, where the valuation by the valuation officer is even more than SDV, then a benefit is given whereby the valuation of the valuation officer is not considered, but SDV is taken as the value of consideration. But where the valuation by the valuation officer is not more than SDV, that means it is either SDV or less than SDV, then the valuation ascertained by valuation officer is then taken to be the full value of consideration. So SDV is benchmarked against the actual consideration, and stamp duty value will be on the date of transfer, which is the date of registration of the property. But there may be a date of agreement to sell, which may be earlier than the date of registration, and the SDV on the date of agreement and the SDV on the date of registration may not be the same. In that case, the SSE can take the SDV on the date of agreement instead of SDV on the date of registration or transfer, right? But if one condition is satisfied, what is that condition? That the consideration, maybe the whole or a part, should be received by a specified mode on or before the date of agreement. Specified mode is the same that we have looked in the context of disallowance of expenditure more than 10,000 made by non-specified mode. The same specified modes are applicable here as well. There are two important compliance related provisions which we will check. The first is on compulsory maintenance of account and then tax audit. 44AA is the provision covering compulsory maintenance of accounts. The requirement depends on whether the person is carrying on a specified profession or not. What is a specified profession? It covers legal, medical, engineering, architectural, accountancy, technical consultancy, interior decoration, authorized representative, film artist, company secretary, and information technology. If the person is carrying on a specified profession, then we need to determine the total gross receipts in the profession. For what period? All the 3 immediately preceding previous years. If for all these years the gross receipts is more than 1.5 lakh, then rule 6F applies and the person should keep and maintain books and other documents as prescribed in rule 6F. If this condition is not satisfied, then reasonable books of accounts only need to be maintained. That means those books of accounts and other documents as may enable the AO to compute his total income in accordance with the provisions of the Act, reasonable books of accounts. What if the person is not carrying on a specified profession? That means a person is either carrying on a business or a non-specified profession. In this case, we need to check what? We need to check 1. Income from business or profession, and 2. We need to check total sales, turnover or gross receipts in business or profession. When? For what period? In any one of 3 immediately preceding previous years. So if the income from business or profession, is more than 2.5 lakh in any one of these 3 previous years, or if total sales, turnover or gross receipts in business or profession is more than 25 lakh in any one of 3 immediately preceding previous years. If this condition is satisfied, then reasonable books of accounts and documents need to be maintained. If this is not satisfied, then there is no requirement which has been prescribed in respect of maintenance of accounts. Now we need to note that the limit of 2.5 lakh and 25 lakh, they apply to an individual or HUF. For other persons, the corresponding limits are for 2.5 lakh it is 1.2 lakh and for 25 lakh it is 10 lakh. What if the business or profession is newly set up? That means what happens in the first year? In such case, how do we check the 3 immediately preceding previous years? In that case, it should be checked if monetary limits which are given above are likely to exceed during such previous year, that means the current previous year. Now we take a look at the tax audit provisions under section 44AB. This depends on whether the person is carrying on a profession or a business. In case of a profession, we need to check gross receipts. The threshold is 50 lakh. If gross receipts exceeds 50 lakh, then tax audit is required, otherwise tax audit is not required for the previous year. Where the person is carrying on a business, then we need to check whether both these conditions are satisfied. And both these conditions are satisfied. The first condition is, it refers to the amounts received during the previous year. So we need to figure out all the amounts received during the previous years, and they include amounts received for sales, turnover or gross receipts. We aggregate all of that. Then we figure out amounts which are received during the previous year in cash mode. And the amounts received in cash mode should not be more than 5% of the total amounts received. This is condition number 1. Condition number 2, we do the similar exercise for payments. So we determine the payments made during the previous year, and this includes amounts which are incurred for expenditure. And then we determine payments made in cash mode. So payments made in cash mode during the previous year should not be more than 5% of the total payments made. If both conditions 1 plus 2 are satisfied, then the threshold for tax audit is rupees 10 crore. Else, if both the conditions are not satisfied, then the threshold is rupees 1 crore. And this threshold is to be seen in respect of what? Total sales, turnover or gross receipts in business in the previous year. If this exceeds more than 10 crore, where 10 crore threshold applies, then tax audit is required, otherwise it is not required. Where it exceeds rupees 1 crore in the previous year, where threshold of 1 crore applies, then tax audit is required, otherwise it is not required. Now what is the meaning of cash mode? So cash mode is what? It is cash, and it includes check which is not account payee and bank draft which is not account payee. These 3 modes of payments are considered as payments or receipts in cash mode. Once tax audit becomes applicable, then 2 things need to be done in terms of compliance. 1, the person should get his accounts of the previous year audited by an accountant before the specified date. And 2, furnish a tax audit report in the prescribed form by the specified date. So what is the specified date? It is the date which is 1 month prior To what? To the due date for furnishing ROI under section 139(1). For example, if ROI due date is 31st of October, then the due date to furnish tax audit report will be 30th of September. We will now look at the presumptive income provisions for small enterprises. And there are three schemes. 44AD applies to a business, 44ADA applies to a profession, 44AE applies to a goods carriage business specifically. First, we look at the provisions of 44AD. And this applies to an individual, HUF or a partnership firm who is a resident, but LLP or any other person is not covered. The SSE should be engaged in any business, but not under section 44AE because it's a separate scheme. And the total turnover or gross receipts in the previous year should not be more than 2 crore. Further, the SSE should not claim deduction under section 10AA for special economic zones, newly established units, or under chapter VIAC, that means under sections 80HS to 80 RRB, right? If presumptive income is availed 44AD, then these deductions cannot be claimed. If presumptive income provisions are not availed, then these deductions can be claimed. The person should not be carrying on a specified profession under section 44AA, or should be earning commission or brokerage income, or should be carrying on agency business. Section 44AD does not apply to these persons. If the aforesaid eligibility criteria is fulfilled, then we compute deemed profits and gains under section 44AD, and it is A plus B. For this, we determine the turnover or gross receipts in the previous year on account of such business, and we bifurcate into two parts. One, that turnover or gross receipts which is received by specified modes. The specified modes are the same as we have been discussing in this video. So that which is received by a specified mode when? Either during the same previous year or before the due date for furnishing ROI under section 139(1) of that previous year. That turnover or gross receipts, we compute 6% of that, and that is A. For any other turnover or gross receipts, that is the second component. We compute a higher presumptive rate of 8% on that. That becomes B. A plus B is equal to deemed profits and gains of such business taxable under the head PGBP under section 44AD. Since the income is determined at a predetermined rate, deductions under sections 30 to 38, all the specific deductions are deemed to have been already given full effect to. Therefore, no further deduction is specifically allowed. The SSE can claim a sum which is higher than the presumptive income. The SSE can claim a higher sum to have been earned by him. What about books of accounts and tax audit? If the SSE declares profits and gains under 44AD, he is not required to comply with maintenance of books of accounts and documents under section 44AA or tax audit under section 44AB. Can the SSE claim a lower income than that computed under 44AD? Yes. But there is a restriction. If the SSE declares profits for any previous year under 44AD, then he should continue to do so for next 5 previous years as well. So 1 plus 5. So that means there is a lock-in of 6 years, 6 previous years. There is a lock-in under section 44AD of 6 previous years. What if there is a default? That means if he declares profits for any of such 5 previous years, that means within the lock-in period, which is otherwise than under 44AD, that means if he opts out in between, then what will happen? He shall not be eligible to claim 44AD benefit for the next 5 previous years. That means the previous year in which he opts out, that is the first previous year, he doesn't claim 44AD. He will also be moved out forcibly out of 44AD for the next 5 previous years. So for 6 previous years, he will be out of 44AD. And for these subsequent 5 years for which he is moved out of 44AD, 2 implications will arise. And this depends on the level of total income. If the total income is more than the basic exemption limit, then the 2 implications that will arise is he will need to comply with 44AA and 44AB. But if total income is not more than basic exemption limit, then these requirements will not be there. So this is about 44AD. Now we come to 44ADA, which deals with a case of profession. And this applies to whom? This applies to an individual or a partnership firm who is a resident. So it doesn't apply to an LLP, an HUF, or any other person. The condition is that the assessee should be engaged in a profession, but not all, in a specified profession which we have discussed in 44AA. And the total gross receipts in the previous year should not be more than 50 lakh. If this is satisfied, then 44ADA can be availed, and deemed profits and gains of such profession will be equal to 50% of the total gross receipts of in the previous year on account of such profession. Like 44AD, no specific deduction will be allowed. Like 44AD, a higher sum than 44ADA can be claimed to have been earned. Like 44AD, 44AA and 44AB will not apply. Can the assessee claim a lower income? Now there is a difference. As against 44AD, assessee can claim lower profits and gains in any previous year, so the lock-in concept of 6 years doesn't apply here. But the same implications arise which were there for 44AD in the year when the assessee wants to move out. The same implications as we had discussed for 44AD, they apply. Now we come to 44AE. And this applies to all the persons. And the condition is that the assessee should be engaged in the business of what? Plying, hiring or leasing of goods carriages. And should not own, so ownership is important, should not own more than 10 goods carriages when? At any time during the previous year. If this condition is fulfilled, then deemed profits and gains can be computed under 44AE. And how do we calculate? This is the formula. And this calculation is to be done for each goods carriage which is owned by the assessee in the previous year. The formula depends on whether the goods carriage is a heavy goods vehicle or other vehicle. What is a heavy goods vehicle? Heavy goods vehicle means any goods carriage whose gross vehicle weight is greater than 12,000 kg, which means greater than 12 ton. So for a heavy goods vehicle, the formula is rupees 1,000 into gross vehicle weight or unladen weight, as the case may be, in ton, further multiplied by months or part of a month during which the vehicle is owned by the assessee in the previous year. So put to use condition is not relevant. The calculation is done based on the months of ownership, even for a part of a month. For vehicle which is not, for a goods carriage which is not a heavy goods vehicle, the formula is what? 7,500 multiplied by months or part of month of ownership by the assessee during the previous year. Similar to 44AD and 44ADA, no specific deductions are supposed to be allowed, but there is an exception. Where the assessee is a firm, then salary and interest to partners is also deductible from 44AE computed income, which is subject to limit under section 40B that we have discussed some time back. This exception is not available under 44AD and 44ADA. A higher income can be claimed to have been earned for each vehicle. Like 44AD and 44ADA, 44AA, tax audit, 44AB and books of accounts 44AA are not applicable. What about claim of lower income? An assessee can claim lower profits and gains than 44AE in any previous year, but these two things need to be complied with, which is 44AA and 44AB. So this brings us to the end of the topic on PGBP. We now proceed to capital gains. First, we look at the chargeability. What is charged to tax under the head capital gain? Covered by section 45(1). So any profits or gains from what? From the transfer of what? Of a capital asset. Transfer made when? Which is affected in the previous year, is taxable under the head capital gain unless exempted under section 54 to 54H. And this capital gain is deemed to be the income of which previous year in which the transfer took place. So capital gain is taxable in the year in which the transfer of capital asset took place. What is the meaning of capital asset? Relevant section is section 214. Let's look at this chart. Property A, B and C are capital asset and therefore their transfer is liable to tax under the head capital gain. A. Property of any kind, so the scope is very wide, which is held by the SSE whether or not connected with his business or profession. But this excludes the following: 1, 2, 3, 4, and therefore transfer of these properties is not taxable as capital gain. 1. Stock in trade, consumable stores or raw materials held for the purposes of business or profession. Transfer is not taxable as capital gain. Number 2. Personal effects. Personal effects. What is a personal effect? Movable property, not immovable. Movable property, but it includes wearing apparel and furniture, which should be held for what purpose? For personal use. By whom? By not only the SSE but also any member of his family, provided such member is dependent on the SSE. But we need to note that personal effects excludes the following items, and therefore these are capital asset and their transfer is taxable as capital gain. And what are these items? Jewelry, archaeological collections, drawings, paintings, sculpture, or any work of art. And jewelry includes ornaments made of gold, silver, platinum, or any other precious metal, as well as precious or semi-precious stones. So this is the acronym DAPSAJ, DAPSAJ within bracket OS, which you can use if you want for quick learning. Now, third item, which is not a capital asset, is rural agricultural land in India. So land which is agricultural, which is in India and which is in a rural area, transfer thereof is not taxable as capital gain. Fourth, gold deposit bonds issued under the Gold Deposit Scheme 1999 or deposit certificates issued under Gold Monetization Scheme 2015 is also not a capital asset. Now B, any securities held by a foreign institutional investor is a capital asset and transfer thereof is taxable as capital gain. C, ULIP, unit linked insurance plan, which is not exempt, that means it is taxable, not exempt under section 1010D. On what account? On account of it being a high premium ULIP is a capital asset and therefore capital gains applies. Now this is something which is outside the scope of CA intermediate syllabus, so we will not discuss the tax implications in case of a ULIP, but this is what you need to know, that it is a capital asset. So as we noted above, rural agricultural land in India is not a capital asset and transfer thereof is not taxable as capital gain. And what does this mean? This means agricultural land which is in India and which is situated outside urban area. Outside urban area means it is situated in a rural area. So the question is, what do we mean by urban area? It depends on the population of area. If the population is less than 10,000, then the area is not an urban area. If the population is 10,000, urban area means the area within the jurisdiction of municipality or cantonment board, MCB. Where the population is greater than 10,000 and up to 1 lakh, it means area within the jurisdiction of MCB plus up to 2 kilometers from the local limits of MCB measured aerially. Where population is greater than 1 lakh and up to 10 lakh, this 2 kilometers becomes 6 kilometers. Where the population is greater than 10 lakh, the 6 kilometers is further increased to 8 kilometers. So this is the meaning of urban area, and consequently we can determine whether the land is in a rural area, and if the land is a rural agricultural land in India, then transfer thereof does not give rise to capital gain. So transfer of a capital asset is taxable as capital gain. So what all is included within the meaning of transfer? Section 247. There are 7 items to note. 1. Sale of capital asset, exchange of capital asset or relinquishment of capital asset. 2nd, extinguishment of any rights in the capital asset. 3. Compulsory acquisition of capital asset under any law, and this is covered specially by section 45(5), which we will see in some time. 4th, conversion or treatment of capital asset as what? As a stock in trade of a business, and section 45(2) is relevant, which we will look at in some time. Maturity or redemption of a zero coupon bond is a transfer and therefore capital gains arise. 6th, transaction allowing possession of immovable property in part performance of a contract, which is referred to under section 53A of the Transfer of Property Act, is also covered within the scope of the term transfer. 7th, transaction which has the effect of transferring or enabling enjoyment of immovable property. and it can be by way of becoming member or acquiring shares in a cooperative society, company or other AOP, or in any other manner. Types of capital asset and types of capital gain. So what we need to see is whether the capital asset is held by the SSE for more than the specified period immediately preceding what? The date of its transfer. A specified period is basically the cutoff in terms of the period of holding, and this is something that you can see in this table. So if the period of holding is more than this cutoff period, then the capital asset is classified as a long-term capital asset and transfer thereof gives rise to long-term capital gain. Else, the capital asset is a short-term capital asset, transfer thereof gives rise to short-term capital gain. So what is the cutoff of the period of holding? And this is what is given in this table. So 1. Share of a company, and it can be equity shares or preference shares. Shares of a company depends on whether the share is listed in a recognized stock exchange in India. In that case, it is 12 months. If it is not listed in a recognized stock exchange in India, it is 24 months. For example, shares of a private limited company, which is an Indian company, or shares of a listed company, which is a foreign company. 24 months will be the period of holding cutoff. Second, in the case of unit, if the unit is of the Unit Trust of India, 12 months. Unit of an equity oriented fund, 12 months. Unit of a debt oriented fund, 36 months. Debt oriented fund is a fund which is not a unit, which is not a equity oriented fund. Third, zero coupon bond cutoff period of holding is 12 months. As far as other securities are concerned, that means not referred above in 1, 2 or 3, not share or unit or zero coupon bond. And what is the meaning of security? It includes shares, bonds, debentures, derivatives, government securities, rights or interest in securities, etc. So for example, this category 4 will include, say, debentures. So if these other securities are listed in a recognized stock exchange in India, then it is 12 months. Else, that means where it is not listed in a recognized stock exchange in India, it is 36 months. In the case of land or building or both, immovable property, it is 24 months, and in any other case of capital asset, it is 36 months, for example, in case of jewelry. Now we look at the mode of computation of capital gain. What is the formula? Relevant section is section 48. And the gain can either be short-term capital gain or long-term capital gain. We first figure out the full value of consideration. We deduct expenditure incurred wholly and exclusively in connection with the transfer. This gives us the amount of the net consideration. From that, we deduct cost of acquisition and cost of improvement. But in case of long-term capital gain, instead we deduct index cost of improvement, index cost of acquisition and index cost of improvement. From the balance, we reduce the exemption under section 54 to 50H, if any, and consequently we get the amount of short-term capital gain or long-term capital gain, which is chargeable to tax. What is the meaning of full value of consideration? How do we determine this? So there are 3 cases which we need to note. Where the consideration is in money, then full value of consideration or FVC is equal to the value of money. In the case of exchange, FVC is what? It is the fair market value of asset which is received on the date of transfer. So fair market value on the date of transfer of the asset which is received. Where the consideration is not ascertainable or it cannot be determined, then FPC is equal to fair market value of the asset on the date of transfer. But of which asset? Not the asset received, but of the asset transferred. This is by virtue of section 50T. How do we determine cost of acquisition? It depends on where the capital asset became the property of the SSE on or after 1st April 2001 or before 1st April 2001. 1st April 2001 is the cutoff date for this purpose. Where the capital asset became the property of the SSE on or after 1st April 2001, then cost of acquisition is the actual cost of acquisition. But where it became the property before 1st April 2001, then cost of acquisition is what? It is the higher of cost of acquisition, or B, fair market value of the asset as on 1st April 2001. But in this case, if the capital asset is a land or building, The fair market value as on this date cannot exceed the stamp duty value as on this date, wherever it is available, right? So where the property is acquired before 1st April 2001, there is an option to take the fair market value as on 1st April 2001 as the cost of acquisition, where it is higher than the actual cost. Cost of improvement. What is the meaning of cost of improvement? It means expenditure, all expenditure of what? Of capital nature, not of revenue nature, which is incurred in making any additions or alterations to the capital asset by the SSE. But it does not include two items. One, expenditure which is incurred before 1st April 2001, it does not form part of COI. Okay. Second, expenditure which is deductible in computing income under any other head. That means either under the head IHP or PGBP or IFOS, it is not deductible as cost of improvement because it has already been deducted under a different head. Now, in the case of long-term capital gain, instead of COA and COI, we take indexed COA and COI, cost of acquisition and cost of improvement. And how do we compute this? Index cost of acquisition is cost of acquisition multiplied by cost inflation index or CII for the year in which asset is transferred, divided by what? CII for the first year in which the asset was held by the SSE, or 2001, 2002, whichever is later. So in effect, this means that if the asset is acquired before 1st April 2001 that we saw earlier while seeing the formula for computing cost of acquisition, then in that case, the cost inflation index can be taken for 2001, 2002. Else, the cost inflation index for the year in which the asset was acquired, or that means in the year or the first year in which the asset was held by the SSE, is to be taken. Index cost of improvement. Cost of improvement into CII for the year in which the asset is transferred, divided by CII for the year in which improvement to the asset took place. This 2001, 2002 is not relevant here because the expenditure incurred before 1st April 2001 is not included as part of cost of improvement. Now, cost inflation index for 2001-2, which is the base year, is 100, and for 2022-23, which is the current previous year, in our case, which is relevant to us, is 331. This is what you can remember. Now, benefit of indexation is not available in the following cases. So even if the gain is long-term capital gain, you should not provide for indexation. You should not index the cost. 1. Asset forming part of block of assets for purposes of depreciation. Section 50 applies for computing. We will look at this in some time. In debentures. 3. Bonds, except sovereign gold bonds or capital index bonds. Indexation is not available in the case of slum sale and in the case of computing long-term capital gain under section 112A. That is, in the case of equity shares or units of equity-oriented fund on which STT is paid, on which a concessional tax rate of 10% applies. Indexation is not available. What do we do where advance money is received? What are the tax implications? This covers a situation where the SSE was negotiating the transfer of a capital asset and he received any advance or other money on this account. But the negotiation did not result in the transfer of the capital asset, and therefore, in terms of the agreement, the SSE retained or forfeited some amount. Now, what is the tax treatment of such amount which is retained or forfeited? It depends on the date. Where the sum is retained or forfeited on or after 1st April 2014, then it is not taxable as capital gain, but the sum is taxable under the head IFOS. But where the sum is retained or forfeited before 1st April 2014, then capital gain becomes relevant. And in that case, the sum is not directly taxable as capital gain, but is indirectly taxable as capital gain. How? The sum is deducted in computing the cost of acquisition. Sum is deducted from what? Sum is deducted either from the cost for which the asset was acquired, where we pick up the cost of acquisition, or from the written down value, where we compute the capital gain under section 50 on account of depreciable assets forming part of block of assets, or from the fair market value. This is the case where we take FMV as on 1st April 2001 as the cost. So the sum is deducted from either of these cases in computing the cost of acquisition. Now, consequently, when is this sum brought to charge? This sum is then ultimately brought to charge when capital gains arise. And capital gains arise when the capital asset is eventually transferred. Not when the sum is retained or forfeited, but when the capital asset is eventually transferred. What we need to note is only the sum forfeited by the SSE is deducted under section 51. That means under section 51. The sum which is forfeited by the previous owner is not deducted. So where we are taking the cost of acquisition of the previous owner in computing capital gain and the previous owner had forfeited such sum, it is not deducted. If the SSE had retained or forfeited the sum, it is deducted from cost of acquisition. So now we come to the concept of previous owner, and the relevant section which deals with this concept is section 49.1. In certain cases, the cost is determined with reference to the previous owner, not with reference to the SSE. And this covers 7 situations. 7 situations where the capital asset became the property of the SSE. So where the SSE acquires the capital asset either by way of distribution of assets on partition of a HUF, or by way of a gift, or will, or succession, inheritance, or devolution, or by way of transfer to an irrevocable trust, or transfer by a holding company to its wholly owned subsidiary or vice versa, provided the transferee is an Indian company, or transfer in the case of amalgamation or demerger by the amalgamating or demerged company to the amalgamated or resulting company, provided the transferee is an Indian company. In such case, the previous owner is not liable to capital gain on the transfer of the capital asset to the SSE. But now when the SSE who is receiving the capital asset from the previous owner subsequently transfers the capital asset, capital gains arises in the hands of the SSE. And then how do we determine cost of acquisition? Cost of acquisition is the cost for which the previous owner acquired the property. The period of holding includes the period of holding of the previous owner. Consequently, indexation for computing cost of acquisition runs from the year of acquisition by the previous owner, and substitution of fair market value as on 1st April 2001 is also available. In effect, the computation is made with reference to the previous owner, not the SSE. What about cost of improvement? It includes cost of improvement incurred or borne not only by the SSE but also the previous owner. So what is meant by previous owner? Who is the previous owner? So previous owner means the last previous owner who acquired the capital asset by a mode other than that referred above. So A gives the capital asset to B gives the capital asset to C, and C gives the capital asset to D. Now when D transfers it, D will be taxable as capital gain, and A will be the last previous owner who acquired it by a mode other than that referred above. For example, if A purchased the capital asset, so A will become the previous owner in this case. Now there can be a situation where cost is not ascertainable for the previous owner. Then what do? Then we take the fair market value as the cost of acquisition of the previous owner. Fair market value on which date? On the date on which capital asset became his property of the previous owner. Special provisions apply in the case of depreciable assets, and the relevant section is section 50. So as we noted above, how do we compute capital gain? This is the basic formula. This is the basic formula that we noted for short-term capital gain and long-term capital gain. But there is a slight modification in this formula. When the capital asset is an asset forming part of a block of assets in respect of which depreciation has been allowed. In such case, we need to follow 3 steps. Step 1. We first determine the written down value of the block of assets as on 31st March of the previous year. And this is what we calculate for the purpose of granting depreciation. We have referred this in the topic in PGBP. If you recollect, we first figure out the opening WDV for the previous year. We add the actual cost of assets acquired during the previous year, and we deduct the monies payable in respect of assets disposed of during the previous year, and this gives us the WDV for the purposes of depreciation. Next, in step 2, we determine whether depreciation is allowable or capital gains arise. Now what we need to note is depreciation is allowable only where the block of assets exists and the WDV is not nil. So if the WDV is nil, depreciation cannot be allowed. If the block of assets also doesn't exist because all the assets have been disposed of, then also depreciation is not allowable. So where depreciation is allowable, we allow depreciation, capital gains does not arise. But where depreciation is not allowable, then capital gains arise, in which case the capital gain needs to be computed as follows as per step 3. So the formula that we looked above for computing capital gain is slightly modified. Full value of consideration less expenditure, this gives us the net consideration. This remains the same as per the normal method of computing capital gain. But then in the normal method, what we deduct further is the cost of acquisition and the cost of improvement. Now this gets modified. In this particular case, in that place, we deduct what? We deduct a written down value of the block of assets as on 1st April of the previous year. That means the opening WDV of the previous year and the actual cost of assets falling within this block of assets which are acquired during the previous year. These two items is what we deduct, and then we arrive at the amount of capital gain, which is classified as short-term capital gain. So when we apply section 50, we need to note three things. One, option to substitute FMB on 1st April 2011 is not available. Indexation is not allowed. And capital gain is treated as short-term capital gain. Long-term capital gains does not arise in this case. Now, as we know, capital gain is taxable in the year of transfer of capital asset. But there are certain special provisions which create an exception. We will look at these exceptions. That is, capital gain is taxable other than in the year of transfer. Insurance compensation, section 45(1)(a). This covers a case where there is damage or destruction to a capital asset and the SSE receives insurance compensation. The damage or destruction is due to these four categories of specified events. 1. Flood, typhoon, hurricane, cyclone, earthquake or other convulsion of nature, or B, or 2. Riot or civil disturbance, or 3. Accidental fire or explosion, or 4. Action by an enemy or action taken in combating an enemy, whether with or without a declaration of war. In these situations, if insurance compensation is received for damage or destruction of capital asset, then capital gain is computed as follows. So capital gain is taxable in the year in which insurance compensation is received, not in the year of transfer. What is the year of transfer in this case? The year of damage or destruction of capital asset. But capital gain gets taxable in the year in which insurance compensation is received. Full value of consideration is what? It is the amount of insurance compensation. It is the value of any money received from the insurance company, or if assets have been received, then the fair market value of those assets on the date of receipt. We deduct expenditure as far as cost of acquisition and cost of improvement is concerned. The period of holding. The period of holding, it runs till the date of what? Transfer of the capital asset, which is what? Damage or destruction. And as far as indexation is concerned, the year of transfer of capital asset is the year of damage or destruction. So period of holding and indexation is determined with reference to the year of transfer of capital asset, damage or destruction, but it is taxable in the year in which compensation is received. Now, where it is a case of the capital asset forming part of block of assets for depreciation purposes, we have noted that section 50 applies, and then short-term capital gain arises and the computation is made accordingly. So the computation is made as we discussed some time back, and in this particular case, for the full value of consideration is what? The amount of insurance compensation. Rest of the things remain the same. Now there can be situations of conversion of capital asset into stock and trade or vice versa. So we'll look at these provisions now. First, we look at conversion of capital asset into stock and trade, and the relevant section is 45(2). There are two events which occur. First, the owner of the capital asset, that is the SSE, converts the capital asset into stock and trade of a business carried on by him, or treats the capital asset as a stock and trade, right? So transfer arises on account of such conversion. So when does the transfer takes place? In the year in which the capital asset is converted or treated as stock and trade. So year of conversion is the year of transfer, but capital gain is not taxable in the year of conversion. Rather, it is taxable in the year in which the stock in trade is ultimately sold or transferred. So the taxation is deferred. Now, when the stock in trade is sold or transferred, the capital gain is taxable. And how do we compute? Full value of consideration is taken to be the fair market value of the asset on the date of conversion. And for computing the cost of acquisition and cost of improvement, as far as period of holding is concerned, it runs till the date of conversion. It runs till the date of conversion, and indexation runs till the year of conversion. Why? Because this is the date of transfer. Conversion is the date of transfer. So the POH and the indexation run till the date or the year of conversion. So this is how we compute capital gain in event 1, that is on account of conversion. In event 2, the stock in trade will be ultimately be sold or will be transferred. In which case, what will happen? Since it is a stock in trade, business income will arise. And business income will be taxable when? In the previous year in which stock in trade is sold. So ultimately, both capital gain and business income become taxable when? In the previous year of sale. And when we compute business income, the full value of consideration is the actual consideration. And what is the cost in turn? The cost is the fair market value of the asset on the date of conversion. This is what is taken as the fair market value. So the full value of consideration taken for computing capital gain becomes the cost for computing the business income. So ultimately, capital gain and business income, they arise. And they are brought to charge to tax accordingly. Next, we look at a situation where there is conversion of inventory or stock in trade into capital asset. And this is something that we have already discussed while we were picking up the topic of PGBP. And here also two events occur. First, the inventory is converted into the capital asset, in which case business income arises. When is it taxable? It is taxable in the year of conversion. And what is the amount of business income? It is the fair market value of the inventory on what date? On the date of such conversion. Now in event 2, this inventory which is converted into capital asset, the capital asset then is transferred. It is transferred. So when will the capital gain be taxable? It will be taxable in the previous year of such transfer of capital asset. And for this purpose, how do we determine the cost of acquisition? So we take this FMV. We take this FMV that was taken as business income earlier, that becomes a cost of acquisition for the purpose of computing capital gain. And what about period of holding and the indexation? It runs from the date of conversion. So period of holding runs from the date of conversion because this becomes the date of acquisition of the capital asset. And consequently, indexation also runs from the year of conversion, and accordingly we determine the amount of capital gain. Special provision is made under section 45(5) where there is compulsory acquisition of a capital asset. This provision covers two cases. One basically where there is compulsory acquisition of a capital asset and therefore there is a transfer. This also covers a case where the consideration is determined or approved by the central government or RBI. So these two cases are covered. And how do we compute the amount of capital gain? Now there are two components. First is the initial compensation or consideration. This is what is determined or approved in the first instance. And the other component is the enhanced compensation or consideration. The compensation or consideration may be further enhanced by any court, tribunal or other authority, and that is called enhanced compensation. So first we look at the taxability of initial compensation. Now, when does the transfer take place? What is the previous year of transfer? It is the year of compulsory acquisition. But when is capital gains taxable? It is not taxable in the year of transfer. It is taxable in the year in which such initial compensation or consideration is first received. Maybe the whole of such amount or even a part. So whenever the whole or the part is first received, that becomes a year in which capital gain is transferred, although the transfer took place in the year of compulsory acquisition. Full value of consideration is the initial compensation that is received. Now, as far as period of holding and indexation is concerned, It is determined in the context of what? In the context of the transfer of capital asset, which is what? Which is compulsory acquisition. So period of holding runs till the date of compulsory acquisition. Similarly, indexation runs till the year of compulsory acquisition. Now, what about enhanced compensation, which is the second component? If an enhanced compensation is received, it is taxable in the year of receipt. In the year of receipt, and the full value of consideration becomes the amount of enhanced compensation. And what is the cost of acquisition and improvement? It is nil. Why it is nil? Because this has already been taken at the time of determining capital gain in the context of initial compensation. So now it becomes nil. So the entire enhanced compensation becomes taxable as capital gain. Now, what is the nature of capital gain in respect of enhanced compensation? So it is actually the same as that for initial compensation. So if this is LTCG, this is also LTCG. If this is STCG, this is also STCG. If litigation expenses have been incurred in this connection, then those can be deducted as expenditure incurred in connection with the transfer and computing capital gain. Now, sometimes the compensation is received pursuant to an interim order. Now, the court proceedings are going on and an interim order may be passed, and on account of which the compensation may be received, but taxation doesn't happen until the order attains finality. So, such amount which is received pursuant to an interim order is taxable only in the previous year in which the final order is made, not in the previous year in which interim order is made. What about interest? Interest may be also generally received on account of delayed receipt of compensation. The point to note is it is not taxable under the head capital gain, rather it is taxable under the head IFOS. But when? In the previous year in which it is received. So it is taxable on receipt basis, not on due basis. And it is received after giving a flat deduction of 50%. So no other expenses on account of earning of that interest is supposed to be deducted. There is a special provision made in case of transfer pursuant to a joint development agreement or JDA. This is section 45(5)(a). Now this covers a transfer made by an individual or HUF, any other person is not covered, of a capital asset in the form of land or building or both. So any other capital asset is not covered under a specified agreement. And what is a specified agreement? It is a registered agreement in which the owner, that means the individual or HUF, agrees to allow another person to develop a real estate project on such land or building. So this person will be, say, a real estate developer. So the owner, individual or HUF, allows the real estate developer to develop a real estate project on his land or building in consideration, which is what? In turn, the individual or HUF would get a share in the project, and the share would be in the form of what? Land, building in such project, or maybe cash as well. In such case, how do we compute capital gain? So two events will occur. The first event will be where the individual or HUF or the SSE transfers the land or building or both under the specified agreement to the real estate developer. Okay, and then the individual or HUF would get his consideration as share in the project. In event 2, the individual or HUF or the SSE will then transfer or sell his share in the project. So these will be the two events. So we pick up the first event first, where the SSE transfers the land or building under the specified agreement to the real estate developer for developing a real estate project. In which case, what is the previous year of transfer of capital asset? The previous year of transfer is the year in which possession is handed over to the developer. Why? Because as we noted at the beginning of this video, the definition of transfer includes allowing possession of an immovable property in part performance of a contract referred under section 53A of the Transfer of Property Act. This is covered here. So when the possession is handed, that becomes the year of transfer. But capital gain is not taxable in this year. It is deferred. Till when? Capital gain is taxable in the previous year in which certificate of completion for the project is issued by the competent authority. COC for either the whole of the project or even a part of the project. That is the year in which capital gain becomes taxable. Now, what will be the full value of consideration? Full value of consideration will be the value of the share which the individual HUF receives. And what is that value? Stamp duty value of the share, that is land or building. On what date? On the date of issue of COC. Plus cash, if any, that will be added. As far as period of holding and indexation is concerned, that will be determined in the context of the date of transfer of the capital asset, which is what? As we noted above, the date of handing over of the possession. So period of holding runs till the date of handing over of possession, and indexation till the year of handing over of possession to the developer, and accordingly we determine the amount of capital gain. Now subsequently, capital gain will again arise when such individual or HUF transfers or say sells his share in the project which he had received earlier. In that case, capital gain becomes taxable in the year of transfer. In the year of transfer, full value of consideration is the actual amount of consideration. But what is the cost? What is the cost that is taken? It is taken to be the full value of consideration taken earlier under section 45(5)(a). So what was taken as FVC earlier now becomes the cost, and accordingly capital gain is computed. We now look at certain special provisions to prevent tax avoidance. First, we look at section 50C. This is a special provision made to determine the full value of consideration for transfer of land or building. So it covers a situation where there is a transfer of land or building, not of any other capital asset. If the land or building is transferred not as a capital asset but say as a stock in trade, then PGBP applies and the corresponding provision is 43CA, which we have already discussed in the topic of PGBP. But if it is a capital asset, then section 50C applies and capital gains is relevant. Now we determine the full value of consideration for computing capital gain under section 50C. For this purpose, we benchmark the stamp duty value. Against the actual consideration. If the SDV is greater than 110% of the consideration, then SDV is taken as the full value of consideration for computing capital gain. If it is not the case, then actual consideration is accepted as the full value of consideration. Now, where SDV is taken to be the full value of consideration, then sometimes the SSC may claim that, look, the SDV is even greater than the fair market value, which is not justified. So in such case, if the SSC has not disputed the SDV in any court or forum, etc., then in that case, the AO may refer the valuation of the property to the valuation officer. Now, the valuation officer will determine the value of the property. Now, where it is even more than the SDV, then a benefit is provided whereby the full value of consideration is restricted to such SDV. But where if the valuation by the valuation officer is not more than the SDV, then the valuation officer's valuation is accepted as the full value of consideration. So when SDV is taken, SDV refers to what? SDV is the SDV on the date of transfer, which is the date of registration. But there may be a date of agreement as well for the transfer. And the SDV on the date of agreement and SDV on the date of registration may not be the same. So if the SDV on the date of agreement is lower, then it will be beneficial for the SSC to pick up this SDV. So is this allowed? Yes, it is allowed, but there is a condition. So the provisions provide that SDV on the date of agreement may be taken instead of SDV on the date of registration if the consideration, the whole or even a part of it, is received by a specified mode on or before the date of agreement. If consideration or a part is received by a specified mode, then this SDV can be taken instead of this. What is the meaning of specified mode? It is the same as we have been discussing in the video in the context of various provisions under PGBP. So 50C applies for land or building, but there is another provision 50CA which applies in the case of unquoted shares. What is unquoted share? Unquoted share is a share which is not quoted on any recognized stock exchange. For example, share of a private limited company. In that case, if there is transfer, when we determine the full value of consideration, what we do is we benchmark the actual consideration with the fair market value on the date of transfer. If the consideration is less than the fair market value, then we take fair market value as the full value of consideration, else we accept the actual consideration. Right? So section 50CA does not apply to what? If there is a transfer of quoted share, that means a listed share, section 50CA doesn't apply. Or even if it is a transfer of unquoted securities but not being shares, 50CA doesn't apply, because 50CA applies only to unquoted shares. Cutoff of period of holding for computing long-term capital gain for unquoted shares is what? It is 24 months. This is what we need to keep in mind. We will now look at the provisions governing financial assets. So first we look at bonus or right shares or securities. In case of original share, the cost of acquisition is the amount actually paid for acquiring the share. Substitution of FMV on 1st April 2001 is allowed, and period of holding is reckoned from the date of allotment, which is what? Which is the date when the SSE acquired the share. In the case of bonus shares, there is no cost paid, so cost of acquisition is nil, but still substitution of FMV on 1st April 2001 is available, and the period of holding runs from the date of allotment, which is what? Which is the date when the bonus shares were acquired. In the case of right shares, now the SSE first receives or acquires the rights entitlement from the company, and then using that rights entitlement, the right shares are subscribed by the SSE. Now, where the right shares are subscribed by the SSE, what will be the cost? The cost will be the amount actually paid for acquiring the share, the right share. Substitution of FMV on 1st April 2001 is available, and period of holding runs from the date of allotment. Now, in a situation where the SSE doesn't subscribe to the right shares using the rights entitlement, rather he renounces the rights entitlement in favor of some other person, that is, he sells those rights entitlement, then what will be the cost? The cost will be nil, because nothing was paid by the SSE to the company, and therefore substitution of FMV on 1st April 2001 is not applicable. From when will the period of holding be computed? From the date of offer of such right by the company. What will be the treatment in the hands of the person who acquires the rights entitlement from the SSE? What will be the tax treatment in the hands of such person? So what is the amount that such person will pay for acquiring the right shares? First, he will pay the purchase price to the SSE for acquiring such rights entitlement, right? And then he will also pay the amount to the company for acquiring the right share. So both will need to be aggregated. That will become the cost of acquisition. Substitution of FMV on 1st April 2001 will be available, and the period of holding will run from the date of allotment. Preference shares. There may be a situation where the preference shares is, say, converted into equity shares. So this conversion is a transfer, but this transfer is exempt from capital gain. It is not treated as a transfer specifically under section 47. So this conversion is not liable to capital gain. Now what happens when these equity shares are subsequently sold or transferred? Capital gains will arise. Now what about cost of acquisition, period of holding, and indexation? These will be determined not with reference to equity shares but with reference to the original preference shares. What happens when there is buyback of shares or other specified securities by a company? Now there could be buyback of shares from a shareholder or buyback of other specified securities. In the case of buyback of shares, it could be either by a domestic company or by a foreign company. Where there is buyback of shares from a shareholder by a domestic company, the shareholder is exempt under section 1034A on account of income arising from such buyback. So who pays the tax? The company pays the tax. It is called buyback tax or additional income tax under section 115 QA. What is the amount of buyback tax? 20% of distributed income. We had 12% surcharge and 4% HEC on tax plus surcharge. What is distributed income? It is consideration that is paid by the company at the time of buyback of shares minus what? Minus the amount that was received by the company when it issued such shares. In other cases, that means when there is buyback of shares from a shareholder by a foreign company, or when there is buyback of other specified securities, the shareholder is not exempt. Consequently, the company is not liable to pay buyback tax. So capital gains becomes taxable in the hands of the shareholder under section 46A. And how is that computed? So full value of consideration received minus the cost of acquisition. When is it taxable? In the year of buyback. Is indexation available? Yes, indexation is available. Sometimes there are cases when the share capital, when the shares of a company undergo consolidation and division into shares of larger amount, when the shares are converted into the stock, when there is reconversion of any stock into shares, when the shares are subdivided into shares of smaller amount, or when one kind of shares are converted into another kind. Say preference shares are converted into equity shares, or say shares of rupees 10 are split into 2 shares of rupees 5 each. In such case, when these are sold, then the cost of acquisition is determined with reference to the original asset. What about employee stock option plan or ESOP? So, two events occur. When the specified security or sweat equity share is allotted or transferred by the employer to the employee, what happens? Taxable perquisite arises. We have discussed this in the topic on salaries. What is the previous year in which taxable perquisite arise? In the year in which a specified security or set equity shares are allotted or transferred by the employer to the employee. And what is the value of taxable perquisite? It is the fair market value of such security or share on the date on which the option is exercised by the SSE. We reduce the amount which is actually paid by or recovered from the SSE. Subsequently, such specified security or set equity shares may be transferred, say sold by the SSE. In that case, capital gain arise. When is it taxable? In the year of transfer of such specified security or sweat equity share, right? For this purpose, what is the cost of acquisition and or index cost of acquisition? So what is the cost that is taken into account? It is the fair market value which has been taken into account while determining the value of taxable perquisite. That is now taken to be the cost. What about period of holding? It runs from the date of acquisition of the capital asset, which will be what? Which will be the date of allotment or transfer by the employer of the security or shares. Debentures. So as we know, debentures are securities. So what is the cutoff period holding for determining short-term or long-term capital gain? It is 12 months for listed debentures and 36 months for unlisted debentures. We also noted some time back that indexation is not available in the case of debentures. Now debentures of a company may be converted into shares of that company. Debentures are converted into shares. In such case, such conversion is a transfer, but it is not liable to capital gain. It is not treated as transfer by virtue of section 47. Now, what happens if these shares are subsequently sold and capital gain arises? How do we compute the cost of acquisition, period of holding, and indexation? These are determined with reference to the original debentures. What about bonds? Bonds are also securities. Thus, the cutoff period holding for short-term or long-term capital gain is 12 months for listed bonds and 36 months for unlisted bonds. As we noted some time back, indexation is not available in the case of bonds, but it is available for sovereign gold bonds or capital index bonds. Now, just like debentures, bonds may be also converted into shares. In that case, such conversion is not liable to capital gain, but when such shares are subsequently sold, the cost of acquisition, period of holding, and indexation are determined with reference to the original bonds. What we discussed above were the general provisions in respect of bonds. Now, special considerations for zero coupon bond apply. And what is that? we have already noted some time back that maturity or redemption of zero coupon bond is treated as transfer and therefore it is taxable as capital gain. And the cutoff period of holding for a zero coupon bond is 12 months. So if it is more than 12 months, long-term capital gain apply. There are special provisions in respect of intangible assets. And there are 8 kinds of capital assets which you can see here. Goodwill of a business, right to manufacture, produce or process any article or thing, right to carry on any business or profession, goodwill of a profession. So goodwill of a business is in 1 and goodwill of a profession is in 4. Trademark or brand name associated with a business or profession, tenancy rights, stage carriage permits and loom hours. And the acronym which you can use for quick learning is GRRTTSL. What is the cost of acquisition that we should take? If the asset was purchased, then it is the purchase price. It is the purchase price in all the cases. If it was acquired from the previous owner, then it will be the purchase price of the previous owner. But in any other case, that means if it is self-generated, then since there is no cost, the cost of acquisition will be nil. The cost of acquisition will be nil. As far as substitution of FMV on 1st April 2001 is concerned, it is not allowed. It is not allowed. As far as cost of improvement is concerned, it is also taken to be nil. But it is the actual cost of improvement in cases 4 to 8. That means for cases 1, 2 and 3, the cost of improvement is nil. Expenditure on transfer is taken as the actual expenditure. So for items 1 to 8, the provisions are the same except for cost of improvement, which is taken to be nil in the case of items 1, 2 and 3, while it is taken to be actual cost of improvement for items 4 to 8. What about any other intangible asset which is not listed above? In that case, we should note that capital gain is not chargeable if such capital asset, intangible asset is self-generated, because in that case, the cost of acquisition cannot be determined, so the computation provision fails. Now we turn to business reorganization and we look at amalgamation and demerger in brief. First, we look at the case of amalgamation. Now, there can be certain events which will take place. The first event will be where there is amalgamation, there will be transfer of a capital asset by the amalgamating company to the amalgamated company. So by the amalgamating company to the amalgamated company. Now this transfer is exempt from capital gain. Capital gain does not arise. Okay. When amalgamated company subsequently transfers the capital asset, then capital gain arises in the hands of the amalgamated company. And what about then cost of acquisition, period of holding and indexation? These are determined with reference to the previous owner, that is the amalgamating company. And accordingly, we determine the amount of capital gain. What about the shareholder? Shareholder will also face 2 events. The first event will be at the time of amalgamation, when there will be transfer by the shareholder of shares in amalgamating company against allotment of shares in amalgamated company. So the shareholder will get shares in the amalgamated company and he will transfer what? He will transfer the shares which he holds in the amalgamating company. So this transfer is not liable to capital gain. Capital gain doesn't arise. But what happens when the shareholder subsequently transfers or sells the shares in the amalgamated company? Then the cost of acquisition, period of holding, indexation is determined with reference to the shares that he held in the amalgamating company. And accordingly, we determine the amount of capital gain. But the point we need to note is these provisions apply when the amalgamated company is an Indian company. When the amalgamated company is an Indian company. Now we look at the case of a demerger. In the demerger, a company is demerged. In other words, visualize it as if the company is split into 2 parts, right? So the part that is split is the part that is demerged, and what is formed is the resulting company, right? So there is a demerged company and then there is a resulting company. So in the case of demerger, there is a transfer of capital asset by the demerged company to the resulting company, right? And this is not liable to capital gain. Capital gain doesn't arise. In this case, it is specifically exempt. What happens where the resulting company subsequently transfers the capital asset? Then capital gains arise and cost of acquisition, period of holding and indexation are determined with reference to the previous owner, that is the demerged company, and accordingly we compute capital gain. What about shareholders? Firstly, there will be a transfer or issue of shares by the resulting company to the shareholder of demerged company in consideration of demerger. So shareholder will be holding the shares in the demerged company. Pursuant to the demerger, the shareholder will receive or will be allotted shares in the resulting company. In such case, capital gain does not arise. What happens when the shareholder subsequently transfers the shares held in the resulting company? Then in that case, the cost of acquisition, period of holding and indexation is determined with reference to share held in the demerged company. And what will be the cost of acquisition for shares held in the resulting company? So after demerger, so before demerger, the shareholder was holding shares in the demerged company. But after demerger, now shareholder will hold the shares both in demerged company as well as in the resulting company. So you can visualize that his holding in the demerged company is now split as in the demerged company and in the resulting company. So now the cost of acquisition in the resulting company will be computed proportionately. So we will pick up the cost of acquisition of shares in the demerged company, and then we will apply a ratio, which will be what? Which will be based on the net book value of assets transferred in a demerger divided by net worth of the demerged company immediately before the demerger. That will become the cost of acquisition. For these provisions to apply, the condition is that the resulting company should be an Indian company. We now look at the provisions of slump sale, and this is provided by section 50B. A slump sale is a transfer of one or more undertaking. So specific capital asset is not transferred, but it is a transfer of an undertaking. So therefore it will include all the capital assets, right, forming part of that undertaking. So all of them will be transferred in lump sum. So that's why it is called as a slump sale. So slump sale means a transfer of one or more undertaking for a lump sum consideration. So values are not assigned to individual assets and liabilities. So there is a lump sum consideration and there is transfer of one or more undertakings. In that case, full value of consideration is fair market value of the capital asset as on what date? On the date of transfer. We deduct expenditure on transfer, and then we determine cost of acquisition and cost of improvement. It is the net worth of the undertaking or the division. This is deemed to be the cost of acquisition and improvement. Now we need to know that the cutoff period of holding for long-term capital gain is 36 months. But even if the capital gain is classified as long-term capital gain, even then indexation is not available while computing capital gain on slump sale. What is the meaning of net worth? Net worth of the undertaking or division is equal to aggregate value of total assets minus what? The value of liabilities as appearing where? In the books of account. How do we determine aggregate value of total assets? So there are 4 considerations involved. In the case of depreciable assets, we take the written down value of the block of assets computed under the Income Tax Act. In the case of self-generated goodwill of business or profession, the value we take is nil. In the case of a capital asset where whole of the expenditure is allowed as a deduction under section 35AD, we looked at this in the topic on PGBP, the value is taken to be nil. In case of all other assets, what we take is the book value of such assets. What if there is a change in the value of assets because there is a revaluation of the asset? That change in the value, either increase or reduction, we ignore. This is how we compute capital gain in the case of slump sale. Now moving on to certain other transfers which are not liable to capital gain under section 47. Work of art. Where the capital asset is a work of art, archaeological, scientific or art collection, book, manuscript, drawing, painting, photograph or print. And its transfer is to whom? To the government or university, National Museum, National Art Gallery, National Archives or any other notified public museum or institution. Then this transfer is not chargeable to capital gain. Next is the case of reverse mortgage. So reverse mortgage scheme, it applies to a senior citizen basically, right? We are not talking about specific details here, but it basically applies to a senior citizen and it covers what capital asset? A residential house property located in India. Now in the case of reverse mortgage, the transfer of a capital asset is not chargeable to capital gain. The individual would receive a loan in the transaction of reverse mortgage from the lender, say from a bank. It will be exempt under section 1043. We have noted this in the topic on exempt incomes. When does capital gain arise then? Capital gain only arises on the alienation of mortgage property by the mortgagee for recovering the loan. So if there is a default, then the bank needs to recover the amount of loan. For that, it will alienate or maybe transfer or sell the mortgage property, or in that event only capital gain arises. We will now look at the exemptions provided in computing capital gains, and there are 6 sections 54 to 54F, and we will look at each of these sections now. And the presentation here, as you can see on your screen, is in the form of a table, so that makes comparative understanding quite easy. So first we look at section 54. Section 54 benefit is available to an individual or HUF, not to any other person. And exemption is available in respect of capital gain which arise on account of transfer of original asset. Transfer of original asset. What should be the original asset in the case of section 54? It should be a residential house. Income from such residential house should be chargeable under the head income from house property, and it should be a long-term capital asset. So short-term capital gain is not eligible for exemption under section 54. Now to claim exemption, the assessee should acquire a new asset. What should be that new asset? It should be one residential house in India. One residential house in India, right? In respect of this, exemption can be claimed under section 54. There is an exception. Exemption can be claimed in respect of acquisition of 2 houses also. But there is a condition. The condition is that the capital gain should not be more than rupees 2 crore. However, this option of claiming exemption in respect of 2 houses is a once in a lifetime option. Now the new asset should be purchased 1 year before the date of transfer of original asset or 2 years after, or constructed 3 years after the date of transfer of original asset. If that be the case, then exemption under section 54 is equal to lower of the amount of capital gain which arises on account of transfer of the original asset, or B, the cost of new asset. What is the cost of new asset? The cost of new asset is the amount which the assessee utilizes for acquiring the new asset, that means for purchase or construction, before furnishing of return of income, because when the return of income is to be furnished, the details are supposed to be mentioned in the return. So till that date, we need to determine certain things. So cost of new asset is what? Either the amount utilized for new asset before furnishing of return of income, or the amount which is not so utilized can even be deposited in the capital gains account scheme before furnishing of return, but latest by the due date to furnish the return. That amount also becomes eligible for exemption. So both the amount utilized as well as the amount deposited in the scheme needs to be added up, and the capital gain exemption is lower of capital gain or the cost of new asset. So the capital gain account scheme applies in the case of section 54. There is a lock-in period in respect of new asset. So the new asset which is acquired should not be transferred within the lock-in period, and the lock-in period is 3 years. If the new asset is transferred within the lock-in period, then capital gain becomes taxable. The effect is that the exemption is forfeited. Exemption is forfeited, and for this, the cost of acquisition while computing capital gain is what? It is the cost of the new asset minus the capital gain exempted earlier. So in effect, the capital gain exempted earlier gets forfeited. This capital gain on transfer of new asset is taxable in the previous year in which the new asset is transferred. And the capital gain which so arises is long-term or short-term capital gain depending on the period of holding of the new asset. Now, as we noted above, amount can be deposited in the capital gain account scheme, and that amount needs to be utilized in purchase or construction of the new asset within the timelines which are given above. So as we saw, the outer timeline is 2 years for purchase or 3 years for construction. So basically, the outer timeline is 3 years. So if the capital gain account scheme deposit is not utilized, whether wholly or partly, within this outer timeline, time limit of 3 years, then the amount becomes taxable as capital gain. What amount is taxable? The amount which is not utilized to acquire the new asset within this outer time limit. When is this taxable? In the previous year in which this outer time limit of 3 years expires. And what is the nature of the capital gain which is taxable? It is the same as original capital gain. Because in section 54, the original capital gain will always be long-term capital gain. Here also, in the case of non-utilization of CGAS deposit, the capital gain that will be taxable will also be long-term capital gain. In such case, thereafter, the assessee can withdraw the unutilized amount and do whatever he wants to do with that amount. The second exemption provision is section 54B. Like section 54, it also applies to an individual or HUF. What is the original asset in respect of which the capital gain arises, which can be claimed as exemption under section 54B? Agricultural land. So agricultural land should be transferred by an individual or HUF. And what is the condition? The land was being used by assessee or his parent for what? For agricultural purposes. When? In the 2 years preceding the date of transfer, not the year of transfer, preceding the date of transfer. And such agricultural land can either be long-term or short-term capital asset. So either long-term or short-term capital gain can arise, and then exemption can be claimed under section 54B if the assessee purchases what? An agricultural land 2 years after the date of transfer of the original asset. So this is a rollover exemption like section 54. So in section 54, we transfer a residential house and then we need to purchase a residential house. In section 54B, we transfer agricultural land and then we need to purchase an agricultural land. So that is called a rollover exemption. Okay, now if this condition is satisfied, then exemption can be claimed, and the formula is the same as that for 54. Lower of amount of capital gain or the cost of new asset, and cost of new asset is what? The amount which is utilized for purchase of the new asset before furnishing of return, or the deposit in capital gain account scheme before furnishing of return, but latest by the due date to furnish return of income. So capital gain account scheme is also applicable like section 54. There is a lock-in period in terms of the new asset, which is 3 years, right? If the new asset, that is the agricultural land, is transferred within the lock-in period, then capital gain becomes taxable, and the formula is the same as that for section 54. Exemption is forfeited and the cost of acquisition will be equal to cost minus capital gain exempted earlier under 54B. It is taxable in the previous year in which the new asset is transferred, and long-term or short-term capital gain arises depending on the period of holding of the new asset. Similarly, CGAS deposit needs to be utilized within the outer time limit of 2 years. It is 2 years under section 54B. If it is not so, then similar implications arise as they arise for section 54. Amount not so utilized within this outer time limit is taxable as capital gain in the previous year in which this period expires, and the nature of capital gain is the same as that of the original capital gain, that is capital gain arising on transfer of the original asset. And after that, the unutilized amount can be withdrawn freely by the SSE. Now what we need to note is, if it is a case of rural agricultural land in India, we know that this is not a capital asset, and therefore if this capital asset is transferred, the transfer is not liable to capital gain, and therefore section 54B is not relevant, right? Even in the case of new asset, there is a lock-in period, but even if the new asset is transferred within the lock-in period, then also no capital gain arise if that new asset is a rural agricultural land in India. This is what we need to keep in mind. What about urban agricultural land? In a case covered by section 1037, transfer of urban agricultural land is also exempt, and therefore section 54B is not relevant in that case. But this exemption applies for an individual or HUF if 4 conditions are fulfilled. 1. The land is situated in any urban area. 2. It was used for agricultural purposes by such individual or HUF or his parent during 2 years immediately preceding the date of transfer. 3. The transfer is by way of compulsory acquisition, or where the consideration is determined or approved by the central government or the RBI. And 4. The compensation or consideration is received on or after 1st April 2004. If these 4 conditions are satisfied, even transfer of agricultural land, which is urban agricultural land, is exempt under section 1037. So 54B is not relevant in that case as well. The third exemption provision is section 54D. As against 54 and 54B, 54D applies to all SSEs. What should be transferred? What is the original asset? It is land or building. Land or building. What is the condition? There are 2 conditions. Land or building was used in the business of industrial undertaking. When? In the 2 years preceding the date of transfer, not the year of transfer. And number 2, transfer should be by way of compulsory acquisition. So when capital gain arises on account of compulsory acquisition of industrial land or building, then exemption can be claimed under section 54D. And the capital asset, that means which is compulsorily acquired, can be either long term or short term. Now the new asset that needs to be acquired for claiming exemption is land or building. For what? For the purpose of shifting or re-establishing the existing industrial unit or setting up another industrial unit. So it's also in the nature of a roll over exemption. So land or building is acquired compulsorily, and then land or building needs to be reacquired in the form of the new asset to claim exemption. And this new asset needs to be acquired. How? It can be purchased or constructed after 3 years. After 3 years from what? From the date of compulsory acquisition? No. After the date of receipt of compensation. And why? This is on account of section 54H. And this is a general provision, not only applicable to 54D, but it is a general provision which says that in case of compulsory acquisition of the original asset, the time period is reckoned from the date of receipt of compensation. So when we talk about section 54D, while the date of transfer is the date of compulsory acquisition, but the timeline for acquiring the new asset is from the date of receipt of compensation, not the date of compulsory acquisition. If this condition is satisfied, then exemption can be claimed under section 54D, and the formula remains the same as that under 54 and 54B. There is a lock-in period for new asset. It should not be transferred within 3 years. But if there is a default, then again capital gain becomes taxable. And the implications are the same as under 54 and 54B that we have already discussed. Capital gains account scheme is applicable in section 54D as well. And the amount deposited in this scheme needs to be utilized within the outer time limit of 3 years. And if this is not the case, then the amount not utilized becomes taxable in the same fashion as we discussed for section 54 and 54B. The fourth exemption is provided by section 54 EC and it also applies to any SSE. The original asset that needs to be transferred is land or building. And as against 54D, there is no other restrictive condition in respect of the transfer of original asset. So land or building, if it is transferred, exemption is available, but the only requirement is that the original asset transferred should be long-term capital asset. So short-term capital gain is not available, is not eligible for exemption under 54 EC. What needs to be purchased to claim 54 EC? Bonds need to be purchased. Redeemable after 5 years, or long-term bonds issued by NHAI, RECL or any other notified bond. And the purchase needs to be 6 months after date of transfer of the original asset. If this condition is satisfied, then the amount of exemption from capital gain is equal to lower of the amount of capital gain or the cost of new asset. That means the amount of purchase of the bonds. But there is an upper cap of 50 lakh in terms of cost of new assets. So 54 EC exemption cannot exceed the amount of 50 lakh. Capital gain account scheme is not applicable in case of 54 EC. Now there is a lock-in period in terms of new asset. That means the bonds that have been purchased. And there is a higher lock-in period of 5 years. There is a higher lock-in period of 5 years, so the bond should not be transferred or sold within the period of 5 years. Now this also includes a case where the bonds are converted into money within the lock-in period. If a loan or advance has been taken on the security of the new asset, that is the bonds, then that is also deemed as conversion into money. On which date? On the date on which the loan or advance is taken, right? And therefore, there arises a default in such case also. So if the new asset is transferred, or that means it is either sold, transferred, or converted into money, or loan or advance is taken on the security of the bonds within 5 years, then what happens? Exemption is forfeited. Exemption is forfeited and capital gains becomes taxable, which is equal to what? Capital gain exempted earlier. This is taxable in the previous year in which the bonds are transferred. And this capital gain is taxable in all the cases as long-term capital gain, right? Capital gain account scheme CGAS is not applicable, so there are no implications in terms of non-utilization of the CGAS deposit amount. Now, in respect of the investment in bonds, the SSE may be eligible to claim deduction under section 80C as well, but double deduction cannot be availed. So 80C is not allowed for investment which has been taken into account for granting 54 EC exemption. We now finally look at 54F, and this applies only in the case of an individual or HUF. What should be the original asset? It can be any asset but not a residential house, because in that case 54 applies. The condition is that the SSE should not own more than one residential house other than the new asset on the date of transfer. At the most, one residential house can be owned by the SSE on the date of transfer, not more than one. And this is not including the new asset. Why? Because as we will now see, the new asset can be purchased before 1 year from the date of transfer of original asset. So at the time of the transfer of the original asset, the SSE may already be owning the new asset. So that's why we are excluding the new asset here. So other than the new asset, the SSE should not own more than one residential house on the date of transfer. And the asset that is transferred, original asset, should be long-term capital asset. So short-term capital gain is not eligible for 54F exemption. For exemption, what needs to be purchased is one residential house in India. This is the new asset. And this can either be purchased 1 year before or 2 years after, or constructed 3 years after the date of transfer of original asset. If this condition is satisfied, then exemption can be claimed under section 54F, which is lower of either the amount of capital gain or proportionate capital gain. This is different from 54, 54B and 54D that we saw, right? So exemption is not to the extent of cost of new asset, but exemption is to the extent of proportionate capital gain, which is what? Capital gain into cost of new asset divided by the net consideration. Now, what is the cost of new asset? It is similar to what we determine for 54, 54B and 54D. Therefore, capital gain account scheme is applicable. There is a lock-in period in respect of the new asset. And what is the lock-in period? It is 3 years. 3 years is the lock-in period. And what happens if the new asset is transferred within this lock-in period? Two implications arise. One, capital gain arises on transfer of the new asset, which is computed as per the normal way, and it is taxable in the previous year in which the new asset is transferred. And whether it is long-term or short-term capital gain, it depends on the period of holding of the new asset. The second implication that arises is that the exemption granted under 54F is now forfeited. And how does that happen? Capital gain is equal to capital gain exempted earlier. So capital gain exempted earlier now becomes taxable. But we need to note that such capital gain which now becomes taxable is taxable as long-term capital gain. As long-term capital gain. Now here we need to note additional restrictions under section 54F. Additional restrictions. The SSE should not purchase within 2 years or construct within 3 years, the same timeline as for acquiring the new asset. Should not purchase within 2 years or should not construct within 3 years from the date of transfer of original asset. What? Any residential house other than the new asset, right? So above we noted this restrictive condition that the SSE should not own more than one residential house other than the new asset on the date of transfer, right? Additionally, the SSE should not purchase or construct any residential house other than the new asset. If this condition is violated, similar implications arise. What? As per number 2 here, the exemption is forfeited and the capital gain that was exempted earlier under 54F now becomes taxable. When? In the previous year in which the extra house is purchased or constructed, and it is taxable as long-term capital gain. It is taxable as long-term capital gain. What about non-utilization of CGAS deposit within the outer time limit of 3 years? Within the outer time limit of 3 years. Amount becomes taxable as capital gain. What amount? The excess exemption that was allowed earlier under 54F now becomes taxable. And it is taxable in the previous year in which this period, the outer time limit of 3 years expires. The nature is same as with the original capital gain, and after that the SSE is free to withdraw the unutilized amount. We now look at computation of tax on capital gain, and this depends on the category of capital asset. The capital asset can be equity share in a company or a unit of an equity oriented fund, or it can be any other capital asset. Where it is equity share in a company or a unit of an equity oriented fund, capital gain can either be short term or long term. In case of STCG, 111A section is applicable. In case of LTCG, 112A is applicable. For 111A to apply, the condition is transaction of sale should be chargeable to securities transaction tax or STT. For 112A, the condition is that STT has been paid on acquisition and transfer of share. In case of shares, it should be paid on acquisition and transfer. In case of unit, it can be paid only on transfer. Now this condition for shares that STT should have been paid on acquisition also is open to certain relaxations. So this condition of STT payment on acquisition of equity shares is not applicable in certain notified cases. For our purpose, a couple of cases that are relevant is where transaction of acquisition of equity share was entered before 1st October 2004. That is the date when the STT came into force, before that date. So obviously STT would not be payable. Or if it was on or after 1st October 2004, but it is not chargeable to STT, in that case also this condition doesn't apply. This condition doesn't apply where acquisition of equity share is through an issue of shares by the company, the direct issue by a company. For example, it can be a bonus issue or a right issue. In that case, STT would not be paid on acquisition. So in these cases, even if STT is not paid on acquisition but only on transfer, 112A still becomes applicable. Now when 11A applies, a concessional tax rate of 15% is applicable. If 112A applies, then a further concessional rate of 10% is applicable, and there is also a threshold of 1 lakh. So 10% is applicable on LTCG exceeding rupees 1 lakh. Indexation is not available in case of STCG, but in case of 112A, even if the gain is LTCG, indexation is still not applicable. Now we talk of any other capital asset. The gain can either be STCG or LTCG. In case of STCG, the gain is treated as a normal income. It is not taxable at a special rate, so regular rate of tax applies as per the slab rates. And obviously, since it is short-term capital gain, indexation is not available. As far as LTCG is concerned, the relevant section is section 112. And now under 112, long-term capital gain can be categorized into 3 parts. 1. Where the capital asset is unlisted securities or shares of what? Of a closely held company, not a widely held company. And it is in the case of a non-resident. So this is the case of unlisted securities or shares of a closely held company in the case of a non-resident. In that case, a concessional rate of 10% applies and indexation is not applicable. Second category is of listed securities, but other than a unit or a zero coupon bond, right? In that case, how do we compute capital gain? It is lower of A or B. It is 20% with indexation or 10% without indexation. So A or B, and then we find out lower of A or B, and that is the tax on capital gain under section 112. Now, as far as indexation is concerned, we should note that as far as zero coupon bond is concerned, indexation is not applicable on a zero coupon bond. As far as any other capital asset is concerned, which is a long-term capital asset and therefore long-term capital gain arises falling under 112, then the rate of tax which is applicable is the rate of 20%, and in that case indexation is available. So indexation is available only in the case of this general rate of 20% for LTCG. In all other cases, 111A, 112A and the other cases of LTCG under 112 as well as short-term capital gain which is not under 111A, indexation is not available. Now there is this benefit of unexhausted basic exemption limit which is available, UBEL. Before we move to that, we need to note what is the treatment of STT, because as we said, 111A, 112A, STT would have been paid. Can this be claimed or is this deductible in computing capital gain? No, it is not. STT is not deductible in computing capital gain. It is neither a part of cost of acquisition nor a part of expenditure incurred on transfer. What we also need to note that once we compute tax on capital gains, surcharge may become applicable, as we discussed in the topic on rates of tax. We need to recollect that surcharge on tax on capital gain cannot exceed the rate of 15%. In what cases? In the cases of tax under 111A, 112 or 112A. For an individual HUF, AOP, BOI or AJP. This is the limit of the rate of surcharge, 15%. Now we come to the benefit of UBEL, unexhausted basic exemption limit, which means that the basic exemption limit of 2.5 lakh or 3 lakh or 5 lakh is not fully exhausted. It remains unutilized. So this benefit is given only to an individual or HUF who is a resident. If this is not the case, then this benefit is not available. But if the individual or HUF is a resident, then what we do? We find out the normal income. Normal income means what? The total income excluding capital gain taxable at special rate. That means under section 111A, 112A and 112. Under section 111A, 112A and 112, we exclude that, and the balance total income is what? It is the total income taxable at normal rate. So that is what we call the normal income. If this normal income is lower than the basic exemption limit, this will result in an unexhausted basic exemption limit. Basic exemption limit minus normal income. This is what we deduct from the capital gain under section 111A, 112A and 112A. So we reduce the amount of capital gain by such unexhausted basic exemption limit, and we compute tax on such capital gain on this reduced amount. So this is how we provide benefit of unexhausted basic exemption limit. Now this capital gain may include 111A, 112A and 112 as well. So 111A is taxable at 15%, 112A at 10% and 112 at 20%. So how should we adjust the unexhausted basic exemption limit within these capital gains to compute the tax? So we are free to do that, and accordingly, in order to take maximum benefit, it is good to adjust the capital gain in the following order. So first against capital gain under 112, because it is taxable at 20%, the maximum rate, then 111A because it is 15%, the lower rate, and then 112A, it is 10%, the least of these rates. So in order of descending rate of tax. So this is benefit of unexhausted basic exemption limit. Deduction from gross total income. So we can claim only on short-term capital gain which is taxable at the regular rate. Deduction from gross total income under chapter VIA cannot be claimed in respect of all other capital gain. That means 111A, 112A and 112. What about rebate under section 87A on the tax computed on this capital gain? It is not available in the case of tax on LTCG under 112A, but it is available in all other cases. Of course, in the case of 112 LTCG, which is taxable in the case of non-resident, 87A is not applicable because 87A is available only to a resident. Now there is a special provision for computing cost of acquisition where we are talking about section 112A. That means equity shares or units of an equity oriented fund. If this capital asset has been acquired before 1st February 2018, then there is a special mechanism to compute cost of acquisition, which we then use in computing capital gain, which is taxable under 112A. So the cost of acquisition in such case will be the higher of the following. A is the actual cost of acquisition of the capital asset, the actual cost of acquisition of the capital asset, and substitution of fair market value on 1st April 2001 is allowed in this case. So higher of A or B. B is what? It is lower of A or B. Lower of A, fair market value of the capital asset on 31st of January 2018 or the full value of consideration on the transfer of such capital asset. So higher of A, the cost of acquisition, B, lower of FMB on 31st January 2018 or full value of consideration on the transfer. Once the cost of acquisition is determined, then we compute the capital gain and then the tax on long-term capital gain under section 112A, and as we noted above, under 112A indexation is not available. What if there is a case of bonus shares or right shares which were acquired before 1st February 2018? In that case also the cost of acquisition is determined as per this special provision. Now how do we calculate the fair market value of this capital asset on 31st of January 2018? It depends on whether the capital asset is listed on any recognized stock exchange as on this date or it is not listed on this date. Where it is listed on 31st January 2018, then it depends on whether the asset was traded on the stock exchange on this date, or it was not traded on this date. If it was traded on this date, then the fair market value is the highest price which is quoted on the recognized stock exchange on this date. If it was not traded on this date, then we take the highest price when? In the immediately preceding date on which the asset was traded on the stock exchange. In the second scenario, where the capital asset is not listed as on 31st January 2018, then if it is a case of unit of an equity oriented fund, then we take the NAV of such unit as on 31st January 2018. But if it is a case of equity share, which is not listed on 31st January 2018, and therefore it means it now has been subsequently listed. So therefore it is listed on the date of transfer. It was not listed on 31st January, but it is listed on the date of transfer. So in that case, what we do? Fair market value is equal to cost of acquisition multiplied by cost inflation index for 2017-18, which basically pertains to this date, which is the year pertaining to this date, 31st January 2018. So cost inflation index for 2017-18 divided by what? Cost inflation index for later of 2001-02, which is the base year for indexation, or the first year in which equity shares were held by the SSE. So this is how we determine fair market value, and accordingly we figure out the cost of acquisition as per these special provisions, and consequently we compute the capital gain. So this brings us to the close of the topic on capital gain. We now move to the last head of income, which is income from other sources, IFOS. Now, what kind of income is taxable under this head? So every kind of income is taxable under this head if 1. It is not excluded from the total income, that is, it is not exempt, it is taxable. And 2, it is not taxable under any other head of income. So IFOS is the residual head of income. However, certain incomes are specifically taxable under this head. For example, gifts, winnings, etc. We will look at these incomes as we proceed ahead. Snapshot chart highlighting the steps to compute income under this head. First, we figure out the amounts chargeable under this head. Section 56 is relevant. Then we allow deductions on 2 counts basically under section 57, specific deduction and general deduction. A specific deduction is specific to certain kinds of income. We will look at this as we proceed. General deduction is what we need to look here. We need to note this carefully, because wherever we encounter the term general deduction in our discussion, this is what we mean. It refers to any expenditure not being in the nature of capital expenditure, that means revenue, laid out or expended wholly and exclusively for the purpose of making or earning income. So this refers to the general deduction. Then we add amount which are not deductible, which are listed in section 58. If these have been allowed as deduction, we add them back because these are not allowed as deduction. We add deemed incomes which are provided under section 59, and this results in income taxable under this head. Now we need to note that if an income has been received after deduction of TDS, then it needs to be grossed up for inclusion in the total income. And the formula is income received into 100 divided by, within brackets, 100 minus rate of TDS. So we gross up and then we include that grossed up income while computing the total income. So we first move to the income in the nature of dividend. It is defined under section 222. There are 2 categories. Category A refers to distributions made by a company to its shareholders, and clauses A, B, C, D. 222A, what is treated as dividend? Distribution of accumulated profits if it entails release of assets of the company. For example, cash dividend is distributed. But we need to note that if bonus shares are issued to equity shareholders, that is not treated as dividend. So that is not taxable as dividend in the hands of the shareholders. Clause B, distribution to shareholders of debentures, debenture stock or deposit certificates with or without interest. Second, distribution to preference shareholders of bonus shares. It is treated as dividend. Clause C, distribution to shareholders of a company on its liquidation. That is treated as dividend. But distribution in respect of preference shares issued for full cash consideration is not treated as dividend. Clause D, Distribution to shareholders on reduction of capital is treated as dividend. But same. Distribution in respect of preference shares issued for full cash consideration is not treated as dividend. We also need to make a note that payment which is made by the company on buyback of shares is not treated as dividend. Rather, we discuss this in the topic on capital gain, that either buyback tax is payable by the company, or if that is not the case, then capital gain is leviable in the hands of the shareholder. But it is not treated as dividend. What if the distribution is not of money but it is of assets? Then the market value of the asset is taken as the amount of dividend. Now there is a limit to which the amount is treated as dividend under section 222. So these above listed items under clauses A, B, C, D are treated as dividend to the extent to which the company possesses accumulated profits. Whether they may be capitalized or not, it doesn't matter. But the overall limit is accumulated profits. So if the accumulated profits of the company is 1 lakh and dividend is distributed to the extent of 1.5 lakh, then dividend will be treated to the extent of 1 lakh. The other 50,000 component, which is in excess of accumulated profits, will not be taxable because it will be taken to be on account of distribution of capital, not of accumulated profits. Category B is covered by section 222E and it is referred to as deemed dividend. It covers payments made by a closely held company. Closely held company. What is a closely held company? It is a company which is not a widely held company. In other words, it is not a company in which the public are substantially interested. What we need to note basically is private companies or public unlisted companies fall under this category of closely held company or CHC. So three kinds of payments are covered, A, B, C. First, we look at any payment which is by way of advance or loan. So if an advance or loan is given by a closely held company to whom? Category A, where the payment is made to a shareholder. Which shareholder? Who is the beneficial owner of equity shares holding 10% or more of voting power. Right? So this is the CHC. This is the CHC, closely held company. And it is giving a loan or advance to a shareholder who say holds 10% of equity share capital in the company. So being at 10% or more of the voting power which the shareholder holds in the company, the payment of loan or advance will be treated as deemed dividend under section 222E in the hands of such shareholder. Second, payment to any concern. Concern means HUF, firm, AOP, BOI or company in which the shareholder, which shareholder referred in category A, is a member, say a member of HUF or a shareholder or a partner in the firm, and in which he has a substantial interest. Say the shareholder has a substantial interest in a concern. Say this is a firm and this shareholder has a substantial interest in the firm. Okay, and the company, closely held company, and the shareholder holds 10% in closely held company. And if this closely held company gives a loan or advance to the concern, then that will be treated as deemed dividend. So the question is, what is the meaning of substantial interest? If it is a case of a company, then the person has a substantial interest if he is the beneficial owner of equity shares carrying 20% or more of the voting power. If it is a case other than a company, then the person has a substantial interest if at any time during the previous year he is beneficially entitled to 20% or more of the income of such concern. So if in this example the shareholder is entitled to say 20% profits in the firm and he holds 10% shares in the company, and if the company is giving a loan or advance to the firm, then that will be treated as deemed dividend. Now in both cases A and B there is an exception. Even if the case is covered under A or B, it is still not treated as deemed dividend. It is not treated as deemed dividend if it is made by a company in the ordinary course of its business and the lending of money is a substantial part of the business of the company. So if the closely held company in our example, if that is say a money lending company or a company whose main business is that of money lending, then the grant of loan or advance will not be treated as deemed dividend. Category C, payment to any person. Any payment which is made on behalf or for the individual benefit of the shareholder referred in category A, and the payment can be made to any person, that is treated as deemed dividend. So if this is the case of any other person and the payment is made by the company for, say, on behalf of the shareholder, this shareholder, or for the individual benefit of this shareholder, then this payment will be treated as deemed dividend under section 222E. Now in all these cases A, B, C, the payment is treated as dividend to the extent of accumulated profits of the company, that is profits of the company up to the date of payment. So to this extent, amount is treated as deemed dividend. Beyond this extent, it is not treated as deemed dividend. Set off. Any dividend paid by a company which is set off against any previous payment which was treated as dividend under 222E is not again treated as dividend to the extent it is so set off. So if loan or advance was given under 222E of, say, 1 lakh, which was earlier treated as dividend under 222E, and subsequently dividend, say a regular dividend of 1.5 lakh is declared to, and this is what the shareholder is entitled to. But since 1 lakh, after setting of 1 lakh, say only 50,000 is paid to the shareholder. Out of this 1.5 lakh, 1 lakh which is actually set off will not be treated as dividend once again. Only 50,000, which is the excess, will be treated as dividend. This is to avoid double taxation of the same amount. Now what about trade advances which are in the nature of commercial transactions? These are not covered under section 222E and accordingly not taxable as dividend in the hands of the shareholder. What is the deduction that is allowed in computing dividend income? Deduction is allowed only on account of interest expense. No other deduction is allowed. Even on this count, there is a limit. So we need to determine the amount of dividend income that is finally included in the total income for that year without such deduction of interest expense. Then we compute 20% and that is the limit. So up to this limit, interest expense is allowed as a deduction. So this is the only deduction allowable from dividend income. Taxation of dividend income. It is taxable in the hands of the shareholder. It is not taxable in the hands of the company. And dividend is taxable at regular rates plus applicable surcharge we add, and of course 4% health and education cess. We have already noted in the topic on rate on tax that rate of surcharge on tax on dividend income cannot exceed 15% in the case of an individual HUF, AOP, BOI or AJP. Now there are certain special provisions for distribution of assets by a company in liquidation. So as we noted above, 222C, distribution to shareholders of a company on its liquidation is treated as dividend and therefore it is taxable in the hands of the shareholder to the extent of accumulated profits. Okay. Now what are the tax implications in the hands of the company? There is distribution of assets of the company to its shareholders in liquidation, but it is not regarded as a transfer for the purpose of capital gain. Therefore, there is no capital gain which arises in the hands of the company. But capital gain arises in the hands of the shareholder instead when the shareholder receives any money or other assets from the company in lieu of shares. What we also need to note is that the distribution made to the shareholders by the company is treated as dividend under section 222C as we noted above to the extent of accumulated profits. Now when capital gain arises, we compute capital gain as follows. First, we determine the full value of consideration, which is what? Money which is received by the shareholder from the company. In case of assets, the market value of other assets as on the date of distribution. And we deduct the amount which has been assessed as dividend under section 222C to avoid double deduction. 222C becomes dividend taxable in the hands of shareholders and the balance of the consideration becomes the full value of consideration for computing capital gain. We deduct expenditure on transfer if any. What about cost of acquisition and index cost of acquisition of shares? In such case, the period of holding is reckoned up to which date? Up to the date on which the company goes into liquidation. And then accordingly, we arrive at the amount of capital gain taxable in the hands of the shareholder. We will now look at the provisions regarding taxation of gifts. and this is section 56(2)(x). Money or property which is received without consideration, that means as a gift, or for inadequate consideration. First, we look at the applicability of section 56(2)(x). 56(2)(x) applies where any person receives the following in any previous year from any person or persons. And there are three categories, A, B and C. First, we look at category A. This refers to, or this deals with any sum of money, okay, which is received without consideration. That means money received as a gift. Now we need to look at the aggregate value of such sum during the previous year. If it is greater than 50,000, for example, if 60,000 has been received as a gift during the previous year, then the whole of the aggregate value of such sum is taxable. That means in this case 60,000, the whole of the amount, the whole of 60,000 will become taxable under 56(2)(x). If this is not the case, then it is not taxable. For example, if the sum of money received as gift is 40,000, then it is not more than 50,000, so it is not taxable. Category B covers movable property. What is the movable property for this purpose? It is a capital asset of the SSE which is listed under 128 as you can see on your screen, and this is referred to as a specified movable property. If it is a case of any other movable property, then it is not taxable under 56(2)(x). But if it is a specified movable property, that means the capital asset of the SSE being shares and securities or jewelry or archaeological collections or drawings, paintings, sculptures, any work of art or bullion. And this is the acronym which you can use for your reference: DAPSAJ, DAPSAJ within brackets OS. Right? This is the same as you would recollect while we were dealing with the definition of capital asset in the topic on capital gain. Plus BS is the addition here. B for bullion and S for shares and securities. So DAPSAJ, OS plus BS. So in the case of specified movable property, there can be two situations, B1 and B2. B1, where the specified movable property is received without consideration, that means as a gift. Then we need to see whether the aggregate fair market value of such property is greater than 50,000. Right? Say for example, gold is received is of value 60,000. Then in that case, whole of the aggregate FMV is taxable, so 60,000 will become taxable. But if that is not the case, say gold is received of fair market value 40,000, then it will not be taxable under 56(2)(x). B2 category is where the specified movable property is received for consideration. Okay, that means for inadequate consideration. Then we need to figure out the excess, which is what? Aggregate fair market value minus consideration. And we need to check whether that is more than 50,000. Right? For example, if fair market value of gold which is received is 1 lakh, okay, and rupees 20,000 has been charged. So the excess is 80,000. 80,000 is more than 50,000. So such excess, which is 80,000, will be taxable. If that is not the case, if the amount paid is 60,000, so the excess is 40,000, which is not more than 50,000, so it will not be taxable. Now we move to category C, which covers immovable property, which means what? Land or building or both. The condition is that it should be a capital asset of the SSE. Just like movable property, for immovable property also it needs to be a capital asset of the SSE which is receiving this property. C1 covers a case where it is received without consideration, that means as a gift. Then we need to check stamp duty value SDV, if it is more than 50,000 or not. For example, if SDV is 1 lakh, it is more than 50,000, then SDV of 1 lakh is taxable. If that is not the case, for example, if SDV is 40,000, it is not more than 50,000, so it is not taxable. C2 covers a case where the immovable property is received for a consideration. Then we need to figure out the amount of excess. Excess is what? Stamp duty value minus the consideration. And we need to check whether that is more than 50,000. Further, the second condition is that whether the SDV is more than 110% of consideration. For example, if SDV is 20 lakh and the consideration is 10 lakh. So excess is 20 lakh minus 10 lakh is equal to 10 lakh, and 10 lakh is more than 50,000. First condition is satisfied. Second condition, SDV of 20 lakh is more than 110% of consideration of 10 lakh. That is also satisfied. So both the conditions are satisfied. In that case, the excess is what? 20 lakh minus 10 lakh, 10 lakh. So 10 lakh becomes taxable. If both these conditions are not satisfied, then it is not taxable under 56(2)(x). Now, as regards immovable property, we will recollect the provisions of 43CA and 50C. 43CA and 50C apply while determining full value of consideration in the case of the transferor. If the land or building is a stock in trade, then full value of consideration 43CA applies. If it is a capital asset, 50C applies. Now there are two provisions of 43CA and 50C which equally apply to 56(2)(x). And what are they? First, SDV on date of agreement can be taken instead of SDV on date of registration if the consideration, may be whole or any part, is received by a specified mode on or before the date of agreement. Second provision, which is similar to 43CA and 50C, is that AO can refer the valuation of the property to the valuation officer, where the SSC claims that SDV is more than FMV and he has not disputed the SDV in any forum. In such case, the value determined by valuation officer is taken. But if the value so determined is even more than SDV, then SDV is taken and the valuation of valuation officer is not considered. Now, there could be a situation where the income is arising outside India on account of a sum of money which is covered under section 56(2)(x), right? Sum of money, category A. So income is arising out of India. Why? Because the sum of money is paid by a resident in India to a non-resident, okay, not being a company, or if it is a company, then to a foreign company. So that means income is arising outside India. But in that case, such income is deemed to accrue or arise in India under section 9, and therefore it becomes taxable in India for such non-resident as well. Now, certain points to note in this respect: 56(2)(x), the limit of 50,000 that we noted above in the chart applies separately for each of the 5 categories A, B1, B2, C1, C2. A, B1, any movable property gift and receive for consideration. C, immovable property. In this case, C1 was without consideration gift and C2 was for consideration. So A, B1, B2, C1 and C2. So the limit of 50,000 is not the aggregate for all these categories put together. It applies separately to each of these categories. Second, in the case of immovable property, the SDV per property is considered. It is not the aggregate for all the properties put together for the previous year. But for sum of money as well as for movable properties, in those categories, we were checking the aggregate for the previous year. Third, income is not taxable under this provision if the property is not the capital asset of the SSE, even if it is the capital asset of the donor. Receipt of any movable property other than the specified movable property is not taxable because it is not covered under this provision. For example, if a mobile phone is received, furniture is received, a car is received. What about fixed deposit in a bank? If it is assigned without any consideration, then there are two views. View 1, it is not a specified movable property. It is not listed as a specified movable property and it is thus not covered under 56(2)(x). But view 2 is that it may be said to be a sum of money and therefore it is covered. Whatever view you adopt, it is good to give a note in support of this assumption in your answer. There are certain cases specified where 56(2)(x) is not applicable. So 56(2)(x) is not applicable to any sum of money or any property which is received in the following cases. And now we will look at those cases quickly. Number 1, where it is received from any relative. And what is the meaning of relative? In case of an individual, who is the relative? A spouse of the individual is a relative. So if the individual receives gift of money from the spouse, even if it is more than 50,000, it is not taxable under 56(2)(x) because the spouse is the relative. Brother or sister of the spouse is a relative, and spouse of the brother or the sister is also a relative. Then a lineal ascendant or descendant of the spouse, and further the spouses of such lineal ascendant or descendant is also relative. Next, brother or sister of the individual and their spouses, parent of the individual, brother or sister of either of the parent as well as their spouses, any lineal ascendant or descendant as well as their spouses. All of these are treated as relative of the individual. So if the individual receives a sum of money or any property from a relative, it is not taxable under 56(2)(x). As far as the HUF is concerned, 56(2)(x) doesn't apply if the HUF is receiving money or property from a member of such HUF. Second, on the occasion of the marriage of the individual SSE. Third, under a will or by way of inheritance. Fourth, in contemplation of death of the payer or donor as the case may be. Fifth, from any local authority defined under section 1020. Sixth, from any fund, foundation, university or other educational institution, hospital or other medical institution or any trust or institution referred under 1023C. From or by any trust or institution, but it should be registered under section 12A, 12AA or 12AB. From or by. By any fund, trust or institution, university or other educational institution, etc. referred under 1023C. By way of certain transactions not regarded as transfer under section 47. For example, distribution of capital asset on the total or partial partition of HUF. So if a member of HUF receives asset from the HUF on the partition, 56(2)(x) will not apply. From an individual by a trust created or established solely for the benefit of relative of the individual. From persons and subject to such conditions as may be prescribed. Nothing has been prescribed. 12 and 13 deal with the situations relating to COVID-19. Right? So if there is an expenditure that has been incurred by an individual on the medical treatment of himself or of any member of his family. For what? For any illness which is related to COVID-19. And if he receives any reimbursement on that count from any person, that amount is not taxable under 56(2)(x). If the person has died because of illness related to COVID-19 and an ex gratia payment is received by a member of the family of the deceased, then there can be two situations. If the amount is received from the employer of the deceased, it is not taxable under 56(2)(x). Second, if it is received from any other person, that means other than the employer, then it is exempt to the extent or the sum or the aggregate is not greater than 10 lakh. So 10 lakh is the limit. Beyond 10 lakh, it becomes taxable. But for this exemption, that means under serial number 13, two conditions need to be satisfied. One, the death should be within 6 months from date of testing COVID-19 positive, and second, payment should be received within 12 months from the date of death. Now, as far as number 12 and 13 are concerned, what is the meaning of family? So family means one, either spouse and children of the individual, or two, parents, brothers and sisters or any of them, but if they are wholly or mainly dependent on the individual. You may note that in the topic on salary, we also discussed about COVID-19 related expenditure which is reimbursed by the employer. So this is a summary of COVID-19 related provisions. It can be either reimbursement of expenditure or ex gratia payment on death. Sum which is received by an employee from the employer for medical treatment of self or any member of the family is covered under the head salaries, but it is not taxable as perquisite and there is no limit. Sum received by an individual from any other person not being an employer for medical treatment of self or member of family is covered under IFOS, but it is also not taxable and there is no limit. Ex gratia payment on death received by a member of the family which is received from the employer of the deceased is covered under IFOS, but it is not taxable and there is no limit. But if it is received from any other person not being the employer of the deceased, then also it is covered under IFOS. It is not taxable, but there is a limit of exemption of 10 lakh. What is the deduction which is allowed in computing income under section 56(2)(x)? General deduction is allowed, which is what we noted at the beginning of this video. A quick comparison between 43CA, 50C and 56-2X. This is important from an exam point of view. So 43CA applies for determining full value of consideration, where we are computing business income for the seller of land or building where it is not his capital asset. That means it is his stock in trade. 50C is applicable to a seller of land or building where the land or building is his capital asset. And 56-2X, as we know, is applicable to a buyer of land or building, but the condition is that it should be the capital asset of the recipient, of the buyer. When is this applicable? 43CA applies where SDV is more than 110% of consideration. Same is the case for 50C. But for 56-2X, where it is a case of gift, 56-2X applies where SDV is more than 50,000. And where it is not a case of gift, it applies where two conditions are satisfied. First, the excess, that means SDV minus consideration, is more than 50,000, and second, SDV is more than 110% of consideration. What is the tax implication? In 43CA, the SDV is taken as full value of consideration. Okay, if this condition is satisfied. Same for 50C. For 56-2X, if it is a case of gift, the SDV is taxable. If it is a case of receipt for consideration, that means not a case of gift, then the excess is taxable. Can SDV on the date of agreement be taken? Yes, in all the cases. Can reference be made to the valuation officer for the property? Yes, in all the cases. Now we look at the interplay between 56-2X and capital gain, and questions are sometimes asked in the exam. So there are a few angles that we need to carefully note, and we need to check these angles while solving the questions. So there is a case where the donor has, say, gifted a property or transferred a property without adequate consideration to the recipient. Okay. Now, as far as the donor is concerned or the transferor is concerned, what we need to note? One, if it is a case of gift, so if D has gifted property to R, then we noted in the topic on capital gains that capital gain does not arise for the transferor if it is a case of gift. Correct? But if it is not a case of gift, that means if it is a case of transfer of property for a consideration, that means inadequate consideration, then what will happen? If D has transferred a property which is the stock in trade, then business income will arise. In which case, full value of consideration will be determined as per what? 43CA. If D has transferred a property which is a capital asset, then capital gain will arise. In which case, if it is a case of land or building, 50C will apply for determining full value of consideration. If it is a case of unquoted shares, we need to check 50CA. Fine, this is clear. Now, there are certain angles which we need to keep in mind for recipient, R. When R receives the property from D, taxable income may arise under 56-2X or may not arise. Now, where R subsequently transfers the property, then capital gain will arise because it is capital asset in the hands of R, right? Now, two situations will arise. We need to check what is the situation in the question. Where 56-2X applied, that means where the value of the property was subject to tax under 56-2X in his hands, then when we are computing capital gain on subsequent transfer, we need to figure out the cost of acquisition. What will be the cost of acquisition? It will be the value which was taken into account under section 56-2X. That will become the cost of acquisition for computing capital gain. This is what? This is the fair market value or the stamp duty value that was taken into account under 56-2X. Mind you, it is not the excess of FMV or SDV over consideration. It is the FMV or SDV that was considered while computing income taxable under 56-2X. What about period of holding? In the case of gift, will we include the period of holding of the previous owner? No. If the case had fallen within 56-2X, then subsequently period of holding will be based on the holding of the transferee, that is R. Holding of previous owner, that means D, will not be included even if the property was received as a gift because 56-2X had applied at the time of receipt by R. Second situation is where the value of the property was not subject to tax under 56(2)(x). For example, D was the relative of R and therefore 56(2)(x) didn't apply in the case of R. In that case, capital gain is determined as per the regular provisions, and therefore, if it is a case of gift, then cost of acquisition and period of holding will be determined with reference to the previous owner as is normally done. We will now look at the provisions in relation to interest. Now, taxability depends on the category of interest, and there are three possible categories. Category A is interest on securities. Interest on securities is taxable under this head if it is not taxable under the head PGBP. Now, what does interest on securities means? It means either interest on government security, for example, interest on government bonds, or interest on debentures or other securities issued by a local authority or company or a statutory corporation. For example, interest on debentures issued by a company. Now, interest on securities is taxable in which previous year? Now, this depends on the system of accounting regularly employed by the SSE, whether it is cash or mercantile. What is the deduction allowable? Reasonable commission or remuneration to a banker or any other person for realizing the interest is allowable as deduction. Further, general deduction, as we noted in the beginning of this topic, is also allowable as deduction. Next is interest on compensation. This covers interest received on compensation or enhanced compensation. You will recollect we have already covered this in the topic on capital gain while discussing section 45(5) covering compulsory acquisition. This is taxable in the previous year in which it is received, so taxable on receipt basis. Flat deduction of 50% is allowed and consequently no other deduction is allowed. Category C covers other interest. So any other interest is taxable under this head. For example, interest received on fixed deposit with the bank. And the previous year in which it is taxed, it is the same as that for interest on securities. General deduction is allowable. Now we need to note certain specific items of interest incomes that is exempt. So it is not included under the head IFOS. It is not also included in the total income. Securities, bonds or certificates issued by the central government if notified. So interest thereon is exempt. Interest on gold deposit bonds, interest on deposit certificates under the gold monetization scheme, interest on PPF, interest on Sukanya Samriddhi account, interest on 7% capital investment bonds or RBI relief bonds, interest on post office savings bank account is also exempt, but there is a limit. In case of an individual account, interest is exempt up to rupees 3,500, and in case of a joint account, interest is exempt up to the limit of 7,000. The excess is taxable. Excess share premium is also taxable under this head, and this is covered by section 56(2)(7)(b). Now this covers a case where a closely held company receives from any person being a resident any consideration for issue of shares. So consideration is received where shares have been issued by a closely held company and the consideration is received from a resident. In such case, we need to check the consideration and the face value. If the consideration is not more than face value, then this provision is not applicable. So if you look at this diagram, this is the face value, okay, and this is the consideration received from a resident on issue of shares. If the consideration is not greater than face value, then this provision is not applicable. But if the consideration is greater than face value, then this provision is applicable. And in such case, what is taxable? Aggregate consideration received for such shares minus FMV of the shares. So excess of consideration over the FMV is taxable. So for example, if consideration is more than the face value but less than the fair market value, nothing is taxable under this provision. Now point to note is that income under this provision is taxable in the hands of whom? It is taxable in the hands of the company, not in the hands of the shareholder. We will now look at the other incomes taxable under the head IFOS. We will look at what are such incomes which are taxable under this head and the deduction which is allowed in computing such income under section 57. Now what we need to note in respect of deduction is that general deduction, which we noted at the beginning of this topic, is allowed in computing the relevant income unless it is mentioned otherwise. So we will look at certain specific deductions, and by default general deduction is also allowable unless it is specifically mentioned. Units of mutual fund. Income in respect of units of a mutual fund or units of UTI, Unit Trust of India, is taxable as IFOS. Deduction is allowed in respect of interest expense in a similar fashion as we saw it is allowed in respect of dividend. The same limit applies here as well. No other deduction is allowed. Second, winnings is covered under IFOS. Winnings from what? Lotteries, crossword puzzles, races, it includes horse races as well, card games and other games of any sort, or from gambling or betting of any form or nature. No deduction is allowed in respect of any expenditure or allowance under any provision of the Act. Therefore, what this means is that gross winnings are taxable. At what rate? At a flat rate of 30%. Plus we add surcharge at the rate applicable and 4% HEC on tax plus surcharge. And this is by virtue of section 115 BB. Benefit of UBEL, which we covered in the topic on computing tax in respect of capital gain, is not available here. Deductions under chapter VIA from the gross total income are not allowed from such winnings, but rebate of tax under 87A is allowed in respect of tax on such winnings. Now these provisions are not applicable to income from the activity of owning and maintaining race horses in the case of an owner of horses maintained by him for running in horse races. This is the distinction we need to keep in mind in respect of such activity and winnings. Welfare fund, where the employer receives employees' contribution to Provident Fund, Superannuation Fund, ESI Fund, or any other employee welfare fund, right? Then it is first included as the income under IFOS. If it is not taxable under the head PGBP, then a deduction is allowed to the extent the sum is credited to the employee's account in the fund on or before the due date as per the rules of the fund. Recollect, this provision corresponds to what we discussed in the context of PGBP as well. Next is income from the letting of machinery, plant or furniture. Following income is taxable as IFOS if it is not taxable under the head PGBP. If machinery, plant or furniture is let on hire, then that income is taxable as IFOS if not as PGBP. Income from the letting of machinery, plant or furniture and also building. So this is a case of composite letting. Recollect, this we have discussed already in the chapter in the topic on income from house property, composite rent. In such case, we need to see if both the lettings, buildings as well as machinery, plant and furniture, are inseparable. In such case, entire income is taxable as IFOS, if not taxable as PGBP. If this is not inseparable, then we need to split. And the income from the letting of building is taxable under income from house property, while from letting of machinery, plant or furniture is taxable as IFOS, if not taxable as PGBP. And we need to allow deduction on account of current repairs, insurance premium and depreciation in accordance with the provisions of sections 30 and 32, which we have dealt with in the topic on PGBP. Sum received under keyman insurance policy, including bonus, it is taxable as IFOS if it is not taxable under the head salaries or PGBP. Sum received by employer is taxable as PGBP. Sum received by employee to whom the policy has been assigned is taxable under the head salaries. Sum received by any other person is taxable under this head. We have already noted in the topic on exempt incomes that sum received under keyman insurance policy is not exempt under section 1010D. Advance forfeited. Recollect our discussion on this topic in the context of advance monies in the topic on capital gain. So advance which is received in the course of negotiations for transfer of a capital asset is taxable under this head if it is forfeited and the negotiations do not result in transfer. If such sum is forfeited before 1st April 2014, it is not taxable under this head, but it is deducted in computing cost of acquisition of capital asset while computing capital gain. Next is compensation. If a compensation is received, why? For say termination of employment or modification of terms and conditions, then it is taxable as IFOS. If it is not taxable under the head salaries or PGBP. So compensation received from employer will be covered under the head salaries, which is in connection with business or profession. It will go in PGBP. The other cases will go under IFOS. Family pension. Family pension, which is payable by the employer to whom? Not to the employee. If it is to the employee, it will be taxable under the head salaries. But by the employer to the family member of the employee in the event of his death, that is called family pension. It is covered under IFOS. A deduction is allowed of lower of 1/3 of such income or rupees 15,000. Undisclosed incomes, we refer this in the topic on basic concepts. Income from undisclosed sources are referred under section 68 to 69D. In respect of such incomes, no deduction is allowed in respect of any expenditure or allowance or set-off of any loss under any provision of the Act. Consequently, such income is taxable on gross basis at a flat rate of 60%. We have discussed the rates in the topic on rate on tax. Plus, we add surcharge of 25% and then HEC at 4% of tax plus surcharge under section 115 BBE. Benefit of UBEL is not available as is provided in respect of capital gain. Deduction is not allowed under chapter VIA from the gross total income in respect of such income. Rebate of tax under 87A is allowed, but there is an alternative view. Because of this restriction, an alternative view is that rebate under 87A is also not allowed. You can follow either view, and it will be good to give a note in support of your assumption. Now we look at certain other instances of incomes which will be taxable under the head IFOS. Remuneration. Not being remuneration received from the employer, because in that case it will be covered as salaries. For example, remuneration of a MP or MLA, remuneration for setting question paper for exams, etc. Then award or reward. Note that award or reward instituted by the government is exempt under 1017A. We have noted this in the topic on exempt incomes. If it is not exempt, it is taxable as IFOS. Rent or revenue from land. If it is not exempt as agricultural income. Payment from unrecognized provident fund on retirement, etc. Right? We have discussed this in the topic on salaries, that payment from unrecognized PF is taxable when it is received on retirement. And we noted there that interest on employees' contribution is taxable as IFOS. In the topic on income from house property, we noted that income from letting of vacant land or from subletting of house property is taxable as IFOS if it is not taxable as PGBP. Directors' fees is taxable as IFOS. Royalty is also taxable if it is not taxable as PGBP. For ready reference, let's quickly go through a list of incomes which are taxable under the head IFOS. Now, these are some of the incomes which are specifically taxable under this head. Dividend, gifts, that is money or property received as gift or for inadequate consideration. Excess share premium, winnings, interest on compensation or enhanced compensation, the advance forfeited on failed negotiation for transfer of capital asset and family pension. Certain incomes are taxable under this head if not taxable under any other head. Interest on securities is taxable under this head if not taxable as PGBP. Sum received as employees' contribution to employee welfare fund if not taxable as PGBP. Letting of machinery, plant or furniture belonging to the SSE if not taxable as PGBP. Sum received under keyman insurance policy if not taxable as salaries or PGBP. Compensation if not taxable as salaries or PGBP, and any other taxable income if it is not taxable under any other head. Let's look at certain special provisions. There are certain amounts which are not deductible by virtue of section 58. So these are the disallowances in computing income under this head. 1. Any personal expense of the SSE is disallowed, and this corresponds to section 37(1) of the PGBP. 2. If the sum is payable to a resident and if TDS provisions have not been complied with, then 30% disallowance is made. That is, when tax has not been deducted in the previous year, or if it has been deducted but it has not been paid on or before the due date to furnish return of income under section 139(1). This corresponds to section 40A IA, which we noted in the topic on PGBP. Excessive or unreasonable payment to a related party is disallowed, and this corresponds to 40A2 of PGBP. Any expenditure for which a payment or aggregate is made to a person in a day which is otherwise than by a specified mode exceeding rupees 10,000 is disallowed, and this corresponds to what? Recollect 40A3 in the context of PGBP. Finally, section 59 deals with recovery against deduction already allowed, and this corresponds to section 41(1). Recollect the discussion in the topic on PGBP, deemed profits arising on recovery against deduction already allowed. 41(1) provisions apply as they apply in computing PGBP income. We will now look at clubbing of income. Under these provisions, income of a person can be included in the total income of another person. So first we look at section 64(1)(a), which deals with clubbing of income of a minor child. What does this cover? Income which accrues or arises to the minor child of an individual. Minor child, not major child. Now, where the minor child is suffering from any disability referred under section 80U, right? In the case of 80U disability, then clubbing provision is not attracted, income is not clubbed with the income of the individual. In the case of any other minor child, if income is on account of any manual work done by the minor child, then also clubbing is not done. If income is on account of his skill, talent, knowledge or experience, then also clubbing provision is not attracted. In all other cases, that means in respect of all other incomes, income is clubbed with the income of the individual, that is the parent. Now, where the marriage of his parents does not subsist, then income is clubbed with the income of the parent who maintains the minor child in the previous year. But if the marriage subsists, then income is clubbed with the income of that parent whose total income is greater. And total income is computed how? Excluding the income to be clubbed under this provision. So we determine total income before such clubbing under 64(1)(a), and then income is clubbed in the income of the parent whose such total income is greater. Income in both these cases is clubbed after allowing exemption under section 1032 of rupees 1,500 in respect of each minor child whose income is to be clubbed. Child, it includes a stepchild as well as an adopted child. Exemption of 1,500 under section 1032 is per minor child per year. It is not for each source of income and it is not per month exemption. So as we noted above, income on account of manual work, skill, talent, etc. is not clubbed. So when such income is earned, it is not clubbed. But if such income is invested subsequently, then income arising out of such investment is liable to be clubbed. Okay. So the child wins a prize in a talent competition. That income is not clubbed. But if that prize money is invested in a fixed deposit, then interest on that fixed deposit is liable to be clubbed. We now look at clubbing in case of income of spouse from concern in which individual has substantial interest, section 64(1)(2)(i). This covers a case where income is arising to the spouse of the individual by way of salary, commission, fees or any other form of remuneration, whether in cash or in kind. So income is arising to the spouse from the concern. Now we need to check whether the individual has a substantial interest in the concern. If the individual does not have a substantial interest, then clubbing provision is not attracted. Right? But if the individual has a substantial interest, that means individual has a substantial interest, then clubbing provision is attracted and such income is then clubbed in the hands of the individual. But in such case also, clubbing is still not attracted if the spouse has technical or professional qualifications for the job and the income is solely attributable to the application of a technical or professional knowledge and experience. If that be the case, clubbing is not attracted. If that is not the case, then if the individual has substantial interest in the concern, then the income of the spouse is routed back into the income of the individual by way of the clubbing provision. Now the question is, when is an individual supposed to have substantial interest? Now where the concern is a company, then substantial interest is there when the equity shares of at least 20% are beneficially owned by such person or partly by such person and partly by one or more of his relatives at any time during the previous year. Where the concern is not a company, then 20% is to be seen in respect of the profit share in the concern at any time during the previous year. What is the meaning of relative? Spouse, brother, sister, or any lineal ascendant or descendant. You can use the acronym SBSLED for quick learning. What if the income of both the spouses is liable to be clubbed? It can be the case where both the persons, both spouse as well as the individual, are not technically competent for the job and both hold substantial interest in the concern. In that case, clubbing will be attracted in case of both the persons. Then income will be clubbed in the income of the spouse whose total income before applying this provision, that means excluding such income to be clubbed, is greater. Now when we are supposed to club salary income of the spouse with the income of the individual, then it should be computed under the head salaries and then we should allow standard deduction under section 16 IA 50,000. If both the spouses have salary income, then both would be entitled to standard deduction and after providing standard deduction, the income will be liable to be clubbed. Now we look at the provisions regarding clubbing of income from assets transferred to spouse or son's wife. There are three situations. Situation A, 64.1 IV or 64.14. Asset is transferred by the individual to the spouse, right? An asset includes money. And the asset is transferred which is otherwise than for adequate consideration or in connection with an agreement to live apart. So for example, asset is gifted to the spouse and then income arises to the spouse out of such assets transferred, then such income is clubbed with the income of the individual. Situation B covers a similar situation, but in such case, instead of the spouse, assets are transferred to the son's wife, which is otherwise than for adequate consideration. In such case, the income from such asset is clubbed with the income of the individual. In situation C, the income from the asset is routed via, say, any other person or an association of persons. So asset is not directly transferred to the spouse or the son's wife. So asset is transferred to any other person or an association of person by the individual without adequate consideration. Okay? And the income from such assets is then clubbed with the income of the individual, but to what extent? To the extent it is for the benefit, whether immediate or deferred, for the benefit of the spouse or the son's wife, right? So assets have been transferred to any person or association of persons and clubbing is to the extent the income from such assets is for the benefit of spouse or son's wife. Now while applying the clubbing provisions, we also need to keep in mind the 56(2)(x) angle. A spouse or son's wife is receiving a sum of money or assets from the individual, 56(2)(x) still won't apply because the asset is being received from a relative which is specifically exempt in terms of 56(2)(x). But this is what we should nevertheless keep in mind. Now there will be a situation where the assets are invested by the spouse or son's wife. That means the transferee. In case A and B above. In case A and B above. So assets are received and assets includes money and this is invested by the spouse or son's wife. In such case, income to be clubbed in a previous year is computed as follows. First situation is where the assets are invested by the spouse or son's wife, that means transferee, in a business. then the amount to be clubbed is computed. How? We first determine the income of the transferee from the business in the previous year, and then we apply a ratio to determine the amount to be clubbed. What is the ratio? We figure out the value of such assets that are invested as on what date? As on first day of the previous year, not on any other date, right? And we figure out the total investment in the business by the transferee as on the same day, that is first day of the previous year. We figure out the ratio and we apply this ratio to the income. That brings us to the income to be clubbed. The spouse or son's wife may be a partner in a firm, and the assets may be infused as capital contribution in the firm. In that case, the interest which is receivable from the firm is liable to be clubbed. To what extent? Again, we multiply interest amount with a ratio which is similar to that in the case of business. So we figure out value of such investment as on first day of the previous year, and total investment as capital contribution made by the transferee on the first day of the previous year, and this divided by this becomes the ratio which we apply to the interest, and that brings us to the amount of interest liable to be clubbed. Now, value of assets transferred which are invested as on first day of the previous year is relevant. So even though the assets may be invested during the previous year but not on first day of that previous year, so clubbing will not apply, because the day which is supposed to be reckoned is the first day of the previous year for the purpose of calculations. Now we need to note that first day of the previous year is mentioned, not 1st April. First day of the previous year is not necessarily 1st April. Recollect the topic on basic concepts. We saw there that if a business is newly set up, then first day of the previous year is the date of setting up of the business, not 1st of April. Clubbing provisions are attracted in case of conversion of self-acquired property into property of HUF, and this is section 64(2). When the member of HUF converts his property into the property of the HUF, the income is clubbed in the hands of the individual. So, in the case of member of a HUF, where he treats his separate property, that means his own property, either he converts it into the property of the HUF, or he throws it into the common stock of the HUF, or he transfers it to the HUF otherwise than for adequate consideration, then in that case, following is the tax treatment. What happens in respect of income from such property till partition of the HUF? Till partition of the HUF, income from such property is deemed to arise to the individual and not to the HUF, and therefore it is taxable in the hands of the individual, not the HUF. What about income from such converted property after partition? After partition, income that is received by the individual himself is taxable in his own hands. But income which is received by the spouse of the individual is clubbed with the income of the individual. So his own income is taxable in his hands, and his spouse's income share is also taxable in his hands by way of clubbing. Income which is received by other members is taxable in their own hands, not in the hands of the individual. But if the other members includes minor child, then section 64(1)(a) will also come into play, and then income arising to the minor child, right, in this case will be clubbed in the hands of the individual under this provision after giving exemption of 1,500 under section 1032. Now there can be certain transfers which are in the nature of cross transfers. There are two simultaneous or parallel transfers, and both the transfers are intimately interconnected and are parts of the same transaction, but they are shown or they appear in such a way that it can be said that a circuitous method has been adopted as a device to evade section 64 implications, that means tax evasion. In that case, clubbing provisions will apply, and this is by virtue of the Supreme Court decision. So take an example where Mr. A, Master A, who is the minor son of Mr. A, Mr. B, who is the brother of Mr. A, and Mrs. B, who is the spouse of Mr. B. Now Mr. B gives 50,000 for purchase of house to Mrs. B, right? So since Mrs. B is not the spouse or the son's wife of Mr. A, the income from such house will not be clubbed in the income of Mr. A. Now shares worth rupees 50,000 are parallelly gifted by Mr. B to Master A. Now income arising on account of these shares will not be clubbed in the hands of Mr. B because Master A is not the minor son of Mr. B. So effectively Mr. A and Mr. B have indirectly transferred assets to their minor child and spouse without attracting clubbing under section 64(1)(a) or 64(1)(4). Thus in the above example, the cross transfer implications will be triggered. And then income from house property arising to Mrs. B will be clubbed with the income of Mr. B. And dividend income or other income arising to Master A from the shares will be clubbed with the income of Mr. A. Mr. A and Mr. B will be called deemed transferors to Master A and Mrs. B respectively. Now there may be a situation where the amounts involved in cross transfers are not exactly the same, right? So for example, this is 50,000 and this is say 1,50,000. So if the amounts involved vary, then income to be clubbed will be to the extent of the common amount, that is 50,000. That is the lower amount. Income relating to the excess, that is 1 lakh, will be taxable as per the regular provisions in the hands of the transferee, and clubbing provisions won't apply. Now certain principles common to section 64, common to the clubbing provisions. Just as income is to be clubbed, loss is also to be clubbed. Second, clubbing provisions cannot be avoided by saying that the asset transferred has changed its identity, right? For example, cash is gifted to the spouse and the spouse deposits such cash in fixed deposits of a bank from which interest is received. So cash has been converted to a fixed deposit. Identity has changed, but this will not avoid the clubbing provision. Next, income from accretion of transferred asset is not clubbed. For example, shares are gifted to the spouse, right? Now dividend on shares will be clubbed, but now subsequently bonus shares are issued, which is accretion on account of the shares. So this accretion will not be liable to be clubbed. So if the bonus shares are sold and capital gains arise, then capital gain will not be clubbed. Second generation income is not clubbed. That is income on income, right? For example, if the shares are gifted, then dividend arising on account of that shares is clubbed. Now say dividend income is in turn invested in a fixed deposit. What about interest on fixed deposit? It is second generation income. So that interest on fixed deposit will not be clubbed in the hands of the individual. But we need to note that as far as income of minor child is concerned, this is not relevant because all incomes, whether first generation, second generation, are liable to be clubbed in the hands of the parent under 64(1)(a). Steps to club income. So X is the person whose income is to be clubbed and Y is the person in whose hands it is to be clubbed. So how do we proceed? We figure out the own income of X and Y, which is not liable to be clubbed, which is the normal income. Then we figure out income of X, which is liable to be clubbed in the income of Y. So how we compute it? We compute such income under the relevant head of income after allowing all applicable exemptions and deductions. So that means as per the provisions of the Act. And then we include such income in the income of Y under the relevant head of income. Consequently, we figure out the gross total income of both X and Y, and then we allow deductions under chapter 6A in the hands of X for payments made by X, in the hands of Y for payments made by Y. This gives us the amount of total income on which we compute tax liability for each of X and Y, and we apply the rate of tax as applicable to each of X and Y independently, rebate 87A independently, and surcharge as applicable to each of X and Y independently. So far, we have looked at the specific provisions of clubbing which apply in specific cases. Now we look at the general provisions of clubbing which apply to all persons. Income arises to any person by virtue of a transfer. There are 4 cases, right? Section 60. There is a transfer of income, but there is no transfer of the related assets. So for example, house property is not transferred, but the income from house property is transferred. In such case, clubbing will be attracted under section 60 and income will be taxable in the hands of the transferor. Next situation is where there is a revocable transfer of assets. Section 61. In that case also the income is clubbed. That means it is taxable in the hands of the transferor. So there is a revocable transfer of assets. The transfer can be revoked, right? But there are 2 exceptions. In these 2 exceptions, section 61, that means clubbing does not apply. Number 1, where the transfer is not revocable during the lifetime of the transferee. It may be revocable afterwards, but not during the lifetime. In such case, clubbing doesn't apply. Second, where the transfer is made before 1st April 1961 and which is not revocable for a period of more than 6 years. This is section 61. Third case is where the transfer is deemed to be revocable. It may not be actually be revocable, but it is deemed so, and therefore clubbing applies and income is taxable in the hands of the transferor, section 63. Section 63. And there are two situations where the income is clubbed under section 63. Where transfer contains any provision for retransfer of the income to the transferee, it is deemed to be revocable. Or where the transfer gives the transferor a right to reassume the power over the income or the assets, then it is considered to be revocable and clubbing is attracted. Lastly, where there is irrevocable transfer of the assets, there is no issue, right? And therefore there is no clubbing. Income is taxable in the hands of the transferee. We will now look at the provisions for set off and carry forward of loss. 3 steps are basically involved. The first is inter-source adjustment, under which we set off loss from a source against income from another source but under the same head. This is section 70. Second is inter-head adjustment, under which if the loss cannot be set off in step 1, it is set off against income under another head but for the same assessment year, and this is section 71. Third is carry forward and set off. If the loss still cannot be set off, that means even after inter-source and inter-head adjustment, then it is carried forward to the following assessment year for being set off against income of that assessment year. So these are the 3 steps involved in the process. Now first we look at step 1, which is inter-source adjustment under section 70. We set off loss from a source against income from another source but under the same head. Okay. As you can see on your screen, this is the table depicting the rules in this regard. These are the heads of income, income from house property, PGBP, capital gains and IFOS, and these are the various categories of losses. Now, as far as income from house property is concerned, loss from a house property can be set off against income from another house property and there is no restriction. As far as the PGBP head is concerned, it depends on the category of business. Loss from a speculation business. Loss from a speculation business can be set off only against income from another speculation business. Okay? Not from the other categories of business. What about section 35AD? Loss from a specified business referred under section 35AD can be set off only against income from another specified business, not against other categories of income. Loss from any other business can be set off against income from another business and there is no restriction in this regard. Coming to the head capital gain, long-term capital loss can be set off only against long-term capital gain. But short-term capital loss can be set off against any capital gain, whether long-term or short-term. As far as income under the head IFOS is concerned, loss from the activity of owning and maintaining race horses, OMRH. Activity of owning and maintaining race horses. So loss from this activity can be set off only against income from such activity. As far as winnings is concerned, that means winnings from lottery, crossword puzzles, horse races, games, etc. No loss can be set off against such winnings. No loss can be set off against such winnings. And the loss in respect of such activities in the nature of winnings also cannot be set off. So winnings are basically completely ring-fenced. Loss from any other source under this head can be set off against income from another source, but except from winnings. We also need to keep in mind that this activity of owning and maintaining race horses is different from winnings from horse races. Winnings from horse races is covered under winning, and OMRH is what? It is basically the activity of owning and maintaining racehorses. Now, if the source of income is exempt, say for example under section 10, then loss from that source of income cannot be set off against income from a source which is taxable, right? So if an income is exempt, it is not taxable. Similarly, the loss from that source of income which is exempt, it also cannot be set off against income from a taxable source. We will now look at step 2, inter-head adjustment under section 71. If the loss cannot be set off in step 1, that is inter-source adjustment, then it can be set off against income under another head but for the same assessment year. So this is the income and this is the loss under various heads, right? And now as far as loss under the head income from house property is concerned, it can be set off against income under any other head, but up to a limit of rupees 2 lakh. If the loss exceeds rupees 2 lakh, it cannot be set off under inter-head adjustment. As far as loss under the head PGBP is concerned, it can be set off against income under any other head except salaries. So it cannot be set off against salary income. As far as capital gains is concerned, loss under the head capital gains cannot be set off against income under any other head. It cannot be set off. Inter-head adjustment is not possible for capital gains loss. And as far as loss under the head IFOS is concerned, it can be set off against income under any other head. Now what we need to note is that there are certain losses and incomes that are ring-fenced. So the losses that are ring-fenced are the losses which cannot be set off against any other income, both inter-source as well as inter-head. These losses cannot be set off against any other income but only against that income. So long-term capital loss can only be set off against long-term capital gain. Loss from speculation business can be set off only against income from such business. Loss from specified business referred under section 35AD can only be set off against such business under 35AD. Loss from activity of owning and maintaining racehorses can only be set off against income from such activity. Similarly, there are certain incomes that are ring-fenced. That means no loss can be set off against these incomes. And this is both inter-source or inter-head. So no loss can be set off against winnings and no loss can be set off against undisclosed income. So if there is winnings and undisclosed incomes, the whole of that amount will be taxable and it cannot be reduced on account of set off. Inter-head adjustment under section 71 can be done at what stage? Only after making inter-source adjustment under section 70 that we discussed previously. Now this limit of rupees 2 lakh for set off of loss under the head income from house property, it is only relevant as far as inter-head adjustment is concerned. It is not applicable for inter-source adjustment of loss within the head income from house property. We looked earlier that there is no restriction in that regard. We should note that there is no particular order of set off which is specified under section 71, right? So a loss is supposed to be set off against the incomes and there are incomes under multiple heads. So the question will be how to set off, where to set off first and where to set off next. So the idea should be to minimize the total income and therefore the tax liability. So we should first attempt to set off the losses which cannot be carried forward because otherwise they will lapse. Where there is a loss which can be set off against say multiple categories of incomes which are taxable at different rates. In such case, it will be better to first set off such loss against the income taxable at a higher rate and then against income taxable at a lower rate. Now we have looked above that speculation business is relevant in the context of set off because the loss from a speculation business can be set off only against income from such business. So the loss from a speculation business is ring-fenced. So the question is, what is a speculation business? So speculation business results from speculative transactions which are carried on by an SSE which are of such a nature as to constitute a business. That is what we call speculation business. So the question is, what is the meaning of speculative transaction? It means a transaction in which a contract for purchase or sale of any commodity, this includes stocks and shares as well, is periodically or ultimately settled otherwise than by the actual delivery or transfer of the commodity or scrip. So the contract is settled, but there is no actual delivery or transfer of the commodity or scrips, right? For example, day trading in shares. So without the actual transfer or delivery of shares, the contract are settled and therefore they are categorized as speculative transactions. But there are 5 categories of transactions which are not deemed to be speculative transactions, even if the contract is settled otherwise than by actual delivery or transfer. One is a hedging contract entered into by a manufacturer or merchant to guard against loss through future price fluctuations. Hedging contract entered by a dealer or investor in stocks and shares to guard against loss through price fluctuations. Forward contract entered by a member of forward market or a stock exchange to guard against loss. Trading in derivatives and securities carried out in a recognized stock exchange. And trading in commodity derivatives carried out in a recognized stock exchange, which is chargeable to commodities transaction tax. But the condition of CTT is not applicable to trading in agricultural commodity derivatives. So these are 5 transactions which are not deemed to be speculative transactions in this respect. We now look at step 3, which is carry forward and set off. If the loss cannot still be set off under steps 1 and 2, that is inter-source and inter-head adjustment, then we need to carry it forward to the following assessment year and set off against income of that year. So now we look at what are the relevant sections as far as carry forward and set off is concerned. What is the loss that can be carried forward? What is the income against which brought forward loss can be set off? And what is the time limit for carried forward, if any? Is return of loss to be filed in time? Is that a requirement? And should original business continue? Is that a requirement? So there is a requirement as far as filing of return of loss in time. So this is provided by section 80. Certain losses, not all the losses, certain losses which are specified cannot be carried forward unless they are determined in pursuance of a return of loss which should be filed in accordance with section 139.3 and within the time allowed under section 139.1. So there are certain losses for which a return of loss should be filed as per section 139.3, and this return of loss should be filed within the time allowed, which is under section 139.1, which is for furnishing of return of income, which is either 31st of July, 31st of October or 30th of November. And this is provided under section 80. If this is not complied with, then such loss cannot be carried forward to the following assessment year. So what is disallowed under section 80 is the carry forward of loss of the assessment year in which it was first computed, right? So consequently, inter-source adjustment of loss is not affected, that is not barred. So even if return of loss is not filed in time, inter-source adjustment of loss under section 70 is possible within that year. Similarly, inter-head adjustment of loss under section 71 is also not affected. That can also be freely done even if section 80 is not complied with. Similarly, loss of an earlier assessment year is also not affected. Such loss of the earlier assessment year can be brought forward to the current year and it can be set off in the current year. Even if there is default under section 80 in the current year, it doesn't matter. So the loss of an earlier year can be brought forward and it can be set off, and if it still remains unabsorbed, then it can be carried forward to the subsequent year. So what is impacted by section 80 is the carry forward of loss of the current assessment year. So what is the effect? The effect is that only the unabsorbed loss of the current assessment year lapses if section 80 is not complied with. That means if the return of loss is not filed under section 139.3 within the time allowed under section 139.1. We will now look at various provisions for carry forward and set off of loss. Section 71B deals with loss under the head income from house property, which can be carried forward, and the brought forward loss can be set off against income from house property. The time limit for carry forward is 8 years, so it can be carried forward till a period of 8 years. And there is no requirement in this respect that the return of loss be filed in time. Section 73 deals with loss from a speculation business. It can be carried forward and set off against income from any speculation business. not against income from any other business, but against income from any speculation business. There is a reduced time limit for carry forward, which is 4 years only, and the condition of filing return of loss in time applies. It is not required that the original business continue. And what is this? It is not necessary that the business in which the loss was incurred should also be carried on in the year of set-off. So it is not necessary that the speculation business in which such loss was incurred should also be carried on in the year of set-off. The assessee may be carrying on some other speculation business in the year of set-off. Successor cannot carry forward and set off the loss of predecessor. The condition is that if there is a succession in business and if there is a loss of the predecessor, then the successor cannot carry forward and set off such loss. But there is an exception. The exception is in the case of inheritance. In the case of inheritance, even the successor can carry forward and set off the loss of the predecessor, but not in any other case. Section 73A deals with loss from a specified business referred under Section 35AD. This loss can be carried forward and set off against income from any specified business. But what we need to note is the loss can be set off against income from any specified business which is referred under Section 35AD, whether or not it is eligible for deduction under Section 35AD, because there is a list of specified businesses, but there are certain further conditions to be satisfied so that 35AD deduction can be claimed. Both are different aspects from a loss point of view. So the loss from 35AD business can be carried forward and set off against income from any specified business which is referred under Section 35AD, even if that specified business is not otherwise eligible for deduction under Section 35AD. That doesn't matter. Now, the benefit is that there is no time limit for carry forward. It can be carried forward indefinitely till it is fully absorbed. The condition of return of loss to be filed in time applies. Original business need not continue in the year of set-off, and successor cannot carry forward and set off loss of predecessor. What about loss from any other business? It is covered under Section 72. That means loss which is not from a 35AD specified business or speculation business. So the general business loss can be carried forward and it can be set off against income from any business or profession, whether it be a normal business or profession or a 35AD business or a speculation business. The time limit to carry forward is 8 years. Return of loss needs to be filed in time. Original business need not continue in the year of set-off, and successor cannot carry forward and set off loss of predecessor. What about unabsorbed depreciation? This is covered by Section 32(2). Now, unabsorbed depreciation can be carried forward and it can be set off against any income, but except under the head salaries, right? Why? Because unabsorbed depreciation becomes part of the current year's depreciation under Section 32(2). Hence, it can be set off against any income except under the head salaries. It can be set off even if the business to which it relates does not exist in the year of set off. And the benefit is that there is no time limit to carry forward. Return of loss to be filed in time, that condition is not applicable. Now, there could be a situation where in the year of set off, we have current year's depreciation, the unabsorbed depreciation, as well as brought forward business loss. So the question would be, what should be the order of set off? What is it that we should set off first and then next? So the order of set off is this. First, we need to adjust or deduct or set off the current year's depreciation. Second, brought forward business loss, and lastly, unabsorbed depreciation. Coming to loss under the head capital gain. This is Section 74. As far as short-term capital loss is concerned, it can be carried forward and set off against any capital gain, whether short-term or long-term. The period is 8 years and the return of loss needs to be filed in time. But as far as long-term capital loss is concerned, it can be carried forward and set off only against long-term capital gain, not against short-term capital gain. And the time period remains for carry forward at 8 years and return of loss condition applies. Finally, under the head IFOS, only one loss can be carried forward to be set off, that is under Section 74A, and that is loss from the activity of owning and maintaining race horses. It can be carried forward and set off only against income from such activity. There is a reduced time limit of carry forward of 4 assessment years. The return of loss condition applies. And in this particular case, it is required that the activity in which the loss was incurred should be carried on in the year of set off as well. Successor cannot carry forward and set off the loss of predecessor. Now certain points that we need to keep in mind. As far as brought forward loss is concerned, it can be set off only against income under that head which we have noted in the table above. Inter-head adjustment is not possible. For example, loss from house property can be carried forward and set off against income from house property, not against income from any other head. What about rupees 2 lakh limit of set off of loss from house property under any other head that we noted as far as inter-head adjustment is concerned? That limit is not applicable in respect of carry forward and set off of such loss under section 71B from income from house property. That limit is only in respect of inter-head adjustment. Loss which is not specified above in the table cannot be carried forward, and therefore it simply lapses if it is unabsorbed for that assessment year. So for example, loss under the head income from other sources, right? It cannot be carried forward and therefore it lapses, but there is only one loss which is from activity of owning and maintaining resources that is only allowed to be carried forward. If there is any other loss under this head IFOS, there is no provision to carry forward such loss. We now come to deductions from gross total income under chapter VIA, under chapter 6A. First, we look at certain general principles. The aggregate amount of deductions from gross total income cannot exceed the gross total income. Therefore, total income cannot become negative on account of these deductions. Deductions from gross total income are not allowed from the following incomes. Basically, these are the incomes taxable at a special rate. Number 1, capital gain which is other than normal short-term capital gain. That means short-term capital gain under section 111A and long-term capital gain under section 112A or 112. 111A taxable at 15%, 112A 10%, 112 20%. In the case of winnings. And thirdly, on undisclosed income under section 68 to 69D. So first we will cover the deductions for investments which are covered in 80C, 80CCC and 80CCD. So first we look at section 80C, which is on account of specified payments or deposits. Who is the eligible SSE? Individual or HUF. The maximum deduction allowed is 1,50,000 in respect of specified payments or deposits. What is permissible as a deduction? Sum paid or deposited in the previous year by the SSE. So deduction is allowed on payment basis, not on due basis. So we will look at these specified payments or deposits one by one. First is on account of life insurance premium. The insurance should be on the life of either self or spouse or the child in the case of individual, or member of HUF in the case of an HUF SSE. Now deduction is allowed up to a specified percentage of sum assured. Up to a specified percentage of sum assured. Date of issue of policy. If it is on or before 31st March 2012, then deduction under section 80C is allowed for premium paid up to 20% of sum assured. Where policy is issued during the financial year 2012-13, then deduction is allowed for premium paid up to 10% of minimum sum assured. 20% comes down to 10%. The position on or after 1st April 2013. Two situations. Where the insured is a person with disability or severe disability referred under section 80U, or suffers from disease or ailment specified under 80DDB, then the percentage is 15%. The deduction is allowed up to this extent. In case of any other insured, the deduction is for premium paid up to 10%. So a lower amount of 10% is prescribed. Now a lock-in period of 2 years is prescribed in this respect, and we will look at the lock-in periods in some time. Second, deferred annuity plan. Deferred annuity plan is covered under 80C, but not covered in number 11. What is number 11? Payment to annuity plan of the LIC or any other insurer. That is covered separately, but what is not covered there is covered here. Deferred annuity plan. Contract should be on the life of whom? Self, spouse or child in the case of an individual. And contract should be non-commutable. Right? Number 3. The sum deducted from the salary for securing a deferred annuity for a government employee only is allowed as deduction. Now, sum may be deducted for securing deferred annuity to individual assessee or making a provision for his spouse or children. There is a limit. The deduction is limited to 20% of salary. Fourth, contribution to statutory provident fund is allowed 80C deduction. And this is only for employees' contribution. Number 5, contribution to recognized provident fund. And this is only for employees' contribution. Employees' contribution to unrecognized provident fund is not eligible for 80C deduction. Sixth, contribution to PPF. And the contribution should be to the account of self, spouse or child in the case of individual or member of HUF in the case of an HUF. 7. Contribution to approved superannuation fund. And deduction is for employees' contribution. Employees' contribution to unapproved superannuation fund is not eligible for 80C deduction. 8th, deposit in Sukanya Samriddhi account. And the deposit should be in the name of either the individual or any girl child of that individual or any girl child for whom such person is the legal guardian. 9th, subscription to National Savings Certificate NSC, 8th issue or 9th issue. Now what we need to note is the accrued interest, except for the last year. Accrued interest is deemed to be reinvested and therefore it is also eligible for deduction under 80C. 10. Contribution to ULIP, Unit Linked Insurance Plan 1971 of UTI, Unit Trust of India, or ULIP of LIC Mutual Fund. Now the contribution should be in the name of self, spouse or child in the case of individual or member of HUF in the case of a HUF. As far as ULIP of LIC Mutual Fund is concerned, it should be notified and a lock-in period of 5 years has been prescribed. We will look at this shortly. Number 11, payment to annuity plan of the LIC or any other insurer, and the annuity plan should be notified. 12, subscription to units of a mutual fund or UTI, the scheme should be notified. 13, contribution to pension fund of a mutual fund or UTI, the pension fund should be notified. What we need to note is pension fund of LIC or any other insurer is covered where? Under section 80 CCC. Pension scheme of central government, that is NPS or Atal Pension Yojana APY, is covered where? Under section 80 CCD. 80C covers what? Pension fund of a mutual fund or UTI. Number 14, subscription to National Housing Bank Tax Saving Term Deposit Scheme 2008. Number 15, subscription to deposit scheme of a housing authority or housing finance public sector company, and the scheme should be notified. Number 16, covers tuition fees, and tuition fees should be paid to what? To any university, college, school or other educational institution situated within India, not outside India. It should be for the purpose of full-time education, not part-time education. Of what? There is a limit of any 2 children of the assessee, not beyond 2 children. Deduction is not available for what? For development fees, donation or similar payment. Number 17, if certain specified payments are made for what? For purchase or construction, not for any other purpose. Of what? Of residential house, not for a non-residential house. And the condition is that income from such house property should be taxable under the head IHP, and therefore it includes a self-occupied property as well. What are the specified payments? 1. Payment under a scheme of any development authority, housing board, etc. 2. Payment to a company or cooperative society of which the assessee is a shareholder or member towards the cost of the house property allotted to him. Right? So payment of installments in cases 1 and 2. 3. Repayment of amount that has been borrowed from whom? From either the government or bank or life insurance corporation, national housing bank, housing finance company, etc. So that repayment of principal is covered here. 4th, stamp duty, registration fee and other expenses for what? For transfer of house property in the name of the assessee is covered. There are certain payments which are not deductible under section 80C. 1. Admission fee, cost of share and initial deposit for what? For becoming a shareholder of a company or member of a cooperative society. Number 2. Cost of any addition, alteration, renovation or repair of house property is not deductible under 80C. Carried out after the issue of completion certificate or after the house property has been occupied or is let out. Number 3, interest on capital borrowed, which is deductible under section 24 in computing income under the head income from house property. A lock-in period of 5 years is prescribed, which we will note in some time. This is a snapshot. Nature of property and capital is borrowed for what purpose? Whether the property is residential or non-residential and capital is borrowed for purchase, construction, repair, renewal or reconstruction, interest is deductible under section 24B in computing income under the head IHP. But 80C deduction is available only on account of principal, where the property is residential and capital is borrowed for purchase or construction. It is not available in other cases. Next, number 18. Subscription to equity shares or debentures or units of a mutual fund. The condition is that the subscription should be made in an eligible and approved issue of capital by a public company or a public financial institution, and a lock-in period of 3 years has been prescribed for what? For shares and debentures. 19. Term deposit with a bank, but it should be for 5 years or more. 20. Subscription to bonds of NABARD, and the bond should be notified. 21. Deposit in the senior citizen savings scheme. A lock-in period of 5 years has been prescribed. 22. Deposit in 5-year post office time deposit scheme, POTD. A lock-in period of 5 years has been prescribed. And finally, number 23, contribution to Tier 2 NPS account. Now, NPS account has a Tier 1 account, which is the individual pension account, and Tier 2 account, which is the additional account. Contribution to Tier 1 account is eligible for deduction under 80CCD in the case of all individuals. But 80C covers contribution to Tier 2 NPS account. But the 80C is available only when such contribution is by a central government employee, not any other employee. And the contribution should be for a fixed period of 3 years or more. Now we come to the lock-in period, which have been specified. And as you can see, column 1 refers to the serial number in the table of the above that we discussed. What should be the default? That means within the lock-in period. And then what are the implications? As far as life insurance policy is concerned, the default is that the policy terminates or ceases to be in force when? Within 2 years after commencement of the policy. If it is a case of a single premium policy, premium is only paid once and the policy terminates or ceases to be in force within 2 years after commencement. In other cases where the policy terminates or ceases before premiums are paid for 2 years. So 2 years is the lock-in period. Number 10 of the table was a case of ULIP 1971 of the UTI or notified ULIP of LIC mutual fund. In that case, what is the default? ULIP terminates or ceases before contributions are paid for 5 years. So 5 years lock-in period. Number 17 was purchase or construction of residential house property, specified payments made. What is the default? The property is transferred before the expiry of 5 years from the end of the financial year in which possession is obtained. So 5 years is the lock-in period. In these cases, what are the implications? In the current year, no deduction is allowed under section 80C for the sum paid in the current previous year. So in the current previous year, no deduction is allowed under section 80C. But what about the deduction under section 80C which have been allowed in the preceding previous years? So the aggregate of deductions under section 80C which have been allowed for preceding previous years is deemed to be the income of the current previous year, and therefore it becomes taxable in the current previous year. So that means 80C deduction allowed earlier is effectively reversed or clawed back. In the case of equity shares or debentures, which we noted above, where subscription is made in an eligible and approved issue of capital, in that case, there is this lock-in period of 3 years. Where shares or debentures are transferred within 3 years from the date of acquisition, then the deduction under section 80C, which was allowed in the preceding previous years, is reversed, it is clawed back. Finally, in the case of senior citizen savings scheme or 5-year post office time deposit scheme, What is the default? The amount, and this includes the interest accrued. That amount is withdrawn before expiry of 5 years from the date of deposit. What happens? The amount so withdrawn is deemed to be the income of previous year of withdrawal, and therefore it becomes taxable. Now in this situation, what we need to notice that as far as the principal withdrawn is concerned, it is taxable, it becomes liable to tax. But there is an exception where it is received on death. Where it is received on death, the amount is withdrawn, it is not taxable. As far as interest accrued which is withdrawn is concerned, it is liable to tax if it was not taxed earlier. But if it was taxed earlier, say on due basis or accrual basis, then it will not be taxed again upon withdrawal, because double taxation of the same amount is not permissible. Section 80 CCC covers contribution to a pension fund. The deduction is available to an individual and the maximum deduction is rupees 1,50,000. Now this covers contribution to a pension fund of the LIC or any other insurer which is referred to in section 1023 AAB. So LIC or any other insurer basically. And there are two categories. Where the amount is paid or deposited in the previous year by the SSE. To what? To any annuity plan in such pension fund for receiving pension from such fund. So contribution is to the annuity plan for receiving pension from such pension fund. Then the deduction is equal to such amount up to a limit of rupees 1.5 lakh, right? But this excludes interest or bonus if it is accrued or if it is credited. So basically the amount which is paid or deposited is allowed as deduction. Now this amount on which 80CCC deduction has been allowed, it may be received by the SSE from the fund or by his nominee together with interest or bonus. Now in such case the amount may be received in two situations. Where say the annuity plan is surrendered in the previous year or pension is received from the annuity plan. In both these cases, the amount which is received is deemed to be the income of the SSE in the year in which the withdrawal is made or the pension is received and is accordingly taxable in that previous year. 80CCD, it covers contribution to pension scheme. Which pension scheme? The new pension scheme NPS or Atal Pension Yojana APY. Deduction is allowed to an individual and maximum deduction is of a specified percentage of salary or gross total income. 80CCD covers amount paid or deposited in the previous year in the account of the SSE under the notified pension scheme, where the SSE is employed by an employer. That means in the case of an employee and in any other case. In the case of an employee, the contribution may be made by the employer as well as the employee. Both are eligible for deduction under 80CCD. As far as employer's contribution is concerned, it is first included in the income under the head salaries and then 80CCD deduction is allowed. And there is a limit to such deduction. What is the limit? 14% of the salary in the previous year in the case of a government employer, whether central government or state government, and 10% of salary in the previous year in the case of any other employer. This is 80CCD2. So employer's contribution 80CCD2. What about the contribution of the SSE employee? That means the employee's own contribution. Deduction is allowed under 80CCD1. And what is the limit? Up to 10% of the salary in the previous year. In addition to 80CCD1, for employees' contribution, an additional deduction is allowed under 80CCD1B of up to rupees 50,000. Right? But on that contribution on which 80CCD1 deduction has not been allowed. So for the same amount, 80CCD1 and 80CCD1B cannot be claimed. So as far as the employee SSE is concerned, employee's contribution allowed up to what? 14% of salary for government employee and 10% of salary in the case of other employees. As far as employee's own contribution is concerned, 80CCD1 up to 10% of salary plus an additional deduction 80CCD1B up to 50,000, provided that the same amount is not deductible under both the provisions. So if the deduction has been claimed on an amount under 80CCD1, on the same amount 80CCD1B cannot be claimed. What about a non-employee? That means in any other case, 80CCD1 deduction is allowed. So in this case, employer will not contribute, only the SSE will contribute. 80CCD1 is allowed, and it is up to 20% of gross total income in the previous year, plus an additional deduction of 80CCD1B in the same fashion as that for an employee's own contribution, which is up to 50,000. So in the case of a non-employee, that means basically a self-employed person, 80CCD1 plus 80CCD1B. Now, what is the meaning of salary? Salary includes DNS allowance, but if the terms of employment so provide. That means if it forms part of salary for computing retirement benefits, but excludes all other allowances and perquisites. Now, deduction under section 80CCD1B, that is additional deduction of 50,000, is allowed whether or not 80CCD1 deduction is allowed, right? But to avoid double deduction, it is allowed only on that contribution on which 80CCD1 has not been allowed. Now, there is an overall combined limit on deductions under section 80C, 80CCC and 80CCD, which we have discussed so far. And this is by virtue of section 80CCE. So 80C, we saw that the limit is 1,50,000. 80CCC, we saw that the limit is 1,50,000, right? And as far as 80CCD is concerned, we saw that there is 80CCD1, 1B and 2. Right? 80CCD is 1, 80CCD1 is for what? It is for SSE's contribution, for NPS or APY, SSE's contribution. In the case of a salaried employee, the limit is 10% of salary. For a self-employed person, it is 20% of gross total income. And then there is additional deduction of 50,000 under section 80CCD1B, which can be allowed for SSE's contribution. And then under 80CCD2, deduction is for employer's contribution in the case of an employee. And what is the limit? 10% of salary or 14% of salary in the case of a government employer. Now 80CCE provides that the limit of deduction combined for 80C, 80CCC and 80CCD1 will be 1,50,000. So combined deduction for all of these three cannot exceed 1,50,000. But this limit does not apply to 80CCD1B, where the limit remains at 50,000 independently, it can be claimed. Similarly, for employer's contribution to NPS or APY, 80CCD2 also, the limit remains independent of section 80CCE. We will now look at the theme for deductions for health and wellness. 80D, 80DD, 80DDB and 80U. Section 80D covers health-related expenditure. It is allowed to an individual or HUF. The maximum deduction for each category can be either 25,000 or 50,000. So SSE can be an individual or HUF. The person for whose benefit the payment is made, in the case of individual, can fall in two buckets. Bucket 1, self, spouse or dependent children. Children who are not dependent are not covered. A spouse can be dependent, may not be dependent, may be dependent, it doesn't matter. Bucket number 2 covers parents. May be dependent, may not be dependent, it doesn't matter. For HUF, payment should be in respect of any member of the HUF. Okay. Now, what are the payments that are covered for the deduction under 80D? Categories 1 and categories 2. Two categories. In category 1, 3 types of payments are covered. Health insurance premium, covered. Contributions made to the Central Government Health Scheme or CGHS, covered. Payment made on account of preventive health checkup, covered and covered. Not covered in case of HUF. So, we figure out the amounts of these 3 payments under category 1 and then we aggregate, and what is the limit of deduction in respect of this category 1? For bucket 1, for individual, bucket 1, self, spouse and dependent children, the overall limit is 25,000. Similar for parents. Okay, so 25,000 for bucket 1 and 25,000 for bucket 2. But if the health insurance premium is paid for a person who is a senior citizen, right? For a senior citizen, then an additional deduction of 25,000 is allowed both in case of bucket 1 as well as bucket 2. So similar is the position for HUF. The general limit of deduction for category 1 for HUF is 25,000, but in case health insurance premium is paid for a senior citizen, additional 25,000 is allowed. So 25,000 is the maximum cap of deduction for category 1, but in case of a health insurance premium for senior citizen, the overall limit rises to 50,000. Now we come to category 2. Category 2 covers medical expenditure which is incurred on the health of a senior citizen, right? So in the case of individual, for each of the two buckets where the person is a senior citizen and the condition is that health insurance premium has not been paid. So health insurance premium has not been paid. That means the medical expenditure is incurred because health insurance premium has not been paid, so deduction is allowed on account of medical expenditure, and the person should be a senior citizen. In that case, such expenditure is also covered. And the limit of deduction for this category 2 is 50,000. Why 50,000? Because the person is a senior citizen. Now we aggregate the eligible deduction under both categories 1 and 2. Both categories 1 and 2 in respect of individual bucket 1, individual bucket 2, and if HUF is concerned, for the members of the HUF. The overall limit of deduction for 1 plus 2, that means the combined deduction limit under section 80D, in the case of individual for bucket 1 is rupees 50,000. For individual bucket 2, that is parents, is again 50,000. For HUF, it is 50,000. Who is a senior citizen? An individual who is a resident in India. Non-residents are not covered. Who is of the age of 60 years or more. When? At any time during the relevant previous year. Now, as far as preventive health checkup is concerned, there is an overall limit of deduction, and this is the sublimit for preventive health checkup, which is 5,000. And this applies combined for self, spouse, children, and parents. The mode of payment, where it is a case of payment for preventive health checkup, it can be in any way. It can be cash payment or in any other mode. But as far as any other payment is concerned, then it should not be in cash. It can be in any other mode. If it is in cash, deduction is not allowed. Sometimes lump sum premium is paid because insurance policy is in force for multiple years and premium is paid one time at the beginning. So proportionate deduction for each previous year is allowed. And how do we compute it? We determine the amount paid and the total number of previous years. Comprised in what period? Which begins with the previous year in which the amount is paid and the subsequent previous years during which the insurance is in force. And then we divide amount paid by the total number of such previous years. That brings us to the deduction for each previous year. Section 80DD, 80DDB and 80U provide for deduction on account of disability or medical treatment of specified diseases. Section 80DD for maintenance and medical treatment of disabled dependent. 80U for disability and 80DDB for medical treatment of specified diseases. The presentation is in a tabular format, so this will help you in understanding the comparative provisions as well. So we first look at 80DD. Deduction is allowed to an individual or HUF who is a resident. Conditions: 1. The assessee has incurred expenditure for the medical treatment, training and rehabilitation of whom? Of a dependent. Or 2. Has deposited amount in an approved scheme of UTI, LIC or any other insurer for maintenance of a dependent. The deduction under 80DD is allowed to whom? To the assessee making the payment, not to the dependent. The question is, who is a dependent? In the case of an individual, it means the spouse, children, parents, brothers and sisters of the individual or any of them. In the case of HUF, it means a member of the HUF. But the conditions are that such person, 1, should be a person with either disability or severe disability. So a disabled dependent. Should be wholly or mainly dependent on the assessee for his support and maintenance. So a dependent. And should not have claimed deduction under 80U, because in that case 80U is available, not 80DD. What is the amount of deduction? In the case of a person with disability, it is a flat deduction of 75,000 irrespective of the amount of expenditure. In the case of a person with severe disability, flat deduction of 1,25,000. Disability means where the person is suffering from 40% or more disability. Severe disability means where he is suffering from 80% or more disability. The assessee should furnish copy of the medical certificate along with the return of income in order to claim the deduction. So this is 80DD. Now we come to 80U. This deduction is available to an individual who is a resident, not to an HUF. The assessee should be certified to be a person with disability or severe disability. The deduction is allowed to the disabled assessee, right? That means to the assessee himself, not to any other person. And the amount of deduction is the flat 75,000 or 1,25,000, same as 80DD. The condition of certificate also applies as it applies for 80DD. 80DDB, for medical treatment of specified diseases. It is available to an individual or HUF who is a resident. What are the conditions? The assessee has paid for medical treatment of a specified disease. For whom? For self or dependent in the case of individual, or for member of HUF in the case of HUF. And the second condition is that the assessee should obtain prescription from a specified doctor. Deduction is allowed to such assessee who is making the payment. Who is a dependent? The list in the case of individual or HUF is the same as that under 80DD. And the condition is that the person should be wholly or mainly dependent on the assessee for his support and maintenance. What is the amount of deduction? It is not a flat deduction. It depends on the amount of expenditure. So deduction is equal to amount paid, but there is a limit. What is the limit? It is 40,000. But this is enhanced to rupees 1 lakh, where the amount paid is in respect of a senior citizen. Who is a senior citizen? An individual who is a resident in India, not a non-resident, who is of the age of 60 years or more, when? At any time during the relevant previous year. Now this amount is further reduced. This amount is further reduced by what? By the amount if it has been received as insurance claim from an insurance company, or it is reimbursed by the employer. Okay. So for example, 1,50,000 is the amount which has been spent in respect of a senior citizen. So the limit will be 1 lakh. And say further, the insurance claim of say 40,000 has been received. So this 40,000 will be reduced further. So 60,000 will be the amount of deduction under 80DDB. We will now move to deduction for interest on loan. 80E, 80EE, 80EA and 80EB. So loan is taken and interest, so deduction is allowed in respect of interest. 80E is for higher education, 80EE and 80EA is for residential house, and 80EB is for electric vehicle. Tabular presentation to help you easily understand the comparative provisions as well. So we first look at 80E. It is allowed to an individual. The loan should be taken for pursuing higher education. Higher education. What is the meaning of higher education? It means any course of study after passing class 12th. After passing class 12th is higher education. Loan should be taken from a bank or notified financial institution or approved charitable institution. The higher education should be for whom? For either self or spouse or children, or a student for whom the assessee is the legal guardian. Deduction is in respect of interest paid during the previous year. So deduction is on payment basis, not on due basis. And the deduction is allowed till a maximum of 8 previous years from the previous year in which the assessee starts paying interest. So the year in which interest payment starts plus 7 subsequent previous years. There is no limit on the amount of deduction per year. So this is section 80E. Now 80EE and 80EA. Deduction is allowed to an individual. Loan should be taken for acquisition of residential house property from a bank or housing finance company. What are the conditions for 80EE? 1. The loan is sanctioned during previous year 2016-17. Second, amount of loan is not greater than 35 lakh. value of property is not greater than 50 lakh. An assessee does not own any residential house property on the date of sanction of the loan. The conditions become a bit different for 80EE. The first condition is that assessee should not be eligible for deduction under 80EE. So if the assessee is covered under 80EE, 80EE doesn't apply. This is first. Now, second condition, loan is sanctioned during previous year 2019-22, 21-22. Okay. Third, SDV of residential house property is not greater than 45 lakh. And fourth, assessee does not own any residential house property on date of sanction of loan. So the difference between 80EE and 80EE is 180EE applies where 80EE doesn't apply. Second, the previous year covered for sanction of a loan are different for 80EE and 80EE. Under 80EE, the amount of loan should not be more than 35 lakh. There is no condition under 80EE as in regard to amount of loan. In 80EE, the value of property should not be more than 50 lakh. 80EE, the SDV of property should not be more than 45 lakh. And the condition of not owning any property on the date of sanction of loan is the same for both the provisions. Now, deduction is of interest payable during the previous year. So, it is not allowed on payment basis but on due basis. And there is no limit on the duration. As against 8 years for 80E, there is no limit on the duration for 80EE and 80EA. For 80EE, the deduction is 50,000 per year, whereas for 80EE, it is 1,50,000 per year. Now, only acquisition of property is covered. If the loan is taken for renewal, repair, etc., it is not covered. What about repayment of principal? Interest deduction is covered under these provisions. Repayment of principal, the deduction is covered under section 80C. Now, interest on capital borrowed is also allowed under 24B in computing income under the head income from house property. This deduction of interest is over and above what is allowed under section 24B. 80EB applies to an individual where loan is taken for purchase of an electric vehicle from a bank or NBFC. The only condition is that the loans should be sanctioned during previous year 2019-22, 2022-23. And deduction is allowed on due basis. There is no limit on the duration of deduction. And the deduction per year is up to rupees 1,50,000. The vehicle can be used for personal purposes or official purposes. It doesn't matter. The deduction is allowed. We will now see deduction for donations. 80G, 80GGA, 80GGB and 80GGC. First we look at 80G, donations to certain funds, institutions, etc. All SSEs are covered. The maximum deduction is at 50% or 100% of donations as specified. The total deduction under section 80G is equal to the aggregate of amounts computed in table A and table B. So amount computed in table A plus amount computed in table B. First we look at table A. The deduction in respect of each item, there are several items as you can see in table A. Deduction in respect of each item is equal to amount of donation multiplied by the percentage specified in this table. And the percentages as you can see can be either 100% of the donation or toward the end there are 4 categories eligible for 50%. We will quickly recap only the more important ones which are relevant from an exam point of view, although you should be aware of all these items in table A, right? So, Chief Minister's Relief Fund or Lieutenant Governor's Relief Fund, 100%, right? Now, there are these three items which you can remember with the acronym CM because they relate to Chief Minister's funds. Chief Minister, Chief Minister, Chief Minister. Okay, so CM. Next, Clean Ganga Kosh. The condition is that assessee should be a resident and the sum paid should not be pursuant to the CSR expenditure under the Companies Act. Fund set up by a state government to provide medical relief to the poor. Now there are certain funds which are national in nature, so which have the word national, and therefore you can remember by NAT. So some of these are National Children's Fund, National Cultural Fund, National Defense Fund, National Sports Fund, right? And certain other funds as well. All of these are entitled to 100%. Then there are three funds which use the word Prime Minister. So you can remember with PM. And the important ones are Prime Minister Citizen Assistance and Relief in Emergency Situations Fund, which is popularly called as PMKS Fund, the Prime Minister's National Relief Fund. Then there is Swachh Bharat Kosh. The sum paid should not be pursuant to CSR under Companies Act. Now there are four items which are eligible for 50%. 50%. Indira Gandhi Memorial Trust, Jawaharlal Nehru Memorial Fund, Prime Minister's Drought Relief Fund, and Rajiv Gandhi Foundation. Acronym which you can use is Congress D. Congress, Indira Gandhi, Jawaharlal Nehru, Rajiv Gandhi. And D is in addition because it is Prime Minister's Drought Relief Fund. So this is table A. So you need to compute the amount of donation into the specified percentage for each item and aggregate that, and that becomes the aggregate for table A. Now we move to table B. Deduction in respect of each item is equal to amount of donation multiplied by percentage specified in the table. There are two items, 100% and the rest are 50%. Okay. 100% of deduction on account of the donation is provided in respect of what? Number one, for promoting family planning. But the donation should be to the government or an approved local authority, institution or association. Second, donation to Indian Olympic Association, IOA, or any other notified sports association or institution established in India, not outside India. But the condition is that the assessee making the donation should be a company. If say the donation is made by an individual, then it is not allowed as deduction under ATG. Acronym which you can use is FOS to remember, and both these donations are eligible for 100% deduction. The rest are eligible for 50%. And there are 5 of them. Donation to a housing authority. Donation to a corporation established by the government for promoting interest of minority community, which is notified. Donation for renovation or repair of what? Of a temple, mosque, gurudwara, church or other place of worship which is notified. Next, donation to a charitable fund or institution which is established in India and it satisfies the prescribed conditions. So, donations to a charitable fund or institution which is in India. And finally, to the government or any local authority to be utilized for charitable purpose, but not family planning. Why? Because family planning is separately covered in number 1 here. These are entitled to deduction at the rate of 50%. HOMITEC is the acronym which you can use for quick remembering. Donations, all of them which are listed in table B, they are subject to a limit. The aggregate of donations in table B cannot exceed the qualifying limit. Right? So there is this upper cap. What is the qualifying limit? It is 10% of adjusted total income. For that, we need to compute adjusted total income. What is that? We first need to figure out the gross total income. And then we need to reduce the following from the gross total income. What? Capital gain, which is taxable at a special rate. That means either under 111A at 15% or long-term capital gain under 112 at 20% or 112A at 10%. Second, all deductions under chapter VIA from the gross total income, but except under section ATG. So except ATG, all deductions under chapter VIA. Lastly, income on which income tax is not payable under any provision of the Act. That is share from association of persons or body of individual. So from the gross total income, we reduce all these amounts 1, 2, 3. That gives us the amount of adjusted total income. We compute 10% of that. That becomes the qualifying limit. The total donations in table B is subject to this particular limit. Once we figure out the total eligible donation, Then we apply these percentages of 100% or 50% to arrive at the deduction under table B. And the final deduction under ATG is the aggregate of amount that we compute in table A plus table B. Now, no deduction is allowed under ATG on two counts. For donation which is in kind, it is not allowed. For donation of any sum which is more than 2000, if payment is made in cash, it is not allowed. Next, we have sections 80GGA, 80GGB and 80GGC. 80GGA for scientific research or rural development. 80GGB and GGC for political parties. First, we look at 80GGA. Deduction is allowed to all the SSEs. So, any SSE is covered. And what are the eligible donations? 1. Sum which is paid to a research association, university, college or other institution approved under section 35 for scientific research, research in social science or statistical research. Recollect the discussion in the topic on PGBP, the deduction under section 35 on account of scientific research expenditure. Second, sum paid to Rural Development Fund, National Urban Poverty Eradication Fund or association or institution engaged in rural development approved or notified under section 35 CCA. Recollect 35 CCA in the topic on PGBP. Both 35 and 35 CCA are deductions which are allowed in computing PGBP income. Therefore, if the gross total income includes business income, then deduction can be claimed under 35 and 35 CCA. And therefore, the condition to claim deduction under section 80GGA is what? Gross total income should not include income taxable under the head PGBP. Right? SSE having PGBP income can claim deduction under 35 or 35 CCA. Any sum which is exceeding rupees 2000 should not be paid in cash, otherwise deduction will not be allowed. Deduction is equal to 100% of specified donation and there is no limit to the amount of deduction. Both 80GGB and 80GGC apply in respect of any sum contributed to a political party or an electoral trust. 80GGB applies only to an Indian company, but 80GGC applies to any person except local authority or artificial juridical person. The condition is that contribution should not be in cash. Deduction is of 100% of such contribution and there is no limit to the amount of deduction. We have noted in discussing the topic on PGBP that expenditure on any advertisement in souvenir, brochure, tract, pamphlet or the like published by a political party is specifically disallowed under section 37(2)(b). Deduction is not allowed in computing PGBP income in the case of all the SSEs. But what about deduction under section 80GGB and 80GGC from the gross total income in respect of such expenditure on advertisement? In the case of 80GGB, that is in the case of an Indian company, this expenditure is covered. It is considered as a contribution and therefore an Indian company is allowed deduction from gross total income in respect of such expenditure. But this is not the case with 80GGC. Therefore, any SSE which is not an Indian company is not allowed deduction in respect of such expenditure on advertisement. Now we move to deduction for rent, and this is section 80GG. An individual is eligible for deduction and the maximum deduction can be at the rate of 5,000 per month. 4 conditions need to be satisfied. 1. SSE should not have income in the nature of house rent allowance HRA from his employer. Why? Because in that case, income will be taxable under the head salaries and exemption from HRA can be claimed there. Second, he should incur expenditure on payment of rent in respect of accommodation occupied by him for own residence. If this is not satisfied, then 80GG deduction cannot be claimed. Third, at a place where the SSE ordinarily resides or performs duties or carries on business or profession, any residential accommodation should not be owned at such place. By whom? By either the SSE or his spouse or minor child, or the HUF if the SSE is a member of the HUF. Why? Because if you already have a residential house in such place, what are you paying rent for? So no 80GG. As far as any other place is concerned, any residential accommodation should not be owned by the SSE at such place. Which accommodation? The annual value of which is taken as nil by virtue of it being a self-occupied property. Self-occupied property SOP The NAV is taken as nil, so you cannot take the benefit of nil NAV as well as ATGG deduction. Fourth, SSE should file a declaration in the prescribed form. What is the amount of deduction? It is lower of 1, 2 or 3. 1. 5,000 per month. 2. Expenditure incurred on payment of rent minus 10% of adjusted total income. 3. 25% of adjusted total income. Adjusted total income is what? Similar to what we saw in the case of ATGG. Gross total income, and we reduce the following. Capital gain taxable at special rate, which is what? STCG under section 111A and LTCG under section 112 or 112A. Second, deductions under chapter VIA are to be reduced except under ATGG. So except for ATGG, all other deductions under VIA chapter are supposed to be reduced. This is adjusted total income. Deduction on account of interest income is provided by sections 80TTA and 80TTB. 80TTA is available to an individual or HUF who is not referred under 80TTB. 80TTB applies to a senior citizen. Senior citizen means an individual who is a resident in India of age 60 years or more when at any time during the previous year. So if the person is a senior citizen, 80TTB applies. Else 80TTA applies. So in the case of a non-resident, say for example of 70 years of age, he is not a senior citizen. 80TTB will not apply, 80TTA will apply. Now, under section 80TTA, what is covered? Interest on deposits in savings account with a bank or cooperative bank or post office. Therefore, interest on time deposits is not covered. Time deposits like fixed deposit or recurring deposit. So interest on deposits in savings account is only covered. 80TTB, what is covered? Interest on deposits with bank, cooperative bank or post office. Same, 3 are covered. And therefore, interest on savings account, time deposit or any other deposit is covered. Right? So 80TTA only savings account, 80TTB all deposits. The deduction under 80TTA is up to a maximum of 10,000, which is increased to 50,000 in case of 80TTB. Now in the case of interest on post office savings bank account, in the topic on IFOS, we saw that it is exempt up to 3,500 in the case of individual account or up to 7,000 in the case of a joint account. So first we need to figure out the amount of taxable interest. We add that interest under the head IFOS. It then becomes part of the gross total income, and then we allow deduction under section 80TTA or 80TTB. For example, if interest on post office savings bank account, individual account is 13,500, after 3,500 exemption, we include 10,000 in the income under the head IFOS. Then we allow deduction from the gross total income, say under 80TTA or 80TTB of 10,000. Okay, this is how we allow the deduction. Now, as far as bank term deposit, which is more than 5 years, or 5-year post office time deposit is concerned, we have seen in 80C that the deposit qualifies as deduction under section 80C. Okay, so deposit is under 80C and interest qualifies as deduction under section 80TTB, not 80TTA, because 80TTA applies only in case of interest on savings account. We will now look at deductions for certain other incomes. 80JJAA, 80QQB and 80RRB. Now there are certain points to keep in mind in respect of these deductions. 1. Deduction cannot exceed the income in respect of which the deduction is allowed. Right? So these incomes will form part of gross total income, which will include other incomes as well, and the deductions will be allowed from the gross total income. But we need to keep in mind that the deduction under these sections cannot exceed the income in respect of which the deduction is allowed. Deduction is not allowed unless the SSE furnishes return of income on or before the due date under section 139(1), which is either 31st of July, 31st of October or 30th of November, and the SSE should make a claim for the deduction in such return of income. This is the condition. Now, as far as section 35AD is concerned, recollect the topic on PGBP, right? Tax incentive under section 35AD. Now, Deduction with respect to income of a specified business under section 35AD can either be claimed here or under 35AD. Deduction in respect of income cannot be claimed under 35AD as well as under these provisions. So now we look at 80JJAA, employment of new employees, and there are 5 conditions to be satisfied. Gross total income should include profits and gains derived from business. So SSE should have PGBP income. SSE should be liable to tax audit. Business should not be formed by splitting up or reconstruction of an existing business. Business should not be acquired by way of transfer or as a result of any business reorganization. And the SSE should furnish the report of an accountant before the specified date referred under 44AD, that is specified date in the context of tax audit report. So if these conditions are satisfied, deduction under 80JJAA is available. And what is the quantum of deduction? It is equal to 30% of additional employee cost which is incurred in the course of business in the previous year. 30% of additional employee cost. And deduction under section 80JJAA is allowed for 3 previous years, including the previous year in which the employment is provided. So deduction for 3 previous years, and deduction for the previous year is 30% of additional employee cost. So the question is, what is additional employee cost? In the first year of a new business, additional employee cost is equal to what? The emoluments that are paid or payable to employees employed during that previous year, because all the employees employed in that previous year will be new employees, right? So emoluments paid or payable to the employees employed during that previous year is equal to additional employee cost. But in case of an existing business, that means a running business, additional employee cost is nil. So in effect, the deduction will not be provided. In which cases? 1. Where there is no increase in the number of employees as compared to the total number of employees as on 31st March of the preceding year, right? So in effect, there should be a net increase in the number of employees during the previous year. So if on 31st March of the preceding year, that means at the end of the preceding year, the number of employees are 100 and 10 employees resigned during the year, but 15 employees joined during the year. So there is the net increase of 5. There is a net increase of 5. But if say no employee joins, that means there is no increase. There is no increase in the number of employees compared to 31st March of the preceding year. In that case, 80JJAA deduction will not be allowed. Second, where emoluments are paid otherwise than by a specified mode. Specified mode is something that we have been referring to in the various provisions in this video. For example, if the emoluments are paid in cash, the deduction will not be allowed because that is not a specified mode. In both these cases, additional employee cost will be nil. If these negative conditions are not hit, then additional employee cost is the total emoluments paid or payable to whom? To the additional employees employed during the previous year. So if there were 100 employees at the beginning of the year, that is on 31st March of the preceding year, 10 employees resign and 30 new employees join. Okay, so 20 is the number of additional employees. Emoluments paid to these additional employees will be the additional employee cost. How to determine who is an additional employee? So 2 conditions need to be satisfied. Additional employee means an employee who has been employed during the previous year and whose employment has the effect of increasing the total number of employees employed by the employer as on 31st March of the preceding year. So if on 31st March of the preceding year, 100 employees were there, 10 resigned during the year, but 30 joined, so 20, okay? So the effect of employment of 20 employees is that the number of employees increases as compared to that on 31st March of the preceding year. So 20 are the number of additional employees. These are the additional employees. However, additional employee does not include the following employee in these 4 cases. 1, whose total emoluments are more than 25,000 per month. Highly paid employees are not included. 2, for whom the entire contribution is paid by the government under the employees pension scheme under the EPF Act. Third, an employee who is employed for less than 240 days during the previous year. Less than 240 days. Now, there is a benefit in respect of the business of manufacturing, not retail. Manufacturing of apparel, footwear, or leather products. In that case, 240 days benchmark threshold is reduced to 150 days. But if such employee remains employed for at least 240 or 150 days in the succeeding year, then he is deemed to have been employed not in the year of employment but in the succeeding year, and consequently deduction under 80JJAA can be claimed from such succeeding year. And lastly, an employee who does not participate in the RPF is not considered as an additional employee. Finally, what do we mean by emoluments? So emoluments means sum which is paid or payable to an employee in lieu of his employment, but it does not include two things. One, employer's contribution to any pension fund or provident fund or any other fund for the benefit of the employee under any law for the time being in force. Employer's contribution to the employee welfare fund. Second, any lump sum payment to an employee at the time of either termination of service or superannuation or voluntary retirement, such as what? Gratuity, severance pay, leave encashment, voluntary retrenchment benefits, commutation of pension, etc. These items are not included in the scope of emoluments. We now look at deduction in respect of royalty income. 80QQB applies in respect of royalty etc. of authors of certain books, and 80RRB in respect of royalty on patents. First we look at 80QQB. Deduction is eligible in the case of an individual who is a resident in India and he should be an author. A joint author is also eligible. What is the income eligible for deduction? Income which is in the exercise of profession on two counts. One, either it is a lump sum consideration which is received for what? For assignment or grant of interest in the copyright, right? So if the copyright has been assigned and a lump sum is received, or interest in the copyright has been granted and a lump sum is received, in respect of what? In respect of any book. Book is what? Work of a literary, artistic or scientific nature. Okay, so this is count number one. Count number two, the income in the nature of royalty or copyright fees in respect of such book, right? So lump sum consideration number one and royalty or copyright fees number two. What is the quantum of deduction? Deduction from the eligible income which is included in the gross total income is equal to lower of eligible income or rupees 3 lakh. So the cap of deduction is rupees 3 lakh. Okay, but not the entire eligible income is allowed deduction. We need to look at certain adjustments to be made to the eligible income, and there are two adjustments which are required to be made. Number one, where the royalty or copyright fees, that means in number 2 here, right? Where the royalty or copyright fees, if it is a case of royalty or copyright fees, if it is not a lump sum consideration in lieu of all rights in the book, that means, what does this mean? That the royalty or copyright fees is a percentage of sales. Okay, the gross income which is in excess of 15% of the value of books sold during the previous year is to be ignored. And gross income means it is before allowing expenses attributable to such income. So in simple terms, what this means, for example, if there is royalty which the author is receiving on account of sale of the books as a percentage of sales, then up to 50% is the eligible income. Beyond this, it is to be ignored. So if the royalty is 20%, then beyond 15%, that means 5% of royalty is to be ignored. Up to 50% is to be considered as part of eligible income. The second adjustment which we need to make is if the income is earned outside India, then only so much of the income is taken into account as is brought into India in convertible foreign exchange within a limited period, which is what? 6 months from the end of the previous year in which the income is earned, or a further period allowed by the Reserve Bank of India. The point to note is that the book, when we talk about a book, it does not include the following. brochures, commentaries, diaries, guides, journals, magazines, newspapers, pamphlets, textbooks for schools, tracts, and other publications of similar nature by whatever name called. Now we look at section 80 RRB, which is royalty on patents. And it is also allowed to an individual who is a resident in India and who is a patentee. A co-patentee is also allowed deduction. The income should be in the nature of royalty in respect of a patent which is registered on or after 1st April 2003 under the Patents Act. The deduction, the quantum is the same as a TQQB. Deduction from eligible income included in gross total income is lower of eligible income of 3 lakh. So the cap is 3 lakh. But two adjustments are supposed to be made to the eligible income. One, if the income is taxable as capital gain, 80 RRB is not to be allowed. It is to be excluded from the eligible income. Or if there is a sale, if the income is from sale of what? Of a product which is manufactured using the patented process or article using this patent for commercial use, that is also excluded. That is also not part of eligible income. The second adjustment which we need to make is the same on account of receipt of income in convertible foreign exchange. It is the same as that we saw in the case of 80 QQB. Finally, there is a summary which you can see on this screen. It's a beautiful summary and gives a very compact and condensed snapshot of whatever we have discussed in this topic on deduction from gross total income. Since we have already discussed those provisions, we are not going to take a look at this summary again. This is part of the tax book and this is also part of the document used in this video. So you can take a look at this summary at your own end. It will be very, very useful to you. We will now look at computation of total income and tax liability, and first we look at computation of tax payable or refundable. What are the steps in brief? We determine the tax on total income. We allow rebate under 87A if available, or we add surcharge if applicable, adjusted for marginal relief if applicable. To the balance, that is tax minus rebate or tax plus surcharge, we add HEC at the rate of 4%. Then we reduce AMT credit under section 115 JD AMT, alternate minimum tax, which we will now look at in some time, as well as relief under section 89 if it is available. We add interest under section 234A, 234B, 234C, and or fees under section 234F. This gives us the amount of tax liability. That is the liability in respect of tax for the SSE. In order to arrive at the tax payable or refundable, we need to reduce the prepaid taxes on account of TDS or TCS or advance tax. This tax payable or refundable is rounded off in the same way as total income. This is what we have already looked at in the topic on basic concepts at the beginning of this video. Now you need to note that tax liability is not the same as tax payable or refundable. Tax liability is the liability of the SSE. Tax payable or refundable is what the SSE finally needs to pay or the amount that needs to be refunded. Therefore, if the question asks for tax liability, there is no need to adjust prepaid taxes. But if the question asks you to determine tax payable or refundable, then you need to compute tax liability, then you need to identify the prepaid taxes and adjust those prepaid taxes to arrive at the amount of tax payable or refundable. We will now look at the provisions of alternate minimum tax or AMT. The relevant sections are 115 JC to 115 JF. Applicability of AMT. The provisions of AMT apply to a person other than a company. So AMT doesn't apply to a company. Different provision is applicable to a company, but that is not relevant for CA intermediate syllabus. So AMT applies to a person who satisfies all of the following three conditions. 1. The person has claimed any deduction under the following provisions, and there are three of them. 1. Chapter VIAC, but other than section 80P. That means it includes 80 JJAA, 80 QQB, and 80 RRB. This is what we have discussed some time back on account of deductions from gross total income. Certain other sections are also included in chapter VIAC apart from these, but those are not relevant at CA inter level. So for us, What is relevant is to see whether the person has claimed 80JJAA, 80QQB or 80RRB, or deduction under section 10AA for newly established units in SEZ, or under section 35AD tax incentives, under section 35AD the deduction that we saw in the topic on PGBP. So this is the first condition. The second condition is that the adjusted total income of the person is more than rupees 20 lakh. But this condition applies only to an individual HUF, AOP, BOI, AJP, artificial juridical person. So it doesn't apply to, say, for example, a firm. And number 3, the person has not exercised the option under section 115 BAC in the case of individual HUF. This is something that we will note in some time shortly. Or under section 115 BAD in case of cooperative society, right? So these 3 conditions need to be satisfied. Deduction should not be claimed under any of these provisions. ATI should be more than 20 lakh, and 115 BAC option should not have been exercised by the person. So the question is, what is the meaning of adjusted total income? Adjusted total income is the total income adjusted on certain counts. So first we determine the amount of total income. Then, as we noted above, the person should not have claimed deductions under any of these provisions. So if the deduction has been claimed, we add back. So we add deductions claimed, if any, under 80JJAA, 80QQB, 80RRB, 10AA and 35AD. Now, as far as 35AD is concerned, if we add back the deduction, then in its place, we should now allow the depreciation under section 32, as if no deduction under 35AD was allowed, because if 35AD is not allowed, depreciation should be allowed. So when we are adding back 35AD, we should now provide deduction on account of depreciation under section 32. And this gives us the amount of adjusted total income, or ATI, which, as we noted above, should be more than rupees 20 lakh. Now, if these applicability conditions are satisfied, then we need to proceed to the computation of AMT. And there are 3 steps. Step 1. First, we compute the regular tax payable for the previous year, which is what? Which is tax on the regular total income plus applicable surcharge and HEC. Second, we compute the AMT payable for such previous year, which is what? Which is 18.5% of the adjusted total income plus applicable surcharge and HEC. This rate of 18.5% is 15% in the case of a cooperative society. Then we compare regular tax and AMT. If regular tax is less than AMT, not more. If regular tax is more than AMT, then regular tax is payable, AMT is not payable. But if regular tax is less than AMT, then ATI is deemed to be the total income of the person for the previous year, and consequently the person is liable to pay AMT instead of the regular tax. So ATI is deemed to be the total income. So what happens to incomes taxable at special rate, for example capital gains? They get assimilated within the ATI, hence such incomes are not taxable at their respective special rates. Rather, AMT is computed at the rate of 18.5% of ATI. Surcharge and HEC rate for computing AMT liability is the same as that for computing regular tax liability. This is what we have noted in the topic on rates of tax. We also noted there that there is a 15% limit on the rate of surcharge on tax on what? Dividend and capital gains taxable at special rates 111A and LTCG under 112A and 112 as well, right? But this 15% limit is not applicable while computing AMT. Now AMT credit is available to an SSE. AMT credit is also available. And what is the amount of AMT credit for an assessment year? It is AMT paid minus regular tax payable. So the tax which is paid as AMT, which is in excess of the regular tax, that becomes a credit which is carried forward to the subsequent assessment year, and then it can be set off in an assessment year in which regular tax is more than AMT, right? So where regular tax is more than AMT, to the extent of such excess, the credit can be set off. What about the balance? The balance is then carried forward, and it can be so carried forward for a period of 15 assessment years. But note that no interest is payable on AMT credit. Okay. Now, AMT credit cannot be set off against the tax liability computed under section 115 BAC in the case of individual or HUF, or 115 BAD in the case of cooperative society. AMT credit cannot be set off against the 115 BAC tax liability. We will now cover the provisions of section 115 BAC, which provide for a concessional rate of tax for individuals and HUF. Concessional tax rates. Under this provision 115 BAC, the tax on total income of individual or HUF, is covered, is computed at concessional rates given below, as you can see, at the option of such person. So 115 BAC is not compulsory, it is optional. Now if you look at this table, this is the range of total income. These are the 115 BAC rates of tax, and these are the regular rates of tax, which we have already noted in the topic on rates of tax. And as we noted there, the individual or HUF can be categorized as a normal case, or as a senior citizen, or as a super senior citizen. In normal case, the basic exemption limit is 2,50,000, and then the slab rates of 5% or 20% or 30% are applicable. For a senior citizen, there is basic exemption limit of 3 lakh, and then the slab rates of 5% or 20 or 30% apply. In case of super senior citizen, there is the basic exemption limit of 5 lakh, and then rate of 20% or 30% apply. As against this, the rates of tax under 115 BAC are uniform, as you can see here, for normal case, senior citizen case, as well as super senior citizen case, and the basic exemption limit for everyone is 2,50,000. So there is no tax up to 2,50,000. And then the rates of tax increase with 5%. So 5, 10, 15, 20, 25 and 30%. And you would note that the 5% increase is with the increase of total income by every 2,50,000. So up to 2,50,000, more than 2,50,000, and up to 5 lakh, more than 5 lakh, and up to 7.5 lakh, and then 10 lakh, 12.5 lakh, 15 lakh, and more than 15 lakh. So an easy way to remember the rates of tax under 115 BAC is that you increase the total income. You start from 0 and increase it by 2.5 lakh, right? And start with the 0 rate of tax and increase the rate by 5% at every level. So this is how the rates of tax have been prescribed under 115 BAC. Now certain points that we need to note. As we noted above, rates of tax as well as basic exemption limit is uniform for everyone under 115 BAC in all these three categories. What about incomes taxable at special rates? For example, short-term capital gain under 111A 15%, or LTCG under 112 20%, and 112A 10%, winnings, undisclosed incomes. What about these? They continue to be taxable at their special rates under the 115 BAC regime as well. The normal income is taxable at 115 BAC rates. So what happens is that special incomes continue to be taxable at their special rates, while the normal income gets taxed under 115 BAC rates instead of the regular rates of tax. Rebate under 87A is available on the tax computed under 115 BAC, and the position doesn't change. What about surcharge? Here also the position doesn't change. It is applicable at their regular rates and adjusted for marginal relief if available. And therefore the surcharge on tax on dividend and STCG under 111A and LTCG under 112 or 112A cannot exceed 15%. So the position remains the same as we have noted in the topic on rates of tax as far as the regular provisions are concerned. What about health and education says? It is applicable at the regular rate of 4%. There are certain conditions to be satisfied for availing the concessional rates of tax under section 115 BAC, and now we will look at these conditions. So condition number 1, the total income should be computed without allowing the exemptions and deductions which are listed below in the table. So these are not allowed, the assessee cannot avail. That's why the government wants the assessee to forego these exemptions and deductions, and consequently the government provides the benefit of a concessional rate of tax to the SSE. So we will look at each head of income. First, income under the head salaries. Exemption in respect of leave travel concession is not allowed. Exemption in respect of HRA is not allowed. Then exemption in respect of special allowances is not allowed, except the following 4 items, in which case it is allowed. What are these 4 items? Traveling allowance for tour or transfer, daily allowance for tour or transfer, conveyance allowance for tour or transfer, and disabled conveyance allowance. All of these we have noted in the topic on salaries. 1, 2 and 3 are allowed exemption to the extent the expenses are actually incurred for the purpose for which allowance is granted. So that means to the extent of official expenses. And as we have noted, disabled conveyance allowance is exempt up to 3,200 per month. So these 4 are allowed, but all other special allowances under section 1014 like children education allowance, children hostel allowance, etc. are not allowed. As far as free food and non-alcoholic beverages provided by the employer is concerned through paid vouchers, we have noted there is an exemption given of rupees 50 per meal. This is not allowed. All the 3 deductions under section 16 are not allowed. Standard deduction, deduction for entertainment allowance, and deduction for professional tax. What about income under the head income from house property? 24B deduction is not allowed. What is this? Interest on borrowed capital in respect of SOP or UOP. SOP or UOP, interest on borrowed capital is not allowed. What this means is that interest on borrowed capital in respect of LOP or DLOP is allowed. So SOP, UOP, interest is not allowed. LOP, DLOP, it is allowed. Profits and gains of business or profession. Deduction under section 10AA for newly established units in SEZ is not allowed. Depreciation. Additional depreciation is not allowed. 32(1)(2)IA. That means normal depreciation is allowed. Section 35 for scientific research. Payment to specified entities for scientific research or statistical research or research in social sciences, right, is not allowed. What this means is that deduction for in-house expenditure on scientific research is allowed. 35AD deduction, investment linked tax incentive for specified businesses, it is not allowed. Now since 35AD is not allowed, as a corollary, normal depreciation on capital expenditure that would otherwise have been allowed under 35AD should now be allowed. So if 35AD is not allowed, the normal depreciation should be allowed. 35CCC deduction for expenditure on notified agricultural extension project is not allowed. What about income from other sources? As far as remuneration of an MP or MLA is concerned, daily allowance and constituency allowance is exempt under section 1017 as we have noted before, but this exemption is not allowed. What about family pension? A standard deduction is allowed of lower of 1/3 of such income or rupees 15,000, but it is not allowed under 115 BAC. What about clubbing of income? In respect of income of minor child, exemption of rupees 1,500 per minor child under section 1032, it is not allowed. What about deduction from gross total income? No deduction is allowed except for 2 deductions. Only 2 deductions are allowed. So we noted under section 80CCD, employer's contribution to NPS or APY is allowed under section 80CCD 2. Not employee's contribution, employer's contribution, that is allowed. And 80JJAA on account of employment of new employees, this is also allowed. All other deductions from chapter VIA in computing gross total income are not supposed to be allowed. So this was condition 1. Now we look at condition 2. Condition 2 is that the total income should be computed without set off of the following loss. So these losses cannot be set off. They are not allowed to be set off. And what are these? Number 1, set off of any loss that is carried forward or unabsorbed additional depreciation, right? Because additional depreciation is not allowed under section 115 BAC. Normal depreciation is allowed. So the loss that is not allowed to be set off is what? Set off of any loss that is carried forward or unabsorbed additional depreciation from any earlier assessment year. But what is the condition? The condition is that it should be attributable to any of the deduction which is not allowed in computing 115 BSE. That means if there is a loss which has been carried forward or unabsorbed additional depreciation which has been carried forward, that means it is brought forward and it is attributable to any of these items or the list of deduction that we have seen that is not allowed in computing 115 BSE total income, then set off of such loss is not allowed. The logic is that if the deduction is not allowed, then if the loss has arisen on account of such deduction which is brought forward, that loss should also not be allowed to be set off. Correct? Second, set off of any loss under the head income from house property is not allowed with any other head of income. That means inter-head set off. Inter-head set off of loss under the head income from house property is not allowed. Now, as far as loss on account of SOP or UOP is concerned, there is a limit of 2 lakh, right? But as we have noted above, interest on borrowed capital in respect of SOP, UOP is not allowed. So therefore, when computing 115 BSE income, loss will not arise in respect of SOP or UOP. But interest is allowable in respect of LOP or DLOP interest. So loss in respect of LOP or DLOP can arise. Right? Now, inter-head set-off of such loss is not allowed. Inter-head set-off of such loss is not allowed, which means that intra-head set-off within the head income from house property is allowed. It is not barred. Similarly, carry forward of unabsorbed loss, right, under section 71B is also not barred. That is also allowed. Now we look at condition 3. Now normal depreciation is allowed. Additional depreciation is not allowed. Normal depreciation is allowed in computing 115 BSE income as we noted above. Now, when we allow normal depreciation on the WDV of a block of assets, the condition is that the rate of such depreciation is limited to 40%. So the rate that is applied should not exceed 40%. The last condition is that total income should be computed without any exemption or deduction for allowance or perquisite provided under any other law for the time being in force. So these 4 conditions need to be satisfied, in which case concessional rate of tax can be computed on the total income computed under section 115 BSE. Now, as we noted above, the provision is optional. So the option needs to be exercised. What is the manner in which option is to be exercised? We will see. It depends on whether the person is having income from business or profession, or is the person any other person. That means, is the person having PGBP income or not having PGBP income. If the person is having income from business or profession, then when should the option be exercised? On or before the due date under section 139(1) for furnishing return for any previous year. So this option needs to be exercised once. Okay, not every year. Once this option is exercised, it applies to subsequent previous years as well. Now the option gets invalidated in certain situation. What is that? It is a situation where the person fails to satisfy the above stated conditions for applicability of 115 BSE. These 4 conditions that we noted above. If the person fails to satisfy for the previous year, the option becomes invalid. For which previous year? For that previous year of default as well as for subsequent previous years. In that case, for all these previous years, the regular provisions of the Act apply as if the option had not been exercised, so 115 BSE benefit cannot be availed of. In any other case where PGBP income is not there, then the option should be exercised when? It should be exercised along with the return to be furnished under 139(1) for that previous year. This means that the option needs to be exercised for each previous year, and therefore the option can change for each previous year. In one year, the person may want to exercise. In another previous year, the person may want to opt out. Now, when is the option invalidated in such case? If the person fails to satisfy the above stated 4 conditions for the previous year, the option becomes invalid in respect of that previous year for which it has been exercised. And in that case, so the invalidation happens for that previous year, not for the subsequent previous year, as was the case above. In such case, the regular provisions of the Act apply for that previous year, and 115 BSE concessional tax rates are not applicable. Now in the case of PGBP income, we noted that option once exercised, it applies to subsequent previous years as well. So the question is there no provision for withdrawal of this option? So there is. Such option once exercised by a person having PGBP income can be withdrawn only once for a previous year. Only once, this is the limit. But not in the previous year in which the person has opted for. The option can be withdrawn only once for a previous year which is other than the year in which it was exercised. But there is now a restriction which becomes applicable. Once the option is withdrawn, then the person can never become eligible to exercise the option under section 115 BSE. So the option lapses forever. Okay, but there is an exception. The only exception is where such person ceases to have income from business or profession. If the person, so long as there is PGBP income, he is never eligible to exercise the option under section 115 BSE. But when PGBP income ceases, then the person moves from category 1 to category 2. From category 1 to category 2, in which case the provisions of category 2 starts to apply, and then in that case he can exercise the option every year. We will now look at the provisions of TDS, TCS and advance tax. These are basically called prepaid taxes. So TDS stands for tax deduction at source or deduction of tax at source. Tax is deducted at source. By whom? By the payer on behalf of the payee. That means the SSE in case of specified payments. Next is TCS, which refers to collection of tax at source or tax collection at source. Tax is collected at source. By whom? By the seller. On behalf of whom? The buyer, that is the SSE, in the case of specified transactions. And third is advance tax, where tax is paid in advance by the SSE. So these are called prepaid taxes, and therefore the credit of prepaid taxes is given to the SSE while determining his final tax liability. Right? So if the final tax liability is 1 lakh and the prepaid taxes are 60,000, the final tax payable would be 40,000. Now we will first look at TDS, then we will look at TCS and finally advance tax. So first we look at the salary payments. Section 192. This covers salary. We will look at the section, who should be the payer payee, what is the specified payment liable to TDS and time and rate of TDS and some other points. The payer should be any person responsible for paying income chargeable under the head salaries, that is the employer, and the payee should be the employee. A specified payment is the income chargeable under the head salaries. TDS has to be deducted at the time of payment. What is the rate? The rate is the average rate of tax computed on the basis of what rate? Rates in force for the financial year in which the payment is made. On what income? On the estimated income of the SSE under the head salaries for that financial year. So we determine the income, then we determine the tax on this income. Tax divided by income is equal to average rate of tax, and we apply this average rate of tax to the income to determine the amount of TDS that is supposed to be deducted. Therefore, in effect, what this means is TDS is to be deducted under 192 as per the slab rates plus applicable surcharge in HEC. In without PAN cases, a higher rate of TDS applies, and this is something that is applicable for many of the provisions, and we will consider this in detail after we have discussed the various provisions of TDS. TDS is not deductible where no tax is payable. This is but obvious. That is where income is not more than the basic exemption limit. What are the steps for computation of TDS? We will first look at those steps. To simplify the whole process, I have listed down the steps for computing TDS under section 192. So we start with the estimated income of the SSE under the head salaries. Okay, that which is estimated for the financial year. To this, we add income chargeable under any other head for the same financial year. okay, if the details are furnished by the employee in that respect. The additional income can also be added for the purpose of computing TDS. We deduct loss. We deduct loss, but loss only under one head, that is under the head income from house property, that too up to a limit which is up to rupees 2 lakh for the same financial year, provided details are furnished by the SSE. Except for this loss, any other loss is not supposed to be deducted in computing the amount of TDS. We also add income under the head salaries if it is from the other employees as well, right? In a case where there are multiple employers during the financial year, if details are furnished by the employee. That brings us to the amount of gross total income from which we allow deductions under chapter BIA. And this brings us to the amount of total income for the purpose of TDS. We compute tax on the total income at the applicable slab rates. We allow rebate under section 87A. We add surcharge as applicable and 4% health and education cess. Now, while computing tax, we need to know that under section 115 BAC, concessional rates of tax apply, right? Now, whether we need to apply, whether the employer needs to apply those concessional rates in computing the amount of TDS. In a case where employer is not having income under the head PGBP, okay? Now, in this connection, recollect our discussion on this topic short while ago, where the employee is not having income under the head PGBP. Tax will be computed by the employer under section 115 BAC at those concessional rates. Where the employee intimates the employer of his intention to opt for 115 BAC for that previous year. Because as we know, in such case, the option can be exercised every year. Else, tax will be computed as per the regular provisions. But what if the employee is having income under the head PGBP? We already noted in our discussion on 115 BAC that the option once exercised for a previous year cannot generally be changed subsequently. It applies to subsequent years as well. Therefore, the intimation to the employer for subsequent previous years must not deviate from the option which has been once exercised in a previous year. As per this approach, the employer needs to apply the rate of tax and ultimately determine the tax on the total income. From this, we need to reduce the relief under section 89(1) based on the details furnished by the employee. But this deduction is allowed only where the SSE is either a government servant or an employee in a company, cooperative society, local authority, university, institution, association or body, not in any other case. We also allow deduction of TDS which has been deducted on salary from the other employers or on the other income that we added above, right? So those incomes from other employer or the additional incomes apart from salary which we added, there would have been TDS which would have been deducted. So that also needs to be reduced. So what is the balance? The balance then is the amount of TDS that needs to be deducted under section 192. And how we deduct? We deduct it on monthly basis, that is at the time of payment of salary. And the amount to be deducted is the amount of TDS to be deducted, which is this, right, based on the total income that we computed, divided by the months for which the employee is employed during the financial year. There may be any previous excess or deficiency which can arise, right, because the estimate may undergo a change. In such case, the adjustment can be made by increasing or reducing the amount of TDS subsequently during the same financial year. Tax on non-monetary perquisite under section 192(1)(a). Now the employer may provide non-monetary perquisites to the employee, and tax will be payable on such perquisites as well, non-monetary perquisites. Employer has an option to pay the tax on these perquisites provided to the employee. There is an option that the employer can pay tax on behalf of the employee. We noted in the topic on salary that such tax is exempt as perquisite in the hands of the employee, specifically under section 1010cc. We also noted in the topic on PGBP that employer is not allowed the deduction in computing PGBP income on account of such tax that the employer pays, right? So the employer has an option to pay such tax, and he can pay such tax himself without the need to deduct it as TDS from the salary. And what is the rate at which this tax need to be paid? It is to be determined, the tax payable is determined at the average of tax computed on the basis of rates in force for the financial year on the income chargeable under the head salaries, including the income by way of such non-monetary perquisites. So we compute the income, including this income by way of non-monetary perquisites. Then we determine the amount of tax on such income, right? And we divide tax by the income. So tax divided by such income, it gives us the average rate of tax. Average rate of tax, right? Now this income will have two components. One is the non-monetary perquisite and the other is the balance salary. So we apply average rate of tax to this non-monetary perquisite, which gives us the amount of tax to be paid by the employer under section 192(1)(a), which is the tax on non-monetary perquisites. And then we apply average rate of tax to the balance of salary, which gives us the amount of TDS to be deducted from the salary under section 192. While paying the salary, that tax needs to be deducted. Now, such tax which is paid by the employer on non-monetary perquisites is treated as tax paid on behalf of the employee. What is the consequence? The consequence is that the employee can take credit of such tax, against his final tax liability, even though tax has not been deducted at source. Because it has been paid by the employer, it has not been deducted at source from the salary. Even then, the employee can take the credit of such tax. Now we noted above that the TDS is to be deducted at the time of payment, but there is an exception in the case of ESOP. In such case, the time of deducting TDS is deferred in respect of what? Perquisite on account of employee stock option ESOP provided by not everyone, but by an eligible startup. In such case, TDS can be deducted within 14 days of the earliest of 1, 2, or 3. One is after the expiry of 48 months from the end of the relevant assessment year. 2, from the date of the sale of such specified security or sweat equity share by the assessee. 3, from the date of the assessee ceasing to be the employee of the person. 1 or 2 or 3, whichever is earliest. And what is the rate at which the TDS will be deducted? TDS which is in force in the financial year when it is deducted, that means a later financial year, or the financial year in which the perquisite arises, that is the year in which there is allotment or transfer of the security or share. So it is provided that the TDS will be deducted on the basis of rates for the financial year in which the specified security or sweat equity share was allotted or transferred, not the financial year in which TDS is deducted. This is section 192. Now we come to section 192A, which covers EPF, Employee Provident Fund. The payer is the trustees of EPF and the payee is the employee, and what is paid is the accumulated balance in the recognized provident fund, which is not exempt. Recollect the topic on salaries where we noted that if certain conditions are fulfilled, accumulated balance which is payable is not taxable. If those conditions are not satisfied, it is taxable, it is not exempt. When it is not exempt, TDS needs to be deducted at the time of payment at the rate of 10%, but in without PAN cases, the TDS is to be deducted at the rate of maximum marginal rate, which is at the rate of 42.744%. TDS is not deductible where the payment or the aggregate of such payments is less than rupees 50,000. Otherwise, TDS needs to be deducted. We now move to the theme in respect of TDS on interest, dividend and investment income. First, we look at section 193, which deals with interest on securities. What is the meaning of interest on securities? Recollect our discussion in the topic of interest on under the head IFOS. And we noted there that interest on securities means 1. Interest on government security. 2. Interest on debentures or other securities issued by whom? By a local authority or company or statutory corporation. So basically interest on government security, interest on debenture of a company. These are examples of interest on securities. Now for 193 TDS, the payer can be any person, but the payee should be a resident. And specified payment is what? Interest on securities. TDS is to be deducted at the earlier of credit or payment at the rate of 10%, and there is a higher rate for without PAN or ROI non-filer cases. TDS is not deductible in the following 6 cases. From interest payable on the following: 1. On national development bonds. 2. On any security of the government, central or state. 3. On 8% savings taxable bonds 2003 or 7.75% savings taxable bonds 2018, provided interest for the financial year is not more than 10,000. This is the limit. 4th, interest on debenture issued by a company which is not a closely held company. In other words, which is a widely held company or which is a company in which the public are substantially interested. If three conditions are satisfied. A. Interest is payable to an individual or HUF. B. Interest paid or likely to be paid during the financial year is not more than 5,000. And C. Interest is paid by an account payee check. In that case, interest need not be deducted under 193. Fifth, interest on security issued by a company in dematerialized form, DMAT form, and which is listed on a recognized stock exchange in India. And lastly, interest on 6% gold bonds 1977 or 7% gold bonds 1980, held by whom? Held by an individual. If the total nominal value of such bonds, in either case, that means 6% gold bonds or 7% gold bonds, in either case is not more than 10,000 at what time? At any time during the period to which the interest relates. Next is section 194A, which deals with other interest, that is interest which is other than interest on securities, which we cover under 193 above. The payer should be any person, not being an individual or HUF or a specified individual or HUF. So if it is not an individual or HUF, it can be any person, but if it is individual or HUF, the payer, then the individual or HUF should be specified. The concept of specified individual or HUF is applicable to certain other provisions as well, so it will be good if at this stage we look at this concept. Who is an specified individual or HUF? It is an individual or HUF whose total sales, gross receipts or turnover from the business or profession carried on by him is more than rupees 1 crore in case of business or more than rupees 50 lakh in case of profession. During which year? During the immediately preceding financial year. If this condition is satisfied, then the individual or HUF is called a specified individual or HUF. Right? So section 194A applies where the payer is a specified individual or HUF or in case of any other person. The payee should be a resident. The specified payment is what? Interest, which is other than interest on securities. Interest on securities is covered under section 193. TDS is to be deducted at the time of earlier of credit or payment at the rate of 10%, and there is a higher rate for without PAN or ROI non-filer cases. TDS is not deductible in the following cases. Number 1, where interest credited or paid during the financial year does not exceed the following, and there is a limit. If the interest exceeds, then TDS is supposed to be deducted, otherwise not. And it depends on the payer and the payee. Where the payer is bank or a cooperative bank or post office, the limit is 50,000 for a senior citizen, for others it is 40,000. In the case of other payers, the limit for both senior citizen and others is 5,000. Now the question is, who is a senior citizen? Senior citizen is an individual who is resident in India of the age of 60 years or more at any time during the relevant previous year. So only if interest for the financial year credited or paid exceeds this limit, then TDS needs to be deducted. And now a bank or a cooperative bank will have multiple branches. Now how is this limit to be computed if interest is arising from multiple branches? So the above limit is to be determined per branch. However, if the payer has adopted core banking solution CBS, which is the position in most of the cases these days, then this limit is per payer. That means per bank or per cooperative bank. In other words, the interest for all the branches for that bank is to be consolidated to check whether this limit is exceeding or not, where the payer has adopted CBS, else the limit is per branch. Number 2, TDS is not deductible on interest credited or paid by a firm to its partner. 3, interest credited or paid by the central government under the Income Tax Act. 4, interest on zero coupon bond. 5th, interest on deposits not being time deposits with a bank, which means, in other words, deposits in savings account, so interest on savings bank account. Interest on post office time deposit or post office recurring deposit, post office monthly income account, Kisan Vikas Patra, Indira Vikas Patra, National Savings Certificates 8th issue. Seventh, interest which is credited or paid by a cooperative society, and this doesn't include a cooperative bank, because cooperative bank is what we have noted some time back. So interest credited or paid by a cooperative society to its member, okay, TDS is not supposed to be deducted. Or interest on deposits which is other than time deposits, but still cooperative society is liable to deduct TDS if its total sales, gross receipts or turnover is more than rupees 50 crore in which year? In the immediately preceding financial year. And the interest which is credited or paid during the financial year, current financial year, is more than 40,000. This limit is 50,000 for a senior citizen payee. Number 8, interest credited or paid to a bank. Okay, so you take a loan and you pay interest to a bank, TDS will not apply. Interest credited or paid to a bank or cooperative bank, financial corporation, life insurance corporation, unit trust of India, or a company or a cooperative society carrying on insurance business. Ninth, interest which is credited on the compensation amount awarded by the Motor Accidents Claims Tribunal. 10. If such interest is not credited but it is paid, then interest paid on such compensation where the interest paid during the financial year is not more than 50,000. If it is more than 50,000, TDS needs to be deducted. Next is section 194, which covers dividend. The payer should be a domestic company, not a foreign company. The payee should be a resident. Amount which is covered is dividend. TDS is to be deducted before payment or distribution at the rate of 10%, and a higher rate applies for without PAN or ROI non-filer case. TDS is not deductible where dividend is paid to an individual shareholder by any mode other than cash if dividend distributed or paid during the financial year is not more than 5,000. So if the shareholder is individual shareholder, dividend is not in cash, the payment is not in cash, and the amount during the financial year is not more than 5,000, then TDS is not supposed to be deducted. Now, recollect the definition of dividend, the meaning as we discussed in the topic on IFOS. All payments which are treated as dividend under section 222, which we discussed there, are covered under section 194. Next is section 194K, income from units. The payer should be mutual fund or unit trust of India, and the payee should be a resident, and specified payment is what? Income in respect of units. TDS is deducted at the time of earlier of credit or payment at the rate of 10%, and higher rate applies for without PAN or ROI non-filer cases. TDS is not deductible in two cases. One, where the income credited or paid during the financial year is not more than 5,000, or if the income is in the nature of capital gains. For example, capital gains will arise when? In case of transfer of units. TDS will not apply. Next is section 194DA, life insurance policy proceeds. Payer can be any person, but the payee should be a resident. So any sum under a life insurance policy, this includes bonus, which is not exempt under section 1010D, is covered under 194DA. Recollect our discussion in the topic on exempt incomes, where life insurance proceeds are exempt under 1010D, but where it is not exempt, then TDS needs to be deducted at the time of payment at the rate of 5%, and higher rate applies for without PAN or ROI non-filer cases. TDS is not deductible in the following two cases. One, where the payment during the financial year is less than 1 lakh, or on the sum that is exempt under 1010D. Now we should note that while the threshold for the trigger of TDS provision is 1 lakh, but TDS is not necessarily deductible on this amount. The rate of 5% is applied on the amount of income which is comprised in the payment, and which will be what? Sum received minus the premium paid. So premium paid will need to be deducted, and on the balance 5% will be applied. But sum received is to be considered with respect to the threshold of 1 lakh to see whether 194DA is applying or not. Next is section 194EE. This applies in the case of National Savings Scheme, where the payer is the post office and payee can be any person. And this covers amount which is withdrawn from the National Savings Scheme 1987, but in respect of which a deduction has been allowed under 80CCA, together with interest accrued on such amount. Then TDS is to be deducted at the time of payment at the rate of 10%, and higher rate applies for without PAN or ROI non-filer cases. TDS is not deductible in two situations. One, where the payment during the year is less than 2,500, and 2 where the payment is made to the heirs of the SSE. That means in the case of his death. We now move to casual incomes. 194B and 194BB are relevant and both relate to winnings. But 194BB is in respect of winnings from horse race. For others, 194B is relevant. So 194B first. The payer and the payee can be any person. A specified payment is winnings from any lottery, crossword puzzle, card game, and other game of any sort. TDS is deductible at the time of payment at the rate of 30%. TDS is not deductible where the amount of winning is not more than rupees 10,000. Now, where the winnings are wholly in kind or partly in cash and partly in kind, but the part in cash is not sufficient to meet TDS liability. For example, the winning is in the nature of, say, a car. A car is being given, so it is in kind. Now, how will the TDS be paid? In that case, the payer should ensure before releasing the winning, before that tax has been paid in respect of the winnings, and after that the car can be released. 194BB covers winnings from any horse race. And who is the payer? A bookmaker or a person having license for horse racing in any race course, or for arranging or wagering or betting in any race course, and the payee can be any person. In such case, the time and rate is the same as that under 194B. TDS is not deductible where the amount of winnings is not more than 10,000, same as 194B. Next is the theme on commission. First section is 194D, which deals with insurance commission. The payer can be any person, the payee should be a resident. A specified payment is remuneration or reward, as commission or otherwise, for soliciting or procuring insurance business. So basically insurance commission. TDS is deductible at the time of earlier of credit or payment. Rate, it is 10% where the payee is a domestic company and 5% in all other cases. A higher rate applies for without PAN or ROI non-filer cases. TDS is not deductible where income credited or paid during the financial year is not more than 15,000. 194G covers lottery commission. Payer can be any person. The payee should be any person who is or has been stocking, distributing, purchasing, or selling what? Lottery tickets. So the specified payment is commission, remuneration, or price on such lottery tickets. TDS is deductible at the time of earlier of credit or payment at the rate of 5%. Higher rate applies for without PAN or ROI non-filer cases. TDS is not deductible if the amount is not more than 15,000. Next comes 194H, which is the general provision for commission or brokerage. Payer can be any person if it is not an individual or HUF. But if it is an individual or HUF, the payer should be a specified individual or HUF. Okay. Payee needs to be a resident. A specified payment is commission or brokerage. Commission referred in 194D is not covered in 194H. Okay. TDS is deductible at the time of earlier of credit or payment at the rate of 5%, and higher rate applies for without PAN or ROI non-filer cases. TDS is not deductible in 5 situations. TDS is not deductible in the following cases. 1. Where income credited or paid during the financial year is not more than 15,000. 2. On payment for professional services in case of specified profession under section 44AA. Under section 44AA. This is what we have looked at while covering the topic on PGBP. In such case, TDS is leviable under section 194J, which we will look at in some time. 3. Payment in relation to a transaction related to securities. TDS is not deductible. 4. So on commission or brokerage payable by BSNL or MTNL to their PCO, public call office franchisees. 5. Payment made by TV channels or newspaper companies. TV channels or newspaper companies may make payments to advertising agency. For what? For booking of advertisement, procuring of advertisement, or canvassing for advertisement. In that case, 194H doesn't apply. Why? Because the relation between these parties is that of principal to principal. It is not principal to agent. It is not principal to agent, it is principal to principal. So only principal to agent relationship will result in a commission, not principal to principal relationship. So TDS is not deductible. So 194H applies where the payer is an specified individual or HUF. What about a non-specified individual or HUF payer? Such person will be covered not here but under section 194M. We will now cover the theme of work and services. First, we will look at section 194C, which deals with contract for work. Who should be the payer? A specified person. There is a list of specified persons from serial number 1 to 12. The government, whether central or state, local authority, statutory corporation, company, cooperative society, housing or town planning authority, registered society, trust, university, government of a foreign state or a foreign enterprise or an association or body established outside India, firm, and lastly an individual HUF, AOP or BOI which is not covered under 1 to 11 above, right? But only an individual HUF, AOP or BOI which is specified. What about individual or HUF which is non-specified? They are not covered under 194C but under 194M. So the payer needs to be a specified person. Who should be the payee? A resident. Who is a contractor? Subcontractor is also covered. What should be the specified payment? Sum paid for carrying out any work in pursuance of a contract between the payer and the payee, right? So sum paid for carrying out any work in pursuance of a contract between the payer and the payee is covered under 194C. Work includes supply of labor for carrying out any work. So works contract as well as a labor contract is covered under 194C. Contract also includes subcontract. So subcontract is also covered. Now work includes the following: 1, 2, 3, 4, 5. 1. Advertising. 2. Broadcasting and telecasting. And this includes production of program for such purpose. 3. Carriage of goods or passengers by any mode of transport which is other than by railways. So transportation contract. 4. Catering. And 5. Manufacturing or supplying a product according to the requirement or specification of a customer. Condition is that the manufacture or supply should be by using material purchased from such customer or its associate. So manufacturer or supplier and a customer. And this person is manufacturing and supplying the product as per the requirement or specification of the customer, right? And the material which he uses is procured from the customer, or the associate of the customer. In such case, it will be work liable to TDS under 194C. Okay. But if the manufacturer sources the material from his own, not from the customer or associate, and then supplies, then this will not be a work, this will be a contract of sale. So contract of sale is outside 194C scope. What is the time and rate of TDS? TDS is deductible at the time of earlier of credit or payment. What is the rate? Rate is 1% where the payee is individual or HUF and 2% in case of others. A higher rate applies for without PAN or ROI non-filer cases. Now TDS is not deductible in certain cases. TDS is not deductible in certain cases. Number 1, where the sum credited or paid is not more than rupees 30,000. But TDS is deductible where the aggregate of such sums credited or paid during the financial year is more than rupees 1 lakh. What is the effect of this? TDS is not applicable if the sum is not more than 30,000 in a single payment and not more than 1 lakh in the aggregate during the financial year. This is the effect. Number 2, where the payer is the individual or HUF, TDS is not deductible where the sum is credited or paid exclusively for personal purposes of such individual or any member of the HUF. For example, catering contract given for the marriage function. Number 3, where the sum is credited or paid to the payee who is engaged in a goods carriage business. That means during the course of business of plying, hiring or leasing goods carriages. If two conditions are satisfied. 1, the payee owns not more than 10 goods carriages when at any time during the previous year. And second condition, the payee furnishes a declaration to that effect with his PAN to whom? To the payer. In that case also TDS is not required to be deducted. Now in the case of work referred in number 5, manufacturing or supplying a product as per requirement or specification of the customer using material supplied by such customer or his associate. If the value of the material is mentioned separately in the invoice, then TDS is to be deducted on the value excluding the value of material. If that is not the case, then TDS is to be deducted on the whole of the invoice value. As we noted above, where the material is sourced even from the associate of the customer, it is treated as a work. So what is the scope of the term associate? It means a related party as referred under section 40A2, which we have already discussed while covering the topic on PGVP. In the case of gas transportation, where the owner or seller of gas sells as well as transports the gas to the purchaser end user till the point of delivery. Say G sells as well as transports the gas to P till the point of delivery, where the ownership of gas passes from G to P, right? In such case, the question is whether TDS is supposed to be deducted on the transportation charges, because transportation is covered as work, okay? But this is contract for sale, and therefore TDS is not applicable on gas transportation charges. But there may be a situation where G hands over the gas to a transporter, who then transports the gas to P, and P pays transportation charges to T. In such case, transportation charges paid to a third party will be liable to TDS under section 194C, because that will be treated not as a contract of sale but as a contract of work. What about content production by a production house? So content or a program is produced by production house as per the specifications provided by the broadcaster or telecaster, say BT. So PH is producing the content or program as per specifications provided by BT. And as we noted above, broadcasting and telecasting, see serial number 2, broadcasting and telecasting including production of program for such purpose is included within the definition of work. Okay. So in such case, where the copyright is also transferred to the broadcaster or telecaster, then that is a contract for work which is liable to TDS under 194C. So PH is producing content or program as per specifications of BT, and the copyright is also transferred to BT, that is a contract of work. But if the content has already been produced by PH and the broadcaster or the telecaster, the BT, acquires only the telecasting or broadcasting rights, in that case it will not be a contract of work and 194C will not apply, but other TDS provisions may be explored. So it will not be a contract of work. Advertising agency. So as we noted above, advertising is also included serial number 1 in the definition of work. What about payments made by the client to an advertising agency? So that is work liable to TDS under 194C. What about a cold storage, where the cooling charges are paid by customers of cold storage? That is a contract of work and that is liable to TDS under 194C. 194I, which covers rent, is not applicable because what the customers are paying is not rent, they are cooling charges. What about out-of-pocket expenses? When the payee issues the bill will also include the amount of actual expenses. The bill will include reimbursement for actual expenses. So TDS should be deducted on what amount? TDS should be deducted not on the net amount but on the gross amount including such reimbursements for actual expenses. Why? Because TDS under 194C is to be deducted on the sum paid, and therefore the gross amount of the bill is liable for TDS. So as we noted some time back that TDS under 194C applies to works contract or label contract. It does not apply to a contract of sale. What about payment for professional services in case of a specified profession under section 44AA? We need to note that that is covered under section 194J. But payment for other service contracts can fall under 194C. The next provision is section 194J. It covers FPS, FTS, royalty, etc. Who should be the payer? Payer should be any person if not an individual or HUF. As far as individual or HUF payer is concerned, the individual or HUF needs to be a specified individual or HUF. Payee should be a resident. What is the sum which is covered under 194J? 5 items. Any sum by way of fees for professional services or FPS, fees for technical services or FTS, remuneration or fees or commission to a director of a company, royalty, non-compete fee referred under section 28VA. 28VA, recollect our coverage on the topic on PGBP. This is taxable as PGBP, non-compete fees. TDS is deductible at the time of earlier of credit or payment. There is a higher rate for without PAN or ROI non-filer cases. TDS is to be deducted at the rate specified below where the sums credited or paid during the financial year does not exceed the threshold. For FPS, rate is 10%, threshold is 30,000. For FTS, not being professional services, rate is 2%. Being professional services, rate is 10%. The combined threshold for both these cases of FTS is 30,000. Director's remuneration or fees or commission, rate is 10%, there is no threshold. Royalty, if it is in the nature of consideration for sale, distribution or exhibition of cinematographic films, rate is 2%. In other cases, rate is 10%. The combined threshold for both the cases of royalty is 30,000. Non-compete fees, rate is 10% and the threshold is 30,000. Where the payee is engaged only in the business of operation of call center, then the rate of TDS is a special rate of 2%. TDS is not deductible in the following cases. 1. Where the sum does not exceed the threshold specified above. 2. Where the payer is an individual or HUF, that means the specified individual or HUF. Where the sum is other than by way of FPS or FTS. What this means is that an individual or HUF is liable to deduct TDS under 194J only in case of FPS or FTS. 3. Where the payer is individual or HUF, where the sum by way of FPS is credited or paid exclusively for personal purposes of such individual or any member of the HUF. This exemption is only for FPS, it is not for FTS. It is only for FPS. 4th, in case of director's remuneration, fees, commission on which TDS is deductible under section 192. So where the director is an employee and the remuneration, fees, commission is in the nature of salary, TDS will be deducted under section 192, not under 194J. 5th, where payment is by a person, transferee, for what? Acquisition of software from a resident, which is the transferor. So for example, B is the transferor of software, who is the resident, and C is the transferee. And C is acquiring a software from B. So C is supposed to make payment to B. And the question is whether TDS will be deductible under 194J. TDS will not be deducted if certain conditions are satisfied. First, if software is acquired in a subsequent transfer, that means before B transferred the software to C, B had acquired it from A. So transfer from B to C is a subsequent transfer, right? And the transferor has transferred the software, subsequent transfer, and the transferor, that is B, has transferred the software without any modifications. So B acquired the software from A and without modification transferred it to C without any further modification. TDS was deducted under section 194J or 195 as the case may be for any previous transfer of such software. That means when B made payment to A, B deducted the amount of TDS. And finally, the transferee that is C, obtains a declaration from whom? The transferor, that is B, that TDS has been so deducted along with the PAN of the transferor, that is B. In such case, C will not need to deduct TDS under section 194J. Professional services. Now, fees for professional services is covered under 194J. So, what is professional services? It is services in the course of carrying on profession referred under 44AA. Recollect our discussion under 44AA in the topic on PGBP. Plus advertising, plus services rendered by notified persons in relation to sports activities. Who are these notified persons? Sports persons, umpires and referees, coaches and trainers, team physicians and physiotherapists, event managers, commentators, anchors and sports columnists. What about payments made by TPAs to the hospitals? By TPAs to the hospitals on behalf of insurance companies for settlement of claims under various schemes, including cashless schemes, right? So, patient comes to the hospital is H, patient is P, for example. So, hospital renders services to the patient P, and P is now supposed to make payment to H, but P has an insurance policy within, say, I. Okay. Now, I has appointed TPA, which is T. So, P approaches T, T processes the claim, and on behalf of insurance company, T makes the payment to hospital. So, the patient doesn't make any payment, rather T makes the payment on behalf of insurance company to the hospital. In such case, TPA will be liable to deduct TDS under section 194J. What about payments which are made by advertising agency to their models, artists, photographers, etc.? That will be covered under 194J. What about out-of-pocket expenses? The bill will include reimbursements for actual expenses. In such case, the same consideration as we discussed for 194C. TDS is to be deducted on the gross amount of bill, including reimbursement for actual expenses. We now cover section 194M, which covers payment by individual or HUF not covered under 194C, 194H and 194J. So who should be the payer? Individual or HUF, but other than those required to deduct TDS under 194C, 194H or 194J. So what this means? Following individual or HUF is required to deduct TDS under 194M. Number 1, a non-specified individual or HUF. Why? Because a specified individual or HUF is required to deduct TDS under 194C, 194H or 194J. So a non-specified individual or HUF gets covered as a payer under 194M. Second, even though the individual or HUF is a specified individual or HUF, still he may not be required to deduct TDS under 194C or 194J if the sum is credited or paid exclusively for personal purposes of such individual or any member of the HUF. Recollect 194C or 194J. In that case also, such payer will come and fall within the purview of 194M. Okay, so in these two cases, the individual or HUF is required to deduct TDS under 194M. The payee should be a resident. What is the sum that is covered under 194M? 1. For carrying out any work, it includes supply of labor for carrying out any work in pursuance of a contract or subcontract. This corresponds to 194C. 2. By way of commission, not being insurance commission under 194D or brokerage. This corresponds to what? 194H. 3. By way of fees for professional services, FPS. This corresponds to what? 194J. Okay. Now note here that under 194J, individual is required to deduct TDS in respect of FPS as well as FTS. But 194M covers only FTS. So FTS is not covered under 194M. TDS is to be deducted at the time of earlier of credit or payment at the rate of 5%, and a higher rate applies in without PAN cases. TDS is not deductible in the following cases. 1. Where the sum credited or paid during the financial year is not more than 50 lakh. And 2. Where the individual or HUF payer is required to deduct TDS under 194C, 194H or 194J. The meaning of work is the same as that under 194C. Meaning of commission or brokerage is the same as that under section 194H. Meaning of professional services, FPS, it is the same as that in 194J. You should note that exemption from TDS in respect of sum credited or paid for personal purposes is not available under section 194M. So even in such case, TDS is liable to be deducted under 194M. We will now look at TDS in case of hire or transfer of property. Section 194I covers rent. The payer should be any person, not being an individual or HUF. If the person is an individual or HUF, that person should be a specified individual or HUF. The payee should be a resident. What is the specified payment that is covered? Rent. That is payment for the use of these 8 items: land, building, land appurtenant to a building, machinery, plant, equipment, furniture or fittings. TDS is to be deducted at the time of earlier of credit or payment at the rate of 2% in the case of machinery, plant or equipment. In other cases, the rate of TDS is 10%. There is a high rate applicable in without PAN or ROI non-filer cases. TDS is not deductible in the following cases. 1. Where the income which is credited or paid during the financial year is not more than 2.4 lakhs. This is the threshold. 2. On municipal taxes, ground rent, etc. borne by the tenant. 3. On refundable deposit made by tenant. Not non-refundable deposit, but refundable deposit. TDS is not supposed to be deducted. 4. On cooling charges paid by customers of cold storage. This is liable to TDS under 194C. We have discussed this. We have looked at this under section 194C. On payment of passenger service fees, PSF, by an airline to an airline operator. In these cases, TDS is not deductible under 194I. What about arrears of rent or advance rent or warehousing charges? TDS is deductible under 194I. What about the case of co-owners where they have definite and ascertainable share? In that case, we need to note that the threshold of 2.4 lakh applies separately to each co-owner. Section 194IB covers rent in case of individual or HUF not covered under section 194I. So who should be the payer? Individual or HUF. But other than those referred to under section 194I. Payee should be a resident. What is covered? Rent. That is payment for the use of any land or building. So rent for land or building only is covered. What is the time of TDS? It is the earlier of credit or payment of rent for the last month of previous year. Not for all the months, but for the last month of the previous year. Or the last month of tenancy. If it is a case of tenancy where the property is vacated during the year, then the time of TDS is the earlier of credit or payment of rent for the last month of tenancy. The rate of TDS is 5%, and in without PAN cases, a higher rate of TDS applies. So when the higher rate applies, the amount of TDS will be higher, and it may so be the case that the amount of TDS is more than the rent for the last month of the previous year or the last month of tenancy, which is the time when the TDS is to be deducted. So it is provided that the TDS in such case where the higher rate applies, it cannot exceed the rent payable for the last month of the previous year or the last month of the tenancy, as the case may be. When is TDS not deductible? Where the rent is not more than 50,000. For what period? For a month or even a part of a month during the previous year. Now 194IB applies only in the case of land or building. Therefore, it doesn't apply in the case of machinery, plant, equipment, furniture or fittings, which is covered under section 194I. That is not covered under 194IB. What we need to note is the payer is liable to deduct TDS under 194IB only once in a previous year. That means last month of the previous year or last month in case of the tenancy where the property is vacated during the previous year. But though the TDS is deductible only once in a previous year, it is to be deducted on the entire rent for the previous year, because that is the amount on which TDS is supposed to be deducted. Now we come to section 194IA, which covers transfer of immovable property. Payer can be any person, payee should be a resident. What is covered is the consideration for transfer of any immovable property, that means land or building. The time is earlier of credit or payment, and the rate of TDS is 1% of the higher of such sum, which is the consideration or stamp duty value of the property. So TDS is not on the consideration necessarily. If SDV is more than the consideration, then TDS is on the SDV, not on the consideration. Higher rate applies in without PAN cases. TDS is not deductible in the following three cases. 1. Where the consideration for the transfer of the property and the SDV are both less than 50 lakh. So for TDS not to apply, both the consideration and SDV should be less than 50 lakh. If say consideration is 45 lakh but the SDV is 50 lakh, this condition is not satisfied. So TDS will be at the rate of 1% of higher of 45 or 50 lakh. That means 1% of 50 lakh. 2. TDS is not deductible on transfer of rural agricultural land in India. We have noted in the chapter in the topic on capital gains that this is not a capital asset. So capital gains is not leviable, and that is the reason why TDS also doesn't apply. 3. On compulsory acquisition of the property, 194 IA does not apply. In such case, 194 LA applies, which we will look at in some time. Now, consideration will many a times include incidental charges like club membership fees, car parking fees, or electricity fees, or water facility fees, maintenance fees, advance fees, etc. All these incidental charges are included in the amount of consideration for the purpose of TDS. 194C applies in the case of a joint development agreement. Recollect the topic on capital gain where we discussed the provisions of section 45(5)(a). Okay, in the case of joint development agreement, TDS is applicable under 194 IC in such case. Payer can be any person, payee should be a resident, and TDS is on the consideration under the agreement referred to under section 45(5)(a). The time is earlier of credit or payment and the rate is 10%. A higher rate applies for without PAN or ROI non-filer cases. TDS is not deductible on consideration in kind. So a developer of real estate project is required to deduct TDS from payment made to an individual or HUF on account of transfer of land or building under a specified agreement. This is what we learned in section 45(5)(a). And the TDS in respect of this consideration is under section 194 IC. 194 LA deals with compulsory acquisition of land or building. Payer can be any person, payee should be a resident. What is covered is the compensation or consideration on account of compulsory acquisition under any law of what? Of land or building. TDS is to be deducted at the time of payment at the rate of 10%, and there is a higher rate for without PAN or ROI non-filer cases. TDS is not deductible in the following situations. Where payment during the financial year is not more than 2.5 lakh. This is the threshold. On compulsory acquisition of agricultural land in India, and this may be situated either in a rural area or an urban area, it doesn't matter so long as it is in agricultural land in India. TDS is not deductible under 194 LA on its compulsory acquisition. Where payment is in respect of award or agreement which is exempted from income tax under which act? There is a special act, Right to Fair Compensation and Transparency in Land Acquisition, Rehabilitation and Resettlement Act 2013. Now when we talk about compensation or consideration here, it includes enhanced compensation or enhanced consideration as well. There is one distinction which we need to note between 194 IA and 194 LA. So under 194 IA, only rural agricultural land in India was excluded there for purposes of TDS. But as far as 194 LA is concerned, both rural as well as urban agricultural land in India are excluded. Now when we talk about compulsory acquisition, recollect the topic on capital gain. So you need to keep in mind capital gain computation under section 45(5), which we referred on account of compulsory acquisition of a capital asset. We also saw there, as well as in the topic on IFOS, that interest on such compensation is taxable under the head IFOS in the previous year of receipt after giving 50% deduction. We now cover the theme of trade and commerce. Section 194O covers e-commerce. The payer should be an e-commerce operator or eco. Pay should be e-commerce participant or ECP who should be a resident in India. What is covered is the amount of sale and or services where the sale of goods or provision of services of ECP is facilitated by a ECO through its digital or electronic facility or platform. For example, a seller, that is ECP, is selling goods through an ECO who has a digital or electronic facility or platform, an e-commerce platform, right? For example, Amazon or Flipkart. The time of TDS is earlier of credit or payment, and the rate of TDS is 1% of gross amount of such sales and or services. A higher rate applies in case of without PAN or ROI non-filer cases. TDS is not deductible from sum credited or paid during the previous year to the account of ECP if three conditions are satisfied. 1. ECP should be an individual or HUF. B. Second, the gross amount of sale and or services referred above, that is sale of goods or provision of services which are facilitated by the ECO through its e-commerce platform, during the previous year should not be more than 5 lakh. And thirdly, the ECP should furnish his PAN or Aadhaar number to the ECO. In such case, TDS will not be deducted under section 194O by ECO. Now, when we talk about provision of services, it also includes fees for technical services and fees for professional services, as we noted under section 194J. There may be a situation where even though the sale or services by the ECP are facilitated by the ECO through its e-commerce platform, but the payment to the ECP is made directly by the customer. Ordinarily, the customer would pay the ECO and then the ECO will pay ECP. But sometimes the customer may make direct payment to the ECP. In that case, even such payment will be included in the gross amount, and therefore TDS will be deducted by the ECO on such gross amount, which will include such direct payment. No TDS elsewhere. The objective is to prevent double TDS on the same amount. So following transactions are not liable to TDS under any other provision. 1. Where TDS has been deducted by the ECO under section 194O, then TDS will not be deducted under any other provision of the Act. 2. Transaction which is not liable to TDS under 194O, and what is that? On account of rupees 5 lakh threshold exemption. Because if TDS is not supposed to be deducted under section 194O, it should not be indirectly deducted under any other provision as well. What about a case where payment gateway is involved? So, in most of the cases, the payment made by the customer is facilitated by a payment gateway. For example, in this case, here is the e-commerce participant who is selling goods or providing services through e-commerce operator, e-commerce platform, right? And there is a customer who purchases goods from the e-commerce platform, and the customer uses the payment gateway to make the payment to the e-commerce operator, and then the e-commerce operator makes payment to the e-commerce participant. Now, in this case, the payment is facilitated by the payment gateway. So both ECO and payment gateway may be liable to deduct TDS under 194O, because it can be said that the sale of services are being facilitated by both the e-commerce operator as well as the payment gateway. So both parties will be liable to deduct TDS under 194O on the same amount. To avoid difficulty and double deduction of TDS in such cases, the payment gateway will not be required to deduct TDS. Will not be required to deduct TDS if it has been deducted by the main ECO on that transaction. So if the ECO deducts the TDS, then the payment gateway will be exempted from deducting TDS. We need to note that sale or purchase of goods is also liable to TDS under section 194Q and TCS under section 206C1H. We will now look at the provisions of 194Q. Now we look at section 194Q, purchase of goods. Who should be the payer? Payer should be a buyer. The buyer who is purchasing the goods. But the condition is that the total sales, gross receipts or turnover from the business carried on by him should be more than 10 crore during which financial year? During the financial year immediately preceding the financial year in which purchase of goods is carried out. So the buyer is supposed to deduct TDS, but only that buyer whose total sales, gross receipts or turnover from business is greater than 10 crore in the immediately preceding financial year, which is preceding the year of purchase of goods. Who should be the payee? The seller, and the seller should be a resident. What is covered? Any sum for purchase of any goods of the value or aggregate of such value greater than 50 lakh in any previous year is covered. TDS is to be deducted at the earlier of credit or payment at the rate of 0.1% of such sum. Which sum? This sum. Exceeding 50 lakh. So TDS is not on the entire amount, but on the amount exceeding 50 lakh. A higher rate applies for without PAN or ROI non-filer cases. Turnover or receipts from non-business activity is not counted for computing 10 crore threshold, because this 10 crore threshold is for the business which is carried on by the buyer. So turnover or receipts from the non-business activity is not counted. Only the business turnover or business receipts are to be considered. What about the year of incorporation? In that case, the 10 crore threshold in the preceding financial year would not be satisfied, because in the preceding financial year this amount would be 0. So 194Q will not apply to the buyer in the year of incorporation. Now 194Q applies in the case of goods. That means it doesn't apply to immovable property, because goods do not include immovable property, land and or building, as well as services. So 194Q doesn't apply to services also. TDS is not deductible in the following cases. 1. Where the value or aggregate of such value referred above is not more than 50 lakh. 2. In case of a transaction on which TDS is deductible under any provision of the Act. We saw 194O above. So if TDS is deductible under 194O, it will not be deductible under 194Q. 3. In case of a transaction on which TCS is collectible under section 206C, but other than a transaction to which 206C1H applies. Now we will see that purchase of goods is covered under section 194Q. Buyer is supposed to deduct TDS. Seller in such case needs to collect TCS under 206C1H. Right? So buyer is 194Q, seller is 206C1H. So if a transaction is covered under 194Q as well as 206C1H, TDS needs to be deducted under section 194Q. 206C1H will not apply. But in other cases, if tax is collectible under other provisions of 206C, then TDS under 194Q will not apply. This is the effect. 4. Where the seller is exempt as a person, where the seller, that is the payee, is exempt as a person. We are not talking about a source of income being exempt. The seller as a person is exempt from income tax. For example, a person which is exempt under section 10, or say under any other act like RBI Act, ADB Act, etc. 5th, where the seller, that is the payee, is the central or state government. 6. Where the buyer, that is the payer, is the department of government not carrying out any business or commercial activity, because then this condition of 10 crore business sales, gross receipts or turnover will not be met. 7. Where the buyer is a person notified by the government. What about GST? Is TDS to be deducted on the amount of GST as well? So there can be two situations. TDS can be deducted either at the time of the credit to the seller or payment to the seller. If TDS is deducted at the time of credit to the seller and the amount of GST is indicated separately, then TDS is not to be deducted on GST. It is to be deducted without including GST. But if TDS is deducted on payment basis, that means earlier to the credit, because payment is earlier than the credit, then TDS will be deductible on the whole amount without excluding GST. This is equally applicable to non-GST levies like VAT, sales tax, excise duty and CST. What about a case of purchase return? On purchase, TDS would be deducted under 194Q, and now there is a purchase return. So if the money is refunded by the seller, then TDS which had been deducted earlier under 194Q may be adjusted against the next purchase against the same seller, right? So this is how the adjustment can be made. But if the purchase return is replaced by goods, so there is a purchase return and the goods are replaced, so the replacement gets completed and therefore no adjustment is required. What about advance? TDS applies to advance payment as well because TDS is earlier of credit or payment. What we need to notice, as far as sale or purchase of goods is concerned, apart from 194Q, as we noted above, TDS applies under 194O as well and TCS under 206C1H as well. 194R covers benefit or perquisite with effect from 1st July 2022. The payer can be any person providing any benefit or perquisite, right? The payer, that is the provider, and the payee, that is the recipient, should be a resident. What is covered is provision to a resident, that means the payee or the recipient, of any benefit or perquisite. Whether convertible into money or not is not relevant. But benefit or perquisite should arise from business or the exercise of a profession by such resident, that means the payee. So the payee should be carrying on business or profession and the benefit or perquisite should arise from that business or profession and it should be provided by the payer. Then TDS needs to be deducted by the provider or the payer under section 194R before providing such benefit or perquisite at the rate of 10% of the value or aggregate thereof of such benefit or perquisite. A higher rate applies in without PAN or ROI non-filer cases. TDS is not deductible in the following cases. Number 1, where the value or aggregate of the value of benefit or perquisite provided or likely to be provided during the financial year is not more than 20,000. This is the threshold. Second, where the payer, that is the provider, is an individual or HUF who is not a specified individual or HUF. So only those individual or HUF providers are covered under 194R who are specified individual or HUF. Insufficient cash. Now the benefit of perquisite may be provided wholly in kind or partly in cash and partly in kind. And the part in cash may not be sufficient to meet the TDS liability. And TDS is to be deducted before providing such benefit or perquisite. In that case, the payer, that is the provider, should ensure before releasing the benefit or perquisite that tax required to be deducted has been paid. So there are three options basically. 1. The payee pays advance tax. Payee means the recipient. The payee pays advance tax and the payer then relies on a declaration along with a copy of advance tax payment challan. This ensures compliance with the provision. 2. The payer recovers the tax from the payee and pays it to the government as TDS. Or 3. The payee doesn't do anything but the payer pays tax from his own pocket. In that case, we need to note that the tax which the payer will pay will also in turn be a benefit or perquisite provided to the payee and therefore TDS will in turn need to be deducted on that amount as well. So the amount of benefit or perquisite will need to be grossed up. For example, if the value of benefit or perquisite provided is 900 and the payer is paying 10% TDS under 194R, then the TDS will not be 10% of 900, which is 90 rupees, because such tax will also be a benefit or perquisite on which TDS will need to be deducted under 194R. So this 900 will need to be grossed up into 100 divided by 90, that is 100 minus 10% rate, 90. So 1000. So 1000 will become the value on which TDS will need to be deducted at the rate of 10%, which is 100 rupees, and the result will be 900, which will be then the benefit or perquisite which can be then released by the payer after this 100 rupees has been paid as TDS to the government. Loan settlement. Now sometimes there are cases of one-time loan settlement with the borrowers, or there is a waiver of loan which has been granted on reaching settlement with the borrowers by specified entities, okay, for example banks, etc. So in such case, that is a benefit or perquisite provided, but As a matter of relief, it is provided that TDS is not liable to be deducted. In such cases, TDS is exempt, but the borrower should be the specified entities, and scheduled banks are also included in that list. How is benefit or perquisite valued for purpose of TDS? There are three situations. Where the provider has purchased benefit or perquisite and then he is providing it to the recipient. For example, mobile is given as a gift, so mobile is being purchased from somewhere else and then being provided to the recipient. In that case, the purchase price will be the value. But if, say, the provider is the mobile manufacturer, so he manufactures the mobile and then gives it as a benefit or perquisite. In that case, the value for TDS will be the price that it charges to customers for such items. In any other situation, the fair market value of benefit or perquisite will be the value for TDS. GST will not be included in the valuation. So TDS will not apply on the GST component. Social media influencers are there where the companies provide products like car, mobile, outfit, cosmetics, etc. to the social media influencers for various purposes. For example, for creating a YouTube video, right? Unboxing video. Now in that case where the product is used by the influencer and then returned, then there is no benefit or perquisite and there consequently no TDS. But if the product is retained by the influencer, then there is a benefit or perquisite which is then liable to TDS. What about depreciation? For example, there is a company A which gives a car to its dealer B. It is a benefit or perquisite. B uses the car in his business. Now company A would deduct TDS on gifting of the car under section 194R, and then dealer B will include this benefit as income in his return. In such case, the actual cost of the car will be what? Will be the amount of benefit which is included by dealer B as income in his return. Thereafter, dealer B can claim depreciation on the car. What about bonus shares or right shares issued by the company to its shareholders? That is also in the nature of benefit or perquisite. But no TDS needs to be deducted where the company is not a closely held company. That means it is a widely held company. And the bonus shares are issued to all the shareholders, or right shares are offered to all the shareholders. In that case, TDS need not be deducted. What about TDS during financial year 22-23? We need to note that 194R comes into effect from 1st of July 2022. So TDS is not supposed to be deducted before 1st of July 2022. But as far as the threshold of 20,000 is concerned, it is for the whole year. That means it is for the whole year, financial year 2022-23 as such. So TDS is to be deducted on benefit or perquisite provided when? Only on or after 1st of July 2022. But if the value of benefit or perquisite is greater than 20,000, this threshold needs to be met. For what period? For the whole financial year 22-23, including the period up to 30th June 2022 as well. Therefore, benefit or perquisite provided before 1st July is not liable to TDS for the financial year 2022-23. No TDS applies where the recipient does not carry on business or profession because the benefit or perquisite should arise on account of business or profession. Therefore, there is no TDS if the benefit or perquisite is received in personal capacity, not connected with the business or profession of the recipient. What about benefit or perquisite provided by the employer to the employee? In that case, that is liable for TDS under section 192, not under section 194R. We will now look at certain special cases. First is section 194E. The payer can be any person, but the payee should be A. Non-resident, not a resident, non-resident sportsman, and this includes an athlete, sportsman, or entertainer who is not a citizen of India. So the sportsman or entertainer should both be a non-resident as well as a foreign citizen. Or B, a non-resident sports association or institution. What is the specified payment? In case of a sportsman, income from participation in India in any game or sport. Second, income from advertisement. Third, income from contribution of articles relating to any game or sport in India in newspapers, magazines or journals. As far as entertainer is concerned, what is covered is income from his performance in India. What about non-resident sports association or institution? What is covered? Amount which is guaranteed to be paid or payable to such association or institution in relation to any game or sport played in India. Now, when we talk about a game, we need to note section 115 BB, under which winnings from games are taxable, and we noted that TDS is deductible in that case under section 194B. So in those cases 194E will not apply. The time of TDS is earlier of credit or payment, and the rate is 20% plus surcharge and HEC at 4%. A higher rate applies in without PAN or ROI non-filer cases. Now the incomes which are covered in 194E is basically taxable under section 115 BBA on gross basis. No deduction is allowed at a flat rate of 20%, and that's why TDS rate is also 20%. TDS is deductible under 194E and income is ultimately taxable under 115 BBA. We now come to section 194N that covers payment in cash. And this is the case where the payer is a bank or post office while the payee can be any person. So what is the payment that bank or post office is making? Cash payment. That is any sum in cash from one or more accounts maintained by the payee with the payer. So the payee has an account or accounts with the bank or the post office in respect of which the bank or the post office is making a cash payment. Then TDS applies under 194N at the time of such payment. And what is the rate? The general rate is 2%. 2% of such sum, where the sum or the aggregate of the sums paid during the previous year is greater than rupees 1 crore. In that case, TDS is 2% on the entire amount which is paid. Okay. But in case of a return of income defaulter, ROI defaulter, there is a lower threshold than rupees 1 crore. Where the sum or aggregate of sums paid during the previous year is more than rupees 20 lakh and up to rupees 1 crore, then TDS is at the rate of 2% of the sum paid, entire sum paid. But if such sum or the aggregate paid during the previous year becomes more than 1 crore, then the rate is 5% on the entire amount that is paid. So a higher rate applies and the lower threshold applies in case of a ROI defaulter as compared to general cases. There is a higher rate in case of without PAN cases as well. TDS is not deductible in the following cases: where the sum or aggregate of sums paid during the previous year does not exceed the limit which is given in the table above. TDS is not deductible on any payment made to the government or bank or a post office. 3. On any payment made to any business correspondent of a bank, or on any payment made to any white label ATM operator of a bank. The question is, who is the ROI defaulter? So ROI defaulter is a recipient or a payee who has not filed returns of income. For what period? For all of the 3 assessment years. Which assessment years? Relevant to the 3 previous years for which the time limit to file return under 139(1), which is what, either 31st of July or 31st of October or 30th of November, has expired immediately preceding the previous year in which the payment of the sum is made to him. Now, threshold of 20 lakh or 1 crore that we looked above is in respect of all the accounts maintained by the payee with the payer. So it is qua payer and the payee. It is not per payment or per account. Now, if the threshold exceeds, then TDS is deductible on the entire payment, not on the amount exceeding 20 lakh or 1 crore as the case may be. In the case of ROI defaulter, if the threshold of 1 crore exceeds, then the rate of 5% applies, and the rate of 5% applies to the entire payment. Okay, so it is not 2% for more than 20 lakh and up to 1 crore and 5% for more than 1 crore. Next is section 194P, which applies to a specified senior citizen. In that case, the payer is the specified bank and the payee is a specified senior citizen. What is a specified bank? A scheduled bank appointed as agents of Reserve Bank of India. Who is a specified senior citizen which is covered under 194P? An individual resident in India who satisfies three conditions. 1. He is of age of 75 years or more when at any time during the previous year. 2. He is having pension income and no other income, but there is an exception. That is, he can have interest from any account in the same specified bank in which he is receiving pension income. So the specified senior citizen should be having pension income, or he can also have interest income from the same bank, maybe from a different branch, but should be from the same bank in which he is receiving pension income. He should not have any other income. And third, he should furnish a declaration to the specified bank. In such case, the bank will compute the total income of the payee for the assessment year after allowing deductions from gross total income under chapter VIA as well as rebate under section 87A, and will compute the tax at slab rates, applicable surcharge and HEC at the rate of 4%. Okay, and then that will be the amount of TDS which the specified bank will deduct. A higher rate applies in without PAN or ROI non-filer cases, right? In such case, since the entire tax on the income of the specified senior citizen is deducted by way of TDS under 194P, then the relief is provided that such person is not required to furnish return for such assessment year under section 139. So as we noted in the provisions that we discussed above, a higher rate of TDS applies for without PAN or ROI non-filer cases. Section 206AA applies for without PAN cases, and section 206AB applies for ROI non-filer cases. We will first look at section 206AA. This applies to all the TDS provisions. It is applicable where the payee has not furnished his PAN to the payer, or he has furnished the PAN to the payer but that is invalid or does not belong to the payee. In such case, a higher rate of TDS applies under 206AA, which is higher of regular rate of TDS under the respective provision or 20%. In case of 194O e-commerce and 194Q purchase of goods, the rate of TDS is higher of regular rate of TDS or 5%. What about section 206AB? It applies to all TDS provisions except few sections, which is 192 salary, 192A EPF, 194B and BB, casual income, winnings, 194 IA, transfer of land and building, 194 IB, rent of land and building, 194 M, and 194 N, sums paid in cash, cash payment made by bank or post office. In these sections, 206AB is not applicable. For all other provisions, 206AB applies. 206AB applies where the payee satisfies the following conditions. Two conditions. 1. He has not furnished return of income for which year? For the assessment year relevant to the previous year immediately preceding the financial year in which TDS is required to be deducted. Okay, for which time limit for furnishing return of income under section 139(1) has expired. And the further condition is that the aggregate of what? TDS deducted and TCS collected. So TDS deducted plus TCS collected in his case is not less than 50,000 in the said previous year. If that be the case, then the rate of TDS will be the higher of twice the regular rate of TDS as per the respective provision or 5%. What if both sections 206AA and 206AB apply? In that case, the rate of TDS will be the higher of the rates under both the sections. So higher of 206AA rate and higher or 206AB rate will apply. We need to note that the rate of 206AA and 206AB needs to be applied as such. You should not add surcharge or HEC to this rate. Under the various TDS provisions that we have studied so far, we have noted the respective rates of TDS which have been specified in those provisions. So you need to apply that rate as such. You should not add surcharge or HEC to the rate of TDS as specified. But there are certain exceptions. What are those exceptions? 1. Under section 192 salary and 194P in the case of a specified senior citizen, the rate is the slab rate plus applicable surcharge, and then we need to add HEC at 4% as well. Second, In the case of a non-resident payee, the rate of TDS is supposed to be increased by surcharge at the specified rate plus 4% HEC. For example, in the case of 194E that we saw, non-resident sportsman or entertainer, that needs to be increased by surcharge and 4% HEC. What about GST? Is TDS leviable on the GST component as well? So we need to note that wherever GST on services, which is comprised in the amount payable to a resident, is indicated separately, then TDS is to be deducted on the amount without including such GST. That means excluding GST component. And this treatment applies to service tax as well. No TDS applies under section 196 where the sum is payable to certain entities. 1. The government. 2. The Reserve Bank of India. 3. A statutory corporation which is under any law exempt from income tax on its income. And 4th, a mutual fund. TDS is income of the payee and therefore it is supposed to be included in the income. It is income received by the payee. Hence, the income that is actually received after TDS is supposed to be grossed up, and the income gross of TDS is then included in the income of the payee. And the formula is income received multiplied by 100 divided by within brackets 100 minus rate of TDS. So if 7,000 rupees is received after 30% TDS under 194B on winning from lottery, then 7,000 into 100 divided by 70, 10,000 rupees will be the grossed up income, and this 10,000 will be included as income under the head income from other sources. Under section 199, there is a provision to allow the credit of TDS. Why? Because TDS is payment of tax on behalf of the payee and therefore credit is given to the payee in determining his tax liability. Finally, there is a beautiful table that I prepared providing a very compact and condensed summary of various TDS provisions that we have discussed so far. Since we have discussed all of these provisions already in summary fashion, then we are not going to discuss this table once again. You can look at this document and go through this table for super quick refresh and revision of all the TDS provisions. We will now look at procedure for TDS to the extent it is relevant for our exams. 3 basic steps are involved and which relate to the duty of the payer. First, payment of TDS. The payer should pay TDS deducted to the credit of the central government. 2. Certificate of TDS. The payer should furnish a certificate of TDS to the payee. Third, statement of TDS. The payer should furnish a statement of TDS to the prescribed income tax authority. Now we will look at the due date for payment of TDS. In case where TDS is deducted by a person other than the government, due date is prescribed for TDS under sections other than 194IA, 194IB and 194M, and separately in the case of 194IA, IB and M. What is the due date for payment of TDS to the credit of central government? In the case of 194IA, IB and IM, the due date is within 30 days from the end of the month in which TDS is deducted. What about all other sections? It depends on when is the income or the amount credited or paid. If the income or amount is credited or paid in the months of April to February, then the due date is 7 days from the end of the month in which the TDS was deducted. For March, the due date is 30th April. In certain special cases, the AO may permit quarterly payment of TDS deducted, but under only 4 sections: 192, 194A, 194D or 194H, as follows. For the quarter April to June, the due date is 7th of July. For July to September quarter, it is 7th of October. For October to December quarter, it is 7th of January. For January to March quarter, it is 30th of April. These are the due dates which you can note for payment of TDS to the credit of the government. We will now look at the consequences of default as regards TDS provisions are concerned. 1. SSE in default, section 2011. The payer is deemed to be an SSE in default when? In 2 cases. When the payer does not deduct TDS, or 2. after so deducting TDS, the payer fails to pay it to the credit of the central government, then in that case, the payer is deemed to be an assessee in default in respect of such tax. But there is an exception. If the payer has failed to deduct TDS, the payer will still not be deemed to be an assessee in default if the payee fulfills these three conditions. And you would recollect that we have already made note of these conditions, this provision, when discussing the provisions of section 40A IA in the topic on PGBP, the disallowance under 40A IA. So what are the conditions? 1. The payee has furnished his return of income under section 139. Second, the payee has taken into account such sum for computing income in such return of income. And 3. The payee has paid the tax due on the income declared by him in such return of income. Further, additional condition is that the payer has furnished a certificate to this effect from an accountant in the prescribed form. If these conditions are satisfied, then even if the payer has failed to deduct the TDS, the payer will not be deemed to be an assessee in default. So this is an exception to this provision that we discussed. Second implication, interest under section 2011A. Firstly, interest for not deducting the whole or any part of TDS, right? And then when the TDS has been deducted but there is delay in payment to the credit of the government, then interest will arise for failing to pay TDS after its deduction. So first, interest will arise for not deducting the whole or any part of TDS. And the interest will be levied from point A, which is date on which TDS was deductible, supposed to be deducted, to point B, that is the date on which the TDS is deducted. And the interest will be what? The interest will be simple interest at the rate of 1% for every month or part of a month. Now, where TDS has been deducted, then interest can be levied for failing to pay TDS after its deduction, delayed payment. And the interest will be from point B, which is date on which TDS is deducted, to point C, which is the date on which TDS is actually paid. And the rate will be a higher rate of 1.5% for every month or part of a month. Now we noted the exception above, where even if the payer has failed to deduct TDS, but he is not deemed to be an assessee in default if the payee fulfills certain conditions, right? In that case, how is interest charged? From point A to point B. From point A, which is the date on which TDS was deductible, but what is point B? Till the date of furnishing of return of income by the payee. And in that case, interest is at the rate of 1% for every month or part of a month. Now, while calculating interest, if there is a fraction of a month, it is taken as full month. What about the amount on which interest is to be calculated? It is rounded off to the nearest multiple of rupees 100, and for this purpose, any fraction of rupees 100 is supposed to be ignored. Disallowance under section 40A. Recollect section 40A IA that we covered in the topic on PGBP disallowance. So payment on which TDS is not deducted or paid is disallowed under section 40A in computing PGBP income. We also saw there that the disallowance made is reversed subsequently if conditions in exception that we noted above, that is where the payee satisfied certain conditions, the payee. In that case, disallowance is reversed if those conditions are fulfilled. Fourth implication, penalty in prosecution. They may also be initiated. Fifth is on account of fees under section 234E. And this is for what? For failure to deliver or cause to be delivered a statement of TDS. As we noted above, the payer is supposed to furnish a statement of TDS to the income tax authority. And what is the fee? It is the lower of rupees 200 for every day during which the failure continues, or the amount of TDS which is deductible, lower of A or B. Now we move to the topic on collection of tax at source or TCS. So we look at what is the section, who is the collector and the collectee. So collector is supposed to collect tax at source from the collectee, what is the specified transaction and the time and rate of TCS, and some of the other important points. Section 206C is the relevant section for TCS, and we will now look at the provisions one by one. Section 206C1 covers sale of specified goods. Who is the collector? Seller, and this includes a specified individual or HUF. So seller is supposed to collect TCS. Who is the seller? Seller means central government, state government, local authority or corporation or authority established by or under an act, a company, firm, cooperative society, and it includes a specified individual or HUF. Please note that specified individual or HUF has the same meaning as that we have been discussing in the context of various TTS provisions. So the seller is the collector. Who is the collectee? The buyer who obtains a specified goods in any sale. So this provision applies in the case of sale of specified goods, okay, by the seller to the buyer. And TCS is to be collected at the earlier of debit or receipt, and there is a higher rate for without PAN or ROI non-filer cases. Now we will look at the specified goods and the rate of TCS. In case of alcoholic liquor for human consumption, 1% rate. Tendu leaves, 5%. Timber obtained under a forest lease or by any other mode, 2.5%. Then any other forest produce but not being timber or tendu leaves, 2.5%. Scrap, 1%, and minerals being coal or lignite or iron ore, 1%. These are the specified rates of TDS. TCS is not collectible in the following cases. Number 1. In case of a buyer where the buyer is a resident in India and the buyer furnishes a declaration to the seller to the effect that the goods will be utilized for manufacturing, processing or producing articles or things or for purposes of generation of power, but not for trading. In that case, TCS will not be collected. Second, in case of a buyer in retail sale of such goods purchased by him for personal consumption. So for example, the buyer is purchasing alcoholic liquor for his personal consumption in retail sale, TCS will not be collected. Third, if the buyer is a public sector company, the central government or a state government. In these cases, TCS will not be collected. Section 2061C covers lease or license. TCS is to be collected by a licensor or lessor from the licensee or lessee but other than a public sector company. And TCS is to be collected in the case of grant of lease or license or contract for use of what? Parking lot or toll plaza or mine or quarry for purpose of business at the time of earlier or of debit or receipt at the rate of 2%, and a higher rate applies for without PAN or ROI non-filer cases. TCS is not collectible where the contract, license or the lease is for mining and quarrying of what? Of mineral oil, including petroleum and natural gas. Section 2061F covers motor vehicles. TCS is to be collected by a seller, and seller includes a specified individual or HUF. What is the meaning of seller? Central government, state government, local authority, corporation or authority established by or under an act, company, firm, cooperative society, and includes a specified individual or HUF. Seller is supposed to collect TCS from the buyer who obtains a motor vehicle in any sale by such seller. And what is covered? A specified transaction, receipt of any amount as consideration for sale of a motor vehicle of the value greater than 10 lakh. TCS is to be collected at the time of receipt of consideration at the rate of 1%, but a higher rate applies for without PAN or ROI non-filer cases. TCS is not collectible in the following cases. 1. Where the value referred above is not greater than rupees 10 lakh. That means value of the motor vehicle is not greater than rupees 10 lakh. 2. TCS is not collectible where the sale of motor vehicle is by manufacturer to the dealer or distributor. Why? Because 2061F is meant to cover transactions of retail sale. That means sale to the consumer. Third, if the buyer is central government, state government, local authority or public sector company engaged in business of carrying passengers. So in these cases, TCS is not collectible. What we need to note is TCS is applicable to each sale of motor vehicle, right? And therefore the threshold of 10 lakh is for each sale. It is not applied to the aggregate value of sales during the year. So the motor vehicle needs to be of the value more than rupees 10 lakh. Whether the motor vehicle is a luxury car or not, it doesn't matter. The conditions of 206C1F as we discussed above need to be satisfied. Now there may be a transaction of sale of motor vehicle which may not be covered under 206C1F. Why? Because either the value will not be more than 10 lakh of the motor vehicle, or the sale of motor vehicle could be by the manufacturer to the dealer or distributor. In such case, if 206C1F doesn't apply, then the case may fall under 206C1H, which we will look after some time. So you should keep in mind all the provisions. Section 206C1G basically covers two components. One is remittance out of India and the second is overseas tour program package or OTPP. First we look at TCS on remittance out of India. In such case, the authorized dealer is required to collect TCS from the buyer, who is the person remitting amount out of India. TCS is to be collected in respect of the receipt of the amount from the buyer for remittance out of India under what? Under the liberalized remittance scheme, that is LRS of the RBI. TCS is to be collected at the time of earlier of debit or receipt, and there is a threshold. Threshold is 7 lakh. So TCS is to be collected on the amount or the aggregate of amounts in excess of 7 lakh which is remitted by the buyer in a financial year. If this threshold is crossed, then TCS is to be collected, otherwise TCS is not to be collected. If this threshold is crossed, then the rate of TCS depends on the nature of amount remitted out of India. If it is loan from a bank or any other notified financial institution for pursuing education, then rate is 0.5%, otherwise rate is 5%. A higher rate applies for without PAN or ROI non-filer cases. TCS is not collectible in certain cases. 1. If the amount or aggregate of amounts remitted is less than 7 lakh in a financial year, which is the threshold that we looked at, and that is other than for purchase of OTPP. Why? Because even if the amount is not crossing the threshold of 7 lakh, even then if it is for purchase of OTPP, then this provision for TCS will apply that we will discuss. But if it is less than 7 lakh and it is not for purchase of OTPP, then TCS need not be collected. Second, on amount in respect of which TCS has been collected by the seller of OTPP, because in that case, once again, TCS should not be collected on account of remittance. Third, if the buyer is liable to deduct TDS under any other provision and has deducted such TDS, then TCS will not be collected. Fourth, if the buyer is the central government, state government or local authority, then TCS will not be collected. We need to note that TCS is on amount exceeding 7 lakh which is remitted by the buyer in a financial year. It is not on the whole of the remittance. So if the remittance is 8 lakh, TCS is on 1 lakh, not on 8 lakh. The second component of 206(1)G is overseas tour program package. Under this, the seller of OTPP is supposed to collect TCS from the buyer who purchases OTPP upon receipt of any amount from the buyer of an OTPP. TCS is to be collected at earlier of debit or receipt at the rate of 5%, and higher rate applies for without PAN or ROI non-filer cases. TCS is not collectible in the following cases. 1. Where the buyer is liable to deduct TDS under any other provision and has deducted such TDS. So both TDS and TCS will not apply on the same transaction. Second, if the buyer is central government, state government or local authority. Now the question is, what is OTPP, overseas tour program package? So it means a tour package. So therefore, sale of individual components like hotel or only travel or only sightseeing is not covered. It should be a package. So tour package which offers visit to a foreign country, that means a country or territory outside India. And this includes what? It includes expenses for travel or hotel stay or boarding or lodging or any other expenditure of similar nature or in relation thereto. Section 206(1)H covers sale of goods. Who is the collector? Seller, whose total sales, gross receipts or turnover from business is greater than 10 crore. When? During the financial year. Which financial year? Immediately preceding the financial year in which sale of goods is carried out. And TCS is to be collected from buyer who purchases any goods from such seller. TCS is in respect of receipt of any amount as consideration for sale of any goods of the value or aggregate of such value greater than 50 lakh in any previous year. TCS is at the time of receipt of such amount at the rate of 0.1% of sale consideration exceeding 50 lakh. Exceeding 50 lakh. And a higher rate is prescribed for without PAN or ROI non-filer cases. TCS is not applicable in the following cases. 1. Where the value referred above is not more than 50 lakh. In that case, TCS is not collectible. 2. Where goods are being exported out of India. Star means what? In such case, such goods are not considered in computing the threshold of 50 lakh. So, these goods are excluded. The value of these goods is excluded. Third, where goods are covered under 206C1, 1F or 1G. Okay, and also star, that means the value of such goods is not considered in computing 50 lakh threshold. What is 206C1? We saw above, sale of specified goods. 1F, sale of motor vehicle. 1G, sale of OTPP. So if TCS is collectible there, if goods are covered there, then TCS will not be collected here under 206C1H. Fourth, if the buyer is liable to deduct TDS under any other provision on goods purchased by him from the seller and has deducted TDS. Which section? Section 194Q. If the buyer has deducted the TDS under 194Q, TCS will not be collected under 206C1H. 5. If e-commerce operator has deducted TDS under 194O on sale of goods by seller to the buyer through e-commerce operator. So if 194O has been applied and TDS has been deducted, then TCS will not be collected under 206C1H. Sixth, if buyer is central government, state government or local authority. 7. If buyer is a person importing goods into India. 8. If seller is a notified person. And lastly, where buyer is exempt as a person, not in respect of just a source of income, but as a person from income tax. Say the person is exempt under section 10 or exempt under any other act like RBI Act, etc. Now you need to know 206C1F and 206C1H because a transaction may fall under both these sections. So what should we do in that case? 206C1F applies where? In the case of sale of motor vehicle of value greater than 10 lakh, and 206C1H applies where there is sale of any goods of value greater than 50 lakh. So a sale of motor vehicle can get covered under both these provisions. If the receipt of sale consideration is from a dealer, that means motor vehicle is sold by a manufacturer to the dealer, then 206C1F will not get covered because 206C1F gets covered in the transaction of retail sale, and consequently it will get covered under 206C1H if the conditions of 206C1H are satisfied. Okay. Second, may be a case where receipt of sale consideration for sale of motor vehicle to a consumer is of value not more than 10 lakh. So it is to a consumer, so 206C1F can apply, but since the value is not more than 10 lakh, then 206C1F will not apply, and therefore it can get covered under 206C1H. But for coverage under 206C1H, the receipt of sales consideration for such vehicles during the previous year should be greater than 50 lakh. Third situation could be where the receipt of sale consideration is for sale of motor vehicle to consumer of value greater than 10 lakh. That means 206C1F can apply, right? In that case, it will not be covered by 206C1H. What you need to further note is 206C1H covers sale of goods, and the corresponding a similar section for the TDS was 194Q, which covers purchase of goods of value greater than 50 lakh. So let's take a look at a quick comparison. 194Q and 206C1H. Who is the person responsible? 194Q, the buyer is required to deduct TDS. 206C1H, the seller is required to collect TCS. Total sales, gross receipts or turnover from business in the preceding financial year. 194Q should be greater than 10 crore for the buyer. 206C1H should be greater than 10 crore for the seller. Payment or receipt covered under the provision 194Q. Sum for purchase of goods of value or aggregate greater than 50 lakh in any previous year. 206C1H consideration for sale of goods of value or aggregate greater than 50 lakh in any previous year. What is the time? For 194Q, the TDS is earlier of credit or payment. 206C1H, TCS should be, the time is at the time of receipt of consideration. Rate 194Q, TDS at the rate of 0.1% of such sum exceeding 50 lakh. In without PAN cases, section 206AA, the rate is 5%. Okay. 206C1H, TCS at the rate of 0.1%, same rate of such consideration exceeding 50 lakh. Without PAN cases covered by section 206CC, which we will shortly look at, and the rate is 1%. Now, in addition to 206C1H and TDS under 194Q, also recollect that TDS can be liable under 194O as well if the sale is facilitated by an e-commerce operator. So now on the same transactions, three provisions can apply. If 194O and 194Q applies, then TDS will be under 194O. If 194O and 206C1H applies, then TDS will be under 194O. If 194Q and 206C1H applies, then TDS will be under 194Q. If all the three provisions apply, then TDS will be under 194O. And if only one of these provisions apply, then TDS or TCS will be under the respective provisions. So in nutshell, what you will note is the first priority is given to 194O, second priority is given to 194Q, and third priority is given to 206C1H. This is the position in case of conflict between multiple provisions. Certain points that we will now note in respect of TCS. Just like TDS, there are provisions in TCS also for a higher rate for without PAN case under section 206CC and ROI non-filer case under 206CCA. First we look at 206CC. When is this applicable? Where the collectee, that means from whom the person needs to collect TCS, is the collectee. So the collector needs to collect TCS from the collectee. So where the collectee has not furnished his PAN to the collector or has furnished PAN to the collector but the PAN is invalid or does not belong to the collectee. In that case, the rate of TCS is higher of twice the regular rate as per the respective provision or 5%. In the case of 206C1H, it is higher of twice the regular rate or 1%. Now in case of 206C1H, even if the PAN has not been furnished, but if the collectee has furnished his Aadhaar number, then 206CC will not apply. Now we come to 206CCA, and this applies, and note that this is similar to 206AB in the context of TDS, ROI non-filer case. So the conditions are similar. The first condition, where collectee satisfies the following condition. The first condition, he has not furnished return of income for assessment year relevant to the previous year. Which one? Immediately preceding what? The financial year in which TDS is required to be collected. But that immediately preceding financial year for which the time limit for furnishing return of income under 139(1) has expired. And the second condition is that the aggregate of TDS deducted and TCS collected in his case is not less than rupees 50,000 in the said previous year. If both these conditions are fulfilled, then the rate of TCS is higher of twice the regular rate or 5%. Now what if both 206CC and 206CCA are applicable? Then similar to TDS that we saw, rate of TCS in this case will be the higher of the rates under both sections. So higher of the rate under 206CC or 206CCA will apply. Now the TCS rate that is covered under 206CC and 206CCA is the rate that is referred here. So you should not add surcharge or HEC at the rate of 4% to this rate. Now as far as the rate of TCS is concerned under the various provisions that we have looked so far, the rates apply as they are mentioned in their respective provisions. So what this means is that you should not add surcharge or HEC to the rate of TCS. However, in the case of a non-resident collectee, the rate of TCS is to be increased by a surcharge at the specified rate and at 4% HEC. Key differences between TDS and TCS that we will now finally note. What is the concept? In case of TDS, tax is deducted at source. For example, If 100 rupees are to be paid and 5% is the rate of TDS, then 95% will be paid after deducting TDS of rupees 5. For TCS, it is tax collected at source. For example, if the amount is 100 rupees and 5% is the TCS rate, then 5 rupees will be collected and consequently a total of 105 rupees will be received after collecting TCS. Who are the parties? The payer deducts TDS from the sum paid to the payee. For TCS, the collector collects TCS from sum received from the collectee. What is the time? For TDS, generally it is earlier of credit or payment. For TCS, it is generally earlier of debit or receipt. In case of no PAN, for TDS, generally the rate is higher of regular rate or 20%. For TCS, generally it is the higher of twice the regular rate or 5%. In ROI non-filer cases, for TDS, the rate is higher of twice the regular rate or 5%. For TCS, it is higher of twice the regular rate or 5%. So that is the same. We will now look at the provisions of advance tax. Liability to pay advance tax. Who is liable to pay advance tax? If the assessee is a senior citizen who does not have income chargeable under the head PGBP, then advance tax is not payable by such assessee. In case of any other assessee, there is a threshold of rupees 10,000. So where the amount of advance tax payable by the assessee during the year is less than rupees 10,000, then advance tax is not payable. Else advance tax is payable. So where the amount of advance tax payable during the year is not less than 10,000, that means 10,000 or more, then advance tax becomes payable. What is the meaning of senior citizen? He should be an individual resident in India of age 60 years or more when at any time during the previous year. Since advance tax is the tax paid by the assessee in advance, therefore credit is given to the assessee at the time of his regular assessment. What are the installments and due dates for advance tax? Two categories. The first category is for assessee who declares profits and gains under section 44AD or 44ADA. Recollect our discussion in the topic on PGBP. These are presumptive income provisions. 44AD in case of business, 44ADA in case of a profession. There is only one due date and 100% of the advance tax, entire advance tax can be paid on or before 15th March. But for any other assessee, there are 4 installments for paying advance tax during the course of the year. 15 June. On or before 15 June, amount payable is not less than 15% of advance tax. On or before 15 September, amount payable is not less than 45% of advance tax minus the amount, if any, paid in the earlier installment. On or before 15 December, not less than 75% of advance tax minus amount, if any, paid in the earlier installments. And lastly, on or before 15th March, 100% of advance tax minus amounts, if any, paid in the earlier installments. So this is how advance tax needs to be paid. What about after 15th March till 31st March? In that case also, if advance tax is paid, it is treated as advance tax paid during that financial year. So advance tax can be paid even after 15th March in that year, and that is treated as advance tax paid during that financial year. That means that credit is then given to the assessee in that respect. Interest under section 234B, which is for what? For default in payment of advance tax, is not levied because there is no default. Advance tax has been paid within the year. But interest under 234C is levied. Why? Because it is for deferment of advance tax. So advance tax is paid after 15th of March, so there is deferment, so interest under 234C is levied. Now, advance tax is computed on the current income, which is an estimate. An estimate can change. So assessee can increase or reduce the amount of advance tax in the remaining installments to align with the changes in his estimate of current income. How to compute advance tax? These are the steps. First, we calculate tax on the current income at the rates in force in the financial year. We reduce the rebate under 87A if available and add surcharge if applicable, adjusted for marginal relief if any, and add HEC at the rate of 4%. From the balance, we reduced TDS or TCS which has been deducted or collected during the financial year. from the income which has been taken into account in computing current income, right? If TDS has not been deducted, if TCS has not been collected, then it is not deducted. TDS deducted or TCS collected is deducted, and the balance is the advance tax payable, which is then payable as per the installments and due dates which we have discussed above. Now, interest is payable under sections 234B and 234C. 234B, interest is payable when there is default in payment of advance tax. So the assessee is liable to pay advance tax in a financial year, but he has failed to pay such tax. So there is a default, or advance tax paid is less than 90% of assessed tax. Then there is a default. So interest is payable on what? On the shortfall. Shortfall is what? The assessed tax. Assessed tax basically indicates the total tax which is actually payable by the assessee. So shortfall is what? Assessed tax less advance tax paid, if any. So the question is, what is the meaning of assessed tax? So it is the tax on total income, which is determined when? Upon processing of return under 143(1). So when the return is furnished, the first step is that the return is processed under section 143(1). Okay, so tax on total income, which is determined upon processing of return, or in case a regular assessment is made, then the tax on total income, which is determined under that regular assessment. So that becomes the tax. That becomes the tax on total income. Less we reduce from that what? One, TDS deducted or TCS which is collected on the income which is taken into account in computing such total income. So we deduct TDS and TCS which is deducted or collected. The relief under section 89 and AMT credit under section 115 JD. This is what is reduced, and what is the balance is assessed tax, which actually means the tax payable by the assessee. And if advance tax falls short of that, then interest is payable on that. So how do we compute interest under 234B? So this is the financial year in which advance tax is payable, the relevant financial year. So from 1st April following that financial year, that is point A, and from point A, interest starts becoming payable under 234B. And interest is simple interest at the rate of 1% per month or part of a month on what? On the amount of shortfall, which is what? As we noted above, assessed tax minus advance tax paid. And this is for what duration? It starts from point A, which is 1st April following the relevant financial year, and goes on till point C, which is the date of determination of total income either on processing of return or the date of regular assessment where the regular assessment has been made. But before this, self-assessment tax is payable. What is that? When the assessee furnishes return of income, the assessee is supposed to pay tax along with interest, fees, etc. at the time of or before furnishing such return. That is on self-assessment basis. So it is called self-assessment tax. Now when the self-assessment tax is paid, interest will also need to be computed and paid under 234B. So in that case, interest becomes applicable from point A to point B, which is the date of payment of tax under 140A, which is self-assessment tax. In that case, on what amount is interest computed? Interest is computed basis the tax on total income as declared in the return. That becomes the assessed tax for purpose of 234B. And then interest is computed from point A to point B. Fraction of a month is taken as full month, and amount on which interest is calculated is rounded off to the nearest multiple of rupees 100, and for this purpose any fraction of rupees 100 is ignored. The second interest which is leviable in respect of advance tax is under 234C, and it is for deferment of advance tax, meaning postponement of payment of advance tax. So as we noted above, there are 4 due dates in respect of installments of advance tax, and accordingly there is an expectation that you should pay advance tax fully as required, and if there is a shortfall, interest will be levied. So interest is levied on shortfall in the payment of advance tax. Simple interest is payable under 234C. Right? So for example, the first installment is, as we noted above, 15th of June. And as we noted above, the installments 15%, 45%, 75%, 100% needs to be paid on or before these installments. So for first installment, 15% of advance tax needs to be paid. But for checking the benchmark in terms of how much should you pay for levy of interest, what we will check? We will check tax due on returned income. Tax due on returned income. Now it is not the current income, which is the estimate, but it is the tax due on returned income. And that is what? It is the tax chargeable on total income which you now declare in the return. Okay. So for levy of interest, we will check what you declared in the return, because the expectation is that you should have correctly estimated that for payment of advance tax and accordingly paid it. So we will benchmark the amount with reference to the total income declared in the return. Of course, we will reduce it by TDS deductible or TCS collectible. Relief allowed under 89 and AMT credit allowed under 115 JD. So that becomes the tax due on returned income. So on or before 15 June first installment, you should have paid 15% of the tax due on returned income as advance tax. And whatever you paid, we subtract that. That becomes the shortfall on which interest is leviable at 1% per month into 3 months, right, into amount of shortfall. But there is a margin which is allowed. So 15% needs to be paid, right? But where advance tax paid up to 15 June is not less than 12%. That means it is 12% or more, right? So even if it is not 15%, even then interest is not levied. So this is the leeway which is given. Second installment, 15 September. 45% of tax due on returned income needs to be paid. And then we arrive at the amount of shortfall, and the interest is 1% per month into 3 months into shortfall. And there is a margin. So even if 45% is not paid, if what is paid is not less than 36%, even then interest is not levied. Otherwise, interest will be levied. Third installment is 15th of December, 75% should have been paid. We compute shortfall and interest becomes 1% per month into 3 months into shortfall. And the last installment is 15th March, 100% should be paid. And we compute the shortfall and the interest is 1%. We don't multiply it by 3 months, it's 1% into amount of shortfall. Now in a case where the SSE has failed to pay advance tax, that means no advance tax has been paid whatsoever, then the advance tax paid is taken to be 0 in the above cases. That means this is 0, this is 0, this is 0, and this is taken as 0, and accordingly interest is computed. Now there is a relief, because in certain cases it becomes very difficult to estimate certain incomes, and therefore there is a problem in payment of advance tax. So interest under 234C is not chargeable where the shortfall is on account of underestimate or failure to estimate certain categories of incomes. And what are these? 4 types. 1. Amount of capital gains. 2. Winnings from lotteries, crossword puzzles, etc. 3. Business income, income under the head PGBP, but where the income under this head is arising for the first time. That means it is the first year for such business income. 4th, amount of dividend income not being under 222E. 222E is what? Deemed dividend income on account of loan or advance. In these 4 cases, the interest is not chargeable if there is shortfall on account of underestimate or failure to estimate these, provided there is a condition. The SSE should pay whole of tax payable in respect of such income as part of remaining installments of advance tax, or by 31st March of the financial year where no such installments are due. That means after 15th March. Now amount on which interest is to be calculated is rounded off to the nearest multiple of rupees 100, and for this any fraction of rupees 100 is ignored. Now finally what we need to note is what is the income that we need to refer for various purposes. So when we are talking about payment of advance tax, computation of advance tax, then what is important is the current income. When we are talking about interest under 234B, it is with reference to tax on the assessed income. And when we are talking about interest under 234C, it is with reference to tax on returned income. This is the distinction which you may want to note. We now proceed to the topic on return of income. So there are various provisions relating to return of income, and these are contained in section 139. We first look at the regular return of income, section 139(1). Who is required to file return of income under 139(1)? There are 5 categories A, B, C, D, E. So a person falling under A or B or C or D or E is required to furnish a return of income. Category A company or a firm is required to furnish return of income under 139(1) in all cases. Category B, an individual HUF, AOP, BOI or artificial juridical person is required to furnish return of income if the total income for the previous year is more than the basic exemption limit. And total income for this purpose is without giving effect to the specified exemptions and deductions. What are the specified exemptions and deductions? 1. Capital gain exemption under section 54, 54B, 54D, 54EC, 54F, 54G, 54GA, 54GB. Right? 54G, 54GA and GB are not relevant for CA intermediate. We have discussed 54, 54B, D, EC and F in the topic on capital gains. Second, the deduction under chapter VIA from the gross total income. So total income will be arrived at after providing these capital gains exemptions if available and deductions under chapter VIA, right? In that case, we need to add them back. So that gives us the total income for figuring out whether return of income is required to be furnished or not. So if such total income which is adjusted on this count is more than the basic exemption limit, then return is required to be furnished. Category C, a person who is other than that referred in categories A and B is required to furnish return if the total income for the previous year is greater than basic exemption limit. Category D, a person who is not required to furnish a return under categories B and C is still required to furnish a return of income if he fulfills any of the following 7 criteria during the previous year. Criteria 1. He has deposited more than rupees 1 crore in current accounts with a bank or a cooperative bank during the previous year. Criteria 2. He has incurred expenditure of more than rupees 2 lakh on travel to a foreign country for himself or any other person. Criteria 3. He has incurred expenditure of more than rupees 1 lakh on consumption of electricity. Criteria 4. His total sales, turnover or gross receipts, as the case may be in the business, is more than rupees 60 lakh during the previous year. Criteria 5. His total gross receipts in profession is more than rupees 10 lakh during the previous year. Criteria 6. The aggregate of TDS deducted and TCS collected during the previous year in his case is not less than rupees 25,000. That is rupees 25,000 or more. This threshold is rupees 50,000 in case of a senior citizen. Criteria 7. The deposit in one or more savings bank account. That means he has deposited not less than rupees 50 lakh. That means rupees 50 lakh or more in his savings bank account during the previous year. If any of these 7 criteria are fulfilled, then the person is required to furnish return of income even if he is otherwise not required to furnish under categories B or C. In category A, of course, company or a firm is always required to furnish return of income. Who is a senior citizen? An individual resident in India who is of the age of 60 years or more when at any time during the relevant previous year. Now, if a person is not required to furnish a return of income under the categories that we have discussed so far, then he is still required to furnish a return if he is a resident but not a RNOR. That means he is a resident and ordinarily resident, ROR. Okay. If he at any time during the previous year fulfills any of the following criteria 1 or 2. Criteria 1. He holds asset located outside India, that is, he holds a foreign asset as a beneficial owner or otherwise, or he has a signing authority in any account located outside India. This is criteria 1. Criteria 2, he is a beneficiary of any foreign asset, that is, any asset located outside India. In that case, such person needs to furnish a return of income. Now in this category E, when we talk about asset located outside India, it includes any financial interest in any entity also. Recollect section 194P in the context of TDS, meant for specified senior citizen, in which case we looked that provisions of section 139 do not apply to such specified senior citizen, so such person is not required to furnish return of income. Now once a person is supposed to furnish a return of income, he should do that on or before the due date is specified under section 139(1). And there are three due dates which have been specified: 30th November, 31st October and 31st July of the assessment year. What is the due date? It depends on the category of SSE. And there are three categories, 1, 2 and 3. Category 1 covers an SSE who is required to furnish a transfer pricing report under section 92E. Section 92E is not relevant for CA intermediate syllabus, but due dates are relevant to note. So there are three kinds of persons who are covered in this category. Such SSE, that means who is required to furnish a TP report, or if such SSE is a firm, then the partners of the firm. And thirdly, the spouse of such partner of the firm who is supposed to furnish a TP report. The spouse of such partner is also covered if section 5A applies to such spouse. What is section 5A? It deals with the apportionment of income between spouses governed by Portuguese Civil Code. This is not a part of CA intermediate syllabus. Now in each of these cases covered in category 1, the due date is 30th of November of the assessment year. Category 2 refers to an SSE who is not covered under category 1. That means an SSE who is not required to furnish a TP report. And there are 4 cases here. Number 1, in the case of a company. Second, in the case of a person who is other than a company, that means a non-company, whose accounts are required to be audited under the Income Tax Act, like tax audit under section 44AB or under any other law. Third, a partner of a firm whose accounts are so required to be audited. Fourth, the spouse of a partner covered here, but if section 5A applies to such a spouse. Okay. In these 4 cases, the due date to furnish return of income under 139(1) is 31st October of the assessment year. And category 3 is the residual category, where the SSE is not covered under category 1 and category 2. In such case, the due date is 31st July of the assessment year. This is about return of income under section 139(1). Now we will look at certain other categories of return. Return of loss is covered by section 139(3). Recollect our discussion in the topic on set off and carry forward of losses, where we noted that certain losses cannot be carried forward unless they are determined in pursuance of a return of loss filed in accordance with section 139(3) within the time allowed under section 139(1). Okay, this is return of loss. And all provisions of the Act apply as if such return were a return under section 139(1). So a return of loss which is filed within the time allowed under 139(1) is treated as a return under section 139(1) for all provisions of the Act. Next is belated return. This is section 139(4). Any person who has not furnished a return within the time allowed under section 139(1), 31st July or 31st October or by 30th of November, can furnish a belated return at any time before the earlier of A, 3 months prior to the end of the relevant assessment year, which means 31st December, or completion of the assessment. Revised return is covered under section 139(5). This provides that if any person has furnished a regular return under 139(1) or a belated return under 139(4), and then such person discovers any omission or any wrong statement in such return, then he can furnish a revised return when at any time before the earlier of 1 or 2. 1, 3 months prior to the end of the relevant assessment year, that is 31st of December, or 2, completion of assessment. So the time limit to furnish belated as well as a revised return is the same. Practically, it is 31st of December of the assessment year because completion of the assessment almost in all cases takes place after this date. Now, certain types of return, whether they can be revised under 139.5. Regular return of income under 139.1 can be revised under 139.5. What about return of loss under 139.3? Yes, it can be revised if it was filed within the time allowed under section 139.1, since as we noted above, such return is treated as a return under section 139.1. What about belated return under 139.4? Yes, it can be revised. What about a defective return under 139.9? Yes, it can be revised if it is rectified within the time allowed under 139.9. Section 139.8a provides for furnishing of an updated return. Who can furnish an updated return? So any person can furnish an updated return of income for an assessment year. Whether or not the person has furnished a regular return under 139.1 or a belated return under 139.4 or a revised return under 139.5. So if a regular or belated or revised return has been furnished, the person can furnish an updated return of income. If no return has been furnished so far, then also the person can furnish an updated return, which will be the first return furnished by the person for that assessment year. What is the time limit? Updated return can be furnished at any time within 24 months from the end of the relevant assessment year. So if previous year is 2022-23, the assessment year will be 2023-24, and 2 years, that is 24 months from the end of the relevant assessment year, 31st March 2026. Till this date, updated return can be furnished in respect of assessment year 2023-24. Exclusions. Provisions of updated return do not apply in the following cases, so updated return cannot be furnished. 1. If updated return is a return of a loss for the relevant assessment year. So updated return cannot be a return of loss. See, the whole idea behind these exclusions is to ensure that the government doesn't lose out on its revenue on account of furnishing of updated return. Second, if updated return has the effect of decreasing the total tax liability determined on the basis of return furnished earlier, that is the regular return or belated return or revised return. So if the the updated return cannot decrease the tax liability compared to what has been declared earlier. Third, the updated return should not result in a refund, and it should not increase the refund due compared to what has been the position under the regular return or belated return or revised return for the relevant assessment year. Ineligibility. An updated return cannot be furnished in the following cases. 1. Where an updated return has already been furnished. This means that an updated return cannot again be updated. Second, where any proceeding for assessment or reassessment or recomputation or revision of income is either pending or has been completed for the relevant assessment year in this case. So if these proceedings have been initiated, then updated return cannot be furnished because finality needs to be achieved at some point of time and things cannot go on endlessly. Third, in case of notified persons. Persons have not been notified so far. What if the person had furnished a return of loss within the time allowed under section 139.1? Can updated return be furnished in such case? Yes, updated return can be furnished. The condition is that updated return should be a return of income. There can be a situation, say this is previous year 1 and this is previous year 2. There was an unabsorbed loss in previous year 1 which was then carried forward to previous year 2. Now say updated return is furnished for previous year 1, because of which the loss is reduced and consequently the loss which needs to be carried forward to year 2 is also reduced. Now since the updated return has been furnished in previous year 1 and the loss which has been carried forward to previous year 2 is also reduced, then consequently updated return will also need to be furnished for previous year 2 as well. So what do the provision says? If there is a loss or unabsorbed depreciation or AMT credit which is carried forward and that is to be reduced for any subsequent previous year, okay, as a result of what? furnishing of updated return of income for a previous year, then updated return is not only to be furnished for that previous year but also for each subsequent previous years. This is the effect. Now we come to the provisions of defective return, and this is provided by section 139.9. Now the return is regarded as defective unless all the specified conditions are fulfilled. There is a list of specified conditions, and if any of those conditions is not fulfilled, then the return is regarded as defective. In that case, the AO may intimate the defect to the SSE and give him an opportunity to rectify the defect within a time limit of 15 days, which can be extended in his discretion. If the SSE fails to rectify the defect within this time period, the return is treated as invalid and the provisions of Act apply as if the SSE had failed to furnish the return, as if the return was not furnished at all. The return needs to be verified in accordance with section 140. If return is not verified, it is invalid. Okay, that means it is taken as if the return was not furnished. So verification of return is very important. Who should verify the return? In the case of an individual, by default, the individual himself should verify the return. Where the individual is absent from India, the individual himself can verify, or an authorized person can verify who holds a valid power of attorney which should be attached to the return. Where the individual is mentally incapacitated from attending to his affairs, then the guardian should verify or any other person competent to act on his behalf. Where for any other reason it is not possible for the individual to verify, then an authorized person can verify who holds a valid power of attorney which should be attached to the return. In the case of HUF, by default, the Karta needs to verify. But where the Karta is absent from India, then any other adult member can verify, not a minor member. Where the Karta is mentally incapacitated, in that case also any other adult member can verify. In the case of a company, by default, the managing director should verify the return. But where for any unavoidable reason the managing director is not able to verify, then any director of the company or any person who is prescribed can verify. The person prescribed is basically the person appointed by the adjudicating authority for discharging the duties and functions of an interim resolution professional, a resolution professional or a liquidator under the Insolvency and Bankruptcy Code 2016. So in such case, such prescribed person can verify the return. Where there is no managing director, then any director or any person prescribed can verify. Now where the company is not resident in India, then a person who holds a valid power of attorney can verify the return and the power of attorney should be attached to the return. Where the company is being wound up or where any person has been appointed as the receiver, then the liquidator can verify. Where management has been taken over by the government, whether central or state government, then the principal officer can verify. Where the application for corporate insolvency resolution process has been admitted under the IBC, that is Insolvency and Bankruptcy Code, then the insolvency professional who is appointed by the adjudicating authority can verify the return of the company. In case of a firm, by default, the managing partner needs to verify. But if for any unavoidable reason the managing partner is not able to verify, then any partner not being a minor can verify. And where there is no managing partner as such, in that case also any partner not being a minor can verify. In case of LLP, by default it is the designated partner. But where for any unavoidable reason the designated partner is not able to verify, then any partner or any other prescribed person that we have noted some time back can verify. And the same position applies where there is no designated partner as such. What about a local authority? The principal officer is the person to verify the return by default. In the case of political party, the CEO of the political party, Chief Executive Officer. In the case of any other association, any member or principal officer. And in the case of any other person not covered above, that person himself or by some person who is competent to act on his behalf. So these are the persons who can verify the return under section 140. Now there is a scheme under which, and this is section 139B, this is a TRP scheme. There is a scheme under which an individual or HUF can furnish his return after getting it prepared through a TRP. So the return can be prepared by a TRP in the case of an individual or HUF, and this is at the option of such individual or HUF. This is optional. But there are two cases where the person cannot furnish the return through a TRP. Number one, a person carrying out business or profession during the relevant previous year whose accounts are required to be audited under 44AB or under any other law. So in tax audit cases, the return cannot be prepared by a TRP. Number two, if a person is not resident in India during the relevant previous year, then that person cannot get his return prepared by a TRP. Who is a TRP? TRP can be an individual, but there are four classes where the person or the individual cannot be a TRP. Number one, an officer of a bank. An officer of a bank with which the SSE maintains a current account or has other regular dealings. Number two, any legal practitioner. Number three, an accountant. And number four, an employee of the specified class of persons who has been authorized to act as a TRP under the scheme. What about a revised return? Can a revised return be furnished through a TRP? It cannot be furnished unless the original return was also furnished through a TRP. We will now cover the provisions for PAN and Aadhaar. Permanent account number of PAN. If the person falls in any of these five categories, then he needs to make an application for allotment of PAN if the PAN has not yet been allotted to such person. Number one, if the total income during any financial year exceeded the basic exemption limit, the time limit to apply is on or before 31st May of the assessment year. If the case is not covered here, that means if the total income did not exceed the basic exemption limit, but the person is carrying on a business or profession and the total sales turnover or gross receipts are or is likely to exceed rupees 5 lakh in any financial year, then PAN needs to be applied for before the end of that financial year. Third, in the case of a resident not being an individual, if a resident enters into a financial transaction of an amount of 2.5 lakh or more in a financial year, of an amount aggregating to 2.5 lakh in a financial year, then PAN needs to be applied for on or before 31st May following such financial year. PAN also needs to be applied for by the managing director, director, partner, trustee, author, founder, karta, CEO, principal officer or office bearer of such person, or any person competent to act on behalf of such person. Okay, PAN needs to be applied for by such person also, and the time limit is the same as for the resident who is entering into financial transaction of 2.5 lakh or more in the financial year. And finally, a person who intends to enter into the following transaction 1, 2 or 3. 1. Cash deposits aggregating to 20 lakh or more in one or more accounts with a bank or a post office. 2. Cash withdrawals aggregating to 20 lakh or more in one or more accounts with a bank or a post office. 3. Opening of a current account with a bank or a post office, or cash credit account with a bank or a post office. In these cases, 1 or 2 or 3, the person is supposed to apply for PAN at least 7 days before the date on which he intends to enter into such transaction. Now, PAN needs to be quoted by every person in the following. Number 1, in all his returns to the income tax authority or correspondence with the income tax authority or challans for payment of any sum under the act, or in all documents pertaining to the following transactions entered into by the person. So PAN needs to be quoted in all the related documents pertaining to the following transactions. What are these transactions? In the case of transactions number 1 to 4, PAN is supposed to be quoted in respect of all such transactions in the related documents. 1. Sale or purchase of motor vehicle or a vehicle which requires a registration under the Motor Vehicles Act, but other than two-wheelers. Second, opening of an account with a bank, but this does not include time deposit and a savings bank account. Third, where application is made for issue of credit card or debit card in the case of opening of demat account. In these transactions, PAN needs to be quoted in the related documents. In the transactions 5 and 6, PAN needs to be quoted if the payment in cash is of more than 50,000. Payment to a hotel or restaurant against a bill or bills at any one time. Payment in connection with travel to a foreign country, or payment for purchase of any foreign currency at any one time. So in these cases 5 and 6, PAN is supposed to be quoted in related documents if payment in cash is of more than 50,000. Transactions 7, 8 and 9. PAN is to be quoted where the amount is more than 50,000. Payment to a mutual fund for purchase of units. Payment for acquiring debentures or bonds issued by a company or institution. Payment to RBI for acquiring its bonds, RBI bonds. So amount should be more than 50,000. In case of deposit with a bank or post office, PAN is to be quoted if it is a case of cash deposits more than 50,000 during any one day. If the bank draft or pay order or banker's check is being purchased from a bank, then PAN is to be quoted if payment is in cash for more than 50,000 during any one day. If a time deposit is being made with a bank or a post office or a Nidhi or NBFC, in that case PAN is to be quoted if amount is either more than 50,000 or it aggregates to more than 5 lakh during a financial year. If the payment is to a bank or company or institution for what? For a prepaid payment instrument. For example, say a prepaid shopping card. Then PAN is to be quoted if payment is of more than 50,000 in a financial year. And the payment, what is included? It can be by cash or bank draft or pay order or banker's check. If life insurance premium is paid to an insurer, then PAN has to be quoted if amount aggregates to more than 50,000 in a financial year. What about sale or purchase of securities, not being shares, or sale of purchase of unlisted shares? If it is a case of shares, then it should be unlisted shares, or otherwise it should be sale or purchase of securities, okay, not being shares. Then in such case, in both these cases, PAN is to be quoted if the amount is more than 1 lakh per transaction. In case of sale of purchase of immovable property, that is land or building, PAN is to be quoted if either the amount is more than 10 lakh or the SDV is more than 10 lakh. And finally, in the case of sale of purchase of any goods or services of any nature, okay, which is other than what we have discussed in the table so far, then PAN is to be quoted if amount is more than 2 lakh per transaction. We now look at the provisions for quoting of Aadhaar number. Quoting Aadhaar is required, and this applies to a person who is eligible to obtain Aadhaar. Such person is required to quote Aadhaar number. In what? In the application form for allotment of PAN and in the return of income. There are provisions requiring Aadhaar PAN linking. This applies to a person who has been allotted PAN as on 1st July 2017 and who is eligible to obtain Aadhaar number. Such person is required to intimate his Aadhaar number to the tax authority on or before the date of 31st March 2022. In case of failure, following consequences arise. 1. The PAN becomes inoperative immediately after 31st March 2022. That means on and from 1st April 2022. For what purpose? For the purposes of furnishing, intimating or quoting of PAN. And where such person is then required to furnish, intimate or quote the PAN under the provisions of the Act, then it is deemed that he has not done so because the PAN has become inoperative and therefore he becomes liable for the consequences. Now when the person subsequently intimates his Aadhaar, that means after this date of 31st March 2022, then fee is payable under section 234H, which is rupees 500 if the intimation is made within 3 months from 31st March 2022. That means till 30th June 2022. After that, if intimation is made, then the fees is increased to rupees 1000. Now, when the Aadhaar is subsequently intimated, the PAN becomes operative from the date of such intimation. And then the restriction that we noted in serial number 2 above ceases from this date, from when the PAN becomes operative once again. Provisions above regarding quoting of Aadhaar and Aadhaar PAN linking do not apply. So there is an exemption to an individual who does not possess Aadhaar number, and such individual is residing in the states of Assam, Jammu and Kashmir and Meghalaya, a non-resident of the age of 80 years or more at any time during the previous year, not a citizen of India. In such case, exemption has been provided. Now we looked at implication number 2 above in the case of Aadhaar PAN linking, that PAN becomes inoperative and therefore the person, even if he is required to furnish, intimate or quote his PAN, it is treated as if he has not done so, and therefore consequences follow for such default. So a one-time window has been provided. 31st March 2022 is the last date for intimating, and then the implication starts to kick in from 1st April 2022. But as per this one-time window, the implication shall now come into effect from 1st April 2023. One more year has been granted. So that means that PAN will continue to be functional till 31st March 2023. But what about fees under section 234H? Payable at the time of intimating Aadhaar, it will continue to be payable. It will continue to be payable. That is rupees 500 up to 30th of June and rupees 1000 after that. Right? And PAN will also continue to be functional. But from 1st April 2023, PAN would become inoperative with all its consequences. Now, what are the consequences of late filing or not filing of return? 1. Interest is payable for default in furnishing return, section 234A. Fees is payable for default in furnishing return, section 234F. Certain losses cannot be carried forward unless return of loss is filed within the time allowed under section 139(1), section 80 and section 139(3). The deductions under certain sections cannot be claimed from the gross total income under chapter VIA. We have noted in the topic on chapter VIA the deductions from gross total income, section 80 JJAA, 80 QQB and 80 RRB. Higher rate of TDS and TCS applies for non-filers. We have noted section 206AB for TDS and 206CCA for TCS. And higher rate of TDS applies for ROI defaulter in the case of cash withdrawal. We have noted this in section 194N in the topic on TDS. Now we look at section 234A, which provides for interest for default in furnishing of return, where the return of income is furnished after the due date or is not furnished. In that case, simple interest is payable. And what is the rate? 1% per month or part of a month. Right? And interest is payable from what date? From point A. Point A is what? The date immediately following the due date of furnishing return under 139(1). Okay? So immediately after that, interest starts to be levied. And this runs till what point of time? There are two situations possible. Where the return is furnished, in that case it is point B, which is date of furnishing of the return. Okay, that is where the return is furnished after the due date, the interest is levied from point A to point B. But if say the return has not been furnished at all, where no return is furnished, then best judgment assessment can be made under section 144 by the assessing officer. In that case, interest runs from point A to point C, which is the date of completion of the best judgment assessment. Now, what is the amount on which interest is computed? It is the shortfall. And what is meant by shortfall? Tax on the total income. This total income determined upon processing of return or under a regular assessment. And we reduce 1, 2, 3, 4. 1. The advance tax paid. 2. The TDS deducted or TCS collected. 3. Relief under section 89. And 4. AMT credit under 115 JD. So this becomes the shortfall on which interest is computed. Now in the case of self-assessment, that is, the interest will be payable at the time of self-assessment before furnishing of return by the assessee, right? And where the interest is payable at the time of self-assessment, the shortfall will be computed on the basis of what? On the basis of tax on total income as declared in the return, less the following 1, 2, 3, 4. And accordingly, interest under section 234A will be paid at the time of self-assessment. Now for computing interest, fraction of a month is taken as full month. So it is rounded off. Amount on which interest is calculated is also rounded off to the nearest multiple of rupees 100, and for this purpose fraction of rupees 100 is ignored. Apart from interest under 234A, fees is payable for default in furnishing return under section 234F, where a person who is required to furnish return fails to do so within the time prescribed under 139(1). What is the amount of fees? It is 5,000 rupees. But if the total income is not more than rupees 5 lakh, it is not more than rupees 5 lakh, then the fees payable cannot exceed rupees 1,000. So it remains 1,000. If the total income is more than rupees 5 lakh, then the fees under 234F is rupees 5,000. Self-assessment is covered under section 140A, and we have been referring to this term in certain previous topics. So when the assessee furnishes return, before furnishing the return, the assessee is liable to pay tax due with interest as well as the fees. And this is called self-assessment tax because it is payable on self-assessment basis. How do we compute this? We figure out the tax payable on the basis of the return, and then we make certain deductions. Those are tax which has already been paid under any provision of the Act, like advance tax or otherwise, TDS, TCS which is deducted or collected, relief under 89 and AMT credit under 115 JD. And then we arrive at the amount of tax payable, to which we add interest under section 234A for default in furnishing return, 234B for default in payment of advance tax or deferment of payment of advance tax, section 234C. And we add fees under section 234F if any. And the total is the amount payable on self-assessment. Now there may be a case where the assessee does not pay the entire amount payable on self-assessment. So there is a short payment. In that case, how will the amount paid be adjusted? It will be adjusted in the following order. First, it will be adjusted against fees payable 234F, then against interest payable 234ABC, and then finally against tax payable. Finally, we look at section 140B, which provides for tax on updated return. So recollect our discussion on furnishing of updated return short time back under section 139(8)(a). Now where such updated return is furnished by the assessee, he should pay the following amounts before furnishing the updated return. And the updated return is regarded as defective. Recollect our discussion on defective return under 139(9). Updated return is regarded as defective if it is not accompanied by proof of such payment. Okay, so the following amounts need to be paid before furnishing of updated return, and there are three amounts. One, the tax which will become payable on the basis of updated return. Second, interest and fees will become payable on account of 234ABC, right? Interest under 234ABC and fees under 234F. And third, additional income tax also needs to be paid. Now, how to compute these amounts that are supposed to be paid before furnishing of updated return? Two situations can arise. Situation 1, where an earlier return, that means either a regular or belated return, has not been furnished. This means that updated return is the first return for the assessment year which the assessee is furnishing. In that case, we begin with the tax on total income declared in the updated return. And then we reduce the following amounts, which are in the nature of prepaid taxes and certain reliefs, right? What are these? Tax, if any, which is already paid as advance tax. So we reduce advance tax. We reduce TDS or TCS, which is deducted or collected. relief claimed under 89, and AMT credit allowed under 115 JD. And that gives us the tax payable on the basis of the updated return. To this, we add interest under sections 234A, 234B and 234C, and we add fees payable under 234F. We also add additional income tax. We will look at this in some time. And then what we get is the amount payable before furnishing the updated return. Situation 2 is a situation where an earlier return has been furnished. A regular, belated or revised return has been furnished, and now an updated return is being furnished. So we pick up the tax on total income declared in the updated return, and there are certain amounts that we now reduce. First is, so we would have, the SSE would have paid self-assessment tax at the time of furnishing the earlier return and would have taken the credit in terms of relief or tax under section 140A, that is self-assessment tax at that time, right? So as we noted, the provisions of self-assessment tax, the SSE would have taken the credit of all these amounts. The amount of relief or tax, which is referred to under section 140A, needs to be reduced, for which the credit has been taken in the earlier return. So we reduce that. We further reduce TDS deducted or TCS collected on the additional income which is now being declared in the updated return. That means on income which has not been included in the earlier return. Okay. We further reduce AMT credit, if any, under section 115 JD, which was not claimed in the earlier return. So basically these are the incremental amounts which now we reduce further from the tax on the total income declared in the updated return. Now if a refund has been issued in respect of the earlier return, we need to add it. And this gives us the amount of tax payable on the basis of updated return. To this amount, we add interest under sections 234B, 234C, which is for default or deferment in respect of advance tax. And we don't add the same interest again, which has been paid in the earlier return. So at the time of self-assessment. So we reduce this 234B, 234C by interest paid in the earlier return, and the balance is what we add here. Now note that we don't add interest under section 234A for default in furnishing of return, because the original return has already been furnished either as a regular, belated or revised return. So 234A would have been paid at that time. Similarly, 234F would also have been paid at that time because it is for default in furnishing return of income. So that's why we don't add 234A interest and 234F fees again here. So we only add interest under 234B and 234C. Finally, we add the amount of additional income tax, and that gives us the amount which is payable before furnishing the updated return. Now, in both the situations, you would have noted that towards the end, we add something called as the additional income tax. So how is this additional income tax computed? What is the timeline for furnishing of updated return? End of the assessment year, and updated return needs to be furnished within 24 months from the end of the assessment year. That means within 2 years after the end of the assessment year. So this is 12-month period and this is 12-month period, total of 24 months. Now, if the updated return is furnished before completion of 12 months from the end of the relevant assessment year, that means within this particular time, then what is the amount of additional income tax? We aggregate what? We aggregate the tax payable, which includes surcharge and cess, and interest payable. And then we compute 25% of that aggregate. So 25% of tax plus interest in both situations 1 and 2 above. So in situation 1, tax payable plus interest payable. Fees is not supposed to be included, please note. So tax plus interest. Similarly, in situation 2 also, tax payable on the basis of updated return, and then we add interest under 234B and C, so tax plus interest. So additional income tax is 25% of tax plus interest, where the updated return is furnished within the first 12 months from the end of the assessment year. But if updated return is furnished after 12 months but before 24 months, that means within this period, then the additional income tax percentage is increased from 25% to 50% of aggregate of tax and interest.